And I would say the third area is where, as you start moving from pilots to more scaled ROI projects in AI, customers are looking at how do you do this at scale. So looking at...
Is there a way to define AI revenue? I mean, this is what we earn because of AI projects.
See, we're not doing that for a reason, because AI is all pervasive. Sure. It's there in every service line. So it's hard to just call out a part of the revenue as a AI revenue.
Is it deflationary in terms of pricing?
No, I don't think so.
Okay. Because revenues, the top line it'll drive, but I mean, and we've discussed this in the past, that as we go forward, eventually customers are going to say, well, you're doing a lot more with a lot less, so well, give us the price advantage that you're seeing.
It won't be a deflationary in pricing like Aarti mentioned.
Okay.
But we believe that AI will enable you to do more than with less. Okay. But as I've been telling, eventually you'll be doing a lot more than what you're doing today. Because that will ensure that we have enough opportunity for what we have today and what we'll have tomorrow.
Aarti, you come in with a fresh perspective in that sense. For the last 2 years, the growth has struggled a bit, or it was propped up on account of BSNL. This is a tough year for the entire industry. Do you think, in a way, the company needs to look at the growth versus margin trade-off? I mean, what is your own opinion on this?
See, I think our philosophy or direction, as you may call it, has always been profitable growth.
Yeah.
Right. So I think if you look at all the new age offerings, I think there is enough demand, and especially when you look at AI or enterprise solutions, public cloud implementations, I think the demand is out there. So I think we just need to drive growth.
But you said it's profitable growth, but growth has been missing, right?
No, but we need to drive the growth.
Okay.
So I think while retaining margins, and that's what we intend to do.
So actually, we have always talked about, we believe good growth will actually give you more. Lack of growth probably puts a pressure on margin, but margin doesn't put a pressure on our growth.
Growth solves most problems, as they say. Kriti, just one thing, so actually just completing the BSNL point, there was expectation that as BSNL winds down, margins will improve. There will be a lift to margins. That's not happened. You've also won a new BSNL order, right?
New BSNL order has not kicked in.
It's not kicked in.
Not kicked in yet. We did have close to, I think, there was an improvement, a tailwind because of BSNL, but we also put more, we had more headcount this quarter. Okay, we be expecting more growth. We had actually added a lot of people in the beginning of the quarter. So that put additional expense towards manpower and compensation. So I think as we fine tune our overall manpower expense and other expenses in the next quarter, because this was a fairly turbulent quarter. We started off the quarter thinking that we need to be ready for all the demand.
Sure.
But when it doesn't happen, you already staffed up the people.
Sure.
But our hope is that in the next quarter...
The new TCS, BSNL order, will that add anything to... I mean, there are some expectations it should be 1% of revenue for the full year. Is that... It'll add 1% to the revenue growth this year?
It could be in the range.
What's the size of the...
if you have not published it, we are not going to tell you here now.
$350
From
million.
a size perspective, it's about 22,000 sites, I think. Okay. So 1/4 of the original order.
So since you called the times turbulent, last time you said that growth in FY26 should be better than FY25, at least for the international market.
Still, for the international market, okay,
despite a drop,
I'm still confident because we had a minus 0.5% here, but I think overall for the year we'll be able to do better than what we did in FY25 on the international markets. We're quite confident.
And overall, will there be growth in FY26 over 25?
Growth, yes. Growth better than FY25. We'll work towards it because we had about, I think, 4.2% growth in FY25. To reach that, that's looking like a tough number now. But definitely growth, definitely international growth to be better than FY25.
The other number is deal bookings, right? About $9.4 billion. It's lower as compared to what we saw. And that also does, should that raise doubts about revenue visibility going forward at all?
See, Prashant, we've always been saying our comfort range is between 7 to 9 billion. Okay, and last quarter was about 12 billion, and it was a fairly one of the best quarters we had, and TCV tends to be lumpy. I don't think it is like revenue, like because sometimes you win some huge deals, clients want to close towards the year end, they want to sign, order bookings tend to be more. This is nothing to kind of be concerned about. In fact, we are quite happy with the order bookings for this quarter.
Aarti, can you provide some color vertical-wise? I know the problem areas, we spoke about it last time, was auto, retail, etc. But since growth is much worse than what you had anticipated, which sectors face challenges, and going forward, which are likely to still remain under pressure?
I think our technology, software and solutions vertical has done well, as you would have seen in the numbers. I think manufacturing, it's hard to club it into one. I think the challenges are in the automotive sector, and which is a global phenomena if you look at it. But within life sciences, healthcare, if you see again, healthcare has grown this quarter, and if you look at BFS, right, there are certain segments within BFS which have grown. So it's sort of, some verticals have grown well, and others hopefully will be able to drive growth in the next quarter.
Kriti, you want to add to the problem pockets that you see going ahead?
See, like the slow, definitely, like we had Europe had probably Europe had a bigger negative growth. In fact, North America, as you saw, has a small moderate positive growth on a Q-on-Q basis. UK had again degrowth. In fact, interestingly, if you take BFSI North America, BFSI UK, both of them had a small growth. BFSI UK, Europe was a issue. So, and like she said, auto is an issue, but industrial did well, aerospace did well. And so there are in fact, our tech services, almost all sub-verticals of tech services did very well. So there are pockets of growth. There are some areas where we will recover.
And why is banking weak in Europe?
Banking is weak in Europe for, that we've been doing a large deal before, okay, and that's also coming to a close. So that's one of the reasons where we have extra pressure in Europe.
Kriti, just to sort of wrap it up, how would you describe as you go forward into Q2? It's Q1 has seen a sharp. Will we kind of, if this is more of a one-off, will we see a sharper recovery in that bounce as well in Q2?
I don't know whether Q2 will be a quick bounce back. I don't want to call it up because I've been beaten with what I said. In Q1 I was quite confident. Like Q2 I'm not sure, like we have to wait and watch. But I'm still confident about medium to long term. Like there is a lot of work to be done, and the order book is good, and our client conversations are good. So medium to long term, I'm still confident. And as I said, I'm still confident of having a better international growth in FY26 or 25.
Welcome back. 9 minutes to go for the pre-open session, and it's all about the big sort of corporate stories, right? TCS was one. The other big one is, of course, Glenmark. Let's actually get you the exclusive conversation that my colleague Ekta Batra had with the Glenmark management. I mean, for the uninitiated, if you're just sort of switching on television screens right now, or watching us now, Glenmark has signed a landmark licensing pact with a US-based pharmaceutical company to develop and sell a drug to treat a cancer, basically. The surprise element here is markets, and our colleague Nimesh had kind of sort of highlighted this in his D-Street Chatter segment. But the surprise is what markets were expecting was that the number would be, upfront payment would be around $200 million. Guess what? The upfront payment is about $700 million. So that is the big delta, the big surprise. Here's Glenn Saldana in conversation with Ekta. Ekta began by asking Glenn basically about the deal. I mean, what does Glenn make of it?
Clearly, this is a huge moment for us, right? I mean, we've been working on this for 25 years in the innovation space, and I think 2001 really is a world-class asset, right, which can be transformational for patients. From a partnering perspective, the way we've structured it is we've partnered with AbbVie for US, Canada, Europe, China, Japan, most of the developed markets, and Glenmark will commercialize this product eventually, right, in India and all emerging markets. So the two of us will make sure this asset is successful going forward. IGI clearly is a 100% subsidiary of Glenmark and has done a phenomenal job in developing this asset, getting the phase 1 data. As you know, we have phenomenal data in patients in the phase 1 trial, where the recent presentation we made at ASCO, we had almost 79% ORR and almost 30% of the patients had complete remission. And these are patients who've gone through all prior lines of therapy in multiple myeloma and then eventually come on to 2001 have shown this response. So very exciting times. We are super excited about partnering with AbbVie, great partner, huge global capabilities and huge resources to make 2001 successful and bring it to the market.
Okay. So explain the financials to us. $700 million is what you would get upfront, $1.2 billion in terms of milestones, and the remaining would be royalties.
That's correct. So we get a $700 million payment upfront, and as soon as we get regulatory approvals, that money will be received by us. The milestones, the $1.2+ billion of milestones, are spread into clinical development milestones. So as the molecule progresses to clinics, we keep getting milestones. Regulatory milestones, so as the molecule gets filed in various markets, we get approved, we get milestones. And then we get sales-linked milestones. So cumulatively, that number comes to $1.25 billion, for the asset. And then once it's commercial, we get royalties on sales, which, as you know, some of these innovative products, the life of the royalties is pretty long. So this could pretty much be an annuity if the molecule makes it to market.
Okay. So let's first understand where exactly this molecule stands. Phase 1B currently. Explain that to us. How nascent is this molecule at this point in time?
So ISB 2001 is still at a relatively early stage. The good news is we have patient data in about 40-50 patients. We have good clinical data that we presented at ASCO. So very good safety profile, good efficacy data. But it's still early stage, so it has to go through a significant amount of clinical development as we go forward.
Okay. So AbbVie is now going to take over the entire development of this molecule, we understand. When do you think that it will probably hit the market or show any kind of results?
So AbbVie takes over all clinical development from here on. In terms of time frame, I can't give you a specific time frame, but typically molecules, if you look at other assets, right, in the space, they typically take about 4 or 5 years at least to get to commercialization.
So say 2030 would be a good target to probably expect something tangible coming in from the molecule or hitting commercial sales if it is successful, that is.
So again, I can't specifically talk about ISB 2001, but typically it's about 4-5 years to commercialization.
Okay. Well, let's talk about how you're going to use the funds now. Let's start with $700 million, 6,000 crores of cash on books. It will be on Glenmark's books. Tell us how exactly is this $700 million going to be utilized?
So the way we're looking at it is IGI will continue development of various other assets that they have. They have a great multi-specific antibody platform technology, which they will continue to exploit. And, they will continue. So they spend about $70 million a year. So that spend will continue. Clearly, a big part of this upfront will be allocated to their spends. The balance, some of it will get dividend out to Glenmark, and the rest will sit as cash on the books.
Okay. Any plans of rewarding the shareholders of Glenmark who waited very patiently for a possible R&D deal?
We'll definitely consider, increasing the payouts to shareholders. I think we'll put it up to the board and get that approval.
All right, interesting conversation there, Ekta, with Mr. Saldana, the man of the moment itself. Well, let's get in our technical experts. Shrikant Chavan and Mitesh Thakkar join us on this Friday morning. Good morning, gentlemen. Hope you're feeling good. The markets, though, not too good, because we're going to be starting off with a cut of around 140, 150 points. Post yesterday's 120-point downtick. Mitesh, what's your gut? Go ahead and buy the Nifty, or you believe the Nifty wants to test lower levels?
Morning, Najib. So I think, I've maintained that we might try and test 25,200 odd levels, which is a key trend decider. And the way the GIFT Nifty is indicating, good chance that we might open around those levels. So yeah, in case we don't see follow through, I would be tempted to take a long position for an 1-2 day kind of a bounce back from those levels. 25,200 to me is a very important level. I believe that there is a good chance of a bounce back, but I want to see the market reaction once we start around those levels. In case there is no further follow-up selling, then I think that will be a good time to take a long. And then the first target would be around 25,400 and possibly 25,650.
Okay. All right. Gentlemen, morning. Great to have both of you here on the program as always. And happy Friday to both of you. Shrikant, what about you? How are things set up?
Good morning, Prashant. Good morning, Nigel and everyone. See, for Nifty, it is very clear that it has broken its important support level at 25,400 and it closed below the same. So the next level to watch out for would be 25,100, 25,050 sort of levels. And there the market is having one more leg of important support. So as Mitesh said, I am also of the view that in case if we see the market is dropping to 25,100, then there we should look for taking some contra bets of going long in the market, or we should look for buying some value stocks, because the overall trend of the market is very clearly corrective pattern that we are observing right now and witnessing to the entire rally that we saw from the levels of 24,000 to 25,650. So it's a corrective pattern, and the strategy should be to buy on dips.
Okay, strategy should be to buy on dips. Well, the pre-open is started, but I think we should give it 2 minutes more and then come back to it. Let's get to trades then, in terms of what both of you would want viewers to do. Mitesh, you go first. What's on your list?
Prashant, I have a mix of buys and sells. On the buying side is Paytm, which was a call yesterday as well. Now can be bought afresh with a stop at 928 for a target of around 970. Container Corporation was also a call yesterday. I continue to remain bullish here, so buy with a stop below 618 for a target of around 645 to about 650. And on the selling side is BDL, which is Spark Dynamics. Keep a stop at 1920, look for targets of 1830, 1825. And Siemens is a sell with a stop at 3225 for targets of 3130.
Got that. Shrikant, what about you?
I would like to go short on HL, Hindustan Aeronautics. There we are seeing a good amount of weakness. It is around 4,900. The next level to watch out for would be 4,700. So it's a short at current levels with a stop loss at 4,975. And we should look for adding a few bank stocks in this particular correction. So close to important supports of 255, 254, we should look for adding RBL Bank to our positional portfolio at current levels with a target of 265 and 270. We can keep a stop loss around 247 for the same.
Got that. Thank you very much, both of you, for joining us and running us through specific trades there. You know, the rupee is opened sharply lower. Actually, it's almost a 20 paisa lower open for the currency, which is coming through. Look at that. So 85, 84. I mean, there are no there's still no letter or anything of that sort with regards to India from President Trump's side. But there was this one news item which was doing the rounds yesterday in the evening, which is that, JP Morgan Global Bond Index, there was a Bloomberg story, and it was one of the possibilities which the Bloomberg story reported on, which is that the index provider, that is JP Morgan, could actually lower the weights of India and China in the index. Remember, India just got included, and the expectation was that we'll eventually actually go higher in terms of weight. But that story essentially reported that perhaps they're going to recalibrate, bring in higher yielding bonds, riskier bonds, but also higher yielding bonds, and to sort of create that space, maybe lower the weight for some of the sort of bigger providers of bonds, which is, of course, China. India is, of course, expected to be very large as well. So that is the currency move. But we'll get more on this one as we go along. But it's a move without, of course, any trade or Trump-related headlines, at least nothing new in that sense. Coming back to stocks, the big story, Liva?
There's so many big stories with this TCS. We're just going through them one by one. There's Glenmark, and the other big corporate headline, which came in last night, was HUL looking to undergo a management transition. Rohit Java is all set to step down as the CEO of Hindustan Unilever after just about 2 years at the helm. Priya Nair, who's currently the president of the beauty and well-being business at Unilever, will take the reins, becoming the first woman to lead India's largest consumer staples company. Let's talk about this with Abanish Roy, who's of course been tracking this company in the sector for years and years from a market lens, market perspective. Abanish, very interesting. Typically, I guess, Unilever or any FMCG company CEOs, they have longer tenures, right? This was a short one for Mr. Java. She's an insider. Ms. Priya is an insider, so I don't think there could be any continuity issues. But what would your first thoughts be?
Yeah, thanks and good morning. Yeah, you're right. This was a surprising development. Yes, last 2 years, Rohit definitely tried a lot of initiatives. He did the minimalist acquisition. Project Aspire led to volume-led growth. If you see in Q1, we do expect improvement in volume trajectory for Hindustan Unilever. We expect around 4% volume growth YOY versus 2% previous quarter. So there is an improvement, but we don't see any material reason for this development. Overall, we remain quite positive on Hindustan Unilever. As you rightly said, Priya definitely brings a lot of value to the table, 30 years in HUL, and she has spent most of her time in India. She has done a splendid job in the home care business where she was heading it as executive director for 6 years. And even at the parent level, she was heading the entire beauty and well-being. I think beauty and well-being, clearly HUL has some work to do, and her understanding, being a woman MD, and definitely I would say that category will see that further push. Of course, she has been groomed under Mr. Sanjeev Mehta, who did a splendid job of 10 years when the market cap of HUL went up 4 times and almost had a 900 bips EBITDA margin improvement. Rohit, of course, last 2 years, the macro was very challenging, but when he's exiting, I think the volume growth has recovered, the macro has recovered. So overall, short tenure, but he had 37-year tenure at Unilever.
Yeah. No, and also he's steered the company through a phase of, immense disruption, right? Macro challenges aside, that's one part of it. But just the sheer amount of disruption with the onslaught of quick commerce. So very quickly, just revise for us, what is your growth expectation for Lever this quarter and this year, volume growth? And what you would say would be perhaps the 1 or 2 things that you would expect the new CEO to really focus on to get the growth levers back on track?
Yeah, good question. So we expect 4% volume growth and sales growth around 4.5%. So that's a clear improvement versus the past few quarters. And we expect that trend to continue because clearly palm oil has corrected sharply PFAD. So that benefit will come in H2 for Hindustan Unilever. So they can flow back more towards growth in terms of aggression. And coffee cost has also corrected 30%. So Priya, they are very good credentials, but definitely lucky also in the sense that volume is improving. The margins will be there to push more advertising, more promotion, more innovation. And yeah, last will be essentially minimalist acquisition in terms of doing the D2C more aggression. We see that HUL will be more aggressive on more acquisitions in this space, D2C, and clearly parent, the CFO became the MD few months back at the parent. So he's very aggressive on India, very focused on India. So overall, we see this as a non-issue. We see that definitely Rohit did a good job in 2 years, but macro was very challenging. Now when macro is improving, clearly Priya further can take it up. So we are positive. We see 3055 as the target price for HUL.
You said 5% full year volume growth? This quarter you said 4%. Full year how much?
Yeah, full year should be around 6%. Because
6%.
we see expectation of more improvement. As I said, now palm oil is down and coffee is down. So
yeah, you explained.
We'll be able to fund the growth.
I on a lighter note, I got a call from HUL late in the night.
Okay.
Said, well, be ready to start using your Malayalam.
Oh.
Priya Nair.
Priya Nair, oh.
I said, but you know...
It's all the South Indian women taking charge. When there's Aarti Subramanian at TCS, Priya Nair at HUL, the women from the South, always
women
strong.
in general. But,
and women in general.
You know, the other thing, of course, I think Abneesh, I don't know if he alluded to that. Abneesh, you know, the point is, of course, the environment was tough, etc. The other thing, of course, also is that, you know, Mr. Java came, you know, 20, 25 years overseas, right? I mean, then he was dropped in India, right? Whereas Priya Nair is very much been here and kind of sort of headed divisions, etc. Does that also will that also make a difference? We'll see the execution and what she does, etc. But is that an important difference compared to what we saw under Mr. Java and what perhaps we will see under the new CEO?
Yeah, I think that definitely matters because Priya's experience has been there in India when all this D2C disruption happened. So definitely in beauty and well-being, which is a very focus area for HUL and Unilever, she has the ability to take it to the next level. So to that extent, that should definitely help. And being a woman MD and that part of the understanding will also be helpful. So yes, I do see that the very strong India experience of Priya Nair, and she was heading that part of the business at the parent, and she did a splendid job in the home care also. So it is not that only beauty and well-being or personal care is her forte. In home care, she was the executive director for 6 years, and we saw massive premiumization and massive margin improvement and market share improvement in that category. Of course, Sanjeev Mehta was grooming her, and now we will expect that also to take the company to the next level.
Well, hi, Abneesh. Good to see you. You know, as you said, Rohit took over at very challenging times. Priya's taking actually at an opportune time when the macro tailwinds, inflation is cooling off as well. Rohit had to face a lot of challenges at that point of time. That said, do you think that, you know, this is a big knee-jerk reaction? Because at Unilever PLC as well, we saw a change of guard, I think within a year or so. And out here as well, change of guard within 2 years. Viewing Priya as a change agent post a 5% pop-up in the stock today, would it be running ahead of itself?
So three things. One is investors have interacted with Priya in the events, analyst meets, etc. So to that extent, she's a known face. So I don't see any problem of any knee-jerk negative reaction. So yeah, near term, medium term, I think the stock should do well. And in terms of the overall leadership change, if you see, yes, it is being seen as a positive. So I don't see any knee-jerk negative reaction, but medium term and short term also, we see the stock doing well. The sector is back in favor. If you see, we are going to see a sector churn, right? We have seen some of the other results of tech companies, etc. So we are expecting that investors will shift more towards the staples. HUL clearly is the big daddy there, so that will also benefit. So yeah, we expect a positive reaction to the stock in the near term.
Got it. Okay. All right, Abneesh, thanks a lot for joining in. That's the big mover from the Nifty pack itself. HUL up close to around 4%. And Abneesh saying that it's an opportune time, macros are working in her favor, and we're seeing a shift to a lot of these companies itself, the consumption companies that actually have been underperformers in the last few years. So good time for those shareholders, probably in the near to medium term. Thanks, Abneesh. Well, let's get in our 9-10 call then. Mitesh Thakkar is back with us. Mitesh, what do you have?
I'll go with a buy on Paytm. Look at targets of roughly around 965 to 970.
Paytm, got that. All right, 965, 970. What about HUL? What's the view out there? The stock is starting off 4% higher. Last few years haven't been, given any returns. But the prior 4-5 years, in fact, the stock tripled. What's your view after it opens up 4-5%? Where is it headed?
So, Nigel, my initial feeling is that I was looking at a target of around 2,500 to about 2,520 when this move started about 2 weeks back. We will hit those levels, I think, in the opening. Maybe you would want to take some profits. But eventually, I do believe that the stock has potential to head towards levels of around 2,650. But, it's typically a low beta stock. So, therefore, I think the first suggestion would be to take some profits and trail your stop losses and see if it can get past 2,520 and sustain.
What about TCS? That's the big loser. That's down 2.5%. The stock is, I think, already lost 20% in the last 6-7 months. Valuation-wise, it's trading below its 5 or 10-year averages. The question is how much is in the price, but on the charts, how is it looking?
So the entire IT pack, was slightly negative. We had sell calls on HCL Tech and Tech Mahindra. I think TCS could even go down to about 3,200. Doesn't look strong to me in the short term. I think there'll be pressure, and 3,200, which was the low which the stock did in April, could be revisited.
There's a minute to go for market open. Mitesh, thanks very much. Coming back to you later. Rima is here. Rima, you got 30 seconds. Tata Elxsi is the focus.
Well, it's a disappointing set of numbers. On the top line, revenue has fallen by 3.9% quarter-on-quarter. Year-on-year, it's a drop of 9%. And that's putting pressure on the margins. Margins are down 200 basis points sequentially, 20.9%. And in the last 6 quarters, we've seen the margins of Tata Elxsi fall from nearly 29% down to about nearly about 21%. Profits have also consequently come under pressure, 16.2% lower. The only silver lining is the management commentary, where they are saying that 2 out of the 3 verticals will get back into growth in Q2, and therefore they're hopeful things will recover and there will be an improvement in the margins and bottom line.
All right. Well, that's 30 seconds. Rima, thank you very much for that. Well, I think we've got market opening coming up in just a minute or so, less than a minute actually. The clock will come up on your screen. And of course, we'll be watching out for 3 top names which start out 100 points, clean 100 points lower on the Nifty is what you have. TCS is down 2.5%. And the other one, of course, is Lever, which was up 3.5% at the end of the pre-open session. And of course, Glenmark, which is limit up 10%. There you go. Glenmark, of course, remember, will, the futures, the price will be on freeze for temporarily, and then of course it'll move on to the next circuit levels. The freeze will open up after a couple of minutes. We've got the first rates coming up on your screen. The Nifty is down about 1/3%. The Bank Nifty is absolutely flat. Actually, the Bank Nifty wants to come into the green, 56,940. The mid-cap index is down 0.1. The small-cap index also will come up on your screen. And I think there is some amount of red there as well. Yeah, 0.2%. 25,250. Let's get to stocks pretty quickly, but heat map on your screens. Before we do that, I think it should be more down than up to begin the session. And I think we'll get a glimpse of what Lever at least is doing, which is very much part of the Nifty. And of course, the other end of the spectrum is TCS, Infosys, Wipro, HCL Tech. IT, of course, taking a bit of a hit this morning.
Yep, 100 down also makes us one of the weaker markets across Asia, by the way. Other Asian markets are either flat or positive. Let's look at the losers. No surprises here. TCS is down 2%, Wipro is down 2%, Infosys 3%, Tech Mahindra, HCL Tech, all these stocks are down. And remember, it's not like there was a big build-up in IT stocks this time before Q1. But despite that, fresh negatives, all these stocks are lower. What else? Hindalco, Mahindra and Mahindra, Trent. These are stocks that are losing between 0.5% to about 0.75%. Reliance is adding to the bulls' problem this morning, down about 5 rupees on Reliance. HDFC Bank is lower by about $5 as well. ONGC. These are some of the names on the weak side. Okay, let's talk about what's working for the market. Lever for sure, 2.5% up on the news of the management change. Kotak Mahindra Bank and IndusInd Bank are trying to offer some counterweight along with SBI to the HDFC Bank pressure. Actually, HDFC Bank is the only large bank on the downside. Most others are positive. And ICICI Bank is absolutely quiet, sitting on the fence with just a 1 rupee up move right now. But that's pretty much it on the gainer side. SBI Life, Dr. Reddy's. These are some of the other stocks that are managing a little bit of green, but no green like Glenmark. Look at that, 10%. And what a beautiful run on the stock. I mean, 1 year it's up 50%. This year, 2025, is up 30%. And now builds on that gain with this stupendous news coming in for the company.
Well, that's right. Well, keep an eye out on Oswal Pumps. That's the newly listed company. The stock is actually down 5%. I think they came out with their Q4 numbers yesterday. That's dated numbers. But though the numbers look pretty okay, I think the street is giving it a little bit of a whack, or maybe some profit taking is what we're seeing out there, because now it's down close to around 7% and it's falling on decent volumes as well. So that's one on your radar. Tata Elxsi is down 3.5%. It's come off a little bit from the low point of the day. So I'll keep an eye out on this particular name, because the low of the day, in fact, was much lower. I think it's come off close to 3% from the day's low. It's still down close to around 4%. But there appears some kind of a bounce from the day's low. So keep an eye out on that name as well. IRDA, that's the one that's struggling. The gross NPA spiked up to around 4%. We have that Gensol account that got accounted for, but there was another account as well. So asset quality worsening over there. We'll speak to the management soon, but the stock has opened up with a cut. Zee Entertainment, the investors have rejected the proposal to issue warrants to key shareholders. The stock is down close to around 3.5%. SPML Infra, that's another one that's been awarded a 385 crore rupee water project in Rajasthan under the Jal Jeevan mission. So that stock, I think, in the last 2 months has moved from 180 to around 280 very, very swiftly. So that one is on the radar. Volumes large out there. And Anand Rathi, that's actually the result of the morning on the upside. That stock, in fact, has opened up well in the green. They have managed to meet 88% of the FY26 AUM guidance. The street likes that. The margin has improved as a cost of income as well. Cost-income ratio has dipped by 570 basis points. So that's the one that's reacting positively. And as we did that market check, the markets, in fact, the Nifty has cut its losses by half. We're down only around 60 points as we speak. Prashant.
Absolutely. The low is 25,244 today, right? I mean, I think that maybe if I got my levels jumbled up is another matter, but no, actually, that is the 20-day moving average. That's the level we put out in the morning as well. So the market actually basically kissed the 20-day moving average, and then from there it's bounced sharply. It could be a little lower, a little higher, but broadly, I mean, that's an important, the 20-day, at least in the near term, in terms of directions up and down, important for traders, important tool for traders as well. So hit the 20-day, and maybe we should put it out as an alert as well. At the lowest, hit the 20-day, and then it's actually bounced from there. Exactly there. So 25,290 is where we are at. Okay, let's just quickly, IT, of course, is the biggest cut. Maybe just a quick look at the Nifty IT index without going into all the stocks. But the IT index is down 1.25%. So that's the pressure. That's where the pressure is coming from. Oswal Pumps is a recent listing. Oswal Pumps is coming up with a 5.5% cut, in addition to what Nigel and Surabhi mentioned. And there is a Mahindra and Mahindra, which is down 1.6, 1.5%. So with Mahindra, it'll come up on your screen. There is, and we'll have Pariksha join us a little later. I mean, the talk of Tesla is back. Tesla in India, right?
It's not just talk. I think now it's official, right? 15th of July? Prashant's heading to the showroom. It's here in Mumbai where they're opening.
But I can tell you that Parikshit is heading to Mumbai to cover Tesla in Mumbai.
That launch, yeah.
And I think that is the reason why Mahindra is taking a bit. I mean, markets are all knowing, right? I mean, they react so fast.
Just a word on this Tesla threat actually has been a good omen for Mahindra and Mahindra shareholders, because every time there's that threat, the stock falls and then
you
it
buy
sees a
and then
big
it rises
recovery.
higher.
So, let's see whether that plays out. But past evidence suggests that when it gets whacked because of Tesla, then you have those notes. They're very, very different markets and different pricing and different scalability and different everything. So, I'll keep an eye out on this, whether or not this dip is used as a buying opportunity on Mahindra & Mahindra.
Let's actually bring in Venugopal Gare, right? He's, of course, India head of research at Bernstein. Venu, good morning. Great to have you with us here. And Venu, of course, is someone who, I don't know if you still do, Venu, but you looked at autos very closely. I mean, actually, you have a few of those companies under coverage. You were very bullish on M&M a few years earlier. I remember having those conversations. What is your sense, just throwing that discussion to you, what your perspective on this entire Mahindra, Tesla reality now here in India? What's your sense?
Thanks, Prashant. I was listening to your Tesla sort of comment on Mahindra. Honestly, it does not matter. Tesla pricing-wise will be at a level at which it's going to sort of, target a very, very small market in India. And more importantly, we're not that bullish on electrification in the four-wheeler sort of a space for a fairly long period in India, because I don't think charging infrastructure is ready yet to be able to convince people to sort of buy those products. And pricing-wise as well, if you see, most of the launches, even for the Indian companies, are happening at a premium sort of a pricing. So, this Mahindra stock price, whatever that you see, 1% really doesn't matter. The sort of a decline that you see has nothing to do with Tesla, honestly. It is more about the fact that we're heading into a result season in general, where there isn't much of a positive vibe with respect to margins in general in the sector, Mahindra included. And remember, another aspect of it is things like rare earth supply and potential delay in production for vehicles in general across the board is another thing which is sort of should impact auto companies in general in the near term.
Okay, so you continue to be in the camp, and I think that camp has a lot of followers, that M&M is not going to be directly impacted too much, even with Tesla's entry.
Just for the heck of it, take the other side. Okay. Tesla and their team in India obviously know all this, right? That just out of they're priced out in that sense from where the bulk of the SUV buying or whatever that category of consumers is. So wouldn't they try something new? I mean, they surely know this, or are they planning to sell very few cars in India?
So the reality is this, that if you were to just think about it, we wanted Tesla to come to India, and I don't think Tesla was very keen to come to India. And I think that is
now you put it on its head. Go on, sorry.
Absolutely, that is a reality. Look, China benefited significantly from Tesla's presence in China. A lot of the sort of development that you see in terms of capability building, which happened across the board for a lot of OEMs, from a talent point of view, was to a large extent, I would probably say, also supported by Tesla's presence out there. And I think India needs companies like this to sort of create talent pools and, more importantly, create manufacturing. Remember that we yet don't know whether they are going to bite with respect to creating a local facility out here. So at this juncture, Trump tariffs are also sort of just about looming. So we'll get an idea if anything is sort of happens around that front as well, where you might probably end up being able to import at lower duties from the US, right? And that is probably the positioning that players like Tesla would want to have, even though despite that will be costly or very costly in India. So it's more a distribution gateway for them. And think of it in a different way. When companies like these, even if they think about venturing and creating a presence, they think of 10, 15, 20 years. I don't think investment horizons for anybody is in that time frame. So we'll see what happens 10 years later.
Okay. All right. So let's wait and watch. It's going to be an interesting fight, or an interesting landscape, to say the least, whichever way things go. Venu, hi, great to have you on the show. So lots to talk today. I'm going to quickly get to the FMCG space. Look at Lever, by the way. Lever is the biggest winner on the Nifty right now, 4% up move. Let's pull up a Lever 1 week chart. Lever is the best performing stock on the index this week. Best performing stock on the index in the month of July as well. Now there's a leadership change, but it's not just about leadership, The market is perhaps trying to sense something or smell something, that something is turning finally in FMCG. Do you think this is a bit of a false alarm, or could this be the real deal after I don't know how many quarters and years?
Okay, so interesting conversation. So I had been in a very interesting camp because I was underweight consumption and staples for a very long period of time. Of course, parts and parcels would be buy, auto buy at some point of time, durables buy at some point of time, things like those. But for the first time heading into this calendar year, I upgraded the consumer staples to a neutral. Okay, that is the best rating I could have gone to, neutral, because it's a very costly space with growth to a large extent being still priced in from a valuations perspective, right? But the idea was that I didn't want people to short consumer staples this year. Part of it is because rural data points had started to pick up positively from November, so that gives you a small positive vibe for consumption in general. We've taken a call that monsoons will be decent, that we could have gone wrong on that, but that's also played out at this juncture. And number 3 is tax cuts, which at the margin does lead to some positivity on consumption in general. So these are all the variables which go into relatively positive consumption thesis compared to maybe what it was last year, right? So that's the entire framework with which we work. Now, change of management led stock price increases and things like that. I don't think those are important, but I don't think that's like the broad driver for what we would have taken a call on consumer staples. Number 2, remember that there have been some positive data points from some companies who have given this pre-quarter updates as well. So that's also sort of rubbing off at this juncture. And lastly, I would say that look, branded companies, especially on the FMCG side, in the medium term is not 10 years, medium term is maybe 2 years to 3 years, will have an impact because their distribution channels are getting disrupted. And I think that is inevitable. So you will see a resurgence or a creation of a much larger pool of brands out here. So it's very hard to take a structurally positive view on some of these larger consumer sort of brands and incumbents.
So you don't expect a meaningful pickup in volume growth this year. Would that be right?
Okay, so I do expect a pickup in volume growth from really bad volume growth last year, right? So that is good enough for you to create some degree of positive returns on these companies. But the idea is that when you see the first sign of, which of course you'll see in this quarter as well, of a volume uptake, don't get carried away. So this is not like the next 3-year re-rating story. Okay, so you basically to book your profits is the view, right? Not today. I mean, I haven't shifted to an underweight yet, right? So that's the way I would look at it. I think there are going to be challenges eventually in a year or so. So let it run up a bit. It can't run up a lot. Sell after that.
Hi, Venu. Good morning. Good to see you, Ben. We've got 2 earnings coming in from the tech pack, both of them from the Tatas. And, it's been a little bit disappointing. The commentary as well, a little bit softish. But, both those 2 stocks, initial reaction is that dip is getting bought into. What's your view on tech? Clearly, commentary is still a little bit feeble. The hope is that we'll see a recovery in the second half of the year. However, some of these stocks, if you compare it to the 5-year or a 10-year, on a valuation basis, there is some support. So your view on tech, and also briefly, I want you to tell us about the valuations on the mid-cap side of things. Because mid-caps always traded a big premium to the Nifty, I think 50-70%. That's come down a little bit, though growth as well has cooled off. So tech and mid-cap valuations. Please go ahead.
Okay. So firstly on tech, this year I had moved to an equal weight on ID services from being overweight in the prior year. Okay. So I was a bit nervous about anything to do with US. So it wasn't about just ID services. For healthcare, I had moved to an underweight beginning of the year, right? So both have exposures to US. Now, having said that, there was a lot of concerns around lack of visibility for corporates, discretionary spending was an issue. Then there was another layer of challenges around AI and how it could sort of impact the ID services pack and things like that. Too many variables to essentially focus on. So we decided to neutralize a portfolio beginning of the year. Now, what we see from companies reporting at this juncture, 2 of the companies that you mentioned, TCS was like, yeah, I mean, you can argue that wasn't really a great quarter. But beyond a certain stage, I don't think one should have anticipated a great quarter to start with. Auto ER&D companies, especially the one that reported and the others that you will see will have muted numbers. Globally, autos, we've seen some challenges for the last couple of quarters anyway. So that's not really a major surprise that way. But going forward, what I'm actually looking forward to is at what stage to move from a neutral to a positive view. Now, what to me is important is how does the US economy shape up? for the rest of the year and let's say first half of next calendar year. And I would probably argue that US economy is essentially not in a bad shape. If you look at the the big beautiful bill which has been sort of announced, in some way it's effectively a transfer of money to consumers out there, and to push for capex from corporates. These are all like positive things. They've also going to be expanding some expenditure on the defense side. Where there's a lot of play for ID companies, etc. So I'm of the view that we're probably scraping the bottom, for this sector in terms of sentiment and absolute numbers. Things might look up later in the year. I haven't really proactively yet moved into a more positive view at this juncture, but I would watch out for that.
So still underweight on IT, right?
I mean, I cut it from an overweight to an equal weight in January, so that itself is a good enough sign that I turned sort of cautious. Let me put it this way.
Okay. And mid caps, very quickly, how are you feeling about it?
Mid caps were trading at a 75% premium to large caps in June, July last year. They are now at 35% premium. I mean, anything around 10 to 15% premium is amazing. We're not there yet as yet. So we're not like literally cheap, but I think 35% premium is fair enough, because if you look at the earnings for differences is justifies that sort of a premium. So we neutralized a mid cap to an equal weight about a month back, compared to being underweight relative to Nifty for over a year. What it means is I would proactively look for opportunities, but with relatively lower expectations for returns, because it's still like costly. So that's a broad view on mid caps. I'm not completely against mid caps anymore.
Yeah. We've discussed two large sectors, Venugopal, FMCG and IT, and both, you've got similar views that you're watching very, very carefully to see if there's some sustained, meaningful pickup, at least at the end of the negativity. I think FMCG is a little better. That's neutral for you. Let's see if IT can at least, as you're saying, it's the bottom pretty much, will really help the cause for the index overall as well. Thank you so much for joining in. Great conversation. You have a good Friday, and we'll look forward to connecting again soon. Well, with that, we are, of course, very, very focused on earnings this morning. And IREDA is the next company on our radar. Stock's been down almost 5% since the open, on the back of what looks like a bit of a weak Q1 print. Mr. Pradeep Kumar Das, Chairman and Managing Director at Indian Renewable Energy Development Agency, is with us now. Mr. Das, thank you very much for joining in. Actually, I want to start, before we talk about growth, I want to start with the asset quality pressure. Some of it happened because of your loans to Gensol Engineering, which you had to recognize as NPA. But I think there was one more account. So can you just take us through whether this is just a one-off for two very specific accounts, or is there some other concern, larger concern building up on asset quality?
Yeah, very good morning, and thank you for having me here. First of all, the NPA, particularly what we're talking about, which is grown up, out of the total NPA, as you have already said, Gensol. So Gensol, the market is well aware of it, and that is purely because of the promoter-related matters, rather than anything to do with IREDA or with respect to the sector. Second, the other group what you are talking about, that is not now, that is way back of 1920 of a group, and they were quite badly affected by the Andhra government decision to dissolve the PPA. And there was a High Court stay on not taking any coercive action and not to recognize it NPA, but we had made enough provision since 1920 onwards. And if you see, roughly 1,450 and odd incremental is there in NPA, whereas our provision has gone up only 360, and this provision is on account of one account, that is of Gensol. So as far as the sector is concerned, I don't think there is any major issue. And Andhra government's decision, which is already now, it's a history now. And the group is working out, and there is a proposal in pipeline. So I cannot divulge on the proposal on this matter. But simply I can tell that in last 38 years, we have financed 1.62 lakh crores. And our cumulative write-off is 135 crores. So that speaks about the command and control of...
No, absolutely. Absolutely. Sir, just a quick follow-up question. Two-part question. First, if you could tell us that if these are isolated events, then your NPA, which shot up to 4% in Q1, on a full-year basis, what is the range that you'll work with? And this Andhra issue, which impacted one particular customer, was it a customer-specific legal issue that's playing out in the courts? Or could it impact your other exposure to Andhra as well? I mean, other entities that you're lending to in Andhra?
So by and large, those who are having exposure in Andhra, they had all impacted, but the bigger groups who's having multiple activities and all, they could manage to sell through that. So those who are groups completely concentrated on larger accounts in Andhra only, they were badly affected, and it is one of that. And we do not have major account as such, which we are envisaging that in the time to come. And look at 1920, we had double-digit NP of 10, and we came down to almost below 1 in the last 4.5 years. These 4 also, we are confident in the time to come. And it's just this quarter it has come, and we are confident to sort it out. And as I said, if our cumulative write-up in last 38 years is only 135 crore against 1.62 lakh crores of financing, that to new and emerging technology handling, so we are quite confident. It is just a matter of...
So where will your NPA levels come back down to, sir, by, say, Q2, Q3?
You are asking me what will be the next quarter NPA?
No, for the full year also, if you could just give us some sense, because you're saying these are aberrations, these two events. So full year, should we expect 2% NPA, 2.5%, less than 2%?
Exact figure, it will not be appropriate for me to tell. Now, I can tell you that Gensel matter already IRP has been appointed, and it's a vehicle which we had financed, and we had financed for 5 years. Many of the vehicles, 3 years has been paid and 2 years has been repaid. So balance period, if you see, in a vehicle, the life is 10 years and the battery is 6 years, and our loan was 5 years. If you look at the moment the IRP appointment has been made, and if you look at the IREDA management's approach to handle this transaction is quite appreciable, because we're the first lender who approached to the NCLT and took the approval from NCLT to appoint IRP and to go ahead, because our intent is to, because we understand there is huge good economics in the sector and business model. There is nothing wrong what we have envisaged so far. So therefore, it is a purely promoter-related issue. So once we take back the control of the assets and we can rework to again engage other agency or even outright disposal of that, but we do not envisage any major dent in this kind of assets.
What about any major fraud, sir? Because this hetero renewable energy, there's a small fraud that's been detected over there, 8 crores, I think so. The street is a little bit skeptical on this. You believe that most of these untoward or one-offs are already there, already declared, or are you getting a little bit nervous about the book?
No, first of all, we are not at all nervous. See, the fraud in the banking industry is not new, and for IREDA, probably it is not that much. So that is the reason when I'm talking again and again. Even 38 years, our only cumulative write-up is 135 crore against financing of 1.62 lakh crores. So despite all these stray cases, we have managed to sell through this. See, what is happening in this fraud? One case, what we have already reported at JT Road. And maybe, you see, we have post this Gensel issue. In fact, it is a huge blessing in disguise for the team now, the quite good learning, and all the accounts we are sanitizing, and scrutiny, review, monitoring has been tightened. So our project monitoring has been strengthened quite a lot now.
All right. I'll tell you what, so the problem is you did a QIP, right? And investors were not seeing these sort of results coming. And that's why some investors are a little bit jittery that why all this has come about after that. So that's why, the investor community is a little bit jittery. Let's keep that aside. Let's get to a few numbers. What about the book, the growth? What kind of growth can we work with? And what kind of NIM should we be working with for the remainder of this year?
If you look at the NIM, we are improving gradually. And the borrowing cost is also gone down. So we are quite confident. We have got 54 EC sanction. Definitely, we are targeting to buy to the tune maybe around 4,000-5,000 if we can get. And around 12 to 15 basis points of average cost reduction is going to happen. That is for sure, because we're waiting for this for quite a long time. Since 4.5 years, post by joining the company, I used to pursue. Finally, we have got the approval yesterday, and we are grateful to finance minister for this. Yes. And probably we should have got this much before. So this is a sector, and IREDA as a company working on new and emerging, we do not have any kind of specific benefit. But today in the country, we do not have defined green taxonomy.
Yes,
Mr. 100% green, we are not getting benefit. Okay, Mr. The investors' concern as far as QIP is concerned. See, when we did the roadshow for QIP, the Gensel matter was already in. And post Gensel, we have done the QIP and it was quite successful. And we are confident that once we have the investor meet and interactions, the kind of clarification what I'm giving now, once it is communicated them well, and I don't think there will be any kind of doubt.
Okay, so can we get some numbers now, please, on margin? Can we get the net interest margin number, the final margins for Q1, and what your expectation is? Also, you've been eligible for the 54C bonds, I think. So overall, what is the decline in cost of funds? What is the margin expectation for this year?
And also, so if you're giving us numbers, just give us the growth outlook
The growth
as well.
number
Is the
as
growth
well.
sustainable?
Yeah.
Numbers we're looking at, I think on that 54 EC, you mentioned that 12 to 15 basis point cooling off in cost of borrowing. So I think that's out of the way. Give us a guidance on margins and is the growth sustainable? Please go ahead.
If you take out this NP and other things, our growth is phenomenal. Not only now, 21 quarters continuously. And we are confident the way the sector is growing, we are going to get the market share what we have enjoyed in the earlier. If you look at the already almost 14 gigawatt of capacity addition has happened in the country against annual capacity addition of 29.9 gigawatt last year.
Right.
What in a year the country did in quarter it is already been done. So the speed for 50 gigawatt of bidding every year, 50 gigawatt of addition in a sense by the MNRE, that is already in the pace. So we are going to have this kind of momentum what we had in the past. We do not have any doubt in that.
Okay, we wish you the best of luck. Thank you for joining us and answering all those questions, sir. Appreciate it. Well, let's revisit Glenmark once again in a slightly more detailed way. Stocks, of course, locked up in upper circuit. The pact with, the licensing pact, much larger upfront payment of $700 million is what got the market excited. On your screen, this is a slice of that conversation we played out bits of earlier as well. Ekta speaking with Glenn Saldana. Listen.
Clearly, this is a huge moment for us, right? I mean, we've been working on this for 25 years in the innovation space, and I think 2001 really is a world-class asset, right, which can be transformational for patients. From a partnering perspective, the way we've structured it is we've partnered with AbbVie for US, Canada, Europe, China, Japan, most of the developed markets, and Glenmark will commercialize this product eventually, right, in India and all emerging markets. So the two of us will make sure this asset is successful going forward.
So explain the financials to us. $700 million is what you would get upfront, $1.2 billion in terms of milestones, and the remaining would be royalties.
That's correct. So we get a $700 million payment upfront, and as soon as we get regulatory approvals, that money will be received by us. The milestones, the $1.2+ billion of milestones, are spread into clinical development milestones. So as the molecule progresses to clinics, we keep getting milestones. Regulatory milestones, so as the molecule gets filed in various markets, we get and approved, we get milestones, and then we get sales-linked milestones. So cumulatively, that number comes to $1.25 billion, for the asset. And then once it's commercial, we get royalties on sales, which, as you know, some of these innovative products, the life of the royalties is pretty long. So this could pretty much be an annuity if the molecule makes.
When do you think that it will probably hit the market or show any kind of results?
So AbbVie takes over all clinical development from here on. In terms of time frame, I mean, I can't give you a specific time frame, but typically molecules, if you look at other assets, right, in the space, they typically take about 4 or 5 years at least to get to commercialization.
Okay, well, let's talk more about this deal and the sector growth outlook. Joining us now is Suresh Subramanian, partner and national life sciences leader at EY. Thanks very much for joining us. Suresh, pull back a little bit and talk to us about the significance of the deal, the largest deal of its kind, I think, in the Indian pharma space. How are you looking at this? And we'll get into specifics.
Yeah, hi. Thanks for having me. I think this is a significant deal in many ways. One is the payouts, as you can see. Glenmark has got a good deal on a very good upfront milestone payments. And this comes on the back of very good phase 1 readouts, right? These drugs, the 2001, belong to a category of trispecifics. We have heard of monoclonal antibodies. whereas these are multi-specific drugs, which are antibodies, which kind of engage with both the tumor cells and the immune cells, right? So their power to express and provide, provide cure is much higher with much lesser side effects. And the world is moving to, from chemotherapy to, immunotherapy, and now the whole area of multi-specifics are indeed the future. And to AbbVie, AbbVie buying this is in itself an endorsement, if you may. The beat platform that Glenmark used to make this product, it kind of validates that platform as well, right? And it also kind of validates in some ways, values the pipeline that Glenmark is building on this platform. So I would see this as and just to go one step back, what it helps AbbVie is to kind of play more aggressively in the 30 billion, multiple myeloma market, which probably, by the time it comes will be a trifle more. So I think it is a win-win for both sides. For AbbVie, it complements the portfolio of their modern anti-cancer drugs, the ADCs, as you call it, and this is a very close cousin of the ADCs. So in the first-in-class tri-specific. So I guess that's what makes it special. But it's kind of value adding to both.
Absolutely. And also what makes it special for Glenmark shareholders is just the sheer quantum of money that the company is all set to receive, $700 million upfront and potentially over $1 billion over the course of the next few years if things go as per plan.
Annuity through royalties, right?
Absolutely.
If you look at Humira of AbbVie, that touched 20 billion. It's still 10 billion 10 years after patent expiry. So you can imagine what's the length of these category of drugs and their dominance in the market. So that's another big thing as well.
Absolutely, Mr. Subramaniam. For a second, I just want to zoom back out because what happens is that when you get good news, I mean, that's human psyche, right? We really want to latch onto it and believe that it is a defining new moment. And while it might be that moment for Glenmark as a company, and that's what Mr. Saldana was saying, that it's been 25 years in the making, this milestone. But for the industry as a whole, I mean, does it signify a change? I mean, is this just a Glenmark event? Or is it some sort of, pharma industry event for the industry here in India, where breakthrough innovation simply has not come through over the last many, many years?
Well, I think it's beginning to happen. We talk about Zenic, the anti-infective from Wockhardt. We're beginning to hear shoots now. And, that if Indian pharma is to move from the 52 billion that it is today to 130 billion by 2030, that one point of inflection that will take it to that number is innovation. So there are many companies that are now investing in the transition from small molecules to large molecules, where a large part of the innovation is happening. And that investment is happening, and I know of many of the top pharma in India investing. Second is you have the CRDMOs who are doing contract research and discovery. They work for global companies largely. So from a platform and from a capability perspective, there's a lot of work already happening. It's just that they need to be converged, they need to be leveraged, and they need to be nurtured. So I think Glenmark's story today, that there is commercial value of this kind, is a great, I would say, enhancer of or motivation for the rest of the industry.
Mm-hmm. So if I were to ask you, which could be the next Indian company that could deliver something like this, an R&D breakthrough, a novel Indian drug? You mentioned Wockhardt. I mean, how do you rate some of the other large players? There's Sun Pharma with, of course, the Spark Sun Pharma Advanced Research. There's Reddy's. Who or which entity would you keep your eye out on next couple of years?
Well, I know it's a pertinent question for the program, but from the perch in which I'm sitting, I don't want to comment on that. But it will be good to say that most top companies are, thinking global, and they are getting into this realm. So I won't be surprised in the next 5 years.
Is financing and funding at all an issue? Because I know that most large pharma companies are listed, there are shareholder implications, and how much money can you put to work? Because these are long gestation programs, right? So is financing at all a constraint? What is what could be the potential constraint for the other large Indian pharma companies?
Yeah, no, I think it's a great question. Look at this deal, right? What does it tell you? Post phase 1, the deal has happened. So once you find value, potentially all the cost of 1.6 to 2 billion is in the development phase. You kind of find partners or find an arrangement like this that you do. So my thing is there will be more candidates. You need deep pockets to take it end to end. But I think the whole global pharma is going through, doing things in pockets, outsourcing parts of R&D, and also probably kind of doing deals like this that during the course of the, research and development process, value chain, if you may. So I think there are many incentives for continuing the research. You can kind of cash out on the value at any stage based on the pockets that you have, or get strategic partners to kind of drive the whole thing. So I think there are many models available now than it was before.
All right. Thanks very much for that, Suresh. Great speaking with you. Appreciate your time here. A good perspective. We'll take a quick commercial break here. Coming up at 10 o'clock mark, markets, of course, have bounced quite nicely after hitting the 20-day moving average early on. right at the word go. On the other side, we put the focus on the insurance space. Expectations, this is quarter stuck, our preview, deep dive preview of a sector a day. We have the JM Financial Institutional Securities analyst joining us to help us with that. Stay tuned.
Welcome back. Just a quick look at the market, which is still nursing a cut, but it's lesser than how we opened. Now it's about 60 points lower on the Nifty, a little bit of a red on the mid-cap and the Bank Nifty as well. So that's the market for now. Let's quickly move on to our next discussion. The insurance sector is on the radar. June life insurance data has been a mixed bag. So how will the first quarter earnings season play out for this sector? To talk about this, we have Raghuvesh, who's the insurance and capital market research analyst at JM Financial. Raghuvesh, thanks very much for joining. And I briefly saw your note last evening where you're expecting that at least for the life insurers, margins should start improving, and growth has been very low in this quarter so far in terms of just the premium. But you still have a positive view on life insurers. Tell us why.
Yeah, hi, Surbhi. First of all, thanks for having me on the show. So Coming to growth, as you mentioned it. So last year, the first 2 quarters, growth was very strong for the private sector. In life insurance, 24% YOY, which is much ahead of the historical trend of around 15-16% growth. On that base, the growth is optically looking low in this year. If we look at a 2-year CAGR, the growth is pretty fine at around 15% for the private sector. The expectation is as the year progresses, the YOY growth starts looking better. And we have already seen that in the first 3 months. Yesterday, the numbers which came out, the private sector itself delivered around 13% growth in the individual business, which is, again, moving towards our trend of a yearly expectation of somewhere around 12 to 13% growth for the sector. And that is largely in the price, is my sense. On the margin front, last year, the growth actually came with very strong sales of market-linked ULIP products, which are actually low margin for the insurance companies. As the mix of products moves more towards return guarantees and pure risk products, the expectation is margins should improve as the year goes on.
But for a company like, say, HDFC Life, I mean, in a tough year, so far this calendar year 2025, stock's already up 25%. It's done better than a lot of other large cap Nifty companies, right? So how much of this is in the price? And from here on, what is the trigger? Margin improvement? If so, how much improvement? Will it be first quarter? Will it be back-ended?
Yes, so actually the last year, the price action was pretty muted for the sector, despite the strong growth, because of concerns around, first, the surrender norms, which were updated by ADI. There was the expectations that margins for the sector and the leading companies would be hit by somewhere around 100 to 200 basis points, which through their product innovation and discussions with the channels, the companies have managed to incrementally bring it down. Secondly, there was a lot of concerns around how the bancassurance sales will pan out. Now, all these life insurers, the larger ones, except for LIC, are bank-led and get a decent portion of their premiums from banca. So with that concern now easing out, we have seen the leading companies come out and suggest that they're looking at, say, 10 to 13%, 14% kind of growth from the banca channel. And when we look at the on ground, we see that even the brokers, the agents, they are pretty positive on growth outlook for the year. So that has translated into good price action for, say, an HDFC Life. If I look at historical valuations, it's still below the mean since its listing. From here, we are looking at, say, somewhere around a 15% growth, a slight improvement in margins as the company invests for the future. And with that, we expect a slight improvement in terms of the valuations, somewhere around 2.6 times at this point, which gives a good 10 to 15% upside.
Okay, so still looking at some upsides in these life insurers. Got that. Ragvesh, let's talk about general insurers as well. Tell us, what do you like here? Where could, or which is the company which could see the best growth? And do you prefer overall general insurers or the standalone health insurers? Because I think overall motor third party is a big talking point, the revision in rates. So give us your views.
So the general insurance sector has actually done well in terms of growth, better than life insurance. But if we look at the companies, the listed companies, both ICICI Lombard and Star Health have not done that well in this quarter. In terms of motor third party, my expectation was if there was a price hike to come in, it would have come in already. The news around 18 to 25% revision in rates, that of course supports the companies. But my sense is the players active in the motor space, say ICICI Lombard, they would look at this as an opportunity to grow their book rather than focus on reducing their combined ratio. ICICI Lombard, the multi-line insurer, that we cover and like, over there combined ratio has been in a pretty good sweet spot at 100 to 103%, generating 18% plus ROEs. The concern has been on growth. Last year, the fire business, which is substantially about 20% ROE on a standalone basis, actually declined 5% for the industry, somewhere around 6% for ICICI Lombard. Now that has actually picked up in terms of growth in this year. In the first 2 months, the growth there was 16%. If fire can keep firing, motor third party, if there is a price hike, good. Even otherwise, while the volumes have been low, there has been a ticket size increase. The larger players have been gaining market share, 7 to 8% growth in the motor segment, and continued growth from the health space. That puts in somewhere around 11-12% growth for a company like Lombard, which is good given the ROE profile that it generates. Also, I would like to highlight that the growth that these companies are reporting, they are not like to like. So they are, given the reporting change, say a 9% growth for the industry, which is being reported, should translate to somewhere around 12 to 13%.
So very quickly, apart from HDFC Life, which are the other major insurance stocks that you like?
Right now, the preference is for life insurance over general insurance.
Okay.
Other than HDFC Life, I like ICICI Prudential, which has disappointed on growth so far, but we believe that growth can pick up, and the disappointment is essentially a base effect. We also like Max Financial, which has given strong shareholder returns, but we believe there's room for much more.
Okay, so going for the life insurers topics at JM Financial over there. Thanks very much, Raghvesh. Good to get that perspective. So we're all prepped up for the Q1 insurance earnings season. Well, with that, getting back to the markets, and it's again a 90-point drop. So yeah, volatile morning and volatile week actually. So far with this kind of a screen, the Nifty is down about 1%. But, perhaps that's what we have. Mid-cap index is down about 0.5% right now.
Absolutely. And I think things are sort of drifting a little bit once again, right? As sort of we said, 25,266. 244, by the way, is the 20-day moving average, which is the days, I think, which is, of course, where the market got to as well. Mitesh is with us with what to do now in terms of specific trades. Mitesh, what do you, what's the view? What are the trades? And how are you looking at the IT space specifically?
Morning, Prashant. IT is something, which is slightly on the negative side in the short term. So in fact, I have one of the calls on the IT space. My belief is that most of these stocks have entered some kind of negative signals on the hourly, 2-hourly and 3-hourly charts. So you could see some downward pressure in IT in the coming few days. I have a sell on LTIM with a stop at about 52.60 for targets of 5100, and a sell on KEI Industries, which I would recommend selling with a stop at about 3,700 for targets of 3,550.
Okay, thank you very much, Mitesh, for those trades, and good to get that from you. You know, what we're going to do is take a quick commercial break. On the other side, Manisha is going to be focusing on the commodities space, and she's going to tell us what's top of mind. Stay tuned.
Welcome back. You're with us on Bazaar Morning Call, and the equity market continues to reel under pressure, but we'll now focus on commodities with the birthday girl in the house. Manisha Gupta is here. Manisha, up or down, green or red, doesn't matter. It's all sparkling. We just want to know where's the party. Just tell us where to come.
Oh, yeah. And you know what? Silver is at an all-time high today. So, yes, it is sparkling.
There's always sparkle on the birthday.
It is. Thank you for that, Sylvie. What I'm looking at, though, is copper prices, because we're trading at yet another record highs into this one as well. Well, today actually is a crazy day because Bitcoin is at an all-time high, silver is at an all-time high, copper is also trading at an all-time high. But I'm focusing on copper right now because it depends on tariffs and the way we've seen various statements come in. So, US now has announced 50% tariffs on copper, which is effective 1st of August, and that's taken the prices on the higher side. US did order Section 232 investigation into copper in the month of Feb, and it was understood at that point in time that these investigations would only conclude by the month of November, and if anything that was to come would come in by then. But with the latest statements, you have 50% tariff on copper effective from 1st of August. Now, the National Security Review shows tariffs are needed to protect the US production, is what the US president has said. The US president also says that copper is important because it has higher usage in various sectors like defense and electronics, automobiles, semiconductors, aircraft, ships, data centers, etc., and is the reason the US is looking to promote developing internal markets when it comes to copper in sense of refined numbers there. Now, when you look at the US imports itself, US is dependent on 50% in sense of imports for its requirements. US did buy 810,000 tons of refined copper in 2024, and the major countries which were exporting to US was Chile, Canada, Mexico, Peru, etc. And we've seen some concerns in supply disruptions in many of these as well, is the reason you've seen the copper prices continue to trade higher. But what this has led to is a lot of disparity in the global markets, because when you look at the copper in the international markets, the COMEX market that is, we're trading at an all-time highs. But on LME and Shanghai, you've seen the copper prices decline. The markets do believe that now the kind of inventories that you have in US are higher than the combined inventories in the rest of the world in sense of exchanges there. Also, apart from that, since the deadline is very quickly now on the 1st of August, many of these copper traders are trying to sell their copper to China because they do not think that they can meet the deadlines and be able to ship into US before 1st of August. So you're looking at prices in the rest of the world, barring US, continue to decline. When you also look at the markets, the US is trading on a premium to LME at a record $2,800 a ton as well. So it's a very, very huge disparity in the international markets that we have seen. I want to get a chart on your screens which will tell you on how we've seen the copper prices behave and LME behave as well. So with all-time highs at around 5.6, we've seen copper prices in US gain up by 40%, while LME, which is the major market, has seen prices gain up only by 12%. And the disparity markets believe will only come off after the 1st of August. Until then, the rest of this month could be looking at this arbitrage opportunity.
Okay, Manisha, thank you very much for that. So that's the, a commodities picture. We'll take a quick commercial break here. On the other side, it's our special segment, Indianomics. My colleague Lata discusses the actual tariffs versus the threats from Trump and their likely impact on emerging markets, rates, currencies, with Chetan Iyer of Morgan Stanley, Samir Goyal of Deutsche Bank, and Louis Kujis of S&P Global Ratings. Stay tuned.
Welcome to Indianomics. The threat of tariffs has been larger than the actual tariffs. President Trump has announced 25 to 50% tariffs on about 15 countries this week, but via letters, not executive orders. His executive order has actually pushed the effective date of higher tariffs to August 1, as we know. Now, that explains why markets have not reacted very badly to these very large tariffs that he has announced via letters. And then there is this threat to the BRICS countries that they'll be hit by 10%. There's also a threat for those buying crude from Russia. There is threat on pharmaceuticals. As of now, it appears that the world may have to live with 10% tariffs for all imports into the US, 50% tariffs on steel and aluminium, and a whole lot of threats. Now, what's going to be the upshot for EM economies, for the US itself, and for rates and currency markets? I have with me Chetan Ahya, the Chief Asia Economist at Morgan Stanley, Louis Squeeze, Chief Economist, Asia Pacific at S&P Global Ratings, and Sameer Goel, Global Head of Emerging Markets and APAC Research at Deutsche Bank. Gentlemen, thank you very much indeed for your time for what must be very busy days for all of you. Louis, let me start with you. If this is the status quo that we should get used to, about 10% to 15% imports and a whole lot of threats, what will it mean for the Asia-Pacific region? Should we be prepared for even lower growth?
Well, I think it's clear that both the elevated level of the US tariffs, but also the uncertainty around it that you indicated, is not helpful if you're thinking about where to expand, where to build factories, where to export to. So we expect this to weigh over the region, especially the more export-oriented economies, of which there are quite a number, of course, in the APAC region.
Yes, the uncertainty and therefore the problem with investments, problem for investors. Sameer, what about the impact on the US itself? The latest numbers we saw didn't look all that bad. I mean, even if you looked at inflation, it was not way higher, it was higher enough for for the markets to remove the expectation of any cut anytime soon. Do you think the tariffs are going to show by way of higher inflation in the US sometime soon and therefore prevent the Fed from any rate cuts at all this year?
Hi, morning, Lata. No, so indeed, I think one of the interesting facts about data has been the US economy has proven to be a lot more resilient, even to all this level of unpredictability and the threat of higher tariffs. Now, part of the story could well be front loading. I mean, everybody is fearing those tariffs to go up and therefore exporting rather rapidly to the US. I think it's keeping up sort of general activity levels a lot better. But it is true. I think this high uncertainty around the tariff policy, we suspect will bear down on growth in the second half. Part of the equation has also been how easy financial conditions have been. Financial conditions in the US are right now easier than they have been since sort of early 22, and which has probably been part of why this resilience come about. The consumer balance sheets fairly clean, firm capex plans. Yes, I think sentiment has been weakening, but nowhere near about as large as one would have expected, given how big a shock to the global trade order the last few months have actually proven to be. Still, it's on watch. I suspect second half there will be payback to that front loading and a lot of trade activity. Our view in the House is that growth will slow down. I think we will avoid recession, but growth will slow down in the US. Now, as far as the Fed is concerned, our view is they'll probably only be cutting rates by December of this year. Risks are maybe more two-sided, but I'd argue it will require probably a lot weaker labor markets for the Fed to trigger rate cuts earlier than that.
Okay, then let me just finish the Indian or the Asian situation. We have never seen this kind of rate differential between India and the US. What does that mean for the Indian currency? Do you think that there could be appreciation bias on Asian currencies in general and India?
So I think there's a little bit of a difference. I think India has a bit of a unique position within Asia. So like you said, there's a common factor, which is the rate differential. And absolutely, the rate differential argues a lot more in favor of the US at the moment. I mean, the differential is fairly wide. And on top of it, given how low inflation is in bulk of Asia, including India, the bias should be for, in a way, that differential to at least sustain at these levels, maybe even widen, depending upon how quickly central banks in Asia actually cut rates. The other factor, though, besides rate differential, which is driving, in my view, the currency markets, is, of course, this sort of lessening appeal, the safe haven appeal, if you might, of the dollar, or the willingness of the rest of the world to be able to invest in US assets or recalibrate the exposure they have towards the dollar. And that's something which I think is far more better looked at from the metric of net international investment position. Now, that's where India differs a lot. A lot of Asia is surplus on its NIIP. India isn't necessarily, so it doesn't necessarily benefit from the same factors. But for a lot of the rest of Asia, I'd say the fact that the investment community is not willing to necessarily at least incrementally add to its dollar exposure and probably willing to convert a larger part of its dollar stock holdings into local currency itself lends more of an appreciation bias. I think India is a bit of an exception on that front, but certainly for rest of Asia currencies, our bias is to think for more strength in the second half of the year.
Okay, more strength for other Asian currencies. Rupee perhaps will move both ways. I'll come to your view on the dollar itself in just a minute. Chetan here has joined in. Welcome to the show, Chetan. Well, I wanted to begin at the beginning. You know, as we explained at the start, we are living with 10% import tariffs for the US and 50% for steel and aluminium. But the rest is a whole lot of threats. Nothing has been implemented just yet. What does this mean for EMs? Does it mean that you can actually push up your growth forecasts or no?
Well, not really. I think, Lata, I think not only this the new announcement, but the ones which were announced earlier are also still not yet reflected in the growth data points that we are watching across the region. The reason why there is a lag is because when you think about the tariff impact, so the tariff impact has also been delayed because stuff that gets imported into the US, if it is shipped on a particular day, which is right before the tariff is imposed, it does not attract that tariff on the US shores. And so that is, if you look at the US customs data, weighted average tariff in the US has increased to approximately 10%. But when we do the actual math of what is the weighted average tariff rate based on what were the import values last year, and then what is the tariff imposed on different countries, and that number is 13.5%. So tariff itself has got delayed in terms of actual collection because of the way the accounting is done. Plus, you have the other challenge, which is that, you know, corporate sector has taken a decision not to invest in future projects, or if they have taken that decision not to invest in the future projects, that impact also takes time to come through in the numbers, because right now we are still implementing the projects which were announced earlier. And so the investor base has suddenly got that sort of sense that, oh, tariff doesn't impact US inflation, tariff doesn't impact corporate margins, tariff is not going to be an issue as far as the CapEx decision is concerned. We don't agree with that. We think all of this impact is in the pipeline, and we're going to begin to see that from the third quarter of this year. And for Asia specifically, we are saying that, you know, the CapEx numbers for July, August, which we will be measuring very clearly from the capital goods imports data, which is a high frequency number. And that's what will actually come through. So, and the new announcements are only going to make this whole downtrend that we are building in either more confirmed, or you'll probably see more downside out of additional tariffs.
Okay. Well, I have a lot of questions on then EM growth for you. But, you know, specifically with respect to India, Chetan, see, the big expectation is that we will not be taxed as much as, say, Vietnam or Bangladesh, that we would be, you know, taxed less. Probably we already have a 10%, maybe it would become 15 or 20. Will your forecast of India's growth be very different from what it is now? If it is indeed 15 or 20, let's work with those numbers.
Look, I think the biggest impact that we have been referring to is the point on global trade and global CapEx. and consequently also India's capex trajectory. And that part of the impact is more connected to this uncertainty that has been created on account of tariffs, which is going to remain. I mean, if the global trajectory gets affected more because of the new tariffs, and therefore India's exports or also Indian corporations' confidence on their export demand outlook, that part is sort of independent of what tariff specifically is imposed on India. I think if that higher tariff is imposed on India, then it takes away that offsetting demand which we would have expected India to get through, because India's tariff is less, other Asian trade partners' tariff is higher. Then you could have said that the exporters in India would benefit and they would market share. So that's the only bit which will be sort of taken away if India's tariff rate is similar to other regional players. Like we've heard Vietnam's number at 20, and if India's number is 15, then that gap narrows and it reduces that market share gain potential that Indian exporters would have had.
So what you're saying is that it's a very small needle that moves if India is indeed able to strike a deal at 15, because in any case, the rest of the world will slow because of the uncertainty and, the higher tariffs that the others are suffering, correct?
Yeah, if I may summarize it better, it's a global beta effect, and there is also an alpha story, right?
Yeah.
So that alpha story is a small proportion. I think the beta is a bigger important story. If there's a global slowdown, global exports slow, then it will be hard for India to avoid that downturn.
Okay. Louis, a similar question to you, actually. Where are you all in terms of, pitching the growth story in Asia in general, but more particularly for me, India? Will the deal make a very big difference to your estimate of Indian growth?
Well, so these are almost two different stories, right? The general EM Asia story and the India story.
Okay.
Our India story is also, of course, picking up the fact that after a soft patch last year, the recent data on India has been better, so we have become a bit more optimistic on the domestic side. And in an economy like India that is so large and where the domestic side is so important, that really matters. And so I would say, I think if I recollect correctly, our latest change to the India forecast was moving up because of that better domestic momentum. That having said that, more generally, our story on EM Asia, and that kind of includes India, has from the start been like we should not underestimate the impact of those US tariffs and all that uncertainty that my fellow speakers have also talked about, how that is weighing on investment decisions and economic activity. And so we've generally been a little bit less optimistic, if I use the word. I've heard quite a few economists talking in recent years about looking who are going to be the winners in Asia, the countries that will benefit as supply chains are shifting. We have been a bit cautious on that. We have felt that given all that uncertainty, and if your neighbor's tariff is 20% and yours is 15%, is that really going to drive an investment decision that is based on many other factors as well? So we've been quite careful, and we've also been noticing that actually, if you look since the first Trump administration of quite a while ago, overall FDI into Asia in US dollar terms has come down rather than up. And so I think the general story is not really a good one. And trying to find relative winners is, I think, not the most important or not the most worthwhile effort. Generally speaking,
I get your point. You're basically saying what Chetan put it as, the global beta is more important and the alpha is for India will be, lower. I take your point.
But I would say, Lata, like the global story is important, but Asia is a relatively trade-dependent part of the world, right? And so that's why we have become particularly less bullish on the smaller open economies, be they Thailand, South Korea, these types of places.
Fair point. And maybe that's the blessing for India. But Samir, I want to get to the dollar. You brought a very important point to the table that large parts, many countries in Asia are not interested anymore in, buying US assets, especially US treasuries. Now, where do you see the dollar, therefore? There is the big, beautiful bill, and there is the demand side as well. Supply also is against US yields. There'll be too much of it. And there is less demand. So your trajectory for dollar and US yields?
From my perspective, I think it's very hard to be bullish on the dollar at this point in time, right? I mean, first and foremost, I mean, the twin deficits are bearing down on the dollar fairly significantly. We are probably running a current account in the US is, I would argue, probably close to 4 to 5%. This tariff policy hasn't really made much of a difference, though obviously there is a front-loading impact and we need to see payback to that. But at these levels of the current account in the past, the dollar has been materially weaker over a 1 to 2 year period. The other way to look at it is, of course, increasing pressure on the Fed to also ease policy, which could ultimately also take away that rate differential support, which you were earlier speaking about. But probably what is most critical, I'd say, is the fact that ultimately the global appetite to invest in the dollar is just a mirror image of the trade gap the dollar runs with, the US runs with the rest of the world. And to that extent, a shock to the global trade order will eventually also result, as it has been for the last couple of months, on the rest of the world's appetite to own US assets and to be able to fund that US deficit. Now, the US is sitting on a net international investment position which is negative to about 80-90% of GDP. Even if that were to try and revert back to some level of historical norm of about, let's say, 60%, that would still require potentially material dollar weakness from here. Now, the dollar obviously has that safe haven exceptionalism, so it's hard to be able to look at just historical trends to see how much that correction would be. But it's not obvious to me at all that, particularly with the current set of policies, that the global appetite for the safe haven appeal of the dollar is necessarily going to lend to the same level of financing of deficits.
I will have to stop you for a moment because we have to take a commercial break. But coming back with more specific, requests for growth targets as well as currency and yield targets. Back in a minute for Bazaar viewers, of course, it will be Chartbusters time.
TCS constant currency revenue declines in a weak first quarter. The management also points to delayed decision-making among clients. The stock slips over 2%, recovers from the lows, but drags other IT stocks lower as well.
Glenmark Pharma signs a deal with AbbVie to out-license its myolopa drug, ISB 2001. Glenmark will receive $700 million as an initial upfront payment, which could rise to around $1.2 billion. Glenn Saldana tells CNBC-TV18 that they will commercialize the product in India and emerging markets. The stock is locked 10%.
HUL is the top Nifty gainer, up nearly 5% as Unilever veteran Priya Nair takes over as MD and CEO from Rohit Jawa, who has stepped down from his post.
Shares of IRDA slip 5% as the company reports a sharp rise in the gross NPAs in the first quarter, part of which was due to recognizing Gensol Engineering as an NPA. The management tells CNBC-TV18 that they are confident of resolving the Gensol issue.
Shares of Z Entertainment trade lower, down nearly 4% as shareholders reject the proposal to issue warrants to promoters.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel. With me is Mangalam. And as we speak, actually, the markets are at the low point of the day. The Nifty is down 140 points or thereabouts. The Nifty Bank, that was showing a relative outperformance, that's now down 240 points. And the mid-cap index is down a full 500 points. Remember, in the last 1.5 hours or so, we've seen the Nifty actually try to pull back. It was down close to around 30 points. But from there, it slipped yet again. So interesting times. Let's see how this goes. Hey, Mangalam.
Hi, Nigel. Yesterday as well, through the course of the day, we ended lower and we actually ended at the low point of trade, even though on an absolute basis, the decline wasn't as much. But this morning, the only thing we'll watch out for whether the Nifty goes ahead and closes above the 20-day moving average, which is close to 25,250 thereabouts. So that is an important mark that I'll watch out for. But by and large, we do have a bunch of stocks which are doing well, and all of them actually belong to the consumption space. So if you look at something like, Gillette, which is picking pace. We have VIP, which has been buzzing around for the last few trading sessions as well. And we have a bunch of other consumption names, and not to mention or not to forget mentioning HUL. Remember, before this announcement came back in the last 5 years, the stock had gained just 8%. And today, on day one itself, it's done about 5% of that. So the street will be keeping an eye out on what Priya Nair brings. But remember, the underlying macros of the consumption space are improving. So with an added leader impetus and an underlying macro improvement, aided with the stock not having done much over the last 5 years, could perhaps be an important trigger or an inflection point to watch out for Hindustan Unilever. We're also seeing some traction in Asian Paints, which too has recovered a fair bit from lows, and Interglobe Aviation continues to do well this afternoon. Let's talk about Anand Rathi Wealth. However, the street is cheering those numbers. The company has maintained its trend of delivering strong growth in the first quarter. They've also achieved 88% of its guided AUM for FY26. Firoz Aziz, who's the joint CEO of Anand Rathi, joins us now. Firoz, you want to revise your guidance? 88% you've achieved in the first quarter itself, with 3 quarters to go.
Good morning, Mangalam. No, ideally the AUM number has a lot of external variables, so we will not take chances and disappoint our shareholder at the end of the year. So we'll keep the 1 lakh crore AUM mark as the guidance. Out of the movement from the from 31st March numbers, we've seen about highest ever net mobilization, and market has also given us something. So I think to answer your pointed question, no change in the guidance. All 3 parameters, revenue, PAT, and AUM. But yeah, there seems to be a case of a AUM guidance revision, but we will hold our horses because we want to undercommit and over-deliver.
Can you split that? How much of that was because of external factors? How much of that was because of internal control?
So we added the highest net mobilization, which is net mobilization, by which in Anand Rathi's nomenclature, net mobilization is very microscopically looked at. We don't count if there's somebody holding a tax-free bond. We don't count that. So that's about 3,800 crores of net mobilization in spite of the uncertainties which the markets had.
Got it. All right. Hi, Feroz. Good to see you in. Your cost to income has dipped by around 570 basis points on a quarter-quarter basis. Any one-off out there? What's the sustainable number you're looking at?
Yes, Nigel, of course, there is some degree of operational efficiency which has come in the first quarter. But I don't see any further cost-to-income ratio reductions because we like to reinvest in the business. As you would have heard me see in the last 14, 15 quarters, we've been doing the results. We've always been saying we're going to reinvest our monies and not look at operational efficiency at this stage of our business. We believe that we're not even the first stage of a company's evolution. So not too much should a shareholder expect in terms of operational efficiency, because if we reinvest is when I can consistently grow at about 10, 15 years. Nigel, I think I should definitely highlight to you in the NSE Small Cap 250s, whom we are a constituent of. In the last 3 years, we checked how many have given a bad guidance and met it. We are the only company in NSE Small Cap 250 who has given a bad guidance. Of course, not all of them give. So we want to make sure this statement I'm able to make when I'm 60. So that's why we'll reinvest.
All right, you will reinvest. On the RM front, I have to ask you this, because the last couple of quarters that we've had these conversations, you've been aggressively adding RMs. This has been a case over the last 5 to 6 quarters, if I remember correctly. Now, the last quarter was just 2 additions that we've seen, from 380 to 382. That also has led to some improvement in operational efficiency. Do you think this is a number that you will maintain? And given the sort of rush that there is for relationship managers in the industry, you will hold your horses because you have enough?
Mangalam, like you rightly said, you very clearly, rightly noticed one of the lowest number of RM additions. We had let go of a couple of RMs as well. Because of some issues, but our attrition is near 0, 0.1. 0.2, we've like you said, in the industry, there is so much demand for private bankers or relationship managers, whatever nomenclature we want to use. But we have believed that we have to internally build them. If I buy a relationship manager from somewhere, it is but obvious somebody else will pay him 30, 40, 50% and then take him away. So if you want near 0 attritions, you have to have at least 70, 80% of your RM fraternity internally trained. And that's what we've been doing from 2015-16, when we realized that this hypothesis that building a wealth management business by hiring RMs laterally is not a great hypothesis. So we started investing in this model in 2016, December 2015 to be precise. From there, today, 83-84% of my RMs are from internal trained. Some are from IIM, some are rank holder CAs, some are from modest colleges as well. But we internally train them and keep a cultural fabric intact. Is why our attritions have been low in an industry where attritions are not being able to be curtailed.
All right, a pitch for the team as well there, Feroz. I've interacted with some of them and they're quite happy and quite upbeat on prospects going ahead as well. You keep them fully motivated and keep them on their toes. Good on them. But you're also looking at expanding operations abroad, Bahrain, UK. There's an opportunity you mentioned in the past. So say in the next 3 to 5 years, what would the contribution to the flows, financials from operations as well term up? Because there is a big market out there.
Nigel, I personally believe, like you rightly pointed, there's a huge market out there. See, capital searches for growth. And I think global capital, NRI capital, will look for growth. And I think they will not be able to ignore India for far too long. We are very upbeat about our prospects, like Bahrain and UK. We have a Dubai office, which has done beautifully well so far. So I think I'm very, very positive, but I would not want to comment too much in terms of what business from an Anand Rathi standpoint. But I think I was in Paris for a conference where there were about 1,000 professionals from the globe, where I go every year. The kind of enthusiasm everybody has towards India has dramatically shot up over the last 4 or 5 years, especially post-COVID. So I think we want to be making sure that we lay our chips at the right place, build it. The AIF models or the Gift City models and the AIF freedom which Gift City provides and dollar investments with no problems of repatriation, the tax benefits for a corporate, the tax GST benefits. I think all of this put together creates a very strong case for wealth management outfit to not look away and build the foundation for a robust international business.
You briefly alluded to Gift City. Have you made a decision there?
Mangalam, not as yet. Of course, one of our group entities has had some experience in terms of taking licenses, so that we are borrowing in terms of their understanding, but you will see some action very soon.
You also mentioned Paris. I wondered whether you were in Paris right now or not, because there's so much greenery around you. Where exactly are you joining us from, out of curiosity?
No, I'm joining in from a resort in Bangalore. One of my friends' birthday was but I was
wonderful way to
Paris during the storm. So
okay,
hardly any greenery.
You don't want to disappoint shareholders by over-guiding and under-committing or over-committing and under-delivering and all of that and stuff. But you did give them a bonus last year. There was a buyback. This year, what's the plan? Is there another bonus in the offing? Is there another buyback or maybe some dividends coming in? You're enjoying the party in Bangalore. What about your shareholders?
Yes, Mangalam. See how we look at it. I'm telling you with no holds barred, as transparently as possible. When we discuss, we say after bonus, our dividend, we gave 14 rupees. Can we maintain that in spite of a bonus? That's the target which we have. So every time I give a bonus, I want to keep 14 rupees as a dividend on expanded number of shares. That's the aspiration. Point one. Buybacks, of course, we did buybacks that gives tax efficient payouts, that used to give tax efficient payouts to our shareholders. Bonuses, I think the frequency, as far as if I have to tell you as transparently as I could, good. Yet please don't hold me to it. Every couple of years, 2 to 3 years is what we internally discuss, but that's not a guidance. I'm just telling you exactly how we discuss amongst us as professionals.
All right, Feroz, SEBI has proposed relaxing Regulation 24B and may allow mutual funds to offer investment as well as advisory services to non-broad-based pool funds, which requires a separate PMS license now. What are the kind of implications on your business if this goes through?
Ajay bhai, if you look at regulation is creating several very, very effective vehicles for a manager and a client to pick and choose from. So do I welcome this move? The answer is a big yes. See, now you have the special investment fund in the mutual fund category. You have the mutual fund, special investment fund, AIF, and the PMS with further expansions of the PMS gamut. So to answer your pointed question, does it impact business? Not from a revenue standpoint. Does it help everyone to understand what their capability is and what my client need is and be in the daira of regulation? The answer is yes. So I'm so happy with the canvas expanding and limiting factors are so low. Now, if you see AIF allows you 2 times leverage, allows you covered calls. If you look at SIF, allows you covered calls. Mutual funds have a limit on it. So anywhere you want to go, there is no bahana to do direct derivative or stock. For most investors, if they want risk-adjusted return, they have to come into this gamut. If they go mathematically, there will be no merit left to do direct equity together and derivatives separately, like most people are burning fingers. So I think I love the way regulation is shaping up, and the first July circular of derivative, where we move from notional to delta, is something which is path-breaking for the derivative markets, which will show up in the next 3, 4, 5 months.
Let's see how that shows up for the industry, but more importantly for your numbers as well. For now, we'll let you go enjoy the party that you are having in Bengaluru. Your shareholders rejoicing with these numbers. Look forward to having you on some of the personal finance shows as well. Feroz, thank you as always for discussing the business. We take a short break. On the other side, we have the management of Bellrise Industries. Sumedh, who's the promoter, joins in for a business outlook. Stay with us.
startup universe to becoming a success story in itself as India's longest running show on startups and entrepreneurship.
Welcome back. Well, Belrise Industries, that's the next stock on our radar. Brokerage firm Jefferies recently initiated a buy rating on the stock. They're expecting the company to deliver strong growth going ahead. Sumedh, the promoter of Belrise Industries, joins us on the show. Hi, Sumedh. Thanks a lot for joining in. Well, tell us, how is auto demand first on ground? How's it looking for you? And also, if you could give us a sense about what is your current content per vehicle and how do you see that move in the years to come? What's the targeted number? Please go ahead.
Sure. So firstly, demand-wise, from a two-wheeler industry, the monsoons are good. Looking at positive directionally there. So that's a good sign. And largely, India is a growing economy. There's upward mobility from people who are buying two-wheelers to now buying four-wheelers. So that transition is also happening. And the tax cuts that the government sort of brought in for the general public at large, that is also supporting good directionally again in terms of good demand. Now, with respect to content per vehicle, yeah, sorry, you had a question?
No. We want you to go for that itself. Content per vehicle. Go for it, Sumedh.
So from a content per vehicle, we're about, in the two-wheeler space, we're at 12,500 rupees. And over the years, with addition of new products and increasing content per vehicle across different OEMs, we expect to go to about 17,500. In the four-wheeler space, we're about 25 to 30,000. And we expect that to also increase to 45,000 in the coming years with in due course with increasing content per vehicle with our additional products.
All right, 20,000 goes all the way up to 45,000. What's the update on the recent acquisition of H1? Sumedh, when you had joined us during the IPO, you said that four-wheelers will be a big driver for your business going forward. It's close to around, what, 11-12% of your overall revenue right now? Where do you intend to take that?
Yeah, in the four-wheeler space, we're about at a four-wheeler commercial vehicle space about 12.5%. The H1 acquisition is coming along really well. Good integration that's already taken place. Teams are working together very well. We're very fortunate that one of the main facilities, which is in Rajasthan in the Bhiwadi Tapukera area, is only a few kilometers away from our existing facility there. So big benefit in terms of management and synergies on that front. And the second facility is in Greater Noida, which is also fairly close by. We have good operation in the north. So from a manager's perspective, it's doing pretty well. And we expect to increase that and we expect it to positively add to the four-wheeler revenues going forward. And over the next 2.5 years, we see strong growth in the four-wheeler industry for us specifically. Outperforming our growth in the two-wheeler space because we already have a strong presence and a market leadership position there. So a larger base. With a smaller base in the four-wheeler industry, we expect that to more than almost double in the next 2.5 to 3 years.
So you expect that proportion to double in the next 2.5 to 3 years. You said that it's likely to grow faster than your own growth. You expect your own business to grow faster than the two-wheeler industry and your four-wheeler to grow at 2x the pace of two-wheeler, right?
So we expect so it's currently at 12.5% in the four-wheeler commercial vehicle space. We expect that to double over the next. So we expect it to go 2x the speed in the four-wheeler industry as compared to the two-wheeler industry. Yes.
Okay. All right. A quick question though. You said that the current content per vehicle is 12,500 and that heads to around 15,000. Is that correct?
Upwards of 17,000.
Upwards of 17,000. All right, 12.5. And this is over how long?
In the next about 2 years.
Got it. All right. So that's
sorry. I'll one clarification. Yes. In terms of what I want to say is from a INR crores value in the four-wheeler industry, we expect that in terms of absolute value should double in the next 2.5 or 3 years.
Okay, absolute value should double. Got that. Okay. All right. Also, the industry has been facing some issues with the rare earth magnet issue. Mm-hmm. Any impact on your business?
So obviously, if the rare earth metals impacts the industry, there would be some cascading effects. But we believe that it is the automotive industry is a big contributor to the Indian GDP. The government has eyes on making sure that this is taken care of, and we believe it will in a short span be taken care of with all the forces in the right direction.
That hasn't impacted your end user demand, right? How much of your demand is contingent on the rare earth availability?
So we have whatever the so largely your magnets and your rare earth metals are used in the EV industry, to an extent also in other ICE vehicles to an extent, but largely it's not impacted us so far.
And your EV contribution is how much? What proportion of your revenue is, what do you say, platform agnostic?
So we're significantly platform agnostic. All about 70-80% of our product portfolio is essentially powertrain agnostic. So as a result of that, we believe there'll be not a major impact because of that.
Okay, all right. Basic numbers before we let you go, Sumit. You're giving us a very bright outlook in the time to come. And since you've raised money via the IPO, a brokerage firm is talking about you turning into a net cash company from being a net debt company. They're saying by FY28, you could have net cash of 600 crores. Possible?
I cannot comment on that.
All right.
But it'll be net cash. I mean, that's for sure, right? Because your debt reduction has already taken place.
What I can comment on is what the debt reduction has, what we have already achieved. We have we raised 2150 crores from the IPO, which was a complete fresh issue. All the money came into the company. Out of that, 75% was earmarked towards debt repayment. So about 1600 crores of debt is what we've already repaid. So now our debt position stands at net debt stands about at 1,000 crores. So
net debt is at 1,000 crores. And what the repayment schedule there?
The debt position is about 1,000 crores. Sorry.
What's the repayment schedule for that one?
We'll continue to service debt. It's a very comfortable position that we stand at. If you look at our at our debt to equity position before the IPO, we were at a 1:1. Now we've come down to about 0.2 to 0.3, and based on debt to equity ratio, I think we're at a comfortable position. So through internal accruals and through repayment, we'll be able to maintain that.
Take that point. Thank you so much, Sumit, for joining in. Wish you good luck for this year and the years after as well, with you looking to increase your proportion coming in from the four-wheelers, increase your content per vehicle and improving your balance sheet further as well. That's Bellrise Industries. Did well over the last few trading sessions ever since Jeffries wrote on the company, and now as well post the management commentary we've seen a bit of a spike on that stock. Take a short break. As we do that, we'll tell you about CNBC-TV18 Prime, which brings you insights from policymakers, business leaders and economists, all of them shaping the world and India's future. CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses, gives you unparalleled insights. Tune into CNBC-TV18 Prime at 12 noon daily for the Global Reset, at 1 p.m. for the Big C, and Global Lens at 8:30 p.m. on weeknights.
Welcome back. Markets at the low point of the day. We're 180 points lower. HDFC Life that was holding in the green, that's moved into the red. Bajaj Auto as well. And Hero MotoCorp. All those stocks struggling in today's trading session. Well, on that note, we'll wrap up with Chartbusters. You stay with us. Trading Hour comes up next.
Good morning. Welcome to Trading Hour live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me, as always, Hormis Patakia and Reema Tendulkar. Hey guys, happy Friday to all of you. But looks like for the markets, it's a day of further fall. In fact, we fell below that 25,300 mark yesterday, 400 mark yesterday. Today we are below that 25,200 mark, and in just last couple of minutes we are at the day's low. So Nifty is down around 190 points. We have mid-cap seeing cuts of almost 600 points. Bank Nifty down 0.5%, and this week itself we have seen Nifty declining by around 1.1%. We have seen mid caps down, but IT space, of course, you'll talk about it in greater detail, Reema. That's the top loser in terms of sectoral losers, and PSU banking index as well, not doing so well. So looks like the consolidation theme that we were talking about, that's done with, and now markets are like, we are done with that consolidation and range bound phase. Let's show some colors.
Indeed, it's given way to weakness now, because week to date, the Nifty is down more than 1%. The mid-cap index is a cut of nearly 2%. It's a twofold problem, right? One, of course, weak start to the earnings season with both TCS and Tata Elxsi disappointing the street, and even something like an IREDA, right? Maybe it's a one-off on account of Gensol, but there was a miss in terms of asset quality. And secondly, even, this tariff uncertainty is still lingering on. More than 20 letters have gone on. The start date is going to be 1st of August, but it basically means that from now to 1st of August, the negotiation is going to continue. So it's just this extended negotiation period has also prolonged the uncertainty, for our market. So it's now looking quite muted.
Well, Friday fever, if you could call it that, for
I thought Friday fever was positive.
No, fervor was positive. Friday blues, if you would like to call it.
No, we have to keep.
Sorry.
I think Hormis has spoken. It's Friday fervor means positive. Friday fever means negative. This is it.
We'll go with that. But it's nothing different for the mid-cap index as well. Actually, that's bearing the brunt of the bigger sell-off here. 650 points lower on the mid-cap index, and predominantly led by the earnings reaction that has come in on stocks like Ireda. Stocks like Amber Enterprises also not doing fairly well for themselves. And most of these capital market names are taking a bit of a beating today. BSE down almost 3.75%. CAMS is down close to 3.5%. So CDSL too down around 3%. So it's not been a very good week for a lot of these capital market names. Same is the case for these defense names. They were down yesterday. They are down further in today's session as well. BEML down 3.5%. Data Patterns down 3.5%. Garden Reach down 3% as well. So it is defense, it is capital markets, all of these movers, the outperformers of the first half, seeing some bit of selling pressure now as the markets are moving lower. Now, in fact, the Nifty is now heading towards the 25,150 mark, comfortably below that 20 DMA that it earlier managed to defend and then moved higher. But then that recovery has been very swiftly sold into. But as Rima was highlighting, two poor earnings numbers came out, one from TCS, the other from Tata Elxsi. And the Tata Elxsi number is not spoken about in greater detail considering the focus was on TCS.
Yeah.
But it was a very disappointing quarter there as well, Rima.
Indeed, and just I think the stock price over the last couple of, I think now 3 years is telling the story. The all-time high on Tata Elxsi is 10,760, and now we're sub 6,000. So it's been a sharp fall. In the last 3 years, the stock has given you a negative return of 27%. So basically 3 years, you've not made any sort of a return. But what has happened is that in the last 3 months, the stock had started outperforming some of its peers. So in the last 3 months, Tata Elxsi, even after today's fall, is still up nearly 23%, which is exacerbating the fall. Now let's get to the reasons why the stock has been weak. One, of course, this was the 4th consecutive quarter of a miss. Revenues are down 9% on a year-on-year basis. Secondly, revenues over the last 3 years have materially fallen. When the stock hit those all-time high levels, at that time, the revenue growth rate of the company was close to about 34-35% thereabout. It's been slowly declining, and now in the current quarter, both Kotak and Morgan Stanley are anticipating a revenue drop. This year, Kotak is also a negative. It's a decline of 4.6%. It basically means that it's going to be a negative year of growth of nearly 4%. So, that's disappointing. And then, of course, valuations are on the higher side, as we've been highlighting. Despite the correction, it's still trading at 42 times. It's just that at its peak, revenues were growing at 30-35%, and the stock commanded a valuation premium of about 60-65 times forward multiples. So earnings are getting compressed now, and valuations have gotten derated. But still, analysts say 42 times is very expensive for a company which is going to give you negative growth this year.
That's right. Growth is compressing, and that's the major concern.
Minus 4% is the estimate on the top line, right? So it's not even like,
growth,
some growth.
single-digit growth.
A single-digit growth. It's a
decline
this time.
Okay, explains the move that we're seeing on Tata Elxsi, and in the month gone by, it's down 11% already. But Hindustan Unilever, that has seen a big change, announced the appointment of a new managing director and CEO. This is effective August 1st itself. Mangalam is joining in now, and he'll be talking about what is happening and how's the stock reacting.
Well, it's a big change and a big stock price move. Just for perspective, the last 5 years, the stock gave you 8% returns. And just on this announcement, the stock is up nearly 5%. So it's doing what it hasn't in the last 5 years in just about 1 day. What exactly has happened? Rohit Java, it's a surprise that he's stepped down as MD and CEO within just 2 years of appointment. So that's one of the shortest stints for a leader in HUL. And this, he says, is to pursue the next chapter in his personal and professional journey. Remember, the last 2 years from a macro standpoint have been very, very weak from a consumer sector perspective. And that's reflected in the kind of numbers that HUL has also reported. It's been fairly tough. But importantly, now the leader is Priya Nair, who has been appointed as MD and CEO to succeed Rohit Java. She's currently the Executive Director of Beauty and Wellness for Unilever, Beauty and Wellbeing, that is. And she's been a Unilever lifer. That's how most Unilever leaders are. 1995 is when she joined HUL. She's known for digitization, premiumization, and brand building for the home care business in particular, which saw a fair amount of growth. And while she was in Unilever Global as well, the premiumization play really happened. Priya Nair is the first woman CEO of HUL. It's the first time, but also I think about time, given the sort of leaders that they've spawned in other companies as well. Prabha Narasimhan is ex-HUL, Geetika is ex-HUL, who's currently the MD of Nivea, and you have so on and so forth as well. So now the question is, from here on, what the focus will be for HUL on. most important will be on recovery in volume as the consumer sentiment is turning. Now, because she's been leading, beauty and well-being, and that's been called out as a macro trend for HUL in India and Unilever as well, how that business grows is something we'll be watching out for. And finally, we'll watch out for innovation in foods portfolio post the ice cream demerger, because that portfolio hasn't done well ever since the Horlicks acquisition has taken place. The stock has done nothing over the last 5 years, but in the prior 5 years had moved nearly 4 times. So can this be an inflection moment for HUL or not is the big question we'll get an answer to.
First time, but about time.
About time. I love it. Yeah.
That's the more pertinent takeaway from that.
HUL was established in 1931, which means it's taken it 94 years it's nearly a century to get its first woman CEO.
Well, times are changing and hopefully changing for the better as well. It was woman CEO and after 92 years for HUL. Of course, it's showing up in the price as well, 5% higher on that stock. But from losers to gainers and back to losers, then the other one being Z Entertainment. And that stock is under pressure today. The company's plans to raise funds hit a roadblock, and Vamakshi is here with more details on that. Vamakshi, well, the proxy firms had advised doing so, and the same has happened.
Well, absolutely, the shareholders have gone ahead and actually listened to what they had to say. The special resolution, which was to approve issue of convertible warrants to promoters, failed to get the requisite majority. When we look at the number of shareholders who voted in favor of this, stood at 59.5% and 40.5% were against it. Now, to pass a special resolution, minimum 75% votes need to be passed. So therefore, largely the resolution was defeated in the special meeting that was held yesterday. Keep in mind, like you pointed out, earlier 3 proxy firms, IIAS, SES, as well as InGovern, had recommended voting no to the issue, and some of the key objections revolved around the rationale behind the fundraise, given that the company already had 2,410 crores sitting as cash on the books. Apart from that, there were also concerns raised with respect to the choice of the financial instrument, which is the convertible warrants, and that in turn would have led to almost 15% dilution for the non-promoter shareholders. Resultantly, given that the resolution was defeated, the promoter shareholding will still stand at 3.99% as compared to 18.39% is what it would have stood at if this was given the go-ahead. So negative news flow for Z Entertainment, the stock down in afternoon trade today.
All right, yes, and we had an interview or a conversation with the proxy firms as well. They actually advised shareholders against it, and that's actually gone ahead and happened as well. So the stock is down 4% as we speak. We'll sip into a short break now. Up next, we'll discuss what's buzzing in the commodity space with Manisha Gupta.
Welcome back. There is plenty of choppiness in the markets. In just a few minutes, we've seen a 150-point move on the Sensex from the day's low. The Nifty 2 at one point was down almost towards 25,150 and has seen almost a 60-point recovery from the lows of the day. But shifting focus to the commodity space, but more than Bitcoin hitting a record high today, the bigger occasion is that the OG commodity champion turns a year younger, and Manisha Gupta is here with us. Manisha, very, very happy birthday to you, and it is only apt that it is on your birthday that Bitcoin has hit a record high. Tell us
And
more.
silver as well.
And silver as well, of course, yes.
Okay.
And copper too.
Are we missing out on anything? Just tell us.
Well, thank you so much for that. I will start with Bitcoin, though, because this is where the major action seems to be coming now. You know, when I woke up in the morning, Bitcoin was trading at 116,000, and it was an all-time high. It walked up to 117. It's almost at 118,000 at this point in time. So it has been a very strong gain that we've seen happen in Bitcoin. In this year, until now, we are up by 26%. When you look at the last 12 months, we are up by 105% for the Bitcoin in sense of prices. So very strong gains coming in for there. Well, remember, this year started on a very, very strong note. Institutional demand, ETF inflows, corporate adoption, all has been supportive. And add to that on what US really has been doing in sense of making crypto coin friendly regulations. And we do understand that more supportive policies from the Trump administration can be expected going forward from here. Very interestingly, the Trump media and tech group has filed actually with the SEC to launch crypto ETF. Now, Trump media and tech group is going to be the 6th company which is filing for a Bitcoin ETF. Remember, we've done billions of dollars of trade since the time the Bitcoin ETFs have launched. And this is the reason you've seen institutional investment or money flowing into the Bitcoin markets there. Also, Crypto Week begins from 14th of July, and the expectations are that you could be listening to various high-profile statements, some more regulatory push as well, some more crypto papers could be coming in from various countries, and that is something that crypto as a market would keep an eye on. What led to this very strong run-up in the day today has been the shorts being wiped off. We do understand from various reports that nearly $1.13 billion in shorts has been wiped over. This is the biggest liquidation that you've seen in a matter of hours, the biggest that you've seen in 2025. The data also shows that nearly 237,000 traders were in the short, and 90% of overall trade was in the short. So clearly, not too many people were betting on higher highs, at least so early right now, and they were looking at prices perhaps going below a lakh as well. But that hasn't happened, and the shorts liquidation is what has led to prices running up at this point.
Okay, take that point. But Manisha, it's Friday, it's your birthday. Bitcoin is hitting a record high. I think all these factors, we need a party.
Done deal?
That was so easy. I didn't have to convince you. I'm so glad. Okay, thank you, Manisha, for joining in and wishing you a happy birthday yet again. But with that, we'll slip into a short break. But remember to tune in to the all-new CNBC-TV18 Prime, bringing you insights from policymakers, business leaders, and economists shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune in to CNBC-TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and Global Lens at 8:30 p.m. Welcome back. You're still tuned into Trading Hour. Let's get a conversation on a particular sector, that's the specialty chemical space. In a recent report, Kotak Institutional Equity says they anticipate mixed results amid continued industry-wide challenges as the overall supply-demand scenario in the world chemical industry remains unfavorable. To discuss more on this, Abhijit Akela, who is an analyst at Kotak Institutional Equities, is joining us now. Abhijit, good morning. Thank you for joining in. Well, you know, the conversations that we've had with corporates, they were indicating that maybe demand is coming back now. Your note says it's going to be a mixed set this time. Can you explain what are the reasons? Is it going to be a volume-led recovery, if at all? What's happening with pricing and demand now?
Sure. Good morning. I think while there is some improvement in results across a set of companies in the past couple of quarters, that seems to be stemming from the fact that there's a very easy base effect from last year. In addition to that, there's probably been some benefit from tariff-related front-loading of orders coming in from the Western geographies. And in certain specific product categories, there have been rising prices. For example, if you look at the HFC refrigerant space, which has boosted business for the likes of SRF and Navin Fluorine. And then in addition to that, certain companies have specific growth projects that are in ramp-up mode. So it's really a combination of these things that are leading to the pickup in revenues and earnings that we are seeing on a year-on-year basis. Actually, when you zoom out and look at the overall industry context at this point, and you look at the commentary coming from Western companies, such as the likes of, say, Dow Chemical or LyondellBasell, companies are generally cautious about the demand environment. There is still a considerable amount of oversupply sitting in China. And prices, barring a few pockets where they've gone up, have not really been, firming up of a low base. Plus when you factor in, the concerns going forward, such as, for example, the tariff-related uncertainties, which are really expected to play out only in the second half of this year. It's not a very, I would say, very encouraging macro environment just yet at this point anyway. So, that's broadly how things stand.
Okay, all right. So that's different from actually what you're hearing from some of the corporates as well. They didn't exactly say it's going to be a major recovery, but they did indicate there could be some recovery, so to say. On this tariff-related issue specifically, Abhijit, we don't have the contours out yet, but Aarti Industries did tell us that maybe the US tariff negotiations, what's happening with China, what's happening with the other Asian countries, that could be positive for India. Is that an indication that you're getting?
Very hard to hazard a guess about what exactly happens in the US in terms of tariffs, because that is a moving picture pretty much on a daily basis. But I think the broader point I just wanted to highlight is that there definitely has been some element of front loading of ordering coming from US customers, or maybe even global customers sitting in Europe who are in turn supplying to the US, because they've all been trying to beat the tariff deadline. And therefore, there is a good amount of inventory creation that has already happened in the last few months. We've seen companies like Kumai Chemical, for example, which is a major customer for PI Industries, highlighting such a development. So the concern going forward is that as this inventory overhang maybe starts to exert an impact in the second half of fiscal 26, could there be a slowdown in ordering coming from agrochemical customers or customers in other sectors?
Abhijit, good morning. Thank you for joining in. You mentioned in your note that there is a mixed trend that you're projecting, right? Stocks like Navin Fluorine and SRF could benefit. That PI Industries has a higher base, but Aarti and Deepak Nitrite continue to remain under pressure. What could work for companies like SRF and Navin Fluorine? Navin Fluorine has done fairly well in the recent past. It has also just completed a fundraise through the QIP. What are the likely triggers that can result in these companies outperforming over, say, the next 6 to 12 months?
So from a business standpoint, both companies are benefiting from the increase in HFC refrigerant prices, particularly R32. In addition to that, of course, SRF has been, guiding to 20% growth in its specialty chemicals business on the back of a recovery in agrochemical demand. Things have picked up on that front in the last couple of quarters, but as I mentioned, the risk or the concern to watch for is how much of that is front-loading led because of the tariffs, and therefore will there be a slowdown in coming quarters? So that's something to watch for. From Navin Fluorine's perspective, obviously now having completed the fundraise, one would expect them to announce growth projects in the next few months or so. And then that is where the street's attention will shift. Navin already has a pretty strong pipeline of projects to execute over the next couple of years, which, by the way, is already factored into everyone's numbers. So I think the expectations for both companies already build in a significant amount of growth over the next couple of years. But in our opinion, the valuations already factor in, most of that expected ramp.
You've spoken about UPL, saying it's going to be the weakest of the lot owing to challenges in Latin America and currency headwinds. Explain to us what we should expect from UPL. And the stock, I see, at least in the last 1 year, has done very well. It's okay. It's not bad. 16% up. Year to date, it's been a 30% up move. Now, given that it's going into its earnings with some gains, how would the stock fare over the near term?
Yeah, so when I mentioned weakest, I was actually referring to it in the context of the agrochemical peer group, not the broader chemical segment. Okay. The point here is that because they cater primarily to the international markets, and in particular, Latin America is their largest geography, which accounts for about 40% of the company's revenues. And Brazil in particular, which is the largest country in that region, is going through some very difficult times in the agrochemical industry. There has been more than a dozen distributor bankruptcies in Brazil in agrochemicals over the past year or so. So in that context, it's a difficult environment to show volume growth in. There's also a lot of Chinese competition that's been, flooding the market, plus therefore pricing pressure as well. So from all of those standpoints, it's going to be, one should expect maybe a subdued revenue growth for UPL this quarter on a year-on-year basis. Of course, it's seasonally not a large quarter. UPL's year tends to be very heavily back-ended, but we are already past that seasonal bump. And so, a soft quarter on a year-on-year basis in terms of growth. We should expect some improvement in margins, but then they will probably be some impacts from foreign currency related impacts because of all the currency volatility across the globe. Possibly one will also have to wait and watch if there are any settlements with any distributors regarding collections and whether that has an impact on the P&L.
Got it. So Abhijit, now that we are talking about cautious demand or maybe uncertain demand going forward, what are some of the spaces, barring agrochemicals, where chemical companies are investing or looking at investing, where they can get better returns or at least better orders going forward?
Yeah, so from our perspective, there are three stocks that we've been positive on for some time now. These are specifically Acutaas Chemicals, previously known as Ami Organics, which is primarily in the pharma CDMO space, but is also making a big thrust into the semiconductor chemical space through a recent joint venture they've announced in Korea. So we kind of like that story. We think there is good growth visibility there for the CDMO business, as well as, beyond that. SH Kelkar is the other one. We think that's an interesting idea, undervalued in the flavors and fragrances industry, where growth prospects are steady and there's a lot of operating expenses already built into the company's P&L. And so there's scope for operating leverage to play out over the next 2 to 3 years. The third one that we believe is still at reasonable valuations is Godrej Agrovet. So it's a very diversified story there, but we think that there are turnaround initiatives underway, across some of the more subdued performers. And there could possibly be an option of a demerger at some point in time as well.
Abhijit, thank you for sparing time and joining us to take us through this entire chemicals segment, as Abhijit Akela there of Kotak, to talk about what to expect from the chemical companies this time around. By the way, we started Manisha's segment with the Nifty back above 25,200, but then we are back towards the lows of the day now. 25,150 is where the index lies, 200 points lower. The Sensex is now down 700 points. So that brief recovery that you saw has been sold into as well. All of them, TCS, Infosys, Bharti Airtel, Reliance, HDFC Bank, all of them contributing in excess of 20 points to the Nifty downside. So 1/5 of the Nifty fall is coming in courtesy of these 5 names. Take a short break, focus back on earnings on the other side. This time around, Kumar Rakesh from BNP Paribas joins in to put the spotlight on the IT sector. Stay tuned.
Well, let's get back to talking about TCS. That's the top Nifty loser. The company disappointed on its top line. It's the global macro environment. There were delays in a lot of deal closures, pauses in the deal, so they started late. And as a result of which, even their international business, which is X of the BSNL deal, had a degrowth of nearly 0.5% versus the management's own expectation of a little bit of growth. They said, this quarter missed their own estimates by nearly 100 basis points. But we had a chance, Prashant and I, to catch up with the CFO of the company and the CHRO, Samir Seksaria and Milind Lakkad. And this would be Milind's last interview as the CHRO. He hangs his boot, retires on the 30th of September. Listen in to our conversation.
Two perspectives. If you look at last quarter, we did call out, given the uncertainty, from a headwind which we called out was that operating leverage might be impacted with higher utilization, and that is one thing which played out. We anticipated growth and invested in capacity, whereas we saw towards the end some demand contraction coming in, and that was one impact. In spite of that, we delivered a 30 basis points margin improvement. A considerable part is coming from BSNL and some currency benefit coming from it, offset by what we spoke about before.
I know BSNL is not a popular topic, but I kind of press on it every quarter. The new order, the BSNL order, can you give us broad contours? Is it? I mean, the last one was 2024, you got it, right? That was the $2 billion order, which is winding down now.
Which was for the 100,000 sites, whatever the order was, yes.
And the size this time is about $350 million.
So 26,000 sites, it's about 2,900 is the APO which we have received. APO is just the advanced PO. The circle-wise POs need to be received, so it's not in the TCV this time. So once we receive the circle-wise PO, that's when the execution will start.
Starts to get implemented from Q2?
Once we get it, it should come in Q2 positively, and then the execution starts. I think the 100,000 sites were delivered at record speed. We'd expect a similar
and relative to the margins, your margins, is this order once again like the previous one in that sense dilutive?
So relatively margins would be differential. It's in terms of, it's very similar to the previous one.
Milind, before you go, wage hike is coming, quantum, timing?
So we're still calibrating. We're still yet to decide in terms of how the business decision will turn around and when will it turn around, and based on that we decide. So we have not made any decision on that front yet.
Okay, got that. Also hiring. You all hired ahead of demand, anticipating demand didn't come through. So now clearly you're sitting on a lot of bench strength. And demand is still uncertain. So what's going to be the hiring plan for the remaining? I mean, as of now.
See, these things do happen in our industry, and I always talk about that. Sometimes it is not in line with what you see on the revenue side. Sometimes it is because of the investments we make. All of that happens, right? And that's how you should look at it this time also. Going forward, we will definitely, depending on the business demand for both. From the market and from the campus, we will calibrate and decide how many to get in every quarter.
Samir, full year margins. Kriti was telling us that at least the international market growth in FY26 should be better than FY25. On margins, how do you think this year will pan out versus last year?
So overall, the only guidance which we have given is the guiding beacon, and that stays. Right now, given the overall macro and uncertainty which prevails, our focus is in terms of going ahead and capturing the demand, looking at what our client priorities are, and investing for ensuring long-term growth with profitability.
But considering that there is negative operating leverage because of lack of growth, what measures are you taking in terms of margin defense?
So as Prashant also pointed out, that we have built up capacity. We already have. So we have capacity for the future.
So now hiring should be, you think it's frozen, would you say? No. Tactical will take place, but...
No, it will, I will never say it's frozen. But we will calibrate based on what the situation is.
Sorry.
Calibrate is business speak for...
coming back to...
It's not frozen?
No, it's not only one-way street, right? It would be a balancing act on various parameters.
We have a certain attrition also, right?
But is that attrition linked to, because you didn't give wage hikes?
So?
So you typically give it in April. That
Yeah.
didn't happen. So did
So I
that
think
result
that-
in higher attrition this time?
No. See, the point is overall, based on the market situation, this is the first or second time we have done something like that. So and continued communication with our people is the key, and we continue to do that. And I don't relate both of these points that 13.8% with the fact that the wage hike is not given is not the only reason why people leave.
Not the only reason.
Samir, talk to us a little bit about the environment, right? I mean, just an anecdote. The tariffs on Brazil came at 50%. I was talking to an economist and I was asking him, have you put pen to paper and changed estimates for Brazil? He's a global economist at a MNC bank. He said, no, we've not made any estimates because we don't know that 50% will be there, or by August that 50% will be 25% or 20%. So they've not made any changes. I mean, and that's quite telling. I mean, my question to you is, are businesses responding like that, or businesses are, as you see it, panicking because with what is happening, pulling back? Kriti described it as tactical sort of ramp downs, maybe deferment of projects, etc., but tactical in nature. So what are you seeing?
I think, as you called out, a start-pause scenario and specifically on a trade situation gives no one comfort. So I think I see it as a lot of enterprises being on a wait-and-watch mode on getting more clarity as it happens. But that uncertainty impacts us more because in a wait-and-watch mode, everyone starts getting cautious. Delays start happening, and that is one of the reasons what we saw play out in Q1 against what we were planning for.
The deal booking value is also, but although that is a lumpy figure.
Yes.
Did it include any mega deal?
No, it did not include any mega deal. The BSNL isn't there in it.
Is not included as a part of it.
Because it's only an APO.
The percentage of cost takeouts versus discretionary, has cost takeout even gone up further?
Yes. The primary demand drivers have been on cost optimization and vendor consolidation. Discretionary is under pressure.
Okay, let's get some perspective. What should one do with the stock now? It's fallen about 2 to 3%. Should you bet on TCS, after the fall, or is there more pain ahead? Rakesh Kumar, Rakesh, the India analyst for auto and IT at BNP Paribas, is now joining in with his thoughts. Thank you for joining in. First, throw some light on, we know about the numbers, we've spoken to the management, but in terms of the stock, the valuations, because relative to many of the large cap peers, TCS's premium valuations no longer exist. And also funds have started getting a little underweight on TCS. So keeping that in mind, give us your thoughts on how the stock price will perform from here.
Good morning, Rima. That eventually is one of the silver lining of all the numbers which we have seen, which have been disappointing. But the fact is, on valuation, a lot of these risks are more than priced in. On PE valuation, which you're referring to, the premium relative to some of the other peers is no longer there. But more importantly, on some of the other matrices like dividend yield, TCS is trading at the highest it has ever traded. And the reason I'm bringing in dividend yield is because these companies have gone through significant transformation on the balance sheet cash flow side. The payout ratios have materially improved. Some of these things do not get captured in the PE valuation. And that is what the dividend yield is telling us, that at least the downside from here is quite limited. But at the same time, possibly the catalysts are missing for the next quarter or two. And that is what the market probably would be waiting to watch out for. And there are some of the other names where there could be relatively more growth outperformance, and that may, relative to TCS, may start looking more attractive, such as Infosys.
Kumar, thank you for joining in. Since you brought up dividend yield, is that the only metric that one could think of for staying invested in a stock? Because at the end of the day, capital appreciation is also important, right? Because you say that the headwinds are factored in, yes, but there are no triggers over the next 2 quarters. What if further headwinds emerge? The street does not like uncertainty, right? They would want to have clarity, and clarity is something that is lacking at the moment.
You're right. Yeah, dividend yield gives you a perspective in terms of if there is any further downside risk or not. The TCS is trading at about 3.7% one-year forward dividend yield. Today's correction would have moved that a little higher. And that essentially tells you that, okay, from here on, possibly the downside risks are not there. But the point which you're talking about of the demand environment and the catalyst, that still needs to be there for the outperformance or the stock to start moving up, which is the point which I was referring to. Given the weak first quarter, possibly the full year outlook also is quite muted compared to some of the other peers. And hence, that premium valuation which used to be there may take some time to come back. And that's why relative to TCS, some of the other names may start looking more attractive.
Okay, so the next big number we'll be watching out for will be Infosys. It doesn't report numbers next week, but around 21st, 22nd. What is the expectation there?
So if you look at the stock price reaction today, probably market has already started pricing in that there is some degree of miss across all the IT services companies. There's not much to cut on valuation. So today's stock price reaction is largely reflecting earnings cut possibly happening through the earnings season this time around. And that sets relatively easier base or expectation going into Infosys result. Consensus was expecting close to 2% sequential growth, including acquisition possibly. And some of the expectation also is of the lower end of the guidance being raised. I would expect those expectation would have come down post the yesterday's result. And if they are able to even meet the expectation, that would be positive going into the result.
All right, Kumar, thank you so much for sparing time and joining us today with your views on TCS and, of course, what to anticipate from Infosys as well as it reports results in the next couple of weeks. I'll take a short break. The management of Bansal Wire Industries joins in on the other side to discuss the road ahead and a lot more. Stay tuned. We'll be right back.
Welcome back. The next company on our radar right now is Bansal Wires. Now, the reason we're talking to them is that some of the brokerages are getting bullish on this stock, citing that one, there is a capacity expansion underway, and two, the company is also targeting some high margin businesses, so getting into steel cord, etc. So that could potentially boost the margins going ahead. Pranav Bansal, the managing director and the CEO at Bansal Wire Industry, is now with us on the show. Pranav, thank you very much for joining in. Before we get chatting about, the two things I spoke about, just talk to us about FY26. Do you maintain the 25 to 30% volume growth, and what are you likely to do at the EBITDA and PAT level this year?
So our guidance for this year is definitely the same. We will try to do our best to get a 25-30% kind of a volume growth. The market is good for us today. We see good demand coming from our customers, so that should not change. Similarly, EBITDA should also increase. We are looking at some product mix change, of course. We will have more low value added products that we will be selling this year. So our EBITDA should also increase by about 10% also this year.
That should increase by?
10%.
Okay. EBITDA, the absolute number will increase by 10% is what you're saying.
Absolutely.
What will
That's
the
the
margins
target.
look like? What will the margins look like since you're looking at adding more value-added products? How much will that be as a percentage of your overall revenues by end of this fiscal year?
So by end of this year, we are looking at 20-25% of our revenue coming from high value added products.
Okay, and what?
Going as and when we add capacities for products like steel cord and other high value added.
So what does that do to your margins?
Gradually, over a period of 3 to 4 years, I think we are looking at some margin expansion. In terms of EBITDA per ton, we are looking at about 6,500 rupee level this year, which should gradually go up to maybe 8 or 9-ish kind of a number in the coming 4 years.
So Pranav, just explain, volumes will go up 25 to 30%. What will the revenue go up? Because your EBITDA growth is only seen at 10%.
Revenue might not go up by the same number because, again, revenue is all a matter of my volume. The kind of product that we sell gives us a very different kind of a revenue number. This year, our thought process is to sell more of low value added products, increase those numbers more. Therefore, revenue might go up to about 20-25%. But all of this depends on the raw material prices.
But then shouldn't your EBITDA go up if your revenue at least goes up by 20%? And you're focusing on some high value, then shouldn't the EBITDA growth also be at least more than 20%? Why are you guiding only for 10% this year?
So we have taken a 3-year strategy, wherein this year our thought process is to capture market share, which we have not been able to in the last 2 years because we did not have much capacity. From this year, because of the new facility that has come on stream, we are targeting a higher volume growth, and we will be a little aggressive in terms of our margin profile when we sell. Next year, however, we will try to bring that number to the same level of revenue growth. And the year after that, which is FY28, with our backward integration initiative and with the high value added products, this will further improve. So this is the 3-year plan. The first year is volume growth, second year is stabilization, and third year is going to a new and a better number.
A couple of questions, Pranav. You mentioned that you are aiming for a change in product mix towards more value-added products. Which is the segment that you would pay more emphasis to? Because currently, auto is the bigger segment that contributes to your mix, followed by infra and then engineering and then durables. Where does the mix change? And part 2 of my question is, you had also spoken about gaining market share. What is it currently and what are you aspiring to achieve?
So in terms of market share, in FY24, we were at about 6%, 7% kind of a market share. We are looking at grabbing a 10% market share in the next 3 to 4 years, whereas the industry is growing at about 8 to 10% as well. In terms of product mix, we are looking at steel cord and some other specialty wires like induction tempered wire and oil tempered wires to contribute to a better margin for us. Similarly, in terms of industry also, I think the main focus will still be automotive, which is our largest end user even today. That share should go up, which will drive.
Yes. Pranav, you're saying specialty wires will be a big driver in coming times. You said the margins are higher as well here. Is it already there in the value-added products mix that you told us about? Plus, when we say the EBITDA margins are better, how much better are they? Because one of the brokerage notes suggests it could be 20 to 30% versus 4 to 6% for commoditized wires.
So again, for us, how we look at our margins are more on return ratios. We target a 20-25% kind of an ROE earlier. Now our target for ROC is 20-25%. So any product that gives us 20-25% ROC for us is the right product. In percentage, it might be more or less in terms of percentage of revenue. Specialty wire also in terms of ROC would be similar. In terms of absolute EBITDA percentage, it might be at that range.
Very, very quickly, Pranav, what's the progress on your new products, steel cords? Very quickly.
So steel cord is going good. Our pilot project is already underway. We started production. Samples have already gone to some customers, and we're waiting for approval, which will come to us in the next 12 to 15 months.
All right, Pranav, thank you so much for sparing time joining us today, and wish you good luck for the rest of the year as well. We'll take a short break, but just before we do that, here's some good news for our viewers. India's business news leader is now just a click away, and that is CNBC TV18's all-new app, where you can get access to instant news, breaking news, in-depth articles, and financial world updates right at your fingertips. You can download the app from the Apple Store or the Google Play Store, or even scan the QR code that comes up in just a bit on your screens to download the app on your phone. Take a short break, and we'll be right back on the other side just as the QR code appears on your screens. Welcome back. Still near the lowest point of the day on the index. Now 180 points lower is where the Nifty stands at 25,170. Still fighting to hold that 25,150 mark on the downside are the bulls, and they would be hoping that that level at least is defended at the close of trade. The big mover of the day though is Glenmark, and started off in a 10% circuit, now has gone up to 15%, and it's continuing to be the top performer of the day. In fact, now it's gone up to almost 20% now as we speak. So the stock, possibly the stock of the day, has to be Glenmark. Some of the other movers then, Anand Rathi Wealth, of course, an earnings reaction there, 5% higher on that stock. In reaction to the moves seen in Glenmark, the other one that has moved in tandem is Wockhardt, and that too at one point was up almost 7.5%, has given up some of those gains. It's still holding on to those gains of around 4.5% as we speak. And IREDA, of course, was down around 6%, so some recovery from the lows there as well. And Z Entertainment, 3.5% lower, the big newsmakers of the day. In fact, if you take a look at the week-to-date basis, the worst performing stocks this week on the Nifty 500 have mostly been the capital market names. You take a look at BSE, is down 9% this week, MCX is down 8% this week, and some of the other names like Indus Towers, Sona, BLW, Bharat Forge, they also have seen losses of anywhere between 7 to 8% as the week has gone by. Titan has been the big underperformer this time, around 8% lower this week as well after that business update that it put out. So plenty of losers in the broader markets, although the index is still fighting to hold those lower levels.
You know, there's one stock, Tata Tech. It comes out with, it's a peer of, Tata Elxsi, because both of them are present in the automotive ER&D space. So Tata Tech is actually up close to about 0.8%, and it comes out with numbers on Monday. So on Monday, you have numbers from HCL Tech and Tata Tech. And I was just checking the estimates. My poll suggests that Tata Tech's revenues are likely to fall by 6.5%. But the stock is holding up in the green. perhaps, I was just seeing year to date, Tata Elxsi is down 12%, while Tata Tech is down 19%. So maybe it's already fallen. In the last 1 year also, Tata Tech has underperformed Tata Elxsi by nearly 15%. So maybe a lot of the bad news could be in the price.
In the price already. But again, we'll come to you for the analysis, what's going to happen there. We'll do one thing. We'll wrap on this edition of Trading Half an Hour. But stay tuned. Halftime Report is up next with a lot of buzzing names and the market updates as well. Stay tuned.
Stocks see a fall after TCS's weak show drags IT stocks lower. Energy, auto and industrials are the other big drags, while FMCG, powered by HUL, ekes out gains.
A delay in decision-making and deferment of deals causes a dip in constant currency revenues for TCS in the first quarter. The uncertainty also pushes back wages hikes and hiring in anticipation of a pickup.
Glenmark Pharma's arm inks India's first big drug licensing deal with AbbVie for an upfront payment of $700 million and a milestone payment of over $1.2 billion. Glenmark says it will be considering rewarding shareholders from the bounty.
Hindustan Unilever is set for a sudden change of guard as Rohit Java exits early. Priya Nair, Executive Director, Beauty and Wellbeing at Unilever, will step in to take charge on August 1st. The stock celebrates the entry of HUL's first woman CEO.
Zee Entertainment shareholders block a resolution for issuing warrants to promoters that would have helped them raise their stake from near 4% to over 18%. Strong opposition from several proxy advisors led to the outcome. Good afternoon. You're watching us here on Halftime Report this Friday afternoon. It's me, Mangalam Malu, with me, Vinny, as well as Ekta. We join you from CNBC-TV18's Motilal Oswal studio. There are four things that are playing out in the market right now. The fact that the Nifty has seen a sharp decline down 200 points. The second part, Glenmark up 15%, and the third part, HUL hasn't done has done in a day what it hasn't in the last 5 years. Gained about 5%. The last 5 years, was up just around 8%. So what I can say is, Ekta, you got Glenmark today. I got HUL. Vinny, what do you have?
I think I'm just going to take Z then, because that is also not doing well today. And obviously, you know, those issues coming in where the approval is not coming in is keeping the stock under pressure.
Yes, absolutely. And did you mention TCS?
Oh, yeah.
The market has been accounted for by TCS because IT is the one which is taking the TCS stock lower.
Yeah, but nonetheless, the market's under pressure. And even if you look at it on a week-to-date basis, you can see that there's an underperformance which has taken place for the broader markets as compared to the Nifty at this point in time at current reckoning. So the mid-cap index is down around 1.57% at current reckoning as compared to the Nifty, which is also in the red for the week. But nonetheless, weekday for the markets, mid-cap index down around 0.9%, Nifty down around 0.8%. Tough day.
Absolutely tough day coming in there, but both of you all have taken the gainers of the day, right? The only two sectors that are trading in the green is the FMCG as well as the pharma, so that's what we're keeping an eye out on. While obviously not a good day coming in for IT, or whether you look at an auto pack as well, Nifty Auto, that's not managing to hold on to gains. But Ekta, we should start with Glenmark today, right? Because what a deal coming in. I think better than what everyone was anticipating.
Well, yes, you know, and it's a big deal for Indian pharma. It puts the Indian R&D industry on the map, actually, because it's a huge deal. So AbbVie has validated Glenmark's molecule, or validated the research that they've done by paying $700 million upfront for this particular molecule, ISB 2001, which is being studied for multiple myeloma. So I haven't been able to talk about it as much, but multiple myeloma is a type of cancer, and this particular molecule is actually for those who have not been able to see any success in other kind of treatments. So it is literally the end stage or last mile treatment, and that has shown a strong response in the phase 1 data that they've generated, or the data that Glenmark has generated, and that's the reason that AbbVie has actually gone ahead and out-licensed.
This is phase 1, right, of the
trial? It's in phase 1B. So there are going to be multiple phases that they will go through, and not to mention it's probably going to take 4 to 5 years. So as they keep hitting these milestones in terms of the clinical regulatory milestones, Glenmark will be eligible for money to come through, and that total is around up to $1.2 billion. Now the biggest kicker is the royalties, because if in case this particular drug is successful, it hits the market, it becomes a drug which you can get prescribed, that actually is going to result in royalty payments, in possibly annuity for Glenmark. So that's going to be tiered royalty, double-digit royalty payments. So they're going to keep getting a higher amount of double-digit royalty payments. So that's the kind of deal, and the financials look, great for Glenmark if it does come through. But the big question is if, because there are molecules in the past which have not succeeded as well. So you have to keep that in mind, that R&D is a game of success. As of now, it's showing good results. As of now, there is hope, but let's see how it goes forward. Glenmark, as you can see, has already run up significantly. It's already showing another 13% gain in today's trading session. So, a couple of brokerages such as Nomura have written on it, and they've said they have a neutral and a target price of 1,500 rupees. They say that the deal value is ahead of expectations. In fact, I did catch up with Glenn Saldana and began by asking him about the deal. Listen into this exclusive conversation.
Clearly, this is a huge moment for us, right? I mean, we've been working on this for 25 years in the innovation space, and I think 2001 really is a world-class asset, right, which can be transformational for patients. From a partnering perspective, the way we've structured it is we've partnered with AbbVie for US, Canada, Europe, China, Japan, most of the developed markets, and Glenmark will commercialize this product eventually, right, in India and all emerging markets. So the two of us will make sure this asset is successful going forward. IGI clearly is a 100% subsidiary of Glenmark and has done a phenomenal job in developing this asset, getting the phase 1 data. As you know, we have phenomenal data in patients in the phase 1 trial, where the recent presentation we made at ASCO we had almost 79% ORR and almost 30% of the patients had complete remission. And these are patients who've gone through all prior lines of therapy in multiple myeloma and then eventually come on to 2001 have shown this response. So very exciting times. We are super excited about partnering with AbbVie, great partner, huge global capabilities and huge resources to make 2001 successful and bring it to the market.
Okay. So explain the financials to us. $700 million is what you would get upfront, $1.2 billion in terms of milestones, and the remaining would be royalties.
That's correct. So we get a $700 million payment upfront, and as soon as we get regulatory approvals, that money will be received by us. The milestones, the $1.2+ billion of milestones, are spread into clinical development milestones. So as the molecule progresses to clinics, we keep getting milestones. Regulatory milestones, so as the molecule gets filed in various markets, we get and approved, we get milestones. And then we get sales-linked milestones. So cumulatively, that number comes to $1.25 billion, for the asset. And then once it's commercial, we get royalties on sales, which, as you know, some of these innovative products, the life of the royalties is pretty long. So this could pretty much be an annuity if the molecule makes it to market.
Okay. So let's first understand where exactly this molecule stands. Phase 1B currently. Explain that to us. How nascent is this molecule at this point in time?
So ISB 2001 is still at a relatively early stage. The good news is we have patient data in about 40-50 patients. We have good clinical data that we presented at ASCO. So very good safety profile, good efficacy data. But it's still early stage, so it has to go through a significant amount of clinical development as we go forward.
Okay. So AbbVie is now going to take over the entire development of this molecule, we understand. When do you think that it will probably hit the market or show any kind of results?
So AbbVie takes over all clinical development from here on. In terms of time frame, I can't give you a specific time frame, but typically molecules, if you look at other assets, right, in the space, they typically take about 4-5 years at least to get to commercialization.
So say 2030 would be a good target to probably expect something tangible coming in from the molecule or hitting commercial sales if it is successful, that is.
So again, I can't specifically talk about ISB 2001, but typically it's about 4-5 years to commercialization.
Okay. Well, let's talk about how you're going to use the funds now. Let's start with $700 million, 6,000 crores of cash on books. It will be on Glenmark's books. Tell us how exactly is this $700 million going to be utilized?
So the way we're looking at it is IGI will continue development of various other assets that they have. They have a great multi-specific antibody platform technology, which they will continue to exploit. And, they will continue. So they spend about $70 million a year. So that spend will continue. Clearly, a big part of this upfront will be allocated to their spends. The balance, some of it will get dividend out to Glenmark, and the rest will sit as cash on the books.
Okay. Any plans of rewarding the shareholders of Glenmark who waited very patiently for a possible R&D deal?
We'll definitely consider, right, increasing the payouts to shareholders. I think we'll put it up to the board and get that approval.
Okay, so that's the big news coming in from Glenmark. The stock, remember, has rallied around 50% from its 52-week low, trading at over 30 times 1 year forward at this point in time. We'll take a short break, but on the other side, we'll connect with Mr. Vedhish. He's the former MD at GSK Pharmaceuticals to discuss the entire R&D landscape post this deal in India. Stay tuned.
Welcome back. We've been talking about Glenmark Pharma. We've heard from the management as well. The big stock of the day, it was up 10% for most part of the day, and thereafter the temporary freeze on F&O opened, and thereafter the stock went all the way up to 15% before now settling at around 12.5% in terms of gains. We have with us Annaswamy Vaidheesh, who's the former MD at GSK Pharmaceuticals, who joins in. Mr. Vaidheesh, always a pleasure listening into your views. This big deal that has happened, it's a big one for the Indian pharmaceutical space. For Glenmark in particular, do you think the valuations are more than what the street anticipated? Does that tell you that the possibility of success here is a lot higher? How do you look at this entire space, and who else stands to benefit from something like this?
Well, first and foremost, my hearty congratulations to Glenn. See, what you're seeing today is a resultant of a huge hard work that happened for over, if I'm not mistaken, it's over 10 years. So we are talking about hard work having paid dividend. Particularly in drug discovery, things don't happen overnight, right? And it involves a huge amount of risk. So the first one is ISB 2001, first in class, tri-specific antibody for multiple myeloma, and being taken by AbbVie itself, it clearly shows the credibility of the platform itself. So to that extent, I think we are, India is really making an impact in the drug discovery, though it's not the full length of the drug discovery value chain, but at least now we are becoming a country that many companies in US or the Western world will look at us. You know, I'm going to stop here and let me know what exactly you want to know about this deal.
Okay. Mr. Vaidheesh, hi, welcome to the show. Just wanted to understand what this means for the R&D landscape for India. Are we on the map now when it comes to R&D, or do you think this is very company specific?
You know, you know it, and you know this space quite well. See, drug discovery, as you know, it's a very expensive proposition all over the world. It's not everybody's cup of tea, right? And including countries like China, Korea, they're all investing. As a country, they're investing behind drug discovery, particularly in the biologic targeting on the immuno-oncology or some of the diseases that requires huge amount of unmet need that has to be, driven by the companies. Now, as far as India is concerned, I think what Glenn has done, and I know very well, is that he's one of those leaders who always believed in innovation even before anybody else was thinking about it, almost about 10, 15 years back. So frankly, in my opinion, right now, there are a few other companies that are also spending enough resources behind it, particularly in the early stage discovery. And I do believe that this is a clarion call for Indian pharma companies, but I do have few suggestions as we discuss.
Right. Mr. Vaidheesh, good afternoon. What is, like you're mentioning, there are few companies which are already, in the works as well. We have Walkhard, we have Spark that are doing a lot of R&D going on that front as well. Now, in terms of overall, do you think such a large deal that we saw coming in for Glenn, is that something that's going to be possible, or how are we watching out for in this space now?
See, what you have seen today is a typical biotech story, right? If you even in US, many other biotech companies, like what Glenn has done it through this separate arm. Many biotech companies work, out of which 100, one or two succeed in coming up with phase 1, and then they go to the phase 2. So frankly, in my opinion, this is a start for our country, and this is going to inspire many companies to do it. If you are asking me, are there any other companies that are on the verge of making it happen? Possibly few of them, but I would say you should take a look at their pipeline. It may not be as big as this, what you just have seen, but I'm quite sure that it's going to inspire many companies to start looking at how do we cooperate, how do we collaborate with multinational companies particularly in the area where the AI is becoming a very important component in drug targeting. So India is going to be in a very good position in accelerating drug discovery, but we are at the early stage, but it's good news.
Okay. Well, Mr. Vedish, a lot of Glenmark's research is done outside of India. What do you think needs to be done in order to increase or encourage indigenous R&D?
Ekta, you said it correctly. So first and foremost, in the Western world, the drug discovery ecosystem is highly evolved. So first and foremost, we need to create the ecosystem here, particularly the academia and the investors. In a Western world, the investors come in very quickly to support any idea, even if there is a 1 in 100 chance that they will support the discovery, right? And then obviously the trained professionals and the regulatory pathways are very clear. So frankly, in my opinion, if it has to happen indigenously, we definitely need to develop a far more robust ecosystem, replicating what's happening in the valley. That we need to start doing it here, but it's going to take some time, but it's worth an effort.
Right. How much, roughly, according to you, would be the investment that would be required from the ecosystem to actually develop something like this in India?
See, typically, as you know, any drug discovery in Western world, they calculate something like a $4 to $5 billion, including some of the risk that is involved in coming up with, out of 100, 2 or 3 will see the light of the day, right? So the way in which we look at it, we are talking about 5 billion. Maybe in Indian system, our like how in the space area where we do it much cheaper than the Western world, possibly we can do it. It's my guess, 1/5 or 1/4 of the cost. But 5,000 crore that is being given to support the innovation, it's a start, but that's not sufficient. You need much bigger investment to drive drug discovery in the country.
Okay, all right, Mr. Vedish, we're going to leave it on that note. Thanks very much for joining in, and I'm sure it's a conversation which we are probably going to continue having, that how exactly do we fuel R&D further in pharmaceuticals in India. Well, remember, as we need to take a break, remember to tune in to the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune in to CNBC TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and Global Lens at 8:30 p.m.
Welcome back to Halftime Report on CNBC-TV18. Now let's talk about some of the gainers in today's trading session. And other than Glenmark, we have HUL that is buzzing in trade as well. And this has come in after we've seen the appointment of Priya Nair as its new managing director. Mangalam, Rohit Java, after his short stint, has, stepped down. But stock reaction positive. Priya Nair, what are we expecting here now going forward?
So the one thing that I've noticed, tracking the FMCG space, the biggest inflection point in any consumer company happens when the management changes. Because everything else considered, these are large companies with very strong processes. Will a management change bring a different direction of growth or not? Is the big question that everyone's looking at. And this has to be looked at in the context of what has taken place in the last 5 years or so. The stock has done virtually nothing. The last 2 years, we've seen a massive amount of disruption in the consumer space itself. The macros were extremely tough. And Rohit Java had just come in after a stellar career by Mr. Sanjeev Mehta. So for all things considered, if you look at those numbers, it has been a very resilient performance by Rohit Java. He's spoken about volume-led growth through Aspire and looking at margins as well as an improvement trigger from here on, given the volatility that we've seen in raw material prices. The stock has moved higher on account of two reasons. One, now the consumer sentiment is turning. Secondly, the stock hasn't seen literally time correction for the last 5 years. And thirdly, with the management change, the street believes that maybe it'll be more of the same with an added growth impetus that will take place in HUL. So Rohit Java stepped down with effect from July 31st. It was a surprise step down. Priya Nair has been appointed. She's currently the Executive Director, Beauty and Wellbeing, Unilever, and now comes back to India after, being in India for nearly all her life. 1995 is when she joined, and she's known for increasing the digitization, premiumization and brand building, particularly in the home care space. She's the first woman CEO of HUL. First time, but I think it's about time because the kind of leaders that HUL has spawned across, you have Prabha Narasimhan, who's leading Colgate, currently HUL leader, Geetika Mehta of Nivea, currently HUL leader. So you have a bunch of leaders from HUL who are now leading other companies. So it's only about time that where consumers, nearly 6 out of 10 are women, the leader has to be a woman as well. In the last 5 years, like I said, the stock is up just 8%. And this is before today's 5% up move. And in the previous 5 years before that, the stock had rallied about 4 times. So there's time correction, valuation correction, and tough macros. What is it that is important to track from here on? Recovery in volume growth led by consumer sentiment. That'll be the most important thing to track. Second thing, growth in premium personal care brands, because that's something where, HUL has been losing market share to some of the D2C players, and premiumization is margin accretive. And finally, I'll personally be keeping an eye out on what they do in the foods business, because the Horlicks growth post-acquisition has not been to what the analysts had been expecting. And now with the demerger of the ice cream business, what is it that they will do to increase the innovation out here is something I'll watch out for.
Okay, all right. Well, thanks very much for that, Mangalam. So that's on HUL, the stock. In fact, maybe there was a little bit of an inkling of any kind of news coming, considering that the stock is up around 7.5% this week. It's up close to 10% this month. Well, let's move on to the other big Nifty stock in focus, TCS. The stock is under pressure post their Q1 numbers. Rima and Prashant caught up with the top TCS management to quiz them on their Q1 performance. They began by asking them about the decline in constant currency revenue. Listen in.
First of all, you need to decipher the number. This also included a minus 2.8% of BSNL degrowth. It's when I say degrowth, there's nothing wrong because we more or less completed the initial phase of the program. So there's very small portion left. And international revenue went down by minus 0.5. And like I was telling Rima before the this interview, we probably would have felt somewhere around another 100 basis point is where we were thinking we will close the quarter with. But even during if you remember in April, we did talk about continuing uncertainties which we are not seeing in January, February, started coming back in March. So that continued, and then we saw more projects getting delayed, paused, decisions delayed. So collectively, and the certain customers wanting to conserve cash. I think it's a question of overall global uncertain macroeconomic situation. But
the BSNL deal, I mean, there was well understood that it is ramping down, right? That's coming to a close.
Yeah.
So that was anyway supposed to happen. I think
Absolutely.
the numbers this
Absolutely.
time
I'm not
are about
saying
little
that
over
as a
700
that's what I'm
crores.
saying.
Yeah.
See the numbers in the context of minus 3.3, in the context of how much is the BSNL ramped down. And as I said, international, maybe another 100 basis point, I would have been happier. But this is the uncertainty like that or the unexpected nature of the overall customers' decision-making behavior that delayed things.
So how many deals got paused, deferred, any cancellations?
Not many cancellations, but delays, right? Like there are situations, see there are sometimes where you have about 1,000 people working on a project. Customer decides that they can go slow and then they say, I don't need 1,000 people, I need only 500 people for the next few months. And they're willing, because of the overall situation, they see they can deprioritize or postpone the programs. So I don't want to quantify how many, but few.
But what led to the disconnect between your own expectations and how the quarter played out? Because even when we spoke last time, that 90-day pause, tariffs being was there.
See, we in fact, if you remember, last time I was telling that I was expecting this to be short-lived. Yeah. Okay, it was not short-lived as I thought. It's continuing. Like if you, we hope that sentiments revive soon, but.
So you think Q2 is also impacted? I
mean, too early to call. One, you know that we are not going to comment on Q2. But see, the overall situation, we have a good pipeline, good order book. We are winning reasonably well in the marketplace. So once the sentiments improve, we should be in a good position.
No, but there's no sign from the there's no sign from your clients who've paused the deals that they want to restart anytime soon.
Not immediately.
Not yet.
And last time you told us that those pauses are tactical in nature.
Yeah.
I mean, they're not.
Yeah. Even now I'm saying, like, because last time also I said, now I'm saying, most of the companies have a huge technology debt. They have to spend. It's a question of timing.
Arthi, it's interesting, as they say, may we live in interesting times, right? And these are interesting times. And how would you characterize the environment in terms of what you've seen in the company so far, and what are you driving at within the company?
I think, like you said, I think these are interesting times. And if you look at what my focus is, we're looking at driving growth across our service lines. Like Kriti said, this quarter, if you look at it, our new age services have grown. So if you look at whether it's AI, it's cybersecurity, or interactive services, many of the new age services are doing well, and they have delivered growth this quarter. And specifically, since AI is a topic that everybody is most interested in, and if you look at AI, this quarter, if I look at where the growth has come from in AI, I would say that it has come from 3 areas. One, industry-specific solutions that our customers are building. Second, Kriti talked about technology debt, so customers are turning to AI to really modernize their technology estate. So I think that's an area which is showing an uptick, especially in some industries. And I would say the third area is where, as you start moving from pilots to more scaled ROI projects in AI, customers are looking at how do you do this at scale. So looking at...
Is there a way to define AI revenue? I mean, this is what we earn because of AI projects.
See, we're not doing that for a reason, because AI is all pervasive. Sure. It's there in every service line. So it's hard to just call out a part of the revenue as a AI revenue.
Is it deflationary in terms of pricing?
No, I don't think so.
Okay. Because revenues, the top line it'll drive, but I mean, and we've discussed this in the past, that as we go forward, eventually customers are going to say, well, you're doing a lot more with a lot less, so well, give us the price advantage that you're seeing.
It won't be a deflationary in pricing like Aarti mentioned.
Okay.
But we believe that AI will enable you to do more than with less. Okay. But as I've been telling, eventually you'll be doing a lot more than what you're doing today. Because that will ensure that we have enough opportunity for what we have today and what we'll have tomorrow.
Right, that is the management of TCS speaking to CNBC-TV18. Meanwhile, at the bottom of your screen, there are flashes. VIP Industries, promoters looking to sell stake in the company. They're in talks. What we understand from our sources is that leading private equity investors, including multiples PE, are likely in the race. And remember, as the deal would happen, promoters who own 51.7% stake in the company, this deal is likely to, trigger an open offer for minority shareholders as well. So, short point. Promoters for VIP are in talks to sell stake in the company. Leading private equity investors, including the likes of multiples PE, are in the race. And more importantly, it will trigger an open offer for the deal to happen. CNBC-TV18 has written to both the companies. We are awaiting their response. Remember, promoters in the past have alluded to exploring stake sale due to lack of succession at the promoter's end itself. And that's reflecting the share price as well. The fact that there is a deal brewing is, telling in the share price, because despite weak numbers over the last 3 months or so, the stock has recovered 75% from its 52-week low. But over the last few years, if you look at it, the highs that it hit in 2021-22, it's still down about 36% from those levels. And it has been losing market share. It's been losing market share from an investor standpoint and the marketplace as well. If you look at the last 5 years, VIP's shares have rallied about 82%, and this includes the COVID lows. From there, you have someone like a Safari, which was much smaller, has rallied all the way up to 1100%. So that's the underperformance that we've seen in VIP's share price as well. What is it that is important to track from a VIP perspective post-deal? They've been losing market share, so revival of brand VIP and growth in Skybags as well as their premier offering Carlton, something we'll be watching out for. In CSD, the Army CSD, they've been losing market share to Safari. Can they grow there and in general trade along with e-commerce channels? And in e-commerce channels itself, you have these newer brands, the likes of Mokobara, you have Uppercase and other newer players who've flooded this space, which was ripe for disruption. The disruption has happened, unfortunately not led by VIP Industries. So the new buyer, whoever that is, will have to take note of all of these things. The stock has seen a bit of a spike, but remember, is already rallied about 75% from its 52-week low. A deal likely soon.
Okay, all right, Mangnam, thanks very much for that. Interesting to know who actually will buy VIP. If it's a private equity firm, what kind of strategy will they adopt in order to change that kind of losing market share that you did allude to? Well, we need to take a short break, but Manisha Gupta will join in on the other side to talk about what she's tracking in the commodity space. She has with her Ruchi Shukla, the head of energy at MCX. Stay tuned.
Welcome back. You're watching us here on Halftime Report, and this is that time of the day where we speak about commodities. But before that, let's wish our golden girl a very, very happy birthday, Manisha, July 11th. Your birthday. Don't want to ask you your age.
No,
the only thing that I want to ask you is, are you going to give us your
jubilee or
age
golden
equivalent
jubilee?
of gold?
Weight equivalent or age equivalent?
Age equivalent, weight equivalent. I mean, if you must, that's okay. But age equivalent in terms of grams, so maybe silver, gold, or something.
But what are you what are you gifting yourself? Which commodity are you buying for yourself?
Well, I'm hoping diamonds, but let's see how the budget stands by the evening.
Real or lab?
Real.
Right, but wish you a very, very happy birthday, a glittering birthday, and something that shines, something that always sparkles, and something that never goes down in value.
Thank you so much. That's very, very kind and very, very nice of you. Thank you, guys. Thank you for wishing. But let's get to electricity futures. And joining us now to talk about that is Ruchi Shukla. She's head of energy at MCX, and she joins us on the show now. Ruchi, hi. Congratulations are in place, because a lot of people that I have been talking to tells me that Ruchi's worked hard, and it is all because of Ruchi that we have electricity futures right now. Congratulations on that. It's the second day of trade now, and I've been talking to a lot of broking houses as well, which tell us that they're watching right now on how the price moves, etc. It's of course a great plus for the Indian economy. We are the third largest consumers of electricity. What has been your feedback in the last couple of sessions now?
Yeah, thank you, Manisha, and wish you a very happy birthday.
Thank you.
So electricity futures, with this launch, we are providing really it's a transformative movement in the power sector, because it's providing the market participants with a very robust and efficient risk management tool. And as we are seeing yesterday, the first day, we had it was around 4,600 plus lots which traded, a good traction, a widespread traction, and we are seeing the interest from the market, specifically the value chain participants, which includes the generators as well as healthy participation from the end consumers also. So with seeing the first day, it's been a good startup for this contract, which has awaited a large number of years till date.
Absolutely. Ruchi, also, you're not the only one doing it. You have a competition standing right besides. How are you working that on?
Yeah, this, truly speaking, Manisha, power sector is a very wide market. It's like a huge market, and there's a lot of space and lot of new reforms or a build-up that can happen. So I guess with the competition also in place, this markets will grow and deepen further, bringing in higher and higher liquidity and more efficiency.
You said for yesterday was 4,600 contracts. Is it the same enthusiasm? Do you see it today too?
Yeah, the enthusiasm is good today too. And since morning, we are seeing around 500 plus lots have already traded since morning. So that's a good one. Good pick.
We do understand, Ruchi, that a lot of learning for this has come in really from Japan and perhaps South Korea for that matter. How is the Indian contract devised? It is on, of course, the underlying is IEX. How are you working that on?
So while these contracts were designed, a lot of interaction went through with the value chain shareholders as well as the global participants. And the design, which is formally got approval from SEBI and CRC, has been on the global parlances, because we have seen the countries like Europe where these contracts have really done well. The power futures as the leading market in Europe and Japan. So our contracts are also designed accordingly, but we have understood the nitty-gritties of Indian markets also, because these are the contracts which are impacted by more so on the domestic prices. So the international prices impact is very less visible in these contracts. So the design is peculiar for the Indian markets as well to suit the Indian participants. Basically, if you see, we have kept a lot size as a small lot size of 50 megawatt hours, keeping into specific the picture of SME and MSME companies. They also have a lot of exposure to the power sector, the power prices, so they can manage their risk better, and which will provide them more on financial planning and resilience also.
Ruchi, we do understand that from power generation companies to power distribution companies to proprietary HNIs, and as you said, SMEs, MSMEs would also want to be part of it. And then perhaps retail would enter in, because it's not such an easy subject. I mean, it's not like gold, silver, or a copper or a platinum. It's electricity futures is slightly has a longer learning curve, would you say?
Yes, you have rightfully pointed out electricity futures is going to have a little longer term, and it's visible from global markets also. They have also taken around a larger gestation period to develop into further nuances and the further variants for this product. So similarly, the curve in Indian markets will also evolve, though we see it will evolve at a faster rate because the growth rate which India is growing at, and we are moving towards the vision of Viksit Bharat. So with that, the evolvement will be at a much larger pace from the global markets. And it will be a mix of participants going ahead. We will see value chain to start off with, but yes, financial institutions and retail users, once they understand how the price impacts are visible on the volatility and the price impacts are visible in these prices, it's going to be a good market. That's what we foresee from here.
Sure. Ruchi, we do understand that it's available for the contracts, that is available for all 12 months going forward, but it is the front 3 months which are active right now. Is it just the front month, or have you seen activity happen in the further months as well?
So going ahead, we have launched actually 3 contracts right now because the 4th one will become active from 1st August. So we have seen traction yesterday in all the 3 contracts, which again shows a good healthy sign on the first day if you see traction from in farm month contracts also.
Okay, that's an interesting conversation there. Thank you so much, Ruchi Shukla, for joining in with us on the show as well. And obviously, interesting launch coming in there as well. So interesting conversation. Thank you so much for that, Manisha, as well.
Manisha, no gold, no silver, but lunch, is that a possibility?
After you come out of this show?
After we come out of the show.
Right.
Perfect, done. All right.
But for now, let's go for a break.
A lunch break, and we have Sudeep Shah of SBI Securities joining in with some trading strategies on the other side.
Welcome back to Halftime Report on CNBC-TV18. Right now, the Nifty is at 25,100, just 180 levels is what we're keeping an eye on. Almost in the days though, so not much of a recovery there. But we have Elcon Engineering that's reported their Q1 numbers as well, and increase in terms of profit. There's a one-time gain of 80 crores as well. As of now, the stock has seen a bit of spike up coming in. We'll wait out for more details on that front. But let's move on, and we have sources telling us that the IRDAI has initiated the process to take action against 8 insurers where each found lapses in health portfolio. Yash is joining in with us to give us more details on this front. Yash?
Well, that's correct. So, of course, the process has been initiated from the desk of the insurance regulator, IRDAI, and this is with respect to its inspection that it had conducted in the health portfolios of about 8 insurance companies where it had found lapses around multiple things. Of course, one of the most important things there was implementation of the Master Health Circular. Now, since the inspection was done, lapses were established, what IRDAI has done is that it has initiated the process to issue show cause notices to all these 8 insurance companies. Which are these 8 insurance companies? Niva Bupa Health Insurance, Star Health Insurance, Care Health Insurance, Manipal Cigna Health Insurance. These are 4 standalone health insurance companies against which the process to issue show cause notices has been initiated. There are 4 multi-line general insurance companies also where similar process will be followed to issue show cause notice. These are ICICI Lombard, Tata AIG, New India Assurance, as well as HDFC Ergo. Now, as I said, violations have been with respect to implementation of Health Master Circular, also around unnecessary deductions, claim rejections, delayed claim settlement. What we've been given to understand is that IRDAI will be discussing the matter on issuing these show cause notices in its upcoming board meeting. That is likely to happen next week. There will be a panel which will approve issuing the show cause notices, after which in about the next 1 month is when we are expecting these show cause notices will be sent to both general and the standalone health insurance companies. Post which, of course, there could be a reply which would be awaited naturally from these insurance companies on the show cause notices. There could be hearings if required from these insurance companies. And then if the IRDAI establishes these violations in a more firm way, then penalty as well as asking them to return money to policyholders are certain steps which could be considered by the insurance regulator.
All right, we take that point, Yash. Thank you so much for that. That's about the insurance story. We'll keep an eye out on that as it develops. But just watch out for the markets. We have a 180-point downtick that we're seeing on the Nifty. It's actually at the lower end of today's trading range. The Nifty led lower by the Nifty Bank. We're seeing weakness in the mid-cap index, the IT stocks. All of them are taking the frontline index lower. But from a technical standpoint, we are at quite a precipitous level. The Nifty Bank has seen a recovery from the lows as you saw in the intraday chart. But look at the Nifty. After a very, very long time, it's gone ahead and broken the 20-day moving average. So the Nifty 20-day moving average comes up for you on the screen. It is 25,244. That's the mark that we have to keep an eye out on. It's below that. Closing above that would signify a reversal in trend for the market and maybe a move towards its earlier high. But right now, we're looking at 20-day moving average being broken. And that's because the 50-day moving average has been broken on the IT index. Remember, the IT index has been underperforming, still down about 17% from its highs. So it's broken a much longer frame average. The Nifty Bank, however, it's recovered from the 20-day moving average. 56,630 is where the Nifty Bank 20-day moving average is placed. So that's a little more resilient than the IT index. It's the IT which has caused weakness on the Nifty. The other thing we're watching out for, HUL. The reason why the stock's doing a lot better is also because in today's up move, it's conquered the 200-day moving average. The India VIX, which we've been pointing, has been very, very low. After this downtick, has spiked a little, but still factoring in a fair amount of complacency. So let's watch out for where this goes. And the 25,000 mark is also very important. We have the 25,000 put writers very, very active in today's trading session. We have the 25,200 call writers and the 25,300 call writers equally active, telling you that the support has moved lower, as has the congestion zone. So the congestion zone, which was earlier about 25,550, 25,650, has come down to around 25,350 odd itself. And as a result of which, the put call ratio has moved to 0.75 versus 0.95. Remember, the market typically shows a bounce from 0.68 to 0.7. A lot of long positions added in this market as well, and some of them belong to the Mankind Pharma group. That stock has seen a lot of long positions being added. Shorts added in a couple of these capital market plays. So we have CAMS and BSE seeing shorts being added. IRIDA on the back of higher gross NPAs seeing some shorts being added. And we've been talking about Glenmark for a while. The open interest action on Glenmark suggests that the stock may enter F&O ban. So just watch out for that one as well. So Glenmark is a stock that may enter F&O ban, the third stock in the series to go into F&O ban.
Okay, all right, Manglam. We'll do one thing on that note. We'll take a short break. But up next, Sudeep Shah from SBI Securities will join in with some trading calls. Stay tuned. Welcome back. Sudeep Shah joins in to discuss the technicals of the market. Sudeep, welcome to the show. If you could just apprise us of your Nifty call as well as your stocks.
Good afternoon, Ekta. Ekta, what we feel is from the current levels, while Nifty has broken its 20-day exponential moving average, and now it's just come back in that range between 24,950 and 25,300. We feel there could be a retest of this support zone of 24,950, 25,000 on the downside. And remember, this is the support zone is the same support which was a prior resistance in the month of May and major part of June. That 25,000 mark, which we always used to discuss, that's not able to get crossed. We feel now that could act as an important support on the downside. So 24,950, 25,000 zone is that zone where Nifty could find support, and it could be range bound between 24,950 and 25,300, 350. If we see the other indices within the other sectoral indices, Bank Nifty is say relatively more stronger because it's still sustaining above its 20-day exponential moving average, and support could come from FMCG as well as the oil and gas index, which is still doing relatively well. And auto as well as IT indices are on a weaker foot. So considering all these 5 indices put together, we feel overall indices, the broad-based indices could be in a range between 24,950 to 25,000 and 25,300, 350 on the upside.
And individual stocks quickly before we let you go, Sudeep?
Mangalam, 2 stocks that are coming on our radar. One is PFC. Now here there is a reversal that has been witnessed after several sessions, and the stock has now sustained above its 200-day moving average after several months. So the kind of price action which is visible today in such weak markets does show some strength. And that is why we feel from the current levels, PFC could be bought with a stop loss at 428 and trading target of 453 on the upside. The second stock is from the chemical space. Of late in the last several sessions, we have seen a lot of chemical names showing good traction and showing decent momentum. So one of them, a good quality fundamental stock, is Fine Organics, where we have seen a decent base building happening in the last several months. And now the stock is ready for the next move. So around 51.50, 51.70, the stock is trading currently. From a medium-term investment standpoint, we feel that 5,000 could act as a strong support, a stop loss on the downside. And we are looking at targets closer to 5,400, 5,600 in the coming few months.
Okay, Sudeep, thank you so much for joining in with us on the show. But with that, we'll wind down this edition of Halftime Report on CNBC-TV18. Thank you so much from Mangalam, Ekta, myself, as well as the team who put the show together. Don't go anywhere. Your Business Lunch up next.
Stocks fall after TCS's weak show drags IT stocks lower. Energy, auto and industrials are the other big losers, while FMCG, powered by HUL, ekes out gains.
A delay in decision-making and deferment of deals causes a dip in constant currency revenues for TCS in Q1. The uncertainty also pushes back wage hikes after a hiring ramp up in anticipation of a pickup.
Glenmark Pharma's arm inks India's first big drug licensing deal with AbbVie for an upfront payment of $700 million and milestone payments of over $1.2 billion. Glenmark says it will consider rewarding shareholders from this bounty.
Hindustan Unilever is set for a sudden change of guard as Rohit Java exits early. Priya Nair, Executive Director, Beauty and Wellbeing at Unilever, will step in to take charge on August 1st. The stock celebrates the entry of HUL's first woman CEO.
Zee Entertainment shareholders block a resolution for issuing warrants to promoters that would have helped them raise their stake from just under 4% to over 18%. Strong opposition from several proxy advisors led to the outcome. It is the final trading day of the week. We are just a few hours away from the close, but it is not looking like a very pleasant screen. You're watching Business Lunch. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Hormus Patakia. With me is Vamakshi Dhoriawal. Vamakshi, the only saving grace, if you would like to call it that, is the fact that the bulls are still fighting to defend that 25,150 mark on the downside, even though most of the other indices are deep in the red.
Well, absolutely, Hormas. This particular week has not been good at all for all of the indices that we've seen so far. In fact, when you look at today's move itself, moves on the sectoral indices are largely being driven by individual newsmakers is what we've observed. Like, look at, for example, TCS. It was not a great set. Nifty IT is the top sectoral loser. In fact, TCS is the top sectoral loser on the IT index itself. That stock is down almost 3%. Take a look at Zee Entertainment as well. The shareholders rejected a proposal to issue warrants to promoters. Nifty Media is the next big loser as far as sectoral indices are concerned. But on the flip side, what's doing well is the FMCG pack, largely driven by, no surprise there, HUL on the back of the appointment of the company's first woman CEO. So therefore, HUL up in trade. It will come up for you on the screen, up almost 4.8%. And the other index that is doing well is Pharma, driven largely by Glenmark Pharma. That stock is flying high in trade today. There's no question about that. It's a big deal. The stock is flying high. But the big news on Glenmark Pharma, then the company has signed a landmark licensing pact with US pharma company AbbVie to develop and sell a drug to treat multiple myeloma. Let's go across to my colleague Ekta for details on this mega $700 million deal. Ekta?
Well, yes, it's definitely a big deal which has come in for Glenmark. Glenmark's arm, which is basically their innovation arm, IGI, and AbbVie have signed a licensing deal for their drug under development for multiple myeloma, which is ISB 2001. Now, basically, what exactly are the financials with regards to this deal? AbbVie is going to be giving Glenmark $700 million upfront. They are also going to be giving milestone payments up to the tune of $1.2 billion. And that is when these regulatory or clinical milestones are met. And they also have, which is probably the most important, double-digit tiered royalty on net sales. Now, if in case this particular molecule does become commercial, it is successful, it hits the market in the next, say, 4 to 6 years, then Glenmark will be eligible for double-digit royalty on the net sales of this particular molecule for possibly annuity. So, in terms of the financials, there's a huge upside, and that's probably what the stock is factoring in at this point in time. However, one needs to tread with caution because the success of the molecule is the most important. There have been R&D failures which have taken place, and that is basically the crux of R&D as a whole. So that would be something that we would probably need to watch in the next couple of years. Separately, Glenmark is going to retain the rights for emerging markets in India, whereas AbbVie is going to develop, manufacture and commercialize ISB 2001 for North America, Europe, Japan and Greater China. When it comes to utilization of funds, $700 million is going to go into the R&D for IGI going forward. So they need around $70 million per year. So maybe for the next 3 years, they will be funded. The rest of the cash will be on books, and some of it will probably go as dividend as well to Glenmark. Glenmark would look to reward shareholders. This is something that they would consider, or the board would consider eventually. Nomura wrote on this. They have a neutral with the target price of 1,500 rupees. According to them, the deal value is ahead of expectations. To put it into perspective, market expectations were around $300-400 million in terms of milestones. That's come in at around $700 million. And the total drug value was estimated to be $700 to $800 million. And that drug value has come in to be higher at around $2 billion as well, according to experts.
Ekta, thanks a lot for that. A big deal indeed, not just for Glenmark, but the entire Indian pharma space. In fact, Ekta did speak to Glenmark CMD Glenn Saldana on how this deal will aid the company going forward. Listen in.
Clearly, this is a huge moment for us, right? I mean, we've been working on this for 25 years in the innovation space, and I think 2001 really is a world-class asset, right, which can be transformational for patients. From a partnering perspective, the way we've structured it is we've partnered with AbbVie for US, Canada, Europe, China, Japan, most of the developed markets, and Glenmark will commercialize this product eventually, right, in India and all emerging markets. So the two of us will make sure this asset is successful going forward.
So explain the financials to us. $700 million is what you would get upfront, $1.2 billion in terms of milestones, and the remaining would be royalties.
That's correct. So we get a $700 million payment upfront, and as soon as we get regulatory approvals, that money will be received by us. The milestones, the $1.2+ billion of milestones, are spread into clinical development milestones. So as the molecule progresses to clinics, we keep getting milestones. Regulatory milestones, so as the molecule gets filed in various markets, we get and approved, we get milestones. And then we get sales-linked milestones. So cumulatively, that number comes to $1.25 billion, for the asset. And then once it's commercial, we get royalties on sales, which, as you know, some of these innovative products, the life of the royalties is pretty long. So this could pretty much be an annuity if the molecule makes.
When do you think that it will probably hit the market or show any kind of results?
So AbbVie takes over all clinical development from here on. In terms of time frame, I mean, I can't give you a specific time frame, but typically molecules, if you look at other assets, right, in the space, they typically take about 4-5 years at least to get to commercialization.
That was the management of Glenmark Pharma. The stock is perched at an all-time high today. But next big mover is Hindustan Unilever. The company announced the appointment of Priya Nair as its new Managing Director and Chief Executive Officer, effective August 1st, 2025, with Rohit Java stepping down from the board. Mangalam tells us more. Mangalam.
It's an abrupt end to Rohit Java's short career in Hindustan Unilever as the CEO and MD, where in 2 years of his appointment, he has decided to step down to pursue other interests, but more importantly, in his place comes Priya Nair, who is currently the Executive Director of Beauty and Wellbeing at Unilever Global. But she's been a Hindustan Unilever lifer, where she joined in 1995. Thereafter, ran the home care business, parts of the beauty and well-being business in India as well. Known very well for, bringing about premiumization, digitization, and good growth in some of their brands. And that's something that HUL would like right now, even as the last 2 years have been extremely tough from a macro environment standpoint. Going forward, as the consumer sentiment is turning with an increased focus towards premiumization, beauty and well-being, the street may like that. Add to all of this, the stock has been a rank underperformer. In fact, over the last 5 years, X of today's move, it's moved all of 8%, and all of that actually happened in this month itself. So if you look at from the start of the month of July, the stock in the last 5 years has given virtually zero returns. But the prior 5 years, the stock had moved nearly 4 times. So as a result of which, there was valuation headwind in the last 5 years. Now there is comfort. Consumer sentiment is turning. And, the new leadership only adds an increased optimism around this space right now. What is it that the street will be watching out for? Innovation in foods portfolio, post the ice cream business demerger because Horlicks hasn't been doing well. Priya's core strength is beauty and well-being. So premiumization out there is something I'll be watching out for. And by and large, with the improved consumer sentiment, can consumer volume growth for HUL recover is something that the street will be betting on as well.
Mangalam, thanks a lot for that. Bucking the trend in a weak market is HUL, 5% higher in today's trading session, and it has managed to hold on to that gain all through the trading session. So 25.22 on HUL. On the flip side though, what has declined to the lows of the day is TCS, and that is after its first quarter results and some subdued commentary from the management as well. Rima is here to tell us more on that. Rima.
Well, just to tell you, the key reason why the stock is under pressure is the dismal revenue performance. Revenues have fallen by 3.3% on a quarter-on-quarter basis. Consensus was for a 1.5% drop. The reason for the decline is twofold. One, an anticipated drop in the BSNL deal. There was a ramp down of the BSNL deal, so that shaved away about 2.8%. And the other is the international business, which is all the business ex of BSNL. Now, that the management hoped would have grown. But given the macro uncertainty, the international business degrew by nearly 0.5%. In fact, the management acknowledged that the international business performance missed our own estimates by nearly 100 basis points. There were not too many deal cancellations, but there were delays in their deals in Q1. So some of the clients deprioritized their deals, they postponed their programs. And when asked that whether things come back, recover in Q2, he did indicate that as of now the uncertainty continues, so it's too early to say how Q2 is going to shape up, and generally the company refrains from providing any sort of a guidance. But where he is still confident and he's holding out is that FY26 international revenue growth will be better than last year. In terms of some of the steadying factors, margins were in line with estimates, 24.5%. Deal wins steady at $9.4 billion. And if you look at the headcount, headcount has actually gone up by 5,000 employees on a quarter-on-quarter basis. Now, typically, headcount goes up when you're confident about demand, which is why you take on so many people. But, when we asked the management, they said that, we thought that at the beginning of the quarter, in April, we thought things will recover, and therefore they hired people. So they built their strength, the bench strength, in anticipation of demand, but actually what they saw was margin contraction. Attrition also ticked up marginally, 13.8%, so slightly above the company's own comfort band. And as of now, at least, the company has not made any decision on the timing or the quantum of wage hikes. Back to you.
Thanks for that, Rima. That explains why TCS is trading lower today. But let's also listen in to what the management of TCS had to say on the deal postponements as well as business prospects going forward.
Not many cancellations, but delays, right? Like there are situations, there are sometimes where you have about 1,000 people working on a project. Customer decides that they can go slow, and then they say, I don't need 1,000 people, I need only 500 people for the next few months. And they're willing, because of the overall situation, they see they can deprioritize or postpone the programs. So I don't want to quantify how many, but few.
But what led to the disconnect between your own expectations and how the quarter played out? Because even when we spoke last time, that 90-day pause, tariffs being was there.
See, we in fact, if you remember, last time I was telling that I was expecting this to be short-lived. Okay, it was not short-lived as I thought. It's continuing. Like if you, we hope that sentiments revive soon. But
so you think Q2 is also impacted? I
mean, too early to call. One, that we are not going to comment on Q2. But see, the overall situation, we have a good pipeline, good order book. We are winning reasonably well in the marketplace.
And overall, will there be growth in FY26 over 25?
Growth, yes. Growth better than FY25, we'll work towards it, because we had about, I think, 4.2% growth in FY25. To reach that, that's looking like a tough number now. But definitely growth, definitely international growth to be better than FY25.
We'll take a short break. The Nifty still struggling at the lowest point of the day. But just before we take that break, remember to tune into the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. You can tune in to CNBC TV18 Prime at noon for the Global Reset, 1 p.m. for the Big C and the Global Lens at 8:30 this evening.
Welcome back. Thanks for staying tuned into Business Lunch. But moving on, Elon Musk Tesla is set to make its long-awaited entry into the Indian market on July 15th. It will inaugurate its first experience center in Mumbai, BKC. My colleague Parikshit joins us with more details. Parikshit?
Well, yes, Tesla is all set to launch officially in India. This is on the 15th of July, Maker Maxity Mall in BKC in Mumbai. They had already leased out a 4,000 square feet space, and that showroom will come live on the 15th. There will be a launch event between 10 a.m. in the morning and around 12:30. So it's a 2.5-hour launch event. What do we expect? We will expect Tesla cars to be showcased there, and you can expect some of the entry-level models to be sold. So if these cars cost around 35 to 37,000 US dollars in America, you would get them at about 50 to 60 lakhs in the India market. The reason being, there is a 70% duty on fully built cars coming into India, which cost up to 40,000 US dollars. Anything above that has a 100% duty. Even though the starting price is quite high, we're told that there are a lot of Tesla lovers in India. We can expect the company to give out booking timelines and sales timelines and as to when and how the customers can start booking their cars. There will be charging points in the Maker Maxity Mall, which Tesla has already leased out, and we're told that charging options will also be revealed. At the same time, the cars that will be showcased and launched in India will be fully loaded, according to sources. They will have all the features that are there in Tesla models in the US, China, and other key markets as well. No plans to manufacture in India just yet. This is a major litmus test for Tesla. If the Mumbai showroom takes off well, there are a lot of bookings and good amount of sales numbers, then Tesla may consider manufacturing in India in the next 2 to 3 years. But will Elon Musk be there? For the moment, we're told by sources he's unlikely to be there. But this may be a low-key event, but it's a very important moment for Tesla in its journey at a time when it's seeing a slowdown in key markets such as Europe and China.
Well, Parikshit, Vamakshi choked when you mentioned the price of the Tesla. But the question to you is, are you putting in a booking as well?
No, not at all. I just bought my car recently, 3 years back. So neither do I have the money nor any intention of buying a car just yet. But I know there would be many people in our office, maybe Hormuz, and just a lot of Tesla enthusiasts who've been queuing up. In fact, there were many people who had actually booked a Tesla when they had opened bookings globally, but they could, of course, never get it. They would be hoping to go ahead and buy their cars now.
They'll certainly be hoping, but you can count me out on that one, Parikshit. Thanks a lot for that. Take a short break here, but just before we do that, here's some good news for our viewers. India's business news leader is now just a click away, and that is CNBC-TV18's all-new app, where you get instant access to breaking news, in-depth articles, and financial world updates right at your fingertips. You can download the app from the Apple Store or the Google Play Store, or even scan the QR code that comes up on your screen. Take a short break. Be right back. Welcome back. Now, ahead of a key meeting between Russia and the United States over Ukraine, Russia has launched a massive attack on Kyiv with hundreds of drones and multiple missiles, which killed at least 2 people in the Ukrainian capital. Take a look.
Russia unleashed heavy airstrikes on Ukraine Thursday. Officials say at least 2 people were killed and 23 wounded in the attacks on Kyiv. It came before the Rome Conference on Ukraine's reconstruction, at which Kyiv won billions of dollars in aid pledges, and U.S.-Russian talks in Kuala Lumpur. U.S. Secretary of State Marco Rubio said he had a frank conversation with Russian Foreign Minister Sergei Lavrov about finding an end to the war.
I expressed what the president has said publicly, which is that we feel as if we've
dedicated a lot of time and energy to this matter, and just not enough progress has been made. We need to see a roadmap moving forward about how this conflict can conclude.
Moscow's foreign ministry said they had shared, quote, a substantive and frank exchange of views.
We get a lot of bullshit thrown at us by Putin, for you want to know the truth.
U.S. President Donald Trump has expressed frustration with Vladimir Putin over the lack of progress towards ending the war. Ukrainian President Volodymyr Zelensky said Thursday's assault by Russia had involved around 400 drones and 18 missiles, primarily targeting the capital. Eyewitness footage verified by Reuters showed the moment a Russian strike hit Wednesday night. Authorities said air defenses stopped all but a few dozen of the drones.
Well, that's all we have on this edition of Business Lunch. We're leaving you with the Nifty at 25,160. The mid-cap end of the market also not doing too well, down almost 0.7%. Don't go anywhere. Mid-cap radar comes up next.
Good afternoon. Welcome to Midcap Radar. We come to you live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra, and joining me today is Mangalam Malu. Good afternoon, Mangalam. Well, another day of deep cuts that we are seeing. We have consistently been breaching those levels, first 25,500, then 25,400. Today we are below the 25,200 mark, down 200 points on the Nifty, and even the broader markets are not supporting.
Yeah, nearly 2 stocks in the red for every stock which is in the green right now. And we have seen a big cut coming in despite some resilience from the Nifty Bank. That's courtesy IT stocks as well as Reliance. We'll talk about all of that in just a bit. First up, all the top stories that we're tracking. Stocks see a fall after TCS's weak show. IT drags lower. Oil and gas, auto and realty are the other big drags, while FMCG, powered by HUL, ekes out gains. Midcaps fall in line.
Glenmark Pharmaceuticals inks India's first big drug licensing deal with AbbVie for an upfront payment of $700 million and milestone payments of over $1.2 billion. Glenmark says it will consider rewarding shareholders from the bounty.
Anand Rathi gains post first quarter numbers. The company nearly manages to meet its FY26 AUM guidance in the first quarter itself. Strong double-digit growth continues. Management tells CNBC-TV18 they do not see further reduction in cost-to-income ratio.
Tata Elxsi under pressure after reporting their Q1 numbers. Constant currency revenue declines 9% YOY. Margin contracts sequentially. Stock down nearly 2.5%.
And we have shares of IREDA, which slips nearly 5% as the company reports a sharp rise in the gross non-performing assets in the first quarter, a part of which was due to recognizing Gensol Engineering as an NPA. The management will CNBC-TV18 they're confident of resolving the Gensol issue.
All right, those are the top headlines, and in just a bit we'll speak about the mid-cap movers as well. But for now, Nifty at the day's low. It's a 200-point cut that we are witnessing there. For the week as well, Nifty is down more than 1%. Mid-caps and small caps, they are the ones which have not been resilient at all. So the mid-cap index right now it's down around 450 points. But for the week, we have seen a sharper cut as well. Even if we talk about the Nifty small cap index, it's down around 1.3%. And a lot of earnings reactions which are kicking in. And that uncertainty regarding the trade deal with US, that is also keeping markets at the levels that we are seeing right now.
Be that as it may, from the FMCG pack, we're seeing big gains. You know, I'm not talking about HUL itself, but you have, look at Gillette. That stock's moved to the high point. We have VIP. We'll talk about that in just a bit. And VST Industries, another cigarette maker. And we have Globus Spirits. That's the other stock.
The top gainer this week as well.
5.5%. So all of them doing well. So there are pockets which are showing some resilience and some gains. So we'll talk about those movers itself. Let's go across to Vamakshi, who will take us through all the mid-caps that are moving around in trade today. Vamakshi.
Well, it's a sea of red as far as the mid-cap market is concerned. In fact, not just the mid-cap market, but all of the benchmark indices. And some of the stocks that are actually contributing to the declines today includes PC Jewelers. Keep in mind, the stock is seeing a downtick of almost 5.8%. It has been one of the top losers in the last few sessions as well. Dish TV also taking a knock in today's trading session, down almost 4%. V-Mart Retail as well as Amber Enterprises down 4%, each trading close to the day's lowest point. Joining them is the defense pack. The defense stocks had been the darlings of these trade, but they're all taking a knock today as well. Data Patterns down almost 2.6%. Garden Reach Shipbuilders taking a knock of almost 2.89%. Solar Industries, Mascot Docs are some of the stocks that are declining in trade today. But let's then focus in on the newsmakers, because that is where we do have some good news. Glenmark Pharma is up almost 14.5%. In fact, the stock managed to reach an all-time high today. Enviro Infra, there was an order win yesterday. There was an order win the previous day as well, and the stock continues to gain, up almost 12%. Anand Rathi reported a good set of numbers. Stock up almost 4%. IREDA as well as Tata Elxsi, not a great set coming in from both of these companies. The stocks down and out in trade today. And let's finally look at some stocks that are bucking the trend in today's trading session. Stocks includes Datamatics. The stock has surged to the day's highest point, up almost 8.3%. NetWeb, VST as well as Vocart are some of the stocks that are gaining momentum in trade today.
All right, interesting names there. Thank you so much, Vamakshi, for joining in with all those details. It's a good time to get a technical check on the markets. Let's welcome Rajesh Palvia from Axis Securities for just that. Rajesh, good afternoon. Well, it's a big cut that we're seeing right now, continuously breaching important levels. What is the next important level to watch out for, and your individual picks as well?
Yeah, good afternoon. So Nifty broken its important support area of 25,300, and the major call writing activity is now, taking place at 25,300, 25,200 strikes. So that clearly giving us sign that, yes, we could see further more pressure in the Nifty, as Nifty is now slipped below to 20-day moving average support area also. So I think if now Nifty trades below 25,200, 250 zone, we might see further more cut towards 25,100, even 25,050 kind of level in the continuation of this, down move for the Nifty. So 25,000, 25,050 would be the next major support area for this correction. Bank Nifty is almost hovering near to its 20-day simple moving average support area, which is placed at around 56,600 zone. So if at all Bank Nifty breaks below 56,600, then here also we may see some more unwinding pressure, as call writers are now creating their position at around 57,000. So that level may act as an immediate hurdle for the Bank Nifty also. Nifty mid cap also slipped below to 20-day moving average. So I think some more weakness we may see in the market in next couple of days, until the Nifty not able to move back beyond 25,350 or 400 zone. On the stocks front, some of the mid cap stocks are looking attractive and fresh breakout is there. So two stocks ideas, both are on the buy side. First one is NetWeb Technology. Stock taken the support from its 50-day moving average support area, and after a brief consolidation of 3-4 days, stock managed to give breakout with the volume action. The kind of breakout which we are witnessing on the daily weekly chart, we believe that this momentum can extend further, and possible target towards 2000 to 2020 we may see for this NetWeb Technology. One can buy with stop loss of 1905. Another stock is EID Perry, fresh breakout on the counter. So looking at the breakout, we believe that this momentum can extend further. Target we are projecting around 1190 to 1220. One can buy and accumulate with stop loss of 1120.
All right, Rajesh, thank you so much for joining in and giving us your stock picks. We're also seeing some traction build up in Whirlpool. They've informed the exchanges that Nippon India has bought some shares in the company that has been disclosed. So Whirlpool has moved to the high point. And we have, another stock which is spiking right now is Balrampur Chini. So watch out for the sugar pack as well. Typically, all the stocks move together. So Balrampur Chini is one of them, which is now just about shown a bit of a spike. Let's see whether other stocks follow or not. Union Minister for Heavy Industries, H.D. Kumaraswamy, has announced that the centre will soon be launching a scheme with an outlay of nearly 1350 crore rupees to make rare earth magnets in India. Remember, CNBC-TV18 on June 24th had reported that the government is likely to rule out a rare earth magnets manufacturing scheme.
Some progress is going on. We already allocated 1,345 crores. 1,345 crores. We are selecting 2 manufacturers.
Scheme has been circulated for 1,345 crore subsidy for manufacturers. It is under 345 crores. It is under interministerial consultation. We are interested only in magnets. Anybody who gives us magnets will get incentive.
Anyone who gives us magnets will get incentives. That's the new scheme that has been launched, nearly 1,350 crore rupees. But with that, we'll take a short break. And as we do that, let's tell you about CNBC-TV18 Prime, which is something which is our newest offering, which brings you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impacts on Indian businesses, giving you unparalleled insights. Tune into CNBC-TV18 Prime at 12 noon for the Global Reset, 1 p.m. for the Big C and Global Lens at 8:30 p.m. Welcome back. Piramal Enterprises among the broader markets moved to the high point of trade even as the frontline index is now down 210 points. The mid-cap index down 500 points. Let's welcome Rima on the show. Rima, lower on Tata Elxsi today. The street didn't like these numbers.
No, they didn't like the numbers, and the stock has seen quite a fall. The all-time high in the stock was 10,760, and anyway, the stock has been weak. For the last 3 years now, it's not given any return. In fact, if you look at it, in the last 3 years, the revenues have fallen by nearly 27%. But let's explain today's fall. For one, the stock went into its earnings with a little bit of an outperformance versus peers. Look at the 3-month performance. Tata Elxsi share price was up 23%, outperforming some of the peers. So while it's underperformed over the last 3 years, just in the recent last few weeks, there was a bit of an up move, particularly from the April lows. Then in terms of numbers, this was the 4th consecutive quarter for miss and very weak numbers. Revenues down 9% on a year-on-year basis. And growth for the company has also been slowly deteriorating. This was a company which went to its all-time high levels, enjoyed very high valuation multiples when the revenue growth used to be 30-35%. But now the revenue growth has been moderating for the last 2 years, and this year, analysts are expecting negative growth. Both Kotak and Morgan Stanley anticipate a negative growth this time. So this company is likely to degrow, according to analysts. And despite that, valuations, as some point out, is on the higher side, with the stock trading at over 40 times forward multiple. Back to you.
Okay, all right. The stock has recovered, though, a little bit from the lows of the day, but explains the move that we have seen on the back of numbers as well. IREDA is the other stock on our radar, has slipped 5% in trade on the back of its Q1 earnings. Gaurav is joining us with the details of the numbers and highlights from the management conversation with us earlier. Gaurav.
Well, yes, IREDA, when we talk about numbers, top line growth was fine. When we look at net interest income, that increased almost by 38%. PPOP also grew at 49% on a year-on-year basis, but what remains weak is the profitability. And this was largely because of the asset quality. Specifically, when we talk about NPS, we have seen a huge jump somewhere in the range of around 150 crore rupees. Now, this is attributed to 2 accounts. First is that Gensol account, where we have seen around 750 crores of NPS coming up. This was actually known. Another account, which was actually surprise for the market, was one of the borrowers who was shifted from the stage 2 assets to NPS of around 780 crore rupees, and that is the reason why the street actually reacted negatively in terms of earnings. Other than that, there is another issue, is that the stage 3 assets and the slippages are also rising, and that is something which was considered on the back of all the issues. Now, management say that in terms of growth, they are going to sustain the growth that we have seen for the company somewhere in the tune of around 25 to 30%. Other than that, they also expect around 12 to 15 basis point of easing in cost of borrowing because of the recent announcement where the company is now allowed to issue bonds in terms of 54 EC. What they are also saying is that in terms of NPA, they do not see any kind of stress even rising for the company. In fact, they are very confident that they will make some recoveries. And specifically in terms of Gensol, what they have said is that they already had made provisions for the other account. In this quarter, we have seen provisions only for the Gensol account. And from here on, they also believe that the asset quality and the recovery from Gensol is something where they are positive. So, positive commentary from management, but in terms of growth, we have seen some negative surprise, and as a result, we are seeing stock is actually down more than 5% today.
Right, Gaurav, thanks a lot for that. Apart from, IREDA, which is down 5%, let's talk about Anand Rathi. The stock at one point was up 5% and now continues to hold on to those gains. Vamakshi joins in with those details. Vamakshi.
Well, Mangalam, it's a good set coming in from Anand Rathi. As far as the company's guidance for FY26 was concerned, they managed to meet almost 88% of the AUM guidance. The total revenue from operations surged by almost 23% quarter on quarter. So very strong double-digit growth is what we've seen in the first quarter. Similar to the historical trend that we've seen in the past. As far as the cost-to-income ratio is concerned, that managed to see an improvement of almost 571 basis points, thereby putting the margins higher for the company. The net profit seeing an uptick of almost 28% quarter on quarter. Now let's look at how the company has performed as far as its FY26 guidance is concerned. Like I mentioned before, 88% of its AUM guidance for FY26 has already been achieved. They managed to achieve almost 24-25% guidance when it comes to their their revenue as well as net profit. And we were also joined by the management earlier today on Chartbusters, and they said that they are largely maintaining the FY26 guidance. They've in fact added the highest net mobilization in the first quarter, 3,800 crore, despite the kind of uncertainties that we saw. They do not see a further reduction in the cost to income ratio because they will continue to invest in the company itself. Their Dubai office has done very well so far, and they're also expanding their reach in Bahrain as well as the UK, and they do see some potential in the overseas operations. However, they have not yet taken a decision on expansion in GIFT City. So those were some of the important takeaways. The stock is up in trade on the back of good set of numbers as well as commentary from the management.
Take that point, Vamakshi. Thank you so much for joining us with those details. But you're also tracking Zee Entertainment. The stock is under pressure. The company's plans for raising funds has hit a roadblock. Tell us more.
Well, absolutely. Keep in mind that the shareholders were to vote on the special resolution which involved issue of convertible warrants to promoters, but they've gone ahead and rejected that. Now around 59.5% shareholders voted in favor, while 40.5% shareholders voted against this resolution. Keep in mind that typically in order to pass a special resolution, a majority of almost 75% at a minimum is required. So therefore, this resolution did not get passed. Now, keep in mind earlier as well, 3 proxy firms, which is IIAS, SES as well as InGovern, had advised shareholders on voting no for the issue of warrants to the promoters, and some of their key objections included the rationale behind fundraising plans, given that the company already had a huge cash balance on the balance sheet of almost 2,410 crores. The other reason that they highlighted was the choice of the financial instrument, because it would have resulted in a dilution of almost 15% for the non-promoter shareholders. Resultantly, given the fact that the resolution has not passed, the promoter shareholding now still stays at 3.99% as compared to 18.39%, which is what it would have been if the resolution was passed. So negative news flow for Zee Entertainment, the stock down in trade.
Take that point, Vamakshi. Thanks a lot for that. Just before we slip into a short break, Tarmat Limited, that's the stock that should come up for you on the screen. Nothing, that we speak about regularly in terms of Tarmat, but right now the volumes traded are nearly 35 times the average that we've seen, and the stock has seen a big spike up around 16%. Most of the gains coming by in just the last 10 minutes, even as the stock was flat through today's trading session. So watch for Tarmat Limited. Take a short break. On the other side, we have markets and mid-cap movers which are making news. Nifty Bank is showing some recovery, so watch out for that. It's being led by Kotak Mahindra Bank. So Kotak Mahindra Bank at the start of the week reported its first quarter update was fairly good and supported the Nifty Bank all through the way. Up 4% for this week, but right now is batting for the bulls on the Nifty Bank, which has now cut its losses just to around 185 points. We have VIP Industries, which is in focus today, and that's largely because we understand from sources that the promoters are looking to exit their stake. Remember, the promoters had earlier alluded to the fact that they are looking to exit largely because of lack of succession, but right now the talks have reached advanced stages. We understand from our sources that it is a lot of private equity players which are looking to pick up that space, and one of them is multiples PE as well. If the deal does go through, remember, it will trigger an open offer for minority shareholders because the promoters do own 51.7% stake in the company. But more importantly, if you just look at VIP, the promoters alluding to them, looking to sell stake, as a business, it has been underperforming when it comes to the share price. That the deal was brewing is something that the street was sniffing all through, because despite weak numbers, in the last 3 months, from the lows, the stock has rallied almost 75%, but still from the highs that it hit earlier in 2021, 2022, it's down about 36%. Importantly, if you notice, what we'll watch out for is the peers. We have Safari Industries in the last 5 years, which has rallied about 1100%, as against VIP just 82%, and this too from the lows of COVID. In the meanwhile, while VIP has underperformed in the stock market, revival of brand VIP, growth in Skybags and Carlton is something we'll watch out for, along with CSD and, general trade, which we'll keep an eye out on. And finally, watch for competition coming in from existing players like Mokobara, Uppercase, and other newer players. So a deal likely, maybe perhaps soon.
Okay, perhaps soon. So we'll be watching out for that one. Thank you so much for those details, Mangala. Well, from the broader markets, we do have a lot of movers. Jindal Worldwide, for instance, is down 8% in trade as we speak. We do have BEML, that is the other name, which is down 3.5%. The mid-caps continue to be under pressure, though it has recovered a wee bit from the lows of the day. The other one is Keystone Realtors. Metropolis Health is also lower in trade. Remember, it has been buzzing since the time that Q1 update came on the upside, so there is some profit booking that we are seeing right now. Natco Pharma is seeing some profit booking today. The amine stocks, Balaji Amines and Alkyl Amines, both these stocks are lower in trade today. Sapphire has also come in for some profit booking, so 2.5% gone there. But of course, we keep talking about Glenmark. That stock is up around 14%. PFC, REC, these two stocks continue to be higher. So these two stocks are up around 2%. So these are a couple of names from the broader markets which are making big moves today. But as you said, Bank Nifty is the one which is supporting the Nifty a little bit. So that index is not falling as much as the headline index is right now.
And as we slip into that short break, keep an eye out on Eternal and Swiggy. These stocks have recovered from the lows. Actually, for most part of the trade, they were in the red and now have moved into the green. So Eternal Zomato stock comes up for you. And alongside that, we have Swiggy as well, which has now seen a spike, moved from the green, into green from red. We wrap up on this edition of Midcap Radar. Thank you so much for watching. Your stocks when we return.
Hello, good afternoon. You've tuned into Your Stocks, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much for tuning in as always. While we are celebrating that it's Friday, the market isn't, because that's down and out in today's trading session. Almost trading near the day's lowest point as of now is what the Nifty is doing. You can see it, right? 25,170, around that mark is what the Nifty is trading at. Sensex is also down. So almost 0.7% of decline is what we're seeing coming in for the benchmark indices. Other than that, the broader end of the market, that is not doing anything as well, right? Whether you look at the mid cap as well as the small cap, both of them are down in trade as well. 0.7% of decline coming in for the mid cap end of the market, as well as the small cap end of the market is down 0.9%. So clearly, advance decline ratio today is obviously in the favor of declines versus advances. Where's the bright spot, or where's the green on the screen today? Coming in from the FMCG pack as well as the pharma pack. Obviously, HUL news flow that came in, Glenmark news flow that's come in, and on the back of Glenmark, we're seeing even Walk Hard is buzzing in trade. We're seeing Spark that's buzzing in trade as well. So that is something that's where we're seeing a bit of a bright spot coming in. But this is a show where we solve all your stock-related queries, and that is what we'll be doing today as well. We have Shaina Mukaddam, independent market expert, as well as Vaishali Parekh, Vice President, Technical Research at Prabhudas Leeladhar, joining in with us. Shaina as well as Vaishali, good afternoon, and thank you so much for joining in with us as always. Vaishali, before we jump to the queries, a quick check on the markets. What are the levels we should keep an eye out on? Because now we have, gone below those levels that one was keeping an eye out on, the downside of 25,400, 300. Now we're at 25,170 level. So how important is the next level to watch out for, and what is that?
Hi, very good afternoon. So yesterday we saw Nifty was breaking the near-term support of 25,400. So today also the correction continues, and I think it should halt at 25,000 levels. But if it doesn't, then I think it can slide further towards 24,700, 24,800. So I would say now the upside is capped at 25,500 for now, and we'll wait and watch, because if 25,000 levels break, we would be seeing some further profit booking. And as far as Bank Nifty is concerned, well, we are seeing near-term resistance at 57,500, and the near-term support is also 56,500. So, it's at a make or break level, and if that breaks, it could probably go towards 55,500. But so far, Bank Nifty is still holding on. It's the IT sector which is given.
Okay. That's the view coming in on the markets. Nifty, Bank Nifty, keeping an eye out on those levels over there. Let's get started with the queries for today then. The first query is an investment query that we have. This is coming in from Kishore Nayak, who's writing to us from Gujarat. He says, and he's asking if he can look at buying Shriram Finance for the long term at these levels. Shriram Finance, Shaina, what's your view coming in on this one? Is it one of those better placed in the financial world that one could look at? NBFCs, banks, what are you watching out for? And would this be a better bet?
Yeah, so it is among the top 5 NBFCs, and valuations also not expensive. If you look at 1 year forward FY27, it's just about 1.7 times price to book. The size of the assets, total assets, is quite large, 2.6 lakh crores. And while FY26 may see a slight lower growth, we may see a growth of about 15% versus something like a 17-18% last year. At the same time, I think, it's fairly valued. So one can look to enter at current levels. Of course, given the way the markets are moving, it's better to do a sort of SIP in most of your investments that you're making as of now, which includes Shriram Finance.
Okay, that's a word coming in there on the fundamental front. On the technicals, also, does Shriram Finance make the bet for the long-term story, Vaishali?
I do agree, because actually so far we've seen that this is one of the stocks in the NBFC which has done very well, and it continues to be in an upward trend. So even when I'm looking at a weekly chart, since the view is for a longer term perspective, I think this stock is ready for making new highs, all going well. So 600 would act as a near-term support, and we are waiting for a breakout. If it goes above 730 levels, I think this will be poised for even higher levels. So for now, my view would be positive for 750 levels. Then let's have a relook.
Okay, till 750 the view is positive, then one can see have a relook at the stock once that's achieved. Let's move on to the next query for today. We have Venugopal, who is writing to us from Chennai. He's holding 57 shares of Asian Paints. Price is 3,016 rupees per share. Wants to know the long-term view on this one. Okay, right now, obviously, he's making a loss. Asian Paints as such has not done, pretty much anything in terms of a return. China, Asian Paints, and this industry overall has also seen so much happening in the recent time as well, right? AkzoNobel, the takeover coming in there. Then obviously just this week, I think Asian Paints also sold their stake in AkzoNobel, which they purchased a few years ago. So what are we watching out now for Asian Paints specifically? Is there a story that, maybe the viewer could actually come back to those 3,000 levels and recover the cost at least?
Vinny, the only one positive which I see for the near term is the AkzoNobel's, the stake sale, which will bring in some money into the company. But it is not, very huge. And at the same time, I think the competition, the negatives are quite substantial. There is a lot of competition that is coming in. In fact, AkzoNobel's stake was acquired by JSW Paints. So there now, I think they are looking to become a bigger player. And of course, Birla is always like they launched it last year and they are gaining market share. So the segment has become very competitive. So here I see a pressure on overall average realizations over the next 1 year. And margins, we will have to see. They were affected last year. If raw material, the crude oil prices come down, they may see some bit of stabilization. At the same time, I see there is a bit of consolidation that's happening in Asian Paints. So if you want to hold, you can hold with a strict stop loss and sell it, or switch at any bounce, or you can even switch as of now. I would say I would be equal weight to either of the two scenarios.
Okay. Vaishali, on the charts and technicals, what are we watching out for? Because right now what I'm looking at it on the long-term basis seems like, every time it crosses the 3,500 and around that level, then again we see a fall, then again it goes back to those levels. Does it merit that, now maybe on the charts and technicals, at least we could see a bit of a comeback for the stock?
I would say, Vinny, I would take this as a trading strategy. Hard to tell right now for a long-term perspective, because the stock, after a deep corrective move, has given a long consolidation at 2,200. So that means it's made a very strong base at 2,300. Currently, it's shown a rally, and we are seeing some retracement. So as long as 2,300 levels is held on, and once we see the stock moving about 2,600, can one expect higher targets of 2,800 to 3,000 levels? But till then, I would take it as a trading bet. 2,300 acts as a support. It needs to cross 2,550, and then we look for higher targets.
Okay, it has to cross 2,550 first, then you can look at a higher target coming in there and keep an eye out on that support level also that is mentioned by Vaishali. Next query for today coming in from Chandra Moli, who is writing to us from Tamil Nadu. He's holding 600 shares of Laurus Labs. This is at a price of 25 rupees per share, making a profit on this one. Wants to know whether he should sell at current levels or continue to hold this one. China Laurus Labs, what are we watching out for here? Obviously there is that CDMO side and CDRO side that comes in for the company as well. There's a lot more other, segments that they are working on. Laurus Labs, should they book out their profits, given that they're making a considerable one, right? From 425 to 700, above that mark right now. So what should they do?
Yeah, so Vinny, those are the positives. They are into contract manufacturing, and that is the positive in terms of they are a high growth story. They have been, at least. The problems of here are that one is it is expensive at current valuations. Two is that there is some likelihood that the growth may slow down. You can expect something like a 15% growth over the next 2 to 3 years. And the issue over here is whether they will be impacted by the tariffs that the US government is going to be putting on pharmaceuticals. Over the medium term, we will come to know. And that is an important market for the company. In fact, international sales account for about more than 60% of the total revenues. So we will have to wait and watch as to how that will evolve. So I would say take part profits and the remaining you can hold for the longer term, because the company is making acquisitions in various other segments, like, for example, in gene therapy. And those may be long-term opportunities, but at current level, short-term, it is expensive.
Okay. So yes, keeping an eye out over there. A bit expensive for the short term. That's the view there. Lotus Labs on the charts and technicals also. What is it looking like, Vaishali? Should they continue to hold or book out profits?
I would say actually technically too, it has given a one-way run-up right from 600 levels to now 800. So of course the stock has come into deep overbought zone. So I would definitely suggest partial profit booking and then wait for a dip because long-term trend, overall trend looks very positive. If it retraces to around 700, 680 levels, it would be an attractive buy at these levels. So yes, partial profit should be
Okay, surely keeping an eye out on that. Let's move on to the next query for today. We have Gurbinder Singh, who's writing to us from Punjab, holding 10 shares of Trent, and this is at a price of 5,408 rupees per share. He is a long-term investor, wants to know whether it's worthwhile to buy more of these at the current level. Trent, Shaina, what's your view coming in? Obviously, it's given an investor fabulous returns, especially since COVID to now, 2022 to 2025, good returns coming in. But obviously, the updates have come in terms of the AGM as well, where the company was talking about the growth outlook to be at around 20%, while they had spoken about 35% growth CAGR, which we've seen for the company in the past years. Does this mean there's some bit of a concern coming in, and what should the viewer do now?
Yes, so the outlook was a bit disappointing, 20% versus the 25% we've seen in the past year, and which is also again a decline that we saw over the previous year. So basically, we are seeing a declining trend of the growth rate. That is one, and second is it is expensive. Even if you add in the valuation for Zara and for Zudio and for the various subsidiaries that they have. There also the valuation is actually coming down to is just about 70 times. So even if you exclude it, it's 80 times P multiple 1 year forward. So I think it is expensive. So do not add at current levels. I would say a better level to add it would be at least 10% lower than current levels. So you could wait, and it's a good quality stock, and definitely in terms of management. But I see some issues over here in terms of the shorter term. So wait and add it at lower levels.
Okay, wait and add it at lower levels. That's a word on the fundamentals. And technicals also, would you say wait before they add some more?
I definitely would say so because, we have seen one good corrective move. Right now, it is at a make or break level. If we see the stock falling below 53.50, this is ready for a target of 4,800 to start with. So I would say just wait it out. Let's wait for the stock to stabilize, show some clarity. But for now, it's on a corrective mode.
Okay. So wait for some bit of time before you actually enter a trend as of now. Adding some more. So wait for some time. On that note, actually, let's just take a very short break. But remember that you can always tune into the all-new CNBC-TV18 Prime that is bringing you insights from policymakers, business leaders, and economists shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC-TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and Global Lens at 8:30 p.m. Welcome back to Your Stocks on CNBC TV18. Let's keep it going with all the stock-related queries. Now, this next query is come from Jyoti from Mumbai. She is holding 60 shares of Dreamfolk Services. She's bought it at a price of 511 rupees per share. Wants to know if she should book her losses or stay invested. Your view coming in on this one, China. She's making a considerable loss because the stock is already at 159. She's bought it at 500. What's the story now?
Yeah, after the huge stock, the fall in the stock price, the valuations are not expensive for the historical valuations. Having said that, I still think that she needs to exit from the stock. There are a lot of negatives that have happened in the near term, which are likely to affect their business. One is their large, contributors to revenues. Banks, ICICI Bank, Axis Bank have actually, I believe, discontinued their tie-up with Dreamfolk for the airports. Two is Adani is looking to actually, be there by themselves in their own capacity in the same business, which is likely to be a problem for the company. And Dreamfolks will have to actually then revisit the whole business, how they are going to sort of replace the exiting business and get in new companies to, new banks to tie up with them. Or how exactly they're going to grow in terms of margins. Also, their margins are under pressure. So I would say it is better to exit. There are too many variables which are negative.
Okay, better to exit. Too many variables there. Vaishali, on the charts and technicals also, would that be the suggestion?
I would say so. It has been just a downhill right now since a very long time. There is no respite. I think one should exit and move on to a better quality stock.
Okay. Exit and move on to some other stocks is the word coming in there. Let's move on to the next query then for today. This is coming in from K. Padma, who's writing to us from New Delhi. She wants to invest in LIC and is asking if it's the right time to enter this one. And for the long term, what does, does it merit entering LIC versus other insurance companies? Your view on this, Shaina?
Yeah, LIC is in terms of valuation much better placed than the other insurance companies. So yes, you can buy LIC. At the same time, I would still prefer that you buy it at slightly lower levels, maybe between 800 and 900 rupees. You can average it out between this level so that you can make a decent amount of money over the next 1 year. Here, the valuations are good, as I mentioned. Embedded value is just about, if you compare it to price, just about 0.8 times, which in my view is quite attractive. Going forward in FY26, while we may see low single-digit growth in terms of the overall business, in premiums, in the number of policies sold, but I think margins are likely to improve because they are moving on to the non-par side of business, which is actually which enjoys better margins, of course, because they don't have to share their profits and bonuses, etc. So all said and done, I think you could enter into LIC by 10 dips.
Okay, could enter into LIC right now as well. What is the word coming in on the fundamentals? On the technicals, what should one be doing? LIC, given that, in the last couple of months, we have seen the stock run up, Vaishali. So, is it the right time right now to enter, or maybe wait for some bit of a lower level or some bit of a correction there?
I would say, Shaina, it's already in an uptrend. Yes, agreed. But sometimes when the stock is having an inherent strength, it may not correct also. So I would say accumulation would be the best strategy. Right now it's at, of course, 924. And a good strong support comes at around 850, 860. So I would say accumulate from here on at every dip, and so that you can get a better price and then wait for the run.
Okay. Next query for today is coming from Neil Deshpande. He's writing to us from Mumbai. 300 shares of SAIL is what he's holding at a price of 160 rupees per share, and another stock also he's holding, that is NHPC. Here, 500 shares at a price of 115 rupees per share. So they're making a loss on SAIL as well as NHPC as of now. Wants to know whether should they continue to hold or look to exit at current levels. Shaina?
Basically, after the stock having corrected, we are seeing a slight bit of rebound in both the stocks. So at current levels, I would say a hold. There are positives that are there in both of these stories, which have seen that slight bit of rebound. So I would wait for a better price to exit or switch. In SAIL, what has happened is that the government has actually recently put in a 12% safeguard duty. Now, this will to some extent, protect sale, which actually has a large part of its sales from domestic, the domestic market. So to some extent, it will protect it. Also, overall steel prices are stabilizing. If you see a 1 year period, they're slightly soft, but they're stabilizing. So to that extent, I think sales should, have reasonable amount of shows reasonable performance for the year. I would hold, but then again, we have to see what will happen in the international market because of the tariffs being very high, 50% tariffs. So how they will manage that and what will be the impact of it on the global steel prices. As of now, it's a hold. Now for NHPC, there, one of their major projects, which is 800 megawatt HP, the Himachal Pradesh power plant has actually commenced operations in April. So that is going to contribute a large chunk to a growth in revenues. Having said that, there I think the margins are under pressure. So, but in terms of numbers also, maybe the current year will be better than the previous year to some extent. So to that extent, you wait and then look for a bounce to switch from both these stocks.
Okay, wait out for a bounce from both stocks as well. But on the technicals, Vaishali, what are we watching out for? SAIL as well as NHPC. And given that they are making a loss, would it also merit maybe to, average out a bit right now?
Yes, I was just going to say that because actually, depending on the time period that he's trying to hold, if he's a trader, of course, one needs to keep a trading stop loss because market is going through the whipsaws and we are awaiting the big event. So now, if it's for a longer term perspective, yes, do accumulate. If it dips at around 120, 125, that would be a good buying opportunity once again to average out his cost. Now, talking about NHPC, it's already in a good established trend. The stock showed a good momentum even yesterday. Technically, it is showing strength with a support of 8,400, and we would now look at a near-term trading target of 92. Once we see a clarity of the stock going above, I think we can have a possible target of 110, 115. So in my opinion, this makes a fair level to again averaging it out.
Okay, I can look to average also. That's a word coming in there. Okay, that was the last query for today. So thank you so much, Vaishali as well as Shaina for joining in with us as always. And hope you'll have a great weekend. And viewers, thank you so much, as always, for sending us your queries. Remember, you can always send us your queries. Keep sending us your queries. We'll solve them Monday, Wednesdays and Fridays with our experts. But thank you so much for tuning in today as well. Don't go anywhere. Up next, we have Closing Bell to take you through the last hour of trade.
go beyond market headlines to understand the reasons for the day's movers and shakers and get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
The Hang Seng is still holding on to some bit of those gains, trading with gains of around 0.8%. The Taiwanese index is absolutely at the flat.
Company's top line, constant currency revenue growth has declined by 3.3% on a sequential basis.
We partnered with AbbVie for US, Canada, Europe, China, Japan, most of the developed markets.
So the support for the Nifty at 25,244, which is the 20-day moving average.
This also included a minus 2.8% of BSNL degrowth.
The Nifty is down about 1/3%. The Bank Nifty is absolutely flat. Actually, the Bank Nifty wants to come into the green.
India needs companies like this to sort of create talent pools and, more importantly, create manufacturing.
Today we are below that 25,200 mark, and in just last couple of minutes we are at the day's lows.
Now the leader is Priya Nair, who has been appointed as MD and CEO to succeed Rohit Java.
Tesla is all set to launch officially in India. This is on the 15th of July. Maker Maxity Mall in BKC in Mumbai.
Consistently been breaching those levels, first 25,500, then 25,400. Today we are below the 25,200 mark, down 200 points on the Nifty, and even the broader markets are not supporting.
Well, it's 200 points lower on the Nifty. That was the day so far in terms of what has happened. And it's been consistently down, that is. This is the last hour today, the last hour this week in terms of trading action. We're coming to you from the CNBC-TV18 Motilal Oswal studios. With me, my colleagues Surabhi and Reema. Guys, hi. Afternoon.
Hi, good afternoon, folks. It's been a tough week for the bulls. It's been a slow grind. And towards the end of the week, between Thursday and today, it's become now a bit of a cool-off. Index down more than 1% for the week. Mid-caps also. The cuts are between 1 and 2% for the week now.
I'm sorry, Nigel is also with us. I thought Nigel is taking it easy today. But Nigel is... maybe Nigel is taking it easy today.
It's a full house after a long time, guys. So congratulations to all of us for making it.
Feels like an achievement, no?
Yeah.
But
I have been here. Welcome back, guys.
That's right. I think we should welcome ourselves back. Huh?
That's true.
It's kind of a little bit under pressure. But if you had to kind of sort of write headlines for, as they say, news headlines to describe the market this week, would you say it's a bad week? Would you say the markets are in a downward drift? Or would you say it's kind of sort of the activity just generally quietened down quite a bit? And I think it would be the latter. Started on a very quiet note. Bulk of the week has been pretty close, quiet in terms of volumes, etc. And now, once again, today, it is quieter, but on the downside. The only difference between today and, of course, the rest of the last few days has been the fact that the Nifty IT index is seeing an outsized near 2% fall. And that is almost single-handedly contributing to bulk of the losses. It's not as if the broader market is doing all that great. Advance decline, the last I checked, is negative. 2 declines to every 1 advance. But in terms of just the sheer fall that we're seeing, the 200 point, I think you can chalk it up to what's happening on the IT stocks. And Reema will have more on that. Reema?
Indeed, the Nifty IT index is down 1.8%. And even going into the numbers, it was a bit subdued this week. The IT index is down 4%. It's stocks like TCS, 3.5% at the day's low now for TCS. Wipro under pressure, 2.5% ahead of numbers next week. So next week, you have numbers from HCL Tech, Wipro, Tech Mahindra, and on Monday, you also have Tata Tech. So we will know in greater detail whether this TCS number, what we've seen in TCS is a broad-based pain across the industry, or TCS particularly was hit harder than the rest.
Oh, absolutely. It's been a disappointment. No two ways about that. But let's see. Talk about what else is leading the market down, because you cannot squarely pin the blame on TCS. Other weak hands include big names like Reliance. A lot of financials actually are also weak, including the Bajaj twins, Bajaj Finserv and Bajaj Finance, both on the weaker side. There's some cool off in Geo Finance as well. Bharti, second day running. Bharti was down about 2.5% yesterday. It's down another 2.5% this afternoon. So there's a fair bit of weakness. If anything, the banks are relatively better off because at least they're not leading the decline. They're not down the most. ICICI Bank and SBI, they're all sitting on the fence. And if they decide to make a bigger move in the next 60 minutes, it'll obviously have a bearing on the index. On the upside, it's Lever all the way. It's actually been FMCG's week. Lever is not just the best performing stock today, it's the best performing stock of the week as well, of the week and the month. Lever's put on 8% very quickly in the last 5 trading sessions. So really holding out. There's some green on Nestle as well. But yeah, I guess, the big story, Nigel, of the week has been the hope around FMCG.
Well, indeed, Surbhi. And I think by the end of today, the bulls will like to get closer to around the 20 DMA. It's around 80 points away from current levels, but I think the bulls will want to conquer that 20 DMA on a closing basis. So we'll have to see how it goes, but it'll be interesting to see who exactly puts up and fights for the bulls. For the time being, we're seeing a couple of these pharma stocks, Cipla, Sun Pharma, both of them at the high point of the day. And Tech Mahindra actually has cut its losses. So that's another interesting mover out there. Somil Mehta from Mirai Asset Sharekhan joins us on the show. Hi Somil, good afternoon. Good to see you in. Friday afternoon, how are you feeling about the markets? People wanted a dip. They've got a fairly okay dip, 26,000 to around 25,100. You look to enter, or do you believe the market wants to test lower levels?
Hi. Afternoon to everyone. Today is the first sign of reversals. I can see that the markets have broken the previous swing low, which was 25,330. Closing below 20 daily moving average. So this is the first sign of reversals in the short term. And I think it's best to book some profits and go short on weaker sectors like IT is already weakening. Auto sector, the large caps are looking weak. Oil and gas, GAIL, ONGC are looking weak. So large caps are looking weak there. And in fact, mid caps would be correcting very sharply if the large caps are correcting sharply. So today is the first sign of reversal. And I think the next targets would be 40 daily moving average, which is 25,000, close to 25,000, and the lower Bollinger Band of daily charts, that is 24,700. So these are the two levels I'm looking for in the very short term. And now the view becomes a little negative on the short term horizon.
Okay. Samal, hi, afternoon. Good to see you. Your stocks?
My stocks would be, one of them would be from IT, Wipro, sell on every rise, trading below 200 daily moving average, trading below 20 and 40 daily moving average, just broken a small consolidation on the downside. Stop loss would be 265, target would be 242. The second stock would be Crompton, same setup, consolidation broken on the downside, below 200 daily moving average. Sell on the momentum indicators. Stop loss would be 345 and the target would be 320.
Okay, Samal, thank you very much for that. We'll come back to you for more. Lever is the big story, right? So it's made people sit up and take note. Abrupt kind of a departure of Rohit Java, and there's a new boss at the country's largest FMCG company, which of course is also a jewel in the crown for Lever globally. Mangalam is standing by to run us through the news, of course, which we've been tackling, but I mean implications really. Mangalam, over to you.
Well, the most important story that we've seen in the consumer space this month, at least, if not this quarter, that is the management rejig at Hindustan Unilever. The big news that came in yesterday as a surprise was Rohit Java deciding to step down within 2 years of appointment, making it one of the shortest stints that we've seen as an MD CEO of Hindustan Unilever. He wishes to pursue personal goals, but more importantly, Priya Nair has been appointed as the MD and CEO with effect from August 1, 2025. The first woman leader of Hindustan Unilever, the first time, but I guess about time, largely because they've spawned a lot of women leaders who've gone ahead and led other companies, the likes of Prabha Narasimhan, who leads Colgate. You do have Geetika, who leads Nivea India, and many others. Priya Nair currently is the executive director beauty and well-being at Unilever, but that's just a very recent position. Before that, she's been in Hindustan Unilever for a very long time. She joined Hindustan Unilever in 1995, known for digitization, premiumization, and purpose-led brand building, particularly in the home care space. So home care and beauty and well-being well taken care of by Priya Nair's experience. The first woman CEO of HUL. Remember, most of the consumers for HUL are women, so it's about time that the leader is a woman as well. But more importantly, a couple of things that we'll be watching out for as she takes takes the chair of the MD and CEO. The first thing, the consumer sentiment, which has been very tough for the last 2 years. That is turning around. So recovery in volume growth led by consumer sentiment is something that the street will keep an eye out on. Secondly, there has been a strong premiumization trend in beauty and personal care. And in that, Hindustan Unilever has not been at the forefront. In fact, a lot of these D2C brands have been at the forefront. So the minimalist acquisition and all these things that they're doing can, Priya Nair actually go ahead and lead growth in the premium personal care brands as well, along with her experience internationally. And finally, personally, I'll be watching out for what the company does in the foods portfolio, because ever since the Horlicks acquisition, growth in the foods portfolio has not been as analysts expected. The other parts of the portfolio have been impacted by commodity prices. And now with the ice cream business being demerged itself, what remains and how the company can innovate and grow in their foods portfolio, something that the street will be watching. Hindustan Unilever, the stock has been under pressure, in fact, underperforming for the last 5 years, absolutely flat. The previous 5 years grew about 4 times. So after this time correction, after this valuation correction, with a leadership change and consumer sentiment reviving, are pieces of the jigsaw falling in place for Hindustan Unilever to rise again.
Well, Perth, thank you very much for that. Let's ask this question to Siddharth Bambre from Asit C. Mehta Investment Intermediates, who's joining in. Siddharth, would you say that this could be the turning point for HUL, at least over the near to medium term?
Good morning. Good afternoon, Rima. Thanks for having me on your show. Mangalam pointed a lot of important points. And just to add what he mentioned, the beauty and personal care segment, which constitute around 36% of the top line for HUL. And mind you, this is the highest margin segment, around 25% for HUL. And with now a new leader who has extensive experience in the space, and probably would bring in a lot of international experience also with her now. I believe the growth rate in this segment, which is a high margin segment, was very tepid, around 1%. And if it goes to 4 to 5%, I think HUL would see significant re-rating. As Mangalam was pointing out, last 5 years stock has not done anything, thanks to earlier there was a lot of demand issues, first pertaining to rural, then urban stagnation. Now we would see that the P for HUL, which was trading at 7 to 8 years low, around 2200 levels, though there has been a sharp rise in stock price, but we still feel that if the demand revives, combination of premium products coming up, margins expanding. So I believe this would lead to re-rating of HUL, and combined with overall market where in large caps or even in mid caps where valuations is difficult to it's very difficult to justify buying a stock based on valuation. I think HUL would be a compelling story going ahead.
Okay, so positive view on HUL. Got that. Siddharth, good to have you on the show, connecting after a bit of a gap. So good to see you in. Overall, let's talk about earnings and what your estimates are for Q1. I mean, broadly, the expectation is that earnings will be much better this year compared to last year. Which would be the specific smaller segments or sectors where you would expect a meaningful growth pickup?
So, Subi, thank you once again. And great to connect back with CNBC-TV18. We are expecting H1 of FY26 to be a bit muted. And I think we are not different industries also expecting the same. The growth would probably emerge in H2. And FMCG is one of the space where we would see growth would come back. We have some names like Godrej Consumers, then probably Bikaji over there. Then we would probably also see highly competitive space of late. Varun Beverage, which is also a part of our coverage. There we would see that earnings would revive. Stocks has been under pressure. Even if you look at some of the beaten down names, and I might be in minority over here when I state that we are expecting paint companies to see a higher growth rate. But again, I'm saying that it will be more of H2 rather than H1 over here. We are liking their Berger Paints, which is not the leader in space, but we are seeing, in fact, a few weeks back, management was there on your channel and they had a very positive commentary pertaining to the demand scenario. We also like Kansai Nerolac in that space, which is combination of industrial and decorative space. So these are a few names from consumer perspective. From BFSI, I think one should keep eye on what's happening in smaller banks. Some of these smaller banks who had exposure in MFI space have done a lot of rejig in their product mix. Also, there are some of the names down south where we are seeing the credit offtake in these banks are substantial. ROEs are improving. NPAs have been taken care of. And as everyone says that, corporate balance sheets have been quite deleveraged. So even some of the PSU names would probably do well. So there are a lot of pockets where probably you would see earnings reviving. But can you say that valuations are cheap? I think it's very difficult to say that. So lot of tactical positioning one has to do in this kind of market. It won't be easy, just to buy and then forget it for 1-2 years. I think there will be a lot of tactical shifting one would have to do if you are not a very long-term player in this market.
Got that. Let's quickly just address TCS because that's the big drag today. Stock is still down about 3.5%, and now the year-to-date correction stands at nearly 20%. Big miss on the company's top line, 3.3% lower. A majority of the reason is because of the BSNL ramp down, but even otherwise, ex of BSNL, the company degrew by nearly 0.5%. And the thing is that, when we asked the company, the management, about whether some of the projects which are paused right now, are there any signs of them restarting, he said not immediately. When also asked, then is Q2 going to be a washout? He said it's too early to say if it's going to be impacted, but he isn't seeing a big bounce back, at least coming through in Q2. Second half, we'll have to see how that plays out. So what should be the appropriate valuation multiple you should ascribe? Because, it's unlikely, given the state of affairs right now in the start to the year, that FY26 growth for TCS is going to be better than FY25 on the whole. For the ex of BSNL business, it may be. The management believes it can be. They're confident about it. But on the whole, they're saying it's going to be tough for the company's FY26 growth number to be better than FY25. So Siddharth, with this kind of a growth, we're talking about 1-2% kind of a revenue growth for India's largest IT company. What does this tell you about the sector per se and what it's likely to do in the next 1 to 2 years? And if someone is an investor, should they sell out now and perhaps look for other companies where there could be better growth? Or this is not the right time to sell a marquee company like TCS?
We are negative on IT, and I'll tell you why. We are interacting with a lot of money managers, and beginning of this financial year, we took a call that if you want to beat, especially in a large cap fund, if you want to beat index, the strategy is simple: that you have to be overweight bank and you have to be underweight IT. These are the two heavyweights. Why underweight IT? Because now what TCS management said yesterday and today to all of you, that was clearly writing in the wall that because of geopolitical issues, because of trade conflicts, the most impacted sector for India would be IT, probably followed by pharma, because these are the two spaces where the exposure to US is pretty high. And not that this 1%, 2% or 0% growth. This is not first time IT space is experiencing that. We have seen this happening before, but what is different this time is valuation. Earlier, when we saw the IT space not growing or slightly degrowing, you would probably see TCS available at 20-21 times P. You would probably see Infosys available at 17-18 and HCL Tech Wipro probably less than 15 times. But right now, we are seeing most of these names are available at 25 times P. So I am not very comfortable, buying these names now. And if there is no growth rate, the only way they will become attractive in valuation by price correction. So even if you are an absolute investor, I think this is not time. This is not right time to take exposure in IT. And even in mid-cap space where people would say the growth is coming in mid-cap space and now valuations are happening in price to earnings, and people are adding PEG ratio in that. But the sensitivity to growth increases when you see PEG. So even if there is a slight fluctuation on growth on the low side, you would see a significant derating in even mid-cap stocks. So I think for next 1 to 2 quarters, it won't be a wise thing to add too much of weightage in IT portfolio.
All right. Hi, Sid. Good afternoon. Good to see you in. Sid, give us one stock, though. IT, mid-cap IT could be a little expensive, but from the the mid-cap space itself, there'll be a couple of stocks that you like, right? Name one for us. Friday afternoon, our viewers would like to know one stock.
So IT definitely not, Nigel, but then if you insist on other mid-cap space, yes, we are covering a lot of mid-cap names.
Give us
I
one.
mentioned one of these stocks. It's a Bikaji is something which we are liking in FMCG space. You can also look for Karur Vysya Bank from a mid-cap space.
Karur Vysya, got it.
Okay, so Siddharth, let's talk about some ideas. And as we go through some of these earnings, you've given us some names, BFSI, what you're watching out for, some of the paint companies. But if I were to ask you about 3 or 4 high conviction names from your list, your universe, and these are not short-term trades that we're talking about, but investment ideas, what's top of mind for you?
So the ideas which I gave, that is Bikaji and Karur Vysya, these are purely based on fundamentals and the kind of valuations which we are seeing. So Federal Bank, if I have to elaborate on that, so this bank is showing decent credit offtake around 15% or so. We are also seeing that the exposure to MFI is negligible, and we are seeing improving ROAs. Also, we have seen that, from valuation perspective, it is right now available around 1.3, 1.4 price to adjusted book value. And looking at how, financials are doing, easily this stock can move towards, the valuation can move towards 1.6 to 1.7. So we have a decent price target of around, which is giving a decent upside of around 15 to 18% from 1 year perspective. Obviously, if markets are volatile, stocks can come down and we can buy that. Now, if I look at other spaces which we are liking, look at some of the names in cement space. Now, cement story is purely based on how much one is adding capacity. So some of the names which we recently added to our coverage, like Dalmia Bharat and JK Lakshmi Cement. Now, these stocks, of course, they have run up recently, and we did had coverage 1 month back. So these are also 2 names where we are seeing that. The input cost pressure, be it the limestone, be it transportation cost, be it adding green energy to its consumption, we are seeing that from realization perspective, from pricing perspective, the environment is quite favorable for these names, and especially those companies which are trying to cater towards the eastern market, where demand scenario is pretty high. So even Dalmia Bharat and JK Lakshmi Cement are some of the names which we are liking from fundamental perspective, from long-term perspective.
Okay, all right. Thank you very much. I appreciate you joining us. With a couple more questions, but out of time next time. Look forward. Thank you indeed. We'll take a quick commercial break here. We're going to come back with Rahul Veera of Nippon India AIF on the other side. We'll talk some sectors and Rahul's broader market thoughts. Okay, welcome back. Now, about 35 minutes to go as far as market closing is concerned. I just want to quickly make a mention of what's happening in Religare. Religare has moved up sharply. Just look at that, 9% higher on Religare, 273 odd rupees or so at this point in time. Now, there is a board meeting today in which, most likely the Burman family, which already owns a little over 25% in Religare, is going to put in more money. Now, the widespread expectation is that they are essentially going to buy more than 5%. Remember, if they buy more than 5%, that sort of triggers an open offer. The offer will have to be, remember, there was an offer earlier. The earlier offers was at about 235 rupees, but that kind of failed because the price moved up and nobody really tendered their shares in. This time, of course, the expectation is that, they will buy over 5, trigger the open offer and kind of sort of acquire a substantial portion of the company. We'll see. We'll wait and watch what happens. The other sort of line of thinking here is that maybe the Burman stay under 5%, not trigger the open offer, and trigger a pref issue. I mean, essentially the company does a pref issue, brings in some outside investors, etc. as well. So, as I said, the board meet is today. These are the two, in a way, sort of lines of thinking as far as Religare is concerned. We'll have to wait and watch to figure out what essentially exactly does take place with this one. But, the story has been very clear, compelling in terms of Religare, the Burman family, some of that Dabur P multiple magic rubs off on Religare, although in terms of the business value at Religare, it largely is the insurance subsidiary, which is Care Insurance. And of course, there was that protracted battle going on with the CMD, Ms. Saluja. So I think all of that, of course, also now fading into the background. The hope is that there will be the Burmans who will take charge and sort of build out the other businesses, broking, NBFCs, and whatnot. So we'll see how this one goes. But today is an important day in that sense, and a sharp up move coming through. Rahul Veera from Nippon India AIF is with us now to take us through what he's making of things. Rahul, good to have you with us here. Thanks very much. What are you eyeing, Rahul, at the AIF, at the fund? I mean, where are the opportunities?
We believe that overall at this point of time between the large caps versus mid caps, there is some valuation gap between the large cap and mid cap, but given the 1 year or 2 year, mid caps will relatively be better in terms of the absolute alpha or the outperformance versus the large caps. So across, whether it's banking sector or the IT sector, we've seen that the large caps in terms of their outcomes versus the expectations is relatively weaker. Whether it's bank or IT, you will see slightly better returns in the mid caps across banking or IT names.
So you want to just quickly, Rahul, tell us any big changes that you've made to your portfolio in the last 1 month? Any thoughts on IT and the way we've kickstarted the earnings season?
So in IT, we continue to remain a little bit on the mid-capish side. And we might take some contra calls on the ENRD space overall, which have not performed well. But we are seeing some slightly green shoots in that space. Probably some of the names that we have historically been ignored in the last 1.5 years could give some decent alpha over 1 to 3 years now.
So ER&D space, particularly auto, or it would be across, tell us a little bit more about the thinking and what are the green shoots that you're seeing?
We are seeing some positive commentary coming out on the lower base side. So some of these companies that have global companies that have commented slight positive on the ER&D expenditure. So probably this will be the green shoot that we are looking at this point of time. The company's numbers that will be reporting on the domestic side will take some time to show that. But in terms of valuations, they are closer to the bottom now.
Okay, so that's a take on IT companies. Rahul, hi, good to have you on this afternoon. What's your stance on FMCG? Because the market is now building on this hope that maybe we're past the worst. And even if volumes pick up a little bit from here, maybe that could result in stock price appreciation. Your thoughts?
Again, here we are playing a similar thesis in terms of between the large caps and the mid cap. On the consumer discretionary spend, we are focusing on more of niche consumer discretionary names there. Large staples, we'll see some revival. Volume growth is going to come back across a few names, given the low base last year. Plus all the macro indicators, right? Whether it was your salary transfer, taxation, all the other data points that we are aware, good rural monsoon. So some kind of indicators are there, but on a low base, they'll do better. But in terms of pure alpha generation, we prefer to be on the mid-cap names.
Yeah, got that. I just want to take a quick look at some of the other movers, right, which are coming through. BSC is down another 3.6, 3.5%, right? So actually, just look at this week. This week it's down 10%. That is Bombay Stock Exchange. And from the highs, it is the high was made. It was, I think, on Monday morning, right? The news came that SEBI order came. That was last Friday, Friday morning. The high is about 3,030, and the stock is about not 1,000 rupees, but less than 1,000 rupees, 2380 or so on BSE at this point in time. IREDA is another one. We spoke with the management earlier. IREDA, by the way, is down 5.5%, and it's the third largest volume-led loser right now on the NSE. There is MCX, which is another one, which is down about 3.5%. I think for the week it's down again 10%. So it's not a great week for exchanges. And MCX, by the way, is of course the monopoly business as far as commodities is concerned. CDSL, Amber, Elecon, Hitachi India, BEML. Actually, there is, I can spot at least 12, 13 very large volume-led losers coming through today. Unlike what we've seen over the last couple of days or so, there's more HUL information flashing at the bottom of the screen. On the screen, this is a CNBC-TV18 exclusive. The current CFO of HUL, as our colleague Shilpa will tell us, and she'll join us in just a bit, is also likely to step down and is likely to be moved to a global role. This is what we're picking up. We will put out the HUL statement as well. We wrote to them, and I think we've got a response which will be put out as part of the graphics in a bit. So Ritesh Tiwari likely to step down as HUL CFO to be moved to a global role. This, of course, comes after Mr. Rohit Jawar, the CEO and MD, stepped away from that position as well. So looks like at the top level, there are changes and maybe a new team which is being brought in with a new sort of boss right at the top coming through as well. I don't know, Rahul, if you have any thoughts, and as I said, Shilpa will join us with the story in a bit, but in the meanwhile, any specific thoughts on this development? If you don't want to talk about lever per se and what this means for lever, it's a giant, tough environment, in that sense, a new boss. How do you view that as an investor?
So management change, and that too when you see the background of the new MD, right, in terms of the kind of achievements that they've been able to get, the kind of aggression that they've been able to get, there is some kind of a hope that gets built in. So that is what we are seeing, the reflection in terms of the built-in expectations from the investor community at this point of time. But again, as I said, in terms of what we are paying for the same staple companies at 45, 55p, it's a little bit challenging for us to take calls on these at this point of time.
Hi, Rahul. Good afternoon. Good to see you. And how are you placed on pharma? Glenmark Pharma, out of nowhere, there's this big news that's come in there. The stock already rallied 20% in 1 month. It's put on another 15%. The street is optimistic. One would wonder whether or not it's making a near-term peak. But what's your view on the pharma space? What are the opportunities you all have identified?
See, between the pharma space, we are avoiding the larger generic names. CDMOs or domestic pharma names are the relative better ones at this point of time. Again, pharma as a space continuously remains a pure bottom-up stock picking game. Now, the event that we saw today for one of the names that we just discussed, such kind of events will always create a new trajectory for the company and help in the medium term. But on the generic versus CDMO versus the domestic, we are preferring the CDMO and the generic space.
Rahul, so ER&D could be a potential contra call. Anything else where valuations are looking attractive and growth will soon follow?
Right. So at this point of time, whether it's cement, chemicals, and a little bit of discretionary consumption, this is what we are looking at this point of time. We believe there will be a reversal in terms of volumes, pricing across both cement and chemical as well. So there is a kind of an expectation that is not yet built in. So we see some kind of upgrades that will come through in the cement as well as the chemical names.
Okay, all right. We will wind it up on that note. Thank you very much for being with us, Rahul. Wish you a good weekend, and we look forward to more conversations. The Unilever news continues to be digested by the market. The stock is absolutely fine. I mean, though, yes, it is two top-level, potentially two top-level departures. One is official. The other is, it seems to be in the works. The stock is okay because the new lady coming in is not so new after all. She's an old hand. And perhaps the market's, betting on her leadership now. 100 rupees higher on Hindustan Unilever today. Let's move on to the other big story that's been playing out over the last 24 hours, and that's Glenmark Pharma. The company has signed what is a landmark out-licensing deal with the US pharma company AbbVie to develop and sell a drug to treat multiple myeloma. Now, this is very big for Glenmark because the company stands to gain as much as $700 million right up front in upfront payments and maybe over $1 billion over the course of the life of this drug if it proves to be successful. We caught up with Mr. Glenn Sanlana on the deal and what it means for Glenmark.
Clearly, this is a huge moment for us, right? I mean, we've been working on this for 25 years in the innovation space, and I think 2001 really is a world-class asset, right, which can be transformational for patients. From a partnering perspective, the way we've structured it is we've partnered with AbbVie for US, Canada, Europe, China, Japan, most of the developed markets, and Glenmark will commercialize this product eventually, right, in India and all emerging markets. So the two of us will make sure this asset is successful going forward.
So explain the financials to us. $700 million is what you would get upfront, $1.2 billion in terms of milestones, and the remaining would be royalties.
That's correct. So we get a $700 million payment upfront, and as soon as we get regulatory approvals, that money will be received by us. The milestones, the $1.2+ billion of milestones are spread into clinical development milestones. So as the molecule progresses to clinics, we keep getting milestones. Regulatory milestones, so as the molecule gets filed in various markets, we get and approved, we get milestones. And then we get sales-linked milestones. So cumulatively, that number comes to $1.25 billion, for the asset. And then once it's commercial, we get royalties on sales, which, as you know, some of these innovative products, the life of the royalties is pretty long. So this could pretty much be an annuity if the molecule makes.
When do you think that it will probably hit the market or show any kind of results?
So AbbVie takes over all clinical development from here on. In terms of time frame, I mean, I can't give you a specific time frame, but typically molecules, if you look at other assets, right, in the space, they typically take about 4 or 5 years at least to get to commercialization.
Okay, that HUL exclusive that we put out with which our colleague Shilpa is getting to. Shilpa, good break. And what are you picking up? Is this imminent? And tell us about this.
Yes, well, what I'm picking up is that as part of the management rejig that's happening at HUL here, now the CFO also, Ritesh Tiwari, is likely to be stepping down from his role as CFO. But unlike Rohit Chawla, who's leaving the organization, Ritesh Tiwari is most likely to be moved to a global role. And what exactly that is we are yet to get some clarity on. Now, remember, he's been the CFO of the company from 2021, and this move comes at a time where the FMCG industry and the company has been grappling with low volumes. There's been subdued consumer demand. There's been rising competition and rising inflation as well. And at such a time, there is a rejig. And this is not just independently happening only in HUL, right? Even at Unilever, we've seen a rejig that happened in February also. And these are a series of steps that have been, set in motion as a larger turnaround plan for the company at a global level. So what we've been given to understand is that Ritesh Tiwari is likely going to be moving on from HUL, and he will be given a global role. Now, to understand a little bit about him, he's been with HUL since about 1999. He's held a whole host of roles, and he has been the CFO from the 1st of May. Now 1st of May 2021. Now we reached out to HUL, and what they've told us, and I'll read that out to you, is that at Unilever we consistently nurture talent and groom leaders. Our career planning includes equipping our people with wider skills and experiences to pursue diverse career paths, and this is part of our ongoing talent development process. So HUL has not denied the development yet, but they haven't even categorically, sort of confirmed it yet. But this is what HUL is telling us, and that's what we are picking up from our sources as well. Back to you.
All right. Thank you very much for that, Shilpa. Appreciate it. Well, that's the lever sort of break. Stock, of course, has been firm and hopeful from the word go, and kind of hanging on with those gains even right now. So, do you want to come in?
Yeah, no, I was just saying that, that's lever, and lever really has been the stock of the day and the stock of the week as well. We'll take a break on that note, come back on the other side, and we'll get you all the buzz and chatter from dealing rooms, and then some final trading calls for today and for this week.
Welcome back. Well, the markets are still down close to 200 points, really lacking direction. It's a listless session yet again, but now we're moving gradually to the lower end of the range. That said, it's time for our special segment, D-Street Chatter. Nimesh joins us to tell us how is he reading the trading action. Well, Nimesh, another day we're down 200 points, but there's still not a big reason to be concerned, I think so.
Absolutely. If you look at this week, the Nifty is down 1%. We've lost a bit of momentum. There is lack of participation, lack of triggers as well. But having said that, it may not show up on the indices or in the Nifty or the mid-caps index, but a lot of individual stocks have yet done very well, especially the broader market names. I was surprised to see a lot of SME stocks doing very well in this kind of a market where it's lost momentum and a bit of buying interest as well from large institutions. So from that perspective, it's been quite range-bound and lackluster, so to speak. Today it's dragged by IT because that's been a big weight, and because of TCS numbers, we saw a bit of reaction on all IT names. But again, from a flow perspective, it's been pretty mixed. I understand there's going to be a small MOC basket selling, so some individual names may get impacted in the last 30 minutes of trade today. As I said, the broader markets are relatively outperforming. So while we've lost some bit of momentum in the broader markets as well, still selectively in the mid caps, small caps, micro caps, we're seeing a bit of interest and a bit of momentum as well. So that looks like it's going to continue at least in the near term. Of course, earnings will be a big trigger to watch out for. Technically, as you've been highlighting for a while now, 24,500 is a big resistance on the upside. So looks like that will be a difficult ask, given that earnings have been a bit disappointing, so to speak. But from an institutional participation point of view, Nigel, this was a week where we lost a bit of momentum for sure.
Well, that's right. Institutional participation is out. But, Nimesh, I've been looking at two indicators, and one of them that you mentioned. I was trying to do a market recap for the week, and the SME index is up 5%. The BSE
index, exactly,
is up 5%. So that's the big outperformer. Tell you the kind of mood, actually, from the broader markets. And globally, if you look at it, the Bitcoin is making fresh highs yet again. Overnight, it was up 5%. That said, individual stocks, what's on your radar?
So I'll talk about individual names, but just to add to the SME index, even if you look at the IPO index, BSE IPO index, that's up 2%.
2%, correct.
So, clearly there is momentum in newer names, IPO stocks. So that's clearly there. In terms of individual names, though, the first stock on my list is Sagility. That's been seeing a bit of buying interest from larger FIs in the last couple of days. Yesterday there was huge delivery volumes. So is the case today as well. I understand a leading global fund and one domestic mutual fund has been aggressively buying. Remember, today Jefferies has added Sagility to the model portfolio as well. So a bit of institutional interest seems to be back in that name. Second couple of names where I understand there could be blocks very soon, MediAssist as well as BLS International. Both are consolidating off late, but I understand there could be large blocks soon in both those names. And the last name is JSW Energy. After a long bit of consolidation, you're seeing a bit of buying back in that particular name as well. A bit of momentum is back. There is a buying interest is what I understand from larger institutions. And specifically for JSW Energy, a leading domestic mutual fund has just started accumulating at lower levels. So this is where a bit of delivery has happened in the last couple of days. Some domestic mutual funds have bought.
119.
All right, Nimesh, thank you very much for that. So as always, a lot of chatter in the market, even as you put it, maybe a little bit of loss of momentum is what we've seen through the course of the week, especially today. Somal is back with us with what to buy or sell today for a reverse trade tomorrow. Somal, what do you have?
I have a Naukri to sell.
I think you're on mute, Somal.
We can hear you. Go ahead.
Yeah. Naukri is the one which I would like to sell on the sell side. I have HCL Tech as well. Naukri has just broken down a small triangle pattern on the downside, trading below 200 daily moving average. Medium term looks bad. Short term looks bad. So the stop loss for this stock would be 1420. Target would be 1270, probably even below that. The second stock would be HCL Tech. Same consolidation break on the downside. Stop loss would be 1675 and the targets would be 1510.
Thank you very much for that. By the way, IT is recovering. Tata Elxsi, which in the morning was down about 6%, is only down 1.5%. LTTS, also an ER&D player, has moved back in the green. Look at Tata Tech. That's completely flattened out. So from the day's low, even a Tata Tech has recovered close to about, 2% odd. In the large cap space, we've got, I think some of these stocks, like in Tech Mahindra, Infosys too, have managed an intraday recovery. As Rahul was telling us, that even if it takes time, especially on the ER&D company, which is basically Tata Elxsi, Tata Tech, LTTS, Cyient, etc., KPIT Tech, these are the ones you would qualify and classify as ER&D companies. Even if it takes time for the growth numbers to come in, and the fundamentals to improve, valuations perhaps have bottomed out, and some of the customers of these companies are talking positively. So some green shoots there. A little bit of an intraday pullback. But let's talk about Elon Musk's Tesla, which is all set to make its long-awaited entry into the Indian market on the 15th of July. It will inaugurate its first experience center in Mumbai, BKC. Parikshit joins in with more.
Well, yes, the suspense, the mystery is finally over. Tesla will be launching in India formally on 15 July. This is at their showroom in Maker Maxcity Mall in BKC, Mumbai. They have a 4,000 square feet space there, and the launch event is somewhere between 10 a.m. to noon. So over those 2 and 2.5 hours, they will explain their roadmap in terms of bookings and sales. It's quite possible that they may announce that bookings would begin in the next 2 to 3 days and sales will also begin very, very soon. What are they likely to offer in those showrooms and offer to Indian customers? Well, it'll be the Model 3 and the Model Y, which are in the range of $34,000 to $37,000. Now, roughly, this is around 30 to 35 lakhs in Indian rupees. You will have to keep this in mind that these cars are going to be imported from China, from Tesla's Shanghai factory. These are right-hand drives which will be brought in, and this would mean a 70% duty on these cars, which would take up the cost for an Indian customer to over 50 to 55 lakhs or even 60 lakhs for that matter. It's a very high price point, but we're told there are still a lot of Tesla enthusiasts who would like to have a Tesla in their stable. At that price point, it will compete with the likes of Kia EV6, the Hyundai Ioniq, you've got the BMW iX1, you've got a Mercedes SUV electric, which is in that price range. Volvo has a few cars, you've got the BYD Seal and the Sea Lion. So there are quite a few options, but Tesla would definitely be a status symbol for many people. We're also told that it will be fully loaded and the latest Tesla models that will be launched in India with all the bells and whistles. Essentially, whatever features are offered in China, in US, in Europe, in Australia, all of that will be offered to Indian customers with the latest chargers also. In fact, the company has leased out certain spaces for charging within the Maker Max City Mall, where their cutting-edge chargers will also be installed, and they will give a charging roadmap for India as well. Are they going to manufacture in India? No, there are no plans to manufacture as yet. Currently, the Mumbai launch is a litmus test. If it works, the company could consider starting manufacturing in India in 2 to 3 years.
And Parikshit, just to revise, since these cars are not being manufactured in India, they're being fully imported. So what is the duty?
Yeah, so there are two sets of duties. It's an important question, Surbhi. For cars costing up to $40,000, the duty in India currently is 70%. And those which cost more than $40,000, the duty is 100%. Recently in the union budget, the duty for cars costing up to $40,000 was reduced by the finance minister. So this is a reduced duty that Tesla is looking at, but 70% is still very, very high. And both Elon Musk and also Donald Trump have been raising automobile tariffs in different negotiations. In fact, Tesla is actually hoping that because of the India-EU trade talks and India-US trade talks, the tariffs would eventually come down to possibly around 10%. And if that were to happen, and if we get a deal with European Union, we could possibly see more cars come in from Berlin to India than anywhere else. Tesla has also not yet applied for the scheme for promotion of manufacturing electric cars in India. This was literally a scheme that the Indian government had brought out for the likes of Tesla and VinFast. Tesla has not shown interest in this scheme, which would give them a concessional duty of 15% in return for a commitment to manufacture cars with a total outlay of $500 million. But it remains to be seen how these FTAs with US and Europe work out. If it all works out and they see a good response in India, they would follow up with a showroom launch in Delhi and maybe even manufacturing operations.
All right, let's see how India greets Tesla and how Tesla drives on Indian, especially Mumbai roads. Very, very interesting times ahead. Thank you for that, Parikshit. Well, from one interesting story, let's move to another one. VIP Industries is in focus. Now, there's been a lot of buzz around VIP and what's happening, the current promoter's intent on the business itself. Mangalam is picking up some more inputs on this. Mangalam, fill us in.
The promoter's intent has been clear for the last couple of years. They've been alluding to looking to sell stake in the company owing to lack of succession in the company, and as a result of which they were looking at multiple partners. There have been multiple times in the past reports that some of the others are looking to buy stake in the company, but now we understand that a deal is imminent and it's very close. The promoters are in advanced talks to sell a stake in the company, and among many of the private equity players, Multiples is the one which is likely to go ahead and be in the race for VIP Industries itself. Remember, the promoters own over 51% stake, and any such deal that happens triggers a mandatory open offer for minority shareholders. So that is something that may happen as well. But promoters in the past, like I said, have alluded to looking to sell stake in the company. And if you look at VIP, the stock, that there is a deal brewing, the stock was sniffing that because in the last 3 months or so, it's up 75% from its 52-week lows. And more importantly, despite that rally, it's still about 36% away from its previous all-time high, which was last hit only about 3.5-4 years ago. If you look at VIP's performance in the market as well, over the last 5 years, the stock has rallied just about 80%, as against Safari, which has rallied over 1,000%. So not only are they losing market share in the stock markets, but even in the overall market. So whenever the deal happens, or whoever the company goes to, the important part will be the revival of brand VIP, along with growth in Skybags and their premium product Carlton. The second thing you'll be looking at, winning in channels. CSD was taken over by Safari, general trade and e-commerce channels. And finally, the upper end has been fairly disrupted by entrants like Mokobara, Uppercase and other newer players. So to that extent, competing against these players with this brand will also be very crucial to track.
Thank you very much for that. Get into a break. On the other side, we'll get you more on the market. Stay tuned. Welcome back. Sudeep Bandyopadhyay is now joining in. Sudeep, so many big movers on the way down, TCS on the way up, Glenmark, HUL. Any investments, any trades that you made or recommended?
Well, HUL has been on our list for quite some time, and developments have been pretty good. So I think we'll have to see what happens as far as the demand for the FMCG products are concerned. Marico's numbers clearly showed demand is kind of back. I think if that stays, HUL can clock about 6% top line growth during the current fiscal. That's what our estimate. And, we are having a target of 3,000 plus for HUL at this stage.
Glenmark?
Glenmark,
you see it re-rating?
It's a landmark deal. It's a landmark deal, and it's kind of it's more than Glenmark. It's for the Indian pharmaceutical industry. This is probably the first time one molecule from India is being taken up by a global player, and 700 million upfront payment is quite commendable. It does show that we are finally stepping into the serious R&D business. Great for Glenmark shareholders, and I'm sure, as confirmed by the Glenn Saldanha, that good payment will be made to the shareholders as well, so they can expect a good payout.
Yeah, big shot in the arm, Sudeep. Short conversation, but the bell has rung and we've closed at the day's low. The Nifty ends below 25,150, a cut of more than 200 points in percentage terms, about 0.9% lower. For the week, the benchmark indices have lost about 1.25%. The mid-cap index nearly down 2%. Lots of stocks to blame. IT, Reliance Industries, a couple of auto names. Look at M&M, Bajaj Auto, Hero MotoCorp. All these three are down 2.5%, 3%.
Absolutely. And, there's large caps for you. Actually, if you look at the broader markets as well, and I'm just looking at the week, right? I mean, the small cap index ends down 1.5%. The mid cap index is down almost 2%, 1.9 by the way. So, the broader market maybe lost a little bit more in terms of just gains as compared to what the large caps really did. But dullish and slightly sideways, of course, finally, eventually, a down kind of a market is what you had this particular week. It's a wrap on this edition of Closing Bell. From all of us here, it's goodbye. But Editors Roundtable is coming up next, and there's got a very special guest joining us, Mahesh Nandurkar of Jefferies, coming up the other side.
Dalal Street slipped for the week gone by. We had the second straight week of losses. Both the Sensex and the Nifty, they were down about 1%. If you look at the mid-cap index, it almost was down 2%. And the IT sector was one of the biggest laggards. However, on the flip side, FMCG stocks, pharma stocks, they were batting for the bulls. Over the next 30 minutes, we will take stock of the week gone by on the street. We'll tell you what to expect from the earnings season. We'll also put the spotlight on the mega deal in the pharma space. I'm talking about, of course, Glenmark Pharma. And we will make some sense of what the mutual fund flows are telling us in terms of the market's appetite for more stocks and more paper. Hello and welcome to the Editors Roundtable. I'm Surabhi Upadhyay, and with me, my colleagues Nigel D'Souza, Nimesh Shah and Ekta Batra. And also, to make our Friday far more interesting and livelier, we have with us Mahesh Nadurkar, MD and Head of Research at Jefferies India. Guys, hi to all of you. Thank God it's Friday. And Mahesh, welcome to the show.
Thank you. It's good to be back here again.
So there are four of us.
Exactly like 4 months or so, I think. Yeah.
There are lots of corporate deals. There's earnings season. There is a tariff news. And there are 4 of us waiting to grill you. I'm just putting out the disclaimer at the start of the show.
I think
he's used to it.
I think first let's start off the show by just giving a complete recap of what went on during the week. As Surabhi mentioned, the markets end a little bit lower, 1% down, all frontline indices. The Nifty Bank, small cap, mid cap, all of them down 1%. You'll say, what a boring week, right? But there's plenty of action actually. And as Nimesh and me had discussed earlier as well, the BSE SME index was up 5.5%. So there are plenty of stocks that were in focus from the broader markets, telling you the sentiment is still pretty much okay. And from the global markets, the Bitcoin made a fresh all-time high. So that's telling you it's still risk on, in spite of what President Trump is saying. He's going after Powell, tariffs, and lots of global headlines. But still you have the Bitcoin moving up, which is sometimes an indicator of the risk on sentiment. The VIX didn't spike up. At times, the Nifty ended low, but the VIX as well cooled off. And the VIX is still below that 12-odd mark, which is telling you that still there is no big fear in the market. So that's another data point. Well, capital market plays, they got hit harder this week. The defense plays as well. Remember, they rallied very, very hard in the initial part of 2025. For this week itself, both of them were down close to around 2%. While we had 2 stars this week. One was Glenmark Pharma, which Ekta is going to be telling us more about, that big global licensing deal. So stock-specific action continued. The stock, after rallying 18%, it put on another 15% on Friday. And in this week, it was up close to 20%. And HUL, everyone was saying, no returns for the last few years, no returns. And this week, you got 8% return on HUL. So the rejig at the top, the street is optimistic, maybe in fact running a little bit ahead of itself for some. But otherwise, many believe that the proven track record that Priya comes in with, maybe in fact she can turn things around. And finally, what are we looking at now? Trump's tariffs, Q2 earnings, as well as will there be any kind of positive commentary coming in from the Fed? Because some on the street globally are expecting maybe a surprise cut. Maybe that's a little far-fetched, but at least commentary is something that we'll be tracking. I think we continue to remain in this range, 25,000 on the downside, 25,750 on the upside. Well, Mahesh, I want to come to a question to you. When you were here 3 or 4 months ago, as you said, and we are all waiting to grill you, but at that point of time, sentiment was very, very somber. And you said if the time is there to buy, maybe it's now. And you sounded far more optimistic than most voices we heard. How are you feeling about the markets right now? Because we're not at 21,700, we're at 25,000 plus levels.
Yeah, thanks for remembering that previous one, because I'm quite glad that, I came here and discussed market view with all of you guys at that time, and thankfully that call has worked quite well.
Come often. Tell us the call.
Yeah, no, I think at this point in time, things are obviously not looking that rosy from the market outlook perspective, in the sense that, okay, it has done well already. And as you mentioned that, some of the indicators are showing a bit of a risk on, as you mentioned. But I guess if you take a view from a 6-month or a 12-month perspective, I would say it's very difficult to take a very bullish view at this point in time. One is that valuations, have moved up. In fact, we've been highlighting that if you exclude the banks and financials, the 1-year forward PE multiple is 26 times. And the earnings growth is about 12-13%. So that growth versus value equation is not that great. Secondly, we also have this big onslaught of equity paper supply, right? So I think keeping all these things in mind, it looks like the next 6 to 12 months, I think the market will most likely move sideways. Obviously, there will be enough bottom-up stock ideas, sector ideas that would work out well. But at a broader market level, difficult to take a very bullish view.
So time-wise correction is what we could look for. But if you were to give a price-wise correction, could that be large? Or do you think the near-term bottom is in place at around that 21,500, 22,000?
If it wasn't for the big improvement that we are seeing in foreign inflows. I mean, if you would remember, until March 2025, foreigners were like consistent net sellers, almost like $2 to $3 billion, some months even $10 billion a month. Over the last 3 months, we have seen that thing changing materially, right? From that -2 to 3, we are now like plus $2 billion a month. So that's been a big sort of swinging factor on the positive side. On the negative side, the domestic flows are holding up well, but at a much lower level than what we were used to seeing most part of last year. So I think what is happening is domestic flows have come down, the foreign flows have gone up, essentially offsetting each other. But if for whatever reason there were to be some slowdown in the global inflows, maybe we can see absolute correction as well. But my base case is that of a time correction, as you mentioned.
You know, on the flows, and we'll talk about this in more detail in just a bit, because I think if we go beyond the headline surface, the flows picture is not that bad. I'll come to that in a bit, because you have to look at flows now on the hybrid side as well, because hybrid funds are also investing partially in the equity market. So more on that in a bit. But, Mahesh, I think we'll all agree that the fuel of any bull market ultimately is earnings, and that's what we want to talk to you about. But I know Nimesh has done a lot of, research on this in terms of consensus views on the street, expectations. So, Nimesh?
So, Surbhi, I'll go to the wall, but bottom line is we're expecting a weak quarter. So, the starting point is not something which we are too bullish on. So, in that sense, market seems to be, having a bit of a sense that this is going to be a weak quarter. So, I'll explain what the consensus view from the market is. So, for this quarter, broadly the sense is that this will be a weak quarter, but it will set a tone for a very strong September quarter. So, don't look too much into this quarter, but it will be a base for the next quarter. That's a broad consensus view. In fact, most of them are forecasting the Nifty 50 earnings to be 7 to 10%. This is going to be quite heartening because in the last 4 quarters, we've been reporting single-digit growth on the Nifty. So in that sense, it's going to be slightly better off. The low base of last year, as well as the early festive season, is going to set the tone for at least the domestic companies in this quarter as well as in the next quarter. And what RBI has done with front loading of the RBI cut, there's going to be a potential impact on a lot of the financial names as well. So that's going to be a trigger to watch out for in the very near term and for this quarter as well. So that's overall picture. I'll go with sectors which are going to do well to start with. These are the 4-5 sectors which are expected to do well in Q1. Construction materials, which is basically the cement companies, they're expected to do well. Healthcare services, renewable energy and telecom services. These are the 4 sectors which are expected to relatively do better earnings in Q1. Now look at some sectors which are going to report only single-digit earnings growth in Q1. And that includes consumer durables and apparels, electric utilities, IT services, as well as gas utilities and transport sectors. So these are the 4-5 sectors which are expected to report only single-digit earnings growth in Q1. So that's the second set. The third set is where the street is anticipating a very weak earnings, and that includes automobiles, especially Tata Motors is going to drag the auto numbers down this quarter. Banks are going to report weak. Consumer staples are going to report weak numbers. So is gas utilities and transportation. So these are the 5 sectors which are expected to report weak earnings in Q1. Now comes the important part, which is some of the individual stocks. Citi puts out this note every quarter, and according to them, some of the companies which are expected to report positive surprises in Q1, which includes SBI Life, Britannia, Delivery, RBL Bank and Eicher Motors. These are the 5 stocks which Citi believes is expected to report a positive surprise in Q1. Equally, there are going to be some negative surprises as well in Q1 earnings, and that includes names like JSPL, Titan, which has already reported a weak Q1, Hyundai, as well as Tech Mahindra. So these are the 4-5 names which Citi believes are expected to report weak earnings. So net, this quarter earnings are going to be weak, but I guess that's going to set the tone for the September quarter, which is expected to be very strong. So that sums up. Mahesh, what's your broad view on the earnings for this quarter, and how much to read into for the September quarter?
Yeah, no, I think you summarized it quite well. That this June quarter is not really going to be a great quarter, and one of the reasons for that is also the fact that we've seen an early onset of monsoons. And while monsoons, one would argue, is a great news for the economy as a whole, but it does have a negative impact on a variety of things in the quarter. Right? So we had like 10 days early onset of monsoon, which has, which usually has an impact on construction activities, some real estate activities as well, then some summer-related plays like air conditioners and fans and so on get negatively impacted. Also, the credit growth somewhat gets impacted because of all these factors. So Keeping all these things in mind, June quarter is going to be a bit of a week, and I think the September should be a bumper quarter in my view.
Right.
Because of multiple reasons. We had a very, very low base of last year because of immediately after the elections, as we all remember, there was a bit of a slowdown in the government spending. Then this time we also have early festive season. So that's the other factor.
Sure.
And possibly if the monsoons have started much earlier, maybe they recede earlier, maybe. And if that happens, then we'll have a slightly drier September. So all these factors. So I think this quarter, June quarter particularly, we're also seeing a big negative impact coming through because of the impact on the banking sector earnings. Sure. Because as we know, RBI has really upfronted all the tax cuts, and that does have a negative impact on the net interest margins, right? But that's more of a timing issue because the June quarter will probably capture a large part of the negative impact on the banking sector. And as we go through ahead with the next few quarters, as the banks have already taken the deposit cuts, the NIM impact will will keep on getting lower and lower, and therefore earnings growth should improve as we go later.
Okay. So, a word on IT, because we saw what TCS reported, and generally the sense is that IT will report weak numbers. What's your sense? And you have been underweight on IT sector overall. Yeah. What's your sense on IT, and any picks there, if not the large caps, the mid cap IT names?
Yeah, no, we believe that IT sector is going through a bad patch for sure, and we don't really see end of the tunnel just as yet.
Okay.
Because we believe that the economic reality in the US basically implies that very difficult for any large corporations in the US to undertake the discretionary capex, yes, which is really required for the IT sector to do well, for the order flow numbers to be better, which we are not seeing any signs of. And my sense is that at the margin, there is also some maybe initial impact of the AI and the fact that it requires lesser manpower and so on is also beginning to be visible. So in that context, I would say that as I said, we still are underweight on IT services. But within that, maybe some of the mid caps and small cap names, which actually can take advantage of the current situation and actually bid at an aggressive pricing or things like that, can actually grow much faster, and therefore within the segment, that's the segment within IT, sure, that we would prefer.
So just to round up the earnings conversation, Mahesh, just recap for us, which would be the 2 or 3, say, sectors which you think would be growth outliers in Q1 and then growth outliers perhaps in FY26 over the course of the year? Earnings growth.
So from earnings growth perspective, one sector that I would definitely highlight is cement. Mm-hmm. The second one that I feel is telecom services as well. Cement, because it's after a really long time that we are beginning to see some pricing momentum. Mm-hmm. And actually that matters the most because the volume growth has come down. And as we discussed, like June quarter, we'll not really see much of a volume growth because of construction getting impacted, yes, and so on. But I think for the stock prices to move, it's the cement prices that matter more than the volume growth. And what we're seeing is that after the 2 large players that have undertaken significant sector consolidation over the last 2 years or so, it looks like we're going through a period, of a breather, and maybe the larger ones are also kind of so-called like digesting the acquisitions that they have made, which then is a good time for the prices to improve, profitability to improve. So I think, so I think this sector is one of the sector, the cement sector, is where you can actually see some positive earning surprises, which is actually very difficult to come by in an environment like this.
All right, and after many, many quarters, we had some price increases that did stick as well. So that's going to be a positive. That said, the stock of the week was from Ekta's sector, the pharma pack, Glenmark Pharma. Ekta, tell us more.
Well, yes, there's a deal which has taken place in the pharmaceutical space or in a licensing firm for the first time in many years and never of this size. So yes, it's a $2 billion opportunity for Glenmark. $700 million is what they have signed in terms of in-licensing or out-licensing to AbbVie. But I just want to tell you that, R&D as a whole is a difficult path. It's not a bed of roses. In fact, there are multiple molecules which have failed before these companies have seen successes. So, for example, Glenmark, they had a respiratory molecule which failed. They had GRC 15300 for the treatment of pain, which didn't succeed. They had another one which was for pain as well, which didn't succeed. Now, separately, even Spark had something of a rough path, and they still haven't seen that kind of success, though I'll come to what the opportunities are there. But for Parkinson's and psoriasis and dermatitis, they had two molecules which didn't really see the light of day. Now, also Suvain, remember that they had SUVN 502 for Alzheimer's. That was really something that the street banked on, but that didn't go through as well. But what are the opportunities that the street is probably looking at when it comes to R&D? So I'll start with Wockhardt. They have the antibiotic WCK 5222. The market size is expected to be $9 billion globally. They're looking at launching in the US in 26-27. They may look at out-licensing when it comes to this particular molecule. Now, when it comes to Spark, they have SBO 154, which is an oncology drug in the pipeline, and it's basically antibody drug conjugates. The deal value in the past 5 years in this particular segment itself has been around $300 billion, giving you a sense in terms of the kind of opportunity that exists. Origin by Dr. Reddy's, that's also another segment. It's their arm. So they have collaborated with Curis to develop a type of immunotherapy for cancer. And remember that oncology is the hottest space when it comes to R&D. Zydus, they do have a liver molecule, sarglitazar, so it's quite a popular one. It's currently received fast track as well as orphan drug status from the US FDA, so that basically speeds things up. And lastly, we have even Biocon, which has Bicara, so they own around 11%. Biocon owns 11% in Bicara, so that's another one to watch out for, whether or not that is something that they would be able to monetize. So yes, finally, we've seen a big deal taking place in R&D. But Mahesh, I wanted your thoughts on the entire pharmaceutical space, because that's really buzzing in terms of deals. We had the JD Chemical, Torrent Pharma deal that took place, and now this deal with Glenmark.
Yeah, no, I think pharma sector, if I just sort of broad-base, the overall healthcare sector has been one of the better performing sectors, like YTD and I would say like last 1 year or so. But within that, I would still say that the fact that some of the statements that are coming out of President Mr. Trump and threatening some very high level of tariffs, maybe 12 months, 18 months, etc. down the line, I don't know whether that really transpires or not, because we've seen many times and that Mr. Trump announcing something and then not really sort of following through, on that, and we've seen like several examples of that. But I think at some point in time, that uncertainty is still, is going to be there. So in that context, I would much rather prefer like domestic medical services, like the hospitals, as a much better bet. Although we have had a negative news on that one as well. Just yesterday, where the government trying to say that okay, they are looking at ways in which to kind of curb some of the insurance claims and and the pricing for that. But I guess, but still from a long-term perspective, hospital still looks like a very attractive sector.
I just want to interrupt you there. Apollo had this big restructuring that they announced. Any specific view that you would have on hospitals and the kind of digitization theme that they're playing?
Yeah, no, I think, so, without getting into the stock-specific angle here, but as I said, hospitals as a theme is looking very interesting, for sure. And I think what we're clearly seeing is that, the consumers or people's sort of propensity to spend on getting high-quality medical care is going up, and even in smaller towns and villages as well. And that's why we've seen a very quick turnaround to profitability of some of the new hospitals that have come up in like Lucknow and Patna, etc. So I think that space is definitely very, very interesting for sure.
Okay, all right. Well, on that healthy note, we have to take a quick break. We'll come back and continue this conversation with Mahesh in just a bit. Welcome back. Here with us on Editors Roundtable. Another hallmark of this week was the mutual fund data. And guess what? We finally have some good news coming in June because net equity inflows improved. Most fund categories on the equity side got decent flows. I mean, look at flexi cap funds. Month-on-month increase, 49%, large cap, mid cap, I mean, increases between 20% to 30%. All the categories got better flows. And people still love their small cap funds because that's where the net inflows were, in excess of 4,000 crores. The other solid story is the SIP book. It's very strong for mutual funds. So 27,000 crores flowing in systematic investment plans, an all-time high. But the one point I want to make is that we should also look at now perhaps equity flows from the perspective of how much money is coming in arbitrage funds, in balanced funds, even in multi-asset allocation funds, because these funds are drawing very big money and a chunk of that money is eventually going to equities. Sample this, net equity inflows for this month are around 23,500 plus. Net hybrid fund inflows are again 23,200. So net. So hybrid is a big category and a lot of that is also flowing into equities. So that's the simple point. Now with that, Mahesh, I want to ask you, we had some notes this week as well on AMC stocks. Tell us what you think here. And in general capital market plays, because some of them like exchange stocks, etc., they've run big time. There's also regulatory change overhang, etc. So how do you view the whole segment? Yeah, no, it's definitely a big relief, the mutual fund numbers that you just mentioned. Yeah. Because what we saw that as compared to the last month, when the non-SIP flows was almost zero, I think the non-SIP flows this time have gone up by, by almost like $500 million, so roughly like 4,000 crores. So that's definitely a big relief, I would say. And it's a very welcome relief also in the context of the fact that we are also seeing a huge equity supply as well. So we need the demand support, to come through. From the broader capital market standpoint, I believe that, the valuations have once again gone up and the stocks are, already pricing in, a lot of optimism. And so to that extent, I think the mutual fund data is a bit of a supporting factor. But given the fact that, due to some regulatory changes and some of the actions that we have seen, the probability is that it could have some negative impact on the industry volumes, which would probably be a negative for stock exchanges and some of the other sort of capital market plays. But within the capital market, like one segment, as I mentioned, that looks very, very attractive and interesting, is the investment banking side, because just to give you some numbers, like last month, the month of June, we saw almost $10 billion worth of equity raising. The month prior was $7 billion. And I think, this kind of, is setting a good stage for the whole of CY25 or FY26 to be like the record year in terms of fundraising, assuming that the market holds up. So assuming that the market holds up, we could very well see like $80 to $90 billion of total full year, maybe touching even 100 for all you know. And this is a mix of IPOs, blocks, everything put together. Yes, so it basically includes IPOs, it includes QIPs or follow-on offerings, it includes private equity blocks, it includes promoter blocks. And what we've seen is that the last two segments, which is the promoter and the private equity blocks, are now accounting for larger and larger share of the total, fundraising, which, as I said, is good for one segment of the capital marketplace. But for the overall market itself, it basically means that it will essentially cap the returns because the supply pressure is going to be immense. I guess it also ties in with why you're expecting it to be more range-bound next couple of months, because there's so much supply also that's coming through. But very quickly, if we have 30 seconds time, your model portfolio, any major changes, additions, deletions? Yeah, well, so obviously without getting into the stock-specific things, what we have done is we have made our portfolio more value conscious. So we have added some stocks where we see values that's across, that's basically across some of the new auto anchors that have got listed, some of the power utility companies where we actually beginning to see some value. And we have taken out some of the so-called expensive stocks so as to create some kind of a sort of insurance for the model portfolio. Expensive from which sectors? Yeah, so we have taken out some names from capital markets actually, the sector that you mentioned, and also some of the. Reading a report, Nuvama has been removed from that model portfolio list. And also some of the like auto names which we thought were more expensive, we are replacing with the slightly cheaper names. Sure. Okay, with that, it's completely out of time on this very, very interesting conversation. Mahesh, thank you so much for making the time and being with us. Very helpful insights coming in over there. With that, we take your leave in this week's edition of Editor's Roundtable. We'll see you bright and early with the markets again on Monday morning.
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. The Sensex and the Nifty declined for a second week in a row, losing 1% each. IT stocks lead the decline. Mid-caps fall in tandem with the blue chips. India braces for a difficult first quarter as TCS starts the earnings season on a tepid note. Autos, banks, consumer staples are likely to see weak growth, but healthcare services, construction materials, renewables and telecom likely to report strong growth. President Trump threatens 35% tariffs on Canada from the 1st of August, also says he plans to impose 15 to 20% tariffs on, and I quote, remaining countries who are yet to receive any letters. 23 nations have received tariff letters so far. UK and Vietnam have signed a trade deal framework. A management shake-up at Hindustan Unilever. Ritesh Tiwari set to step down as CFO and move to a global role. This comes a day after Rohit Java stepped down as CEO, with Priya Nair set to take the reins. HUL stock up more than 4% today. Promoters of VIP Industries are set to be in advanced talks to sell stake in the company. Sources say private equity players, including multiples PE, are in the race and a deal is imminent. The insurance regulator initiates the process of issuing show cause notice to 8 health insurers over alleged lapses in claim settlements and rejections. Sources tell us insurers are likely to be asked to pay a penalty or return money to policyholders with interest. The suspense over Tesla's India entry is set to end next week. The Mumbai showroom will open on the 15th of July. Timelines on bookings and sales to be announced shortly. Israel intensifies bombing in Gaza amidst widespread reports of hunger and starvation. At least 15 people, including 10 children, killed in an Israeli strike as they queued outside a medical point for treatment. More than 57,700 people have been killed in Gaza since the start of the war 21 months ago. Well, the big story today, the Union Cabinet has cleared a new fund to bolster research, development and innovation. A new fund with a 1 lakh crore rupee corpus has been set up to facilitate long-term financing for private companies. Now, the aim is to provide risk capital to sunrise sectors, promote adoption of cutting-edge technology and boost competitiveness. The government also plans to facilitate a deep tech fund of funds. India's overall spending has increased steadily in the last decade from less than 60,000 crore rupees in FY11. R&D spending in FY21 has nearly doubled to 1.2 lakh crore rupees. According to the government's latest economic survey, the number of patents issued in FY24 nearly 1 lakh compared to just 25,000 patents issued in FY20. But the same economic survey also points at India's R&D expenditure lagging behind several nations. R&D spends in India stands at just 0.65% of the total GDP. China spends 2.4% and the US spends 3.5% of its GDP on R&D. And it's not just the government. The contribution of the private sector to R&D spending in India remains very low. The private sector accounts for just 36% of the total R&D expenditure in India compared to 75% in the US and 77% in China. In a world divided by trade wars, India needs to develop its own technologies to remain self-sufficient. The recent export curbs by China on rare earth magnets is just one case in point. So how can India build strength in sectors like semiconductors, quantum security and cybersecurity? Will this new fund help kickstart an R&D revolution? Joining us now to discuss all of this and more, Ajay Sood, the Principal Scientific Advisor to the Government of India, Ajay Chaudhary, the founder of HCL and also the head of the Quantum Mission, and Saurabh Srivastava, the co-founder and former chairman of NASSCOM. Gentlemen, many thanks for joining us here on the program. Sir, if I can start by asking you, there's been a long anticipation of what this fund is going to do, but I want to link this fund to the strategic imperatives and national priorities that India must bet on. Let's start with that and then move towards how we make this fund work, how this fund is operationalized. What should India today, given the geopolitics, given the volatility, bet on?
So if you look at it, as you said, we need to see what is needed for technological sovereignty of a country. So we need to see what technologies we should be able to have control and not be dictated by other forces. Now that will have to be decided. There are many of them which are very obvious, as you pointed out, but also we have to also see which are little bit futuristic. And that also we have to focus right away. I mean, of course, the immediate thing which you saw in the recent conflicts is the unmanned armed vehicle, UAVs, autonomous vehicles. But that is something, again, is come very timely. But there will be many such things which will happen. So we have to be tech ready to do all this. And in all this, the private sector investment and the private sector working with academia is absolutely must.
You're right in pointing that out, that we need much deeper collaboration and deeper partnership there. But linking tech sovereignty to national security, you brought up the issue of Operation Sindoor, and I would imagine that this now is a challenge and a priority as far as the government is concerned. UAVs are only one aspect to consider. So is there a thinking now? I mean, the Defense Ministry has its own agenda as far as indigenization and localization is concerned. But is there a thinking now on what India should bet on to marry tech sovereignty with defense self-reliance as well?
Answer is yes. I mean, these are being discussed at various fora, and many of us are part of it. And in all this, when you say tech sovereignty, it also does not mean doing everything yourself. It's not like 100% you have to do it here. You need to see what is critical here and which are your reliable global partners on a long term, which is always...
Is there any reliable global partner today?
May not be, but you can do in stages. you have to do in stages. And this is where the critical thinking is needed. And answer is that lot of it is now being thought over, be it drones, be it anti-drones, be it semiconductor technology, be it AI, as you have been getting to know this. So many of these things like biotechnology, which is really, really in the background of many, many development, is again happening on this in this manner.
Mr. Chaudhary, you know, I know that you're a worried man, and I know you've been a worried man for a few years now, and you believe that time is of the essence. We need to act, and we need to act with a sense of urgency. So for the benefit of everyone watching now, let's lay out the next steps. What are we supposed to focus on? What should one think is going to be in the escalation ladder, if I can use that since we're talking about defense, the next steps of action?
You see, I think one area that we must understand that economy and military strength is now directly linked to technology. So if we don't have the technology, we'll have neither. Now, first thing that we need to do is to identify areas where we must excel and own our own technology. As you rightly said, we don't have any friends. We don't know who are our friends. So if we are living in this unipolar world, we need to identify all the technologies that we will need for the next 10 to 15 years. Some of them will not work for us. Some of them will work for us. But as Professor Sood said, in some cases, if we have to collaborate, I would rather go and buy some technology. So this fund actually provides for buying of technology also. And buying of companies also.
And not just Indian companies?
No, global companies. So, for example, we are sitting in one particular technology at level 5. We want to get to 10. Why not go and buy 5 and then get to 10 rather than go from 0 to 10? So that's the approach we have to take because, as you rightly said, time is of essence. Suddenly, this particular war was thrust on us. You know, before that, see what the technology that the Pakistanis used? They went to a private satellite company called Maxar, where a Pakistani had an interest in that company. They were looking at Pahalgam 3 months before Pahalgam happened. So technology was used by our enemies. So if we are not there and we don't use the technology, we are not going to be successful.
You know, let's now talk about operationalizing this fund. And Mr. Srivastava, you have the experience of having worked with the government and within the government ecosystem. You know, that's how NASSCOM happened and that's how the Indian IT export story happened as well. You're talking about acquisitions. You're talking about investing in private companies. This is a government fund. How does this government fund now decide which companies to invest in, which entrepreneurs to back, which technology to invest behind?
You know, Shireen, the very heartening thing is that the government does understand that this fund can't be run in the normal bureaucratic way that things are done. It completely understands that. And so the best thing that's happening is that the intent of the government is to make sure that all these decisions that you said, which companies to invest in, which technologies to buy, which corporates to work with, which startups, government does not plan to take those decisions. The government plans to layer it down and create a second level of entities, which may be fund of funds, AIFs, NBFCs, DFIs, all of those banks. And basically, each of these will have its own investment committee. And they will have experts in different domains, different disciplines. And they will take the calls. But what would have been decided beforehand, where is it that we are focused? Which areas, which sectors? Just like you said, we have to get very specific that we don't boil the ocean. We have a limited budget. 1 lakh crore is good.
It sounds big, but actually, I mean, you know, when you talk about the kind of investments that are required,
it's $12 billion. It's not a lot of money like global standards. So we have to spend it very wisely, in a very targeted way. And I'm really encouraged by the level of industry consultations that the government is doing. You talked about NASSCOM. The last time I felt like this
was at NASSCOM.
Was when we cracked this whole thing between government and industry at NASSCOM. That's the environment today. And that's why we're also really encouraged because we think we can see that light.
So, what should we now expect the next steps to be in terms of actually operationalizing what we've just spoken of as far as the actual money starting to be disbursed? And I come back again to, whether these investment committees will sit and look at which companies and so on and so forth. But there has to be, as you pointed out, an overarching direction that each investment committee will need to follow before they make any decisions. So has that overarching decision been set? If you can share that with us, and when should we expect the fund to actually be operationalized?
So a lot of thinking and a lot of work has already happened. Actually, there are two levels. One is the overarching committee, which is called EGOS, which is chaired by Cabinet Secretary, and PSA and few secretaries are members, which will take overall decisions. The next one, where the fund will be parked, the first level, is Anusandhan National Research Foundation.
Okay.
ANRF, which was recently operationalized. So the executive council of that will really be seeing many things which you have asked. So that's where, and a lot of thinking is happening as we speak, because EC, as you know, is chaired by Principal Scientific Advisor, and DST is responsible for operationalizing it. So many things are actually happening in the background to see how do we have our first cut. Then we have the second level fund managers, which Saurabhji said there can be many. Yeah. In addition to what he said, we also have a possibility it can go to focused research organizations.
Okay.
Like BIRAC or TDB, which already have some experience, and they can be done because like many incubation parks and the research parks in IITs are doing very well. And now if this is given to them, they can really accelerate what they have been doing. So that is a very new thing, not new thing, a very novel thing. So all that actually as we speak is happening, and the identification of whether it is AIF or various, all of will be eligible. It's not one or the other.
Or the other.
It will be multi-prong attack. Also, in addition, some funds are also there for deep tech funds of funds.
Right.
Which will be differently dealt with as compared to corporates. Because we also need substantial support for that. And that is also covered in this. And that could be a mixed of equity and loan.
So the government will actually pick up equity in some of these deep tech companies as
Only
well?
in the startups.
In the startups.
Not in the
funds.
Yeah. Not in the others.
Right.
No, see, the one good thing is, you talked about implementation. The idea is that we want to accelerate the deployment. You use multiple channels. Now in life, some will work very well, some will be slow, some may not. This is something very new that we're doing. So the idea is to diversify the risks, which is a very intelligent thing to do. When it comes to equity, the government is open to taking equity in startups. But large corporates obviously is a different.
It's a different story.
Different story.
Yeah.
So
but so far the government has stayed away from picking up equity. I mean, with the exception of debt conversion into equity, which has happened in Vodafone, etc. But that's a separate story altogether.
No, I want to correct you.
Yeah.
When we remember last time we talked about quantum.
Yes.
In quantum, all startups are being given up to 30 to 50 crores per startup. And we are taking an option to take equity. Already decided. So we are against the money that they are getting. We are not asking for any guarantees, but we are saying when you go for an exit, you give us the equity at 30% discount. So this is the first time the government has already started to think that way. And the interesting part of this fund is that originally when it was announced, it was said to be 50 years, zero interest loan of 1 lakh crore. Now already 20,000 crores this year has already been given to DST. So now DST has the challenge to spend that 20,000 crores by March. So therefore, DST is working very fast. Like PSA has been literally working with DST to make this move because we need to take these decisions very, very fast. And this is the time we want to nudge the corporates to get into R&D. See, this is a major problem. Corporates have not got into R&D. And by giving loans, let's say, for example, I think the plan is to give 50-50. So if, for example, a particular area of product that we want them to develop, let's take magnets, which are really in short. Let's say that needs 500 crores. The government will put in 250 crores. The corporate has to put in 250 crores. The same thing goes for startups. In case of startups, government will put in 70%, 30% startups. So this is the kind of thinking that is going on. And the pace at which this whole program is moving is quite amazing because it's really got the support of the Prime Minister. And therefore, it is very critical for us to take quite quick decisions.
So, if I may add something.
Yes.
See, the one other very good thing that's happening, and again that takes me back to NASSCOM, that there's very good jugalbandi right now between the government departments. PSA, DST, I mean, everybody is working in sync. There's no turf wars going on. Everybody's trying to make it happen. Huge involvement of industry. They're seeking out, talking to a lot of people, taking the inputs, which was the other part of the jugalbandi. That is accelerating it. What is happening, as Ajay said, if you look at deep tech, who's doing it in the country today? It's only startups. Well, I shouldn't say that. There are some corporates that are doing very good work, but they're in a minority. The bulk of them can get by without R&D. And so they do. The challenge we may have is not so much with the startups. They're doing that in any case. And the way we're dealing with startups, or at least the plan, is a very good one, which is to say to startups, government can take equity, but instead of diluting you today, we'll give you a very concessional loan and convert some of it in your next round, which is very helpful for startups.
But then that brings me also to the question of IP, because if the government is actually putting in the money as well, then what happens as far as IP is concerned? Who owns the IP, Professor?
The company things are very liberal here. The government is not trying to get IPs actually here. Even in our quantum mission, the IPs will rest
with the company.
With the company, like the startups or the so it's not that one is trying to get control of IP. So it's not, the process has to be friendly to make sure that the high-end R&D, deep R&D gets into commercialization. That is the bottom line of this scheme. We have to convert deep science and technology into viable commercialization. That's a one-line definition of this concept.
That's the mission. That's the mission as far as
mission statement. And that is why I am emphasizing deep R&D. It cannot be routine R&D. So through your program, we want to give also this message. It is not for really solving day-to-day R&D and you take this. Answer is no. We have to see whatever we do, we have a probability, a high probability to become a global leader.
I mean, and if I could get each one of you then to wrap the conversation with exactly that. So, Mr. Chaudhary, those who are watching, companies who are in this space, you know, you talked about, of course, betting on current technologies, AI and so on and so forth, but futuristic technologies that you believe that we should bet on as well. So give us a lay of the land in terms of priorities. I mean, what kind of companies, what kind of technologies do you believe this fund will help commercialize?
You know, quantum is already funded. But if quantum, we want to add more things beyond what we have planned, we can do through this fund. Semiconductors, for example. Today, what are we doing in semiconductors? We are basically manufacturing, right? The part that is missing today, which is the government is now seriously looking at doing, is the design part of it, because that's where our capability lies. Now, we now need to work on system to chip to manufacturing. So we now need to fund system companies, we need to fund chip companies, and then we will have a full ecosystem. So this kind of thinking is what will come in here, where a lot of the areas which various ministries may not be doing fully, the RDI fund can provide for those things to happen. And to each of those corporates or startups, it will be a top-down approach. So we will finally work on deciding which technologies. This whole discussion is going on between industry and the government. And this discussion started even before it was announced.
Yeah.
3-4 months before.
Yeah.
So we will have a good list available. At this moment, we can't talk about it because it's not final.
I know. So you're constrained by that. Yes, Mr. Srivastava, final comments from you, and then I'll get the PSA.
No, I would say this. You mentioned 0.65% of GDP that we do today. We need to get to 3% in 10 years. $7 trillion economy, let's say, 210 billion from 18 billion. The bulk of it has to come from the private sector.
Yeah.
This fund's intention is not to make a good return on the money.
Is to nudge the private sector
Is to make the private sector take the lead. At the startup world, I can tell you things are happening that are actually unique in the world, right? IIT Kanpur is doing an artificial heart, 1/7 the price of the only other one manufacturer that exists today. Brain mapping being done in IIT Madras and IC Bangalore, 1/10 the price, 10 times the resolution.
Yeah.
So we're like, where? Enough things here.
So where we have a right to win, that is where you believe this fund is going to actually place its bet on. The final comment, when can we expect the first check to be written?
If I can be bold enough,
yes.
I think it will be in less than 2 to 3 months.
Less than 2 to 3 months, we'll have the first check being written.
That's our target.
That's the target.
But as I said, I hope we will do it in this, because it's really going at a very, very good pace. And a lot of alignment is there. And as he said, there is a lot of enthusiasm. That we have to now convert
into actual
action. And we cannot do alone from the government.
Yes.
We need this cutting-edge technology proposals from private sector.
From the private sector, from industry. Well, ladies and gentlemen, you heard it first right here on CNBC-TV18. The hope, the target, the aspiration is that the first check, courtesy the government's R&D fund, is written out in the next 2 to 3 months. We wish you the very best of luck with that, Professor Sood. Thank you very much, Mr. Chaudhary and Mr. Srivastava, for joining us. And if that does indeed happen, then CNBC-TV18 would have played a part in that as well. So thank you very much. But with that, it is time for us to wrap up this special. We will, of course, continue to bring you all the latest developments with the government's R&D push to galvanize the private sector to take bets and risks with deep technology. From all of us here, thanks very much for watching.
Hello and welcome to the CNBC-TV18 special. Over the next 30 minutes, we are unpacking a trend that is both massive in scale and quietly reshaping ownership in corporate India. We're going to be talking about promoter stake sales.
India's promoters, the ultimate insiders, have been steadily selling down their stakes. And this isn't a short-term trend. Over the past 4 years, data shows that a clear trend of exits of promoters is accelerating. Promoter holding across listed companies is falling.
Well, but here is the paradox in that sense, right? The other side of the argument. In a market which is flush with retail inflows, where earnings momentum hasn't always kept pace with liquidity, could this steady promoter selling have actually prevented the market from melting up, overheating in that sense?
And to make sense of this, we are joined by someone who's watched India's capital markets for over 4 decades, whose voice is as respected by promoters as it is by investors. Ramdev Agrawal, co-founder and chairman of Motilal Oswal Financial Services. He's also our guest editor for the day for the next 30 minutes.
So, as always, Rima and I'll take it easy, and Ramdevji will conduct the questions in just a bit. Our expert panel also, though, comprises of Pranav Haldia, who will be doing some of the answering to Ramdevji's questions. He's managing director of Prime Database. He's, of course, crunched the numbers on stake sales and ownership patterns as well. We have Rahul Saraf, India head of investment banking at Citi India, to decode the rationale behind these exits and, you know, also what promoters are doing once they sell with that money. And of course, Feroz Aziz has joined CEO at Anand Rathi Wealth on how a chunk of this promoter cash is actually making a comeback right into the market in a different avatar, not just stock markets, but all kinds of financial assets as well. But, you know, before we get to the conversation and the Q&A, let's just start by laying out the data and what this puts out, just to frame our discussion in the right context. And here is the data. Over the last 5 years, private equity and venture capital exits have surged. In 2023, sell amounts crossed 1 lakh crore for the first time. And 2024 saw a record 534 deals worth over 1.15 lakh crores. In just the first half of 2025, we've seen nearly 37,000 crores worth of exits. Now, this trend is even more striking among company promoters. These are private promoters that we're talking about. In 2023 and 2024, promoter stake sales touched 1.16 lakh crore and 1.1 lakh crores respectively. This is almost double the amounts seen just 2 years ago. In 2025, we've already crossed 64,000 crore rupees. And by the way, it's only July, so I mean, you know, you've got half a year to go. As a result, private promoters' shareholding, I mean, if you just look at these numbers, how it's impacted their shareholding across listed companies on the NSE, it's steadily declined. From 45%, which is what private promoters held at the end of 2021, it's now come to under 41%. That's about 4.5% percentage point drop in just over 3 years. It's massive. On the flip side, where has all this money gone? Domestic institutional investors, powered by largely SIPs, have been stepping up with their shareholding, which has risen from 13% to over 17% in the same time period. So it's almost a transfer from promoters, private promoters, to institutional shareholders, which is largely DIIs. Here's the kicker. For the first time ever, possibly, the value also of DII holdings now exceeds that of FIIs. FII ownership of listed companies was around 16 lakh crores more as compared to DIIs. Basically, it was FIIs owned 16 lakh crores more of all listed companies over DIIs in 2021, right? That 16 lakh crore has all but disappeared, and then some. DIIs actually now own about 1.6 lakh crores in listed equities more as compared to FIIs. So actually, I mean, it's been an absolute dramatic change in terms of the composition of the market, even within institutional shareholders. And DIIs have really emerged as the big kind of, block which has absorbed a lot of this supply which has come in. So that's the data. But now let's get the context and the perspective. Ramdevji, great to have you with us here. Yes. Thank you very much for joining us.
Very nice to see you.
And the data is striking, right? There is no doubt about it.
I was broadly having, but you put it very nicely. The data is absolutely crystal clear. That trend is building up. And, one of the things you said in the beginning, so retail investors are giving a floor. The the resilience to the market, and the promoter selling is going to give that, it is going to save the market from melting up. You know, so that's a fantastic thing to have, because this one, it avoids a crash in the market. It also avoids the melt up in the market. Okay. A second, and this gives a what you call sustained expansion of the capital market activity. Because if you have floating stock of say 30%, or there are a lot of companies there are 25, or government companies there are 15, 10% is there. So your activity is going to be small. But as your floating stock, which is now 60% on aggregate basis, floating stock goes to more like 75%. So what happens is that all the market intermediaries, one is the index, because of index expansion say by 12, 13%, and other is the volume expansion by 4, 5%. So more customers, more stocks to trade, and of course the tailwind of economy, which is sustained at 7%. So I think it's a complete Goldilocks kind of situation, because in the stock market, any kind of melt up is borrowing from the return of the future, which creates problem. Now it will be very good for the market and for the market sustained
The numbers
expansion.
we put out, it shows that private promoter holding is now about 40%. It's come down about 4.5% in the last three years, roughly. You think this pace will continue at this rate?
If you see, now there are two things. Prices of the stocks are not determined by who is buying and selling, because number of stocks remain same fundamentally. So what decides the price of the stock is the earnings momentum. You see Indigo, they sold I think 25-30%, and at every price from 1500 to almost as late as last week at 50. So, and both the promoters have sold. So clearly market wants earnings growth, the company to become bigger and better. If that is happening, so in aggregate, if the Indian corporate profit, which is about say 15 lakh crores, that goes to say in 2 years time or 3 years time to 20 lakh crores, I don't think who buys, sells, I mean then actually the game will be even bigger for the capital market participants. Foreigners will come, domestics will come, and more stocks will be there. So the stock price will not be impacted, but temporarily what will happen is the stock, it also depends on, because promoter knows the value of the company and what is going to happen in the next 3, 4, 5 quarters or something like that. If the motive is not that much positive, see, if I want to set up a family office and I sell by 5-10%, or I want to do philanthropy and I want to sell, that's a very ultimate positive thing to happen. But if I know for sure that outlook 2 years down the road is going to be very bad, or he can see that, and because of that it is being sold. So that will have little...
What a sea change, right? Rima, I mean, 10 years back, 15 years back, I remember, I mean, promoters used to sell, and we used to...
It was a taboo.
It was one of the red flags with companies, promoter sales, but not anymore.
Yeah, so this is the maturity of the market. I mean, in US, all the promoters, like I believe, Bill Gates holds hardly a percentage or two of Microsoft. So he has sold across, I mean, over the year he has sold. Jeff Bezos, this thing, Musk, they keep selling, and that to a good chunk. So markets are not that much perturbed in US, and hence that broader trend. This is the expansion of the market. We are about 5 trillion. In next 4 to 5 years, 6 years, will become 10 trillion large market. And it is required. This kind of liquidity build-up is required, because we've got tons of small companies. If you have 60-70% owned by the promoters, how, I mean, where is the depth? I mean, a lot of fund managers, they won't be able to participate in those stocks, because whenever you go to buy, the impact will be 10%. When you go to sell, it will be 15-20%. So that makes the market very primitive. So this is the best market,
So it's a sign of market depth and not distress.
No, not distress for sure,
So what are the broader implications of this? You spoke about how that this is a structural positive for everything related to capital markets. So from an investment point of view, if this continues, should one be looking at brokerage stocks? Should one be looking at wealth managers or some of these exchanges? I mean, what's the best way to play it?
So now from here, the next derivative starts. Who are the guys who are selling? So all the market intermediaries, like the guys who are going to come, they are the guys, iBankers, they are advising them to sell. So that, I mean, they are going to make their own fee. Then after that, see, how do I say, this promoter holding doesn't exist actually. It exists only in the digital paper. That 50%, 1 lakh crore value of the company, 50,000 crore has no relevance for the market. It's just there for decoration. But the moment you melt it, it is there for everybody. I mean, first the promoter is free to consume for their own consumption and philanthropic purposes. nobody can do philanthropy by not selling the stock. I mean, just the dividend is not good enough to kind of do big projects. So that is one. Second is that promoters can also look for parallelly promoting a very large, kind of new ventures in the family members or themselves, say, and unrelated family ventures. So basically, if you are a textile company and you want to get into steel, now you would not like to diversify within the textile company that particular thing. You sell 5-10% and promote for 1,000 crores, 2,000 crores, another equity base and promote a new venture. So a lot of these possibilities are there. Wealth effect will be there. You can consume, I mean, you see all these 400, 200, 300 crore flats being bought. They're all coming out of the market cap melt down, whether it is IPO, whether it is QIP, whether it is actual selling. So wealth effect has to come.
As an investment house, what is the capital markets has been your favorite area?
Yes, so
I mean,
I can see what happens. One is that, of course, one time the deal value and then some commission you make. But that's the smallest part. Immediately this money comes in wealth management. Sorry, so wealth managers, they get the corpus. So 2, 3, 4 of them will be nominated and everybody will get very large chunk of, I mean, you can see large deals and all the money is again coming back to the market. So actually, at one level, they provide the, what you call, melt up against the melt up. And again, they come back to give the flow to the same market by diversifying the portfolio.
Correct.
So that activity is, so it expands the wealth management platform. It expands the AMC platform because wealth managers, they allocate the money to the mutual fund products or private equity products. So every aspect of the capital market activity will get a boost.
You said that there could be multiple motivation why a promoter may want to sell part of his stake in the company, right? Some will be altruistic for philanthropy purposes, etc., diversification, next generation. But then you will always have these few bad, apples. How can a retail shareholder identify and beware? What are the warning signs in such cases?
It is for the person who is buying the stock. His consideration is not who is selling, because in any case, he's a non-owner of the company. So he is going to buy the company, and it is coming from whatever sources it is coming from. It is coming from existing retail, or it is coming from the promoter. It's a legitimate source for him. Just because the promoter is selling, the prospect for the future is not changed. But since it is coming from promoter, he should be a little extra cautious why he's selling. Maybe he can ask the broker, or he can ask the selling party what exactly is prompting you to sell. Probably most of the time you know why they're selling.
You know what we're going to do, Ramdiji, is take that commercial break and then we'll get you your guests, not my guests, your guests on the other side. So, we'll do that. This discussion continues, but we'll widen the scope. Ramdiji mentioned wealth managers as a space. So we have Feroz Aziz of Anand Rathi joining us. All the data that I put out in the beginning, that was coming from Prime Database, and Pranav Haldia will join us, and he's got a really good eye for data in terms of what is coming up ahead as well. And of course, making a lot of these deals happen is Rahul Saraf, India investment banking head for Citi. So all three on the other side with Ramdiji coming up. Welcome back to our special market show. The market editor, and of course, our market editor today is Ramdeo Agarwal of Motilal Oswal Financial Services. We also now have Pranav Haldia, Rahul Saraf, and Feroz Aziz with us to give us a rounded perspective. And I'll throw it across to Ramdeoji in just a bit. But Pranav, that data that I used to kind of set up the entire discussion came from Prime, and excellent data as always. And that question which I put to Ramdeoji, and he also said you'll have the best idea. Is the pace of these sales, as you see it in terms of the pipeline, I mean, is it as strong? What we've seen over the last few years has been very strong. Is it likely to be as strong going forward as well, both in terms of the IPO pipeline, secondary sales, PE, VC exits? What's your sense?
Firstly, I would just mention that I think with all the promoter exits that you've seen over the last 2-3 years, there's really no reason to panic. The calendar year 2023 saw 36 lakh crore of promoter exits, and calendar year 24 saw 1.40 lakh crores. And this only includes bulk and block and offer for sale, which is used by promoters to meet the minimum public shareholding requirement. But you've seen that there's not been any meltdown in the secondary market. And in fact, we're going from strength to strength. So I think, this is, going forward as well. One can expect a lot of promoter sell downs taking place. We have to understand that, given the kind of IPOs that you've seen over the last 2-3 years, there are a lot of promoters who need to exit and bring down their stake to about 75% within the 3-year timeline to meet the minimum public shareholding requirement. And, block deals is one of the means which they use to reduce their stake. Even apart from this, you are seeing, of course, promoter exits for a whole wide variety of reasons. When promoter is buying, it's always considered to be a good sign. In my view, it should be always taken as a good sign. But when the promoter is selling, I think that's something that you alluded to earlier as well. It can be for a whole wide variety of issues. Of course, one of the issues can also be to, book some profit. They might feel that it's already well priced or the future may not be too bright. So as an investor, I think it's very important to keep a close watch on both promoter buys and promoter exits. One final point I would like to make as far as promoter exits are concerned is that, one of the things which we need to look at apart from for the reason of sale is also that the promoter should continue to hold a good amount of stake post the deal. And the deal should not have idly happened at a huge discount. So if these things are in place, then I don't think it's a really worrying sign as far as investors are concerned.
Rahul and Feroz are with us. Rahul, let me ask you. You work in so many deals, and you're in touch with so many promoters who come to you for all kinds of things. What is the underlying motivation, as you see it, Rahul? I mean, the bulk of it.
Sure, Prashant. I think if you step back in terms of the capital allocation needs of the family, whether it's to create a family office 5-10%, whether it is to buy a big house, as Ramdeoji said, or is it for diversification? I think all of those are very important factors to understand. What is the motivation? Is it for philanthropy? And what we've seen is Indian promoters are actually selling for any of these 4 reasons, but not necessarily to sell because they don't believe in the business. In general, when we see 45 to 40%, bulk of that is, yes, 1 or 2% or 3% sell downs, but you have to put in context the MNC sell downs. Some of the promoters who are MNCs have sold down for capital allocation needs globally. Private equities who are promoters have also sold down because that's their business to, of course, sell down over a period of time and churn capital. Pranav talked about new age companies who actually have very low founder or promoter stake by itself. That skews the data as well. There will be some dilution of stake as well because new capital raise for growth has happened. And then last but not the least, in some cases, the minimum public shareholding has to be met and therefore promoter sell down. So all of that has to be put in context when we look at the promoter sell down, both in absolute terms as well as in percentage terms. I think that therefore the motivations have to be looked at in that context. And yes, 5%, 7% sell down is okay. But I don't believe that Indian promoters, Indian families will have a significant sell down all the way to 25% or below, because as a culture, we have the culture of passing down to the next generation. The big family offices that are getting created are still getting created on the back of control on the basic flagship business. that control is not going away. As against in the West or even in the East, like if you take Japan, the inheritance tax is there, where for the next generation, they have to pay 55% tax. And the only way they can pay is by selling the stake. So I think some of that has to be put in context when we think about what happens 5 years from now or 10 years from now.
Feroz, on the subject of setting up family offices, how much of the money, to your mind, is fed back into the capital markets, re-enters the capital markets?
Yes, Rima. Before I go to that question on the previous topic, I have 3 important points which I want to make. And I really pray Ramdevji's 25% happens. Because in the S&P 500, we are looking at close to about 80% of the companies have 100% free float. And we have not more than 10% of them who have more than 80% free float. There are only 6% of the companies who have more than 90% free float. We are a country with promoter holding, financialization happening. If there's a paradigm shift and there's capital movement, we are a country with 940 lakh crores of household savings, adding 40 lakh crores, out of which only 6.7% is in equity. And largely top 500 companies, because that's what is mandated to domestic institutions as their tier 1 benchmark. So if there's no promoter holding, there will be bubbles, retail will lose money. That's point 1. Point 2, if I personally think that there's hardly any promoter selling in NSE 500 companies. Let me put some math to that table. Out of the Nifty 50 companies, 5 of them have done a stake sale in the first quarter. In the last year, if you look at Bharti Airtel, okay, and Kotak, very second decimal, and Bharti Airtel was 1.21%. After dilution, there's still a promoter holding of 52%. In NSE small cap, which is a little more flamboyant kind of an index, you have a sale from HFCL Limited, and after the sale of 4.2%, we still have a 34% promoter holding. So 34% it's not the last mile out, right? And if you go with this, these are the top 5 sales in those indices of 250 companies. Top 5, the fifth top 5 is 1.58% dilution and is left with 53% promoter owning. So that's point 2. Point 3, if Jane Street should not happen in India again, which SEBI has very rightly, under the auspices of great executive directors there who understand derivatives, your cash market has to be liquid. Otherwise, there could be manipulation in stocks using derivative markets. What did exactly Jane Street do? That was already, on your channel, I've said this twice, that it's so easy. If you have 250 stocks in the derivative index, if cash market free float is not there, वो stock move करेगा, put call खरीदेगा, और पैसे इधर से उधर transfer करेगा. You lose money in cash, you make significantly more money. So having free floats creates manipulation opportunity and overpricing. So that's on point 1. Point 2, does the money find back its way in the family offices? The answer, like Ramdevji said, it's absolutely right that it comes back into the capital markets. Point 3 is, I think the money temporarily comes into capital markets. Anybody who is in the business likes to pull that money over a period of couple of years back into doing another business. But Uday Kotakji had actually said that the next generation of those big promoters actually want to just manage the money. So I think immediately 90% of the money comes back into capital markets, 30-40% goes back into the economy, rightly so. And because the debt capital is more expensive today, for the last 2.5 years, repo rates have been at 6.5, and that's why equity valuations plus high interest rates is creating promoter selling, and that's project is viable at equity. You don't need debt for it, so that's why you see they're deleveraged.
Yeah, no, absolutely. Ramdevji, just a quick point. I mean, as Feroz said, Rahul said, a lot of the money is family offices comes back into the market, so they're diversifying in that sense.
Yeah.
Actually, isn't that also a signal, as we were saying, they are the promoters, are the ultimate insiders. If they are, so essentially they think that this is a great time to actually take some money, put it into family office, all kinds of other financial assets, house, whatever, right?
Yeah.
And then and maybe, as Feroz said, later use that money to start something new, not the business in which they first sold. So is that a bit of a signal at all, or no?
It depends all on the company, you know. Like some of the companies, say like in Indigo, you know, one of the partners is kind of just going out of the partnership. So he sold his entire large chunk, 25-30%. So that is a dissolution of partnership. He was a promoter. So that kind of thing. So every company will have a different reason. You know, I'm only worried about one concern where company knows, because promoter knows everything. I mean, if anybody knows the future of the immediate future, 2-3 years, it is the promoter. So, unfortunately, the investors, they have a very patchy knowledge of the future of the companies. And hence, there should not be arbitrage between the person who knows a lot more to the person who knows a lot less. That should not be the motivation. Otherwise, if I want to buy a house, I want to diversify into a new business, you have fundamental right to, I mean, that's the basic purpose of listing, where you can have the cake and eat it. I mean, in 75% also you control the company, at 50 also you control the company, at 10% also you control the company, if control is an issue.
Thank you once again for joining us here, Feroz. Great that you could come down. Appreciate your time here. Rahul, appreciate you joining us. And next time, hope to see you in the studios. And Pranav, thank you very much for providing all the excellent data and, of course, the perspective as well. It's a wrap on this edition from Breema and me. Thank you very much for watching this edition of Market Editor.
Hello and welcome to Global Eye. I'm Parikshit Luthra. It has been a tariff-heavy week and US President Donald Trump has pulled out all stops. The president has said that all BRICS nations, including India, will face a 10% additional tariff. Trump has alleged that the bloc has plans to hurt America with an aim to degenerate the dollar. Some of the BRICS nations have also been targeting individually by President Trump. Already, President Trump has said that he will impose 50% tariff on imports from Brazil. From the 1st of August, Trump said the duties were a retaliation to Brazil's attack on US tech companies. He also hit out at the country for prosecuting its former president, Jair Bolsonaro, over his alleged role in a plot to overturn the 2022 election. South Africa and Indonesia have been threatened with tariffs of 30% and 32% respectively. That's not all. President Trump is also considering a bill which could impose 500% tariff on buyers of Russian oil. According to S&P Global Commodity Insights, India has already increased its oil imports from the US by 51% in the first half of 2025, but Russia remains India's top crude supplier. Remember, the BRICS nations raised concerns about rising tariffs earlier this week in a joint declaration during its summit. The group said that the trade barriers were inconsistent with the World Trade Organization's rules. So what do these threats mean for India, and how will this change Washington's trade ties with New Delhi? Joining us right now to discuss that and much more, we are joined by Rahul Chhabra, former Economic Relations Secretary at the Ministry of External Affairs, Jayant Menon, Senior Fellow at the ICS University in Singapore, and we're also joined by Pramit Pal Chaudhary, Head of Asia Practice at the Eurasia Group. Gentlemen, thank you very much for joining us. Let me begin by going across to Jayant Menon. Professor Menon, what's your sense? Do you think after these threats imposed by Donald Trump, where he had said that there will be an additional 10% tariff on BRICS nations, the future cooperation of BRICS now faces a question mark?
I don't think so. I don't think anyone should respond to flippant threats from this US administration in any serious way. We've heard a lot of this before. We heard about 100% tariff before the, April 2 reciprocal tariffs were introduced. In his early days, he talked about 100% tariff on the BRICS nations. Now it's an additional 10%. Let's wait and see what happens. I think this is a very erratic and unpredictable environment, and it should not influence individual countries in their serious decisions about how they go about their trade and investment with each other. In fact, I think in the long term, the lesson out of this episode with the Trump administration is that the US has proven itself to be an unreliable trade partner. It's an important trade partner, but longer term, it is unreliable if it's going to continue along this path. And so there is a need for groupings like BRICS to look at increasing integration amongst each other and pursuing new options, diversifying their trade patterns and reducing their reliance in order to reduce risk on an unpredictable trade partner.
Right. Ambassador Chabra, coming to you, do you feel that it's only de-dollarization that Donald Trump is worried about, or is it the emergence of alternate payment systems, because BRICS nations and many other groupings do not want to put all their money or all their reliance on SWIFT?
Yes, exactly. I think I couldn't agree more, firstly, with what Jayant mentioned, Professor Jayant, because, I mean, we must keep in mind that US as a percentage of trade in the 1970s was 15%. Today, it is 9%. So, so there's already a secular decline, and this trend line is further on its way down. So there has to be only that much importance that can be given to statements that are being made in this sort of very arbitrary and erratic manner. So it is important, obviously, even 9% of global trade, it's a huge power block. But then, as Professor mentioned, that I think there will be more sort of move towards trading with other blocks. Coming to your issue on de-dollarization, yes, I mean, people are mixing it up sort of with an alternative currency. So I don't really see BRICS having its own currency in the long run, but alternative payment mechanisms because of the US sanctions against Russia. I think that's how it began. Sort of the move began even earlier, but it was accelerated with that sanctions. So that is when now countries are realizing that, there needs to be an alternative to SWIFT. And again, the move towards that is gaining in strength, both in terms of ideologically countries getting more attuned towards it and being ready to accept that, and actually mechanisms being talked about, that how would they go about it, and the new development bank coming up is also another sort of symbol of that, of what's happening.
Right. Pramit Pal Chaudhary, what's your concern here? Is Donald Trump worried that this is a China-led grouping which is gaining prominence, it's growing year on year, and is seeing greater participation? And this year, for example, you had Belarus, Bolivia, Kazakhstan, Cuba, Nigeria, Malaysia, Thailand, Vietnam, Uganda, Uzbekistan, all becoming members of BRICS.
There's obviously within the American right wing, I would say, a concern that the BRICS was designed, as Trump says, to mean anti-American alignment. The BRICS itself has said that is simply not true. And countries, I said, most of the partner countries, they don't really have voting. Egypt, Indonesia are also not at all interested in having the BRICS become an anti-Western or even an anti-American organization. Keep in mind that the BRICS attempts to create a BRICS gold-backed BRICS currency, which was proposed by Russia, and the creation of a BRICS blockchain, which was designed to basically bypass the SWIFT payment system, were both shot down in the last two BRICS summits. And the two countries that led that were India and Brazil, who argued that one, this would be, we do not, basically both said we do not support de-dollarization, and both were concerned, especially India, that this would effectively make China the dominant player in these spaces. So the BRICS continues to be internally very divided. on this issue between a group that is, quote, anti-American, and that Trump is right to say that there is a cluster there, Russia, China, Iran, obviously being at the heart of that, and another group who want this to be a voice for the global south or for emerging economies, but want to keep this as a non-aligned movement. This keeps the BRICS, this division keeps the BRICS from getting anything, should we say, substantive on their agenda. A lot of statements are made, but nothing much more than that.
Right. Professor Menon, if I were to ask you about the threats to United States being imposed by BRICS. Now, yes, there is talk of greater settlement in local currencies, having a BRICS payment system as well. India has repeatedly said that there is going to be no BRICS currency. Russia has spoken about it in the past, but it has not found support. Why is United States worried about the emergence of an alternate payment system? Is there a feeling that a China-dominated payment system may hurt the American economy?
I think the concern is that it'll take away a lot of the monopoly power that the U.S. currently holds on managing sanctions as it imposes them on the country of its choosing. So an alternative payments mechanism to SWIFT, for instance, there is one, that's the CIPS by China, but SWIFT is the most widely accepted and used system. And so the effectiveness of any sanctions could be bypassed or worked around if there was an alternative. But I think, as my co-panelist mentioned earlier, we need to distinguish between a payment system and a new global reserve currency. I don't think the US dollar will be replaced anytime soon as the reserve currency for the global system. I think countries should, as much as possible, use other currencies, especially in their bilateral trade. There's no reason why they shouldn't use one of their own, either party, their own currency. If India trades with China, it could be in rupees or in yuan. There's no need to have the US dollar always. But that's a separate issue from a reserve currency, which is when you do trade with two countries and you use a third country currency, like the US dollar, there's no currency at the moment that will challenge that, not even the euro. So that's something that we have to live with. And that's a separate issue, and that's not going away. But that's what Trump, I think, is also particularly concerned about. The US dollar is losing its prominence in the global economy, but slowly.
Right, that indeed is right. And Ambassador Chabra, to ask you about India's cooperation with BRICS. The Prime Minister was there this time, but we did not see Xi Jinping. We did not see Vladimir Putin there either. Do you think the kind of threats that are coming, and these are the real threats, Trump did not mince words. He's treating allies and foes in an equal manner when it comes to tariffs. So he's gone on to say that it doesn't matter who you are, if you're a member of BRICS, you get a 10% additional tariff. So even if we get a deal at 10% with Donald Trump, we may as well be facing 20 or 25% tariffs altogether. In this kind of a scenario, how do we assure Donald Trump? Can we break away from BRICS? Because it seems that that's what Donald Trump wants.
No, I don't think, considering India's the investment we've already made, how we sort of fit in as the voice of the global South. I mean, BRICS is really this forum that is emerging now as a more manageable, with BRICS Plus as a more manageable sort of Southern voice rather than the omnibus non-aligned movement as it used to be earlier. So I don't think India can break away from BRICS in that sense, but it'll have to navigate with the conflicting positions here. And the fact that President Putin and Xi Jinping were not here in this particular summit doesn't necessarily mean that, you know, their commitments were not there, because if they did, everybody did sign on to the joint statement, and they were obviously approved at the highest levels possible. So the issues were agreed to. There was a common sort of position that came up. And though Pramit mentioned that it's just statements as of now, but I think it's a good starting point. I mean, even reaching the statement level, and then that's where you start building up the rest of the narrative and the action points from the statement. So I think India is quite committed and invested in the BRICS process, and will have to sort of navigate, like in many other organizations. Obviously, there are no organizations that really flow along so smoothly without contradictions. We've seen that in all multilateral organizations, regional organizations. All countries have their own interests, and you need to sort of, that's where diplomats' role comes in, actually.
All right, we have to take a short break, but clearly the kind of chaos that we're seeing in the world today, and there is no method to Donald Trump's tariffs. A lot of this is outside the WTO. Will this only bring BRICS nations closer together? We'll discuss that with all our guests after the break. Welcome back. You're watching Global Eye. We still have with us Rahul Chabra, former Economic Relations Secretary at the MEA, Jayant Menon, Senior Fellow at the ICS University in Singapore, and Pramit Pal Chaudhary, Head of Asia Practice at the Eurasia Group. We're discussing the future of BRICS in light of Donald Trump's threats against the grouping. Pramit Pal Chaudhary, if I were to ask you about whether the kind of threats that are coming from Donald Trump, the kind of tariffs he's imposing, and look at what's happened with Brazil. In that case, it's purely a personal whim. There is no method to it. Now, when you have such a fragile global order, wouldn't it make more sense for countries like India, Brazil, Russia, India, China, South Africa to just come closer together? We are very closely intertwined. China is putting restrictions on rare earth magnets. US has its own war with China. The whole world is suffering from it. Rather than breaking down the grouping, isn't Trump only making sure that this grouping becomes closer together?
Well, two things, as I think Adam has mentioned. What Trump says and what he does are two very different things. Trump is unusual for being a US president who doesn't seem to think what he verbally says really matters. and often is prepared to say things that are both flippant or just used as a pressure point or a response to a question from an audience. The actual policy, on the other hand, is often quite different and is often a consequence of more complicated negotiations. You'll notice that at present he has still not announced what his tariff on India is, because India is about to enter its 47th round of negotiations on exactly the nature of the tariffs that it faces. But the BRICS, what you've mentioned, though, and I think you rightly cited the issue of China putting a ban on permanent magnets and various other sanctions that it's imposed, not only on the rest of the world, but also specifically on India. And that is part of the problem, is that, and you'll notice that when Indian officials have publicly been asked, are you worried about the damage America is doing to the WTO? Their response is the WTO began dying because China used to cheat on it. The WTO's failure to discipline Chinese subsidies, Chinese currency manipulation is the original sin, if you wish. And this is one of the key problems that the BRICS faces, that countries like Brazil and India look at China and say, this is the original problem in international trade. America is now adding to that, in part because America doesn't know what to do about China. The hollowing out of the manufacturing sector in the United States is a direct, partial consequence of China's own actions. So the BRICS, therefore, has a huge problem, which is China, which is why you're seeing plurilateral trading agreements within the BRICS. India and Russia have a digital payment system. They're negotiating a BTA. The highlight on the sidelines of this BRICS was actually Modi and Lula signing a whole host of agreements and bringing India and Brazil much closer together. But BRICS as a trading bloc faces fundamental differences within it. And at the heart of that is the fact that a number of the countries are very, very wary about Chinese trade practices.
Absolutely. Let me go back to Professor Menon. Professor Menon, does Donald Trump's threat now put India in a lot of difficulty with regard to future cooperation with BRICS? Look at the kind of statements the BRICS leaders' declaration made. It goes exactly contradictory to what US president stands for. They pushed for a just, equitable, agile, effective, efficient, responsive, representative, legitimate, democratic, accountable international and multilateral order. They were against polarization and fragmentation. They spoke about sustainable trade and development policies which are mutually supportive and aligned with WTO rules. How will India proceed with the BRICS if we want to sort out our issues with the United States?
I think, this is a classic problem with the grouping where you have members with disparate interests. And especially for a new grouping, a relatively new grouping like BRICS. BRICS is not that old. It was formed in 2009. You look at, the most successful grouping amongst developing countries, arguably ASEAN, is 60 years old. It takes time for, trust to be built up and for these differences in positions to become more closely aligned. They won't go away. Countries will have their own interests, but they'll find it easier to identify common ground on some issues, at least. At the moment, that's not the case. And the recent widening of BRICS, expansion of its membership, has made it even more difficult because the diversity has increased quite substantially. I mean, this is a playbook that Margaret Thatcher used with the European project when she was concerned about how deep it would go, and she encouraged the entry of Eastern European nations, recognizing that the wider you get, the harder it is to get deep agreements working. So this is what has been happening with BRICS. So it's a challenge for a relatively new grouping. But, over time, I think there will be some sort of coherence in positions. And that's what I think the current climate would probably help that happen. You find a common enemy, if you like, in quotation marks, given that everyone is now facing a lot of pressure from the US. This can help bring these countries closer together and find more common positions.
Absolutely. My final questions now. Ambassador Chabra, the last threat that has come from the US is a 500% tariff, a punishment tariff on countries like India and China if we buy energy from Russia. Till now, we've been reducing our imports from Russia. Earlier, they were not under sanctions. We've increased our purchases from the United States as well. But a 500% tariff, that's almost no trade with India and China.
Going back to exactly the point that Pramit made, that is a threat. So we will see when the actual negotiation happens. So that is the time when you promise additional purchases from the US, you bring down the Russian purchases from Russia. You're always able to negotiate it. So that is sort of a maximalist position that the US president has taken and put on the table. So you're sort of beginning up there. And then it may puts the adversary in a little tough position. But then there is always that scope and room for negotiation. So it is obviously not going to hold that figure. But we'll have to see where we are finally able to settle by promising sort of adjustments to our purchases.
All right. Yes, we have been assuring the United States that we are buying more energy. In fact, in the next 12 to 18 months, we would have bought almost $25 billion worth of energy, and there are major defense contracts also in the pipeline. Ambassador Chabra, Professor Menon, Pramitpal Chaudhary, thank you very much for joining this on a very interesting discussion on the future of BRICS. Clearly, the global chaos and uncertainty will possibly bring BRICS nations and the BRICS Plus closer together. With that, it's a wrap on this edition of Global Eye. Thank you for watching. Goodbye.
Welcome to Indianomics. The threat of tariffs has been larger than the actual tariffs. President Trump has announced 25 to 50% tariffs on about 15 countries this week, but via letters, not executive orders. His executive order has actually pushed the effective date of higher tariffs to August 1, as we know. Now, that explains why markets have not reacted very badly to these very large tariffs that he has announced via letters. And then there is this threat to the BRICS countries that they'll be hit by 10%. There's also a threat for those buying crude from Russia. There is threat on pharmaceuticals. As of now, it appears that the world may have to live with 10% tariffs for all imports into the US, 50% tariffs on steel and aluminium, and a whole lot of threats. Now, what's going to be the upshot for EM economies, for the US itself, and for rates and currency markets? I have with me Chetan Ahya, the Chief Asia Economist at Morgan Stanley, Louis Squeeze, Chief Economist, Asia Pacific at S&P Global Ratings, and Sameer Goel, Global Head of Emerging Markets and APAC Research at Deutsche Bank. Gentlemen, thank you very much indeed for your time for what must be very busy days for all of you. Louis, let me start with you. If this is the status quo that we should get used to, about 10% to 15% imports and a whole lot of threats, what will it mean for the Asia-Pacific region? Should we be prepared for even lower growth?
Well, I think it's clear that both the elevated level of the US tariffs, but also the uncertainty around it that you indicated, is not helpful if you're thinking about where to expand, where to build factories, where to export to. So we expect this to weigh over the region, especially the more export-oriented economies, of which there are quite a number, of course, in the APAC region.
Yes, the uncertainty and therefore the problem with investments, problem for investors. Sameer, what about the impact on the US itself? The latest numbers we saw didn't look all that bad. I mean, even if you looked at inflation, it was not way higher, it was higher enough for the markets to remove the expectation of any cut anytime soon. Do you think the tariffs are going to show by way of higher inflation in the US sometime soon and therefore prevent the Fed from any rate cuts at all this year?
Hi, morning, Lata. No, so indeed, I think one of the interesting facts about data has been the US economy has proven to be a lot more resilient even to all this level of unpredictability and the threat of higher tariffs. Now, part of the story could well be front loading. I mean, everybody is fearing those tariffs to go up and therefore exporting rather rapidly to the US. I think it's keeping up sort of general activity levels a lot better. But it is true. I think this high uncertainty around the tariff policy, we suspect will bear down on growth in the second half. Part of the equation has also been how easy financial conditions have been. Financial conditions in the US are right now easier than they have been since sort of early 22, and which has probably been part of why this resilience come about. The consumer balance sheets fairly clean, firm capex plans. Yes, I think sentiment has been weakening, but nowhere near about as large as one would have expected, given how big a shock to the global trade order the last few months have actually proven to be. Still, it's on watch. I suspect second half there will be payback to that front loading in a lot of trade activity. Our view in the House is that growth will slow down. I think we will avoid recession, but growth will slow down in the US. Now, as far as the Fed is concerned, our view is they'll probably only be cutting rates by December of this year. Risks are maybe more two-sided, but I'd argue it will require probably a lot weaker labor markets for the Fed to trigger rate cuts earlier than that.
Okay, then let me just finish the Indian or the Asian situation. We have never seen this kind of rate differential between India and the US. What does that mean for the Indian currency? Do you think that there could be appreciation bias on Asian currencies in general and India?
So I think there's a little bit of a difference. I think India has a bit of a unique position within Asia. So like you said, there's a common factor, which is the rate differential. And absolutely, the rate differential argues a lot more in favor of the US at the moment. I mean, the differential is fairly wide, and on top of it, given how low inflation is in bulk of Asia, including India, the bias should be for, in a way, that differential to at least sustain at these levels, maybe even widen, depending upon how quickly central banks in Asia actually cut rates. The other factor, though, besides rate differential, which is driving, in my view, the currency markets, is, of course, this sort of lessening appeal, the safe haven appeal, if you might, of the dollar, or the willingness of the rest of the world to be able to invest in US assets or recalibrate the exposure they have towards the dollar. And that's something which I think is far more better looked at from the metric of net international investment position. Now, that's where India differs a lot. A lot of Asia is surplus on its NIIP. India isn't necessarily, so it doesn't necessarily benefit from the same factors. But for a lot of the rest of Asia, I'd say the fact that the investment community is not willing to necessarily at least incrementally add to its dollar exposure and probably willing to convert a larger part of its dollar stock holdings into local currency itself lends more of an appreciation bias. I think India is a bit of an exception on that front, but certainly for rest of Asia currencies, our bias is to think for more strength in the second half of the year.
Okay, more strength for other Asian currencies. Rupee perhaps will move both ways. I'll come to your view on the dollar itself in just a minute. Chetan Ahya has joined in. Welcome to the show, Chetan. Well, I wanted to begin at the beginning. You know, as we explained at the start, we are living with 10% import tariffs for the US and 50% for steel and aluminium. But the rest is a whole lot of threats. Nothing has been implemented just yet. What does this mean for EMs? Does it mean that you can actually push up your growth forecasts or no?
Well, not really. I think, Lata, not only this the new announcement, but the ones which were announced earlier are also still not yet reflected in the growth data points that we are watching across the region. The reason why there is a lag is because when you think about the tariff impact, so the tariff impact has also been delayed because stuff that gets imported into the US, if it is shipped on a particular day, which is right before the tariff is imposed, it does not attract that tariff on the US shores. And so that is, if you look at the US customs data, weighted average tariff in the US has increased to approximately 10%. But when we do the actual math of what is the weighted average tariff rate based on what were the import values last year, and then what is the tariff imposed on different countries, and that number is 13.5%. So tariff itself has got delayed in terms of actual collection because of the way the accounting is done. Plus, you have the other challenge, which is that, corporate sector has taken a decision not to invest in future projects, or if they have taken the decision not to invest in the future projects, that impact also takes time to come through in the numbers, because right now we are still implementing the projects which were announced earlier. And so the investor base has suddenly got that sort of sense that, oh, tariff doesn't impact US inflation, tariff doesn't impact corporate margins, tariff is not going to be an issue as far as the CapEx decision is concerned. We don't agree with that. We think all of this impact is in the pipeline, and we're going to begin to see that from the third quarter of this year. And for Asia specifically, we are saying that, the CapEx numbers for July, August, which we will be measuring very clearly from the capital goods imports data, which is a high frequency number. And that's what will actually come through. So, and the new announcements are only going to make this whole downtrend that we are building in either more confirmed, or you'll probably see more downside out of additional tariffs.
Okay. Well, I have a lot of questions on then EM growth for you. But, specifically with respect to India, Chetan, see, the big expectation is that we will not be taxed as much as, say, Vietnam or Bangladesh, that we would be, taxed less. Probably we already have a 10%, maybe it would become 15 or 20. Will your forecast of India's growth be very different from what it is now, if it is indeed 15 or 20? Let's work with those numbers.
Look, I think the biggest impact that we have been referring to is the point on global trade and global CapEx. and consequently also India's capex trajectory. And that part of the impact is more connected to this uncertainty that has been created on account of tariffs, which is going to remain. I mean, if the global trajectory gets affected more because of the new tariffs and therefore India's exports or also Indian corporations' confidence on their export demand outlook, that part is sort of independent of what tariff specifically is imposed on India. I think if that higher tariff is imposed on India, then it takes away that offsetting demand which we would have expected India to get through, because India's tariff is less, other Asian trade partners' tariff is higher. Then you could have said that the exporters in India would benefit and they would have market share. So that's the only bit which will be sort of taken away if India's tariff rate is similar to other regional players. Like we've heard Vietnam's number at 20, and if India's number is 15, then that gap narrows and it reduces that market share gain potential that Indian exporters would have had.
So what you're saying is that it's a very small needle that moves if India is indeed able to strike a deal at 15, because in any case, the rest of the world will slow because of the uncertainty and, the higher tariffs that the others are suffering, correct?
Yeah, if I may summarize it better, it's a global beta effect, and there is also an alpha story, right?
Yeah.
So that alpha story is a small proportion. I think the beta is a bigger, important story. If there's a global slowdown, global exports slow, then it will be hard for India to avoid that downturn.
Okay. Louis, a similar question to you, actually. Where are you all in terms of, pitching the growth story in Asia in general, but more particularly for me, India? Will the deal make a very big difference to your estimate of Indian growth?
Well, so these are almost two different stories, right? The general EM Asia story and the India story.
Okay.
Our India story is also, of course, picking up the fact that after a soft patch last year, the recent data on India has been better, so we have become a bit more optimistic on the domestic side. And in an economy like India that is so large and where the domestic side is so important, that really matters. And so I would say, I think if I recollect correctly, our latest change to the India forecast was moving up because of that better domestic momentum. That having said that, more generally, our story on EM Asia, and that kind of includes India, has from the start been like we should not underestimate the impact of those US tariffs and all that uncertainty that my fellow speakers have also talked about, how that is weighing on investment decisions and economic activity. And so we've generally been a little bit less optimistic, if I use the word. I've heard quite a few economists talking in recent years about looking who are going to be the winners in Asia, the countries that will benefit as supply chains are shifting. We have been a bit cautious on that. We have felt that given all that uncertainty, and if your neighbor's tariff is 20% and yours is 15%, is that really going to drive an investment decision that is based on many other factors as well? So we've been quite careful, and we've also been noticing that actually, if you look since the first Trump administration of quite a while ago, overall FDI into Asia in US dollar terms has come down rather than up. And so I think the general story is not really a good one. And trying to find relative winners is, I think, not the most important or not the most worthwhile effort. Generally speaking,
I get your point. You're basically saying what Chetan put it as, the global beta is more important and the alpha is for India will be, lower. I take your point.
But I would say, Lata, like the global story is important, but Asia is a relatively trade-dependent part of the world, right? And so that's why we have become particularly less bullish on the smaller open economies, be they Thailand, South Korea, these types of places.
Fair point. And maybe that's the blessing for India. But Samir, I want to get to the dollar. You brought a very important point to the table that large parts, many countries in Asia are not interested anymore in, buying US assets, especially US treasuries. Now, where do you see the dollar, therefore? There is the big, beautiful bill, and there is the demand side as well. Supply also is against US yields. There'll be too much of it. And there is less demand. So your trajectory for dollar and US yields?
Lata, from my perspective, I think it's very hard to be bullish on the dollar at this point in time, right? I mean, first and foremost, I mean, the twin deficits are bearing down on the dollar fairly significantly. We are probably running a current account in the US is, I would argue, probably close to 4 to 5%. This tariff policy hasn't really made much of a difference, though obviously there is a front-loading impact and we need to see payback to that. But at these levels of the current account in the past, the dollar has been materially weaker over a 1 to 2 year period. The other way to look at it is, of course, increasing pressure on the Fed to also ease policy, which could ultimately also take away that rate differential support, which you were earlier speaking about. But probably what is most critical, I'd say, is the fact that ultimately the global appetite to invest in the dollar is just a mirror image of the trade gap the dollar runs with, the US runs with the rest of the world. And to that extent, a shock to the global trade order will eventually also result, as it has been for the last couple of months, on the rest of the world's appetite to own US assets and to be able to fund that US deficit. Now, the US is sitting on a net international investment position which is negative to about 80-90% of GDP. Even if that were to try and revert back to some level of historical norm of about, let's say, 60%, that would still require potentially material dollar weakness from here. Now, the dollar obviously has that safe haven exceptionalism, so it's hard to be able to look at just historical trends to see how much that correction would be. But it's not obvious to me at all that, particularly with the current set of policies, that the global appetite for the safe haven appeal of the dollar is necessarily going to lend to the same level of financing.
Samir, let me just stop you there. I have to take a commercial break. But after the break, I want from all of you some specific numbers on how much of dollar depreciation you see and how much of growth may be impacted by this overall global slowdown that Chetan just spoke about. Back in a minute. Welcome back to Joe. Also, we've been discussing the tariff uncertainty and the tariff threats with Chetan Ahya of Morgan Stanley, Louis Squeeze of S&P Global Ratings, and Sameer Goel of Deutsche Bank. Gentlemen, thank you very much for your patience. Sameer, I know you're running into a wall in terms of the time limit. So, a final question to you. Can you tell us what you're looking at? You argued that there are reasons for a further dollar fall. What are we looking at? Are we looking at a dollar index of 90, even below 90, 89 types? And what does it mean for dollar rupee?
Lata, we don't have formal targets on DXY, but I argue that moving below 95 over the next 6 months, very possible. Once the Fed cycles really underway over an 18-month period, can we actually be looking at something closer to 90? Not entirely impossible, depending, of course, upon how we land on various sort of US policies.
Okay. And the dollar rupee?
So, like I said, I think it's hard for the rupee to completely sort of be able to move against that trend. I'd still probably put dollar rupee higher than where we are right now, then lower, probably towards closer to the forwards of 86.5 in the next sort of 6 months. But that would still mean the rupee is sort of underperforming what rest of Asia currency would.
Which is what you argued. Thank you very much, Sameer, for your time. I know you're running too many appointments. Chetan, I wanted to ask you about, therefore, what do you look at as the Indian growth? You said the alpha is not enough. So do you think the Reserve Bank's 6.5 is very tough? Do you think we could be in a rate lowering, in a downgrade trend come second half when people realize the impact?
That's right, Lata. So we are expecting growth to slow in India, and the fourth quarter of this year, calendar year, we're expecting growth to slow to 5.9%. So we are expecting it to get to that, below 6%, just below 6% kind of numbers. And that's because of the reason that I mentioned in the first half of our discussion today, that there is going to be that global downtrend that will weigh on India's exports. And we do think that the corporate sector in India is also conscious of these trade tensions. And another point which I didn't mention earlier is that to the extent to which China has been going through this deflation challenge, and we know that when the trade downturn comes in, there will be even bigger deflationary pressures from China to the rest of the region, including India. And that is also making the Indian corporate sector conscious of not going ahead with aggressive capacity expansion because, you know that there is a pricing power problem. You know that there is a competition from China. And so, I think India is going to find it difficult to continue to keep maintaining its growth rates while you have this global trade slowdown and global capex slowdown.
Okay, I want to come to the inflation issue as well. Let me put that first to Louis. Louis, would there be a big deflationary pressure from Asia and from the world in general because of not being able to sell to the big market? India is almost heading towards 2.5% CPI for the next few months. Can the pressure of disinflation mount?
Yeah, so I think when we look at our inflation forecast, there are other drivers than the China or the overcapacity story that are putting downward pressure on inflation. We have had commodity prices, we've had energy prices, but I do think that the wave of industrial products that will be looking for a market now that those US tariffs have gone up and now that we've had a divergence between prices in the US and everywhere else, I think that these pressures will amplify and are going to put more downward pressure on inflation and also, of course, on corporate profits in the region.
Chetan, your view, also the inflation trajectory in India because of the global or Asian disinflationary pressures as well, therefore, is this the last of the rate cuts we saw, or will the Reserve Bank be forced to do more because of growth, if not inflation?
So, Lata, I mentioned my growth forecasts, and those are not very good in the sense that India will still outperform the rest of the region, and those numbers which I mentioned are respectable. But there is going to be a slowdown, and already inflation has reached low point. You're going to have deflationary pressures on account of tariff. Tariffs are inflationary for the US, but deflationary for the rest of the world, particularly Asia. And as Louis mentioned, we've got this commodity price decline that is adding on to it. So we think all the factors, domestic capacity utilization suffering with growth slowdown, the international factors like trade, as well as commodity prices, inflation will remain pretty much in control unless you have some supply shocks on account of food. But I think at this point of time, rainfall is looking like it's going to be on track. Area under coverage is up. So yeah, we are highlighting the point that the central banks in the region, including India, will probably end up doing more than what the markets are pricing in right now. And we, in our base case, have one more rate cut. But we are also highlighting the risk that the central banks may end up doing more because of the way the inflation trajectory is going to be across the region. Oh, and sorry, one more point to add, that this currency movement and the dollar weakness is also adding to some kind of disinflationary trajectory. So yeah, it's an additional factor, and it's also an important factor because when the central banks are looking at their domestic growth inflation dynamics and taking a decision to cut their rates, they are not being held back by what's happening to the dollar. Because in the early last year, if you remember, we still had the concern on, what are the currencies going to do if you cut rates ahead of time. But now, with the way the dollar is going, that's another factor that will help central banks, if need be, to cut rates more.
Okay. Well, thank you very much for an extremely enriching discussion, Louis and Chetan. The key takeaway that we may have a small alpha if our tariff rates are lower than, say, Vietnam or Bangladesh, but the bigger beta of global slowdown will take away that advantage. More rate cuts coming, but not for a good reason. They will come because growth is going to disappoint. That's not a very pleasant situation to be in, but that's the way things are panning out. Thank you very much for watching this special edition of Indianomics.
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. The Sensex and the Nifty declined for a second week in a row, losing 1% each. IT stocks lead the decline. Mid-caps fall in tandem with the blue chips. India braces for a difficult first quarter as TCS starts the earnings season on a tepid note. Autos, banks, consumer staples are likely to see weak growth, but healthcare services, construction materials, renewables and telecom likely to report strong growth. President Trump threatens 35% tariffs on Canada from the 1st of August, also says he plans to impose 15 to 20% tariffs on, and I quote, remaining countries who are yet to receive any letters. 23 nations have received tariff letters so far. UK and Vietnam have signed a trade deal framework. A management shake-up at Hindustan Unilever. Ritesh Tiwari set to step down as CFO and move to a global role. This comes a day after Rohit Java stepped down as CEO, with Priya Nair set to take the reins. HUL stock up more than 4% today. Promoters of VIP Industries are set to be in advanced talks to sell stake in the company. Sources say private equity players, including multiples PE, are in the race and a deal is imminent. The insurance regulator initiates the process of issuing show cause notice to 8 health insurers over alleged lapses in claim settlements and rejections. Sources tell us insurers are likely to be asked to pay a penalty or return money to policyholders with interest. The suspense over Tesla's India entry is set to end next week. The Mumbai showroom will open on the 15th of July. Timelines on bookings and sales to be announced shortly. Israel intensifies bombing in Gaza amidst widespread reports of hunger and starvation. At least 15 people, including 10 children, killed in an Israeli strike as they queued outside a medical point for treatment. More than 57,700 people have been killed in Gaza since the start of the war 21 months ago. Well, the big story today. The Union Cabinet has cleared a new fund to bolster research, development and innovation. A new fund with a 1 lakh crore rupee corpus has been set up to facilitate long-term financing for private companies. Now, the aim is to provide risk capital to sunrise sectors, promote adoption of cutting-edge technology and boost competitiveness. The government also plans to facilitate a deep tech fund of funds. India's overall spending has increased steadily in the last decade from less than 60,000 crore rupees in FY11. R&D spending in FY21 has nearly doubled to 1.2 lakh crore rupees. According to the government's latest economic survey, the number of patents issued in FY24 nearly 1 lakh compared to just 25,000 patents issued in FY20. But the same economic survey also points at India's R&D expenditure lagging behind several nations. R&D spends in India stands at just 0.65% of the total GDP. China spends 2.4% and the US spends 3.5% of its GDP on R&D. And it's not just the government. The contribution of the private sector to R&D spending in India remains very low. The private sector accounts for just 36% of the total R&D expenditure in India compared to 75% in the US and 77% in China. In a world divided by trade wars, India needs to develop its own technologies to remain self-sufficient. The recent export curbs by China on rare earth magnets is just one case in point. So how can India build strength in sectors like semiconductors, quantum security and cybersecurity? Will this new fund help kickstart an R&D revolution? Joining us now to discuss all of this and more, Ajay Sood, the Principal Scientific Advisor to the Government of India, Ajay Chaudhary, the founder of HCL and also the head of the Quantum Mission, and Saurabh Srivastava, the co-founder and former chairman of NASSCOM. Gentlemen, many thanks for joining us here on the program. So if I can start by asking you, there's been a long anticipation of what this fund is going to do, but I want to link this fund to the strategic imperatives and national priorities that India must bet on. Let's start with that and then move towards how we make this fund work, how this fund is operationalized. What should India today, given the geopolitics, given the volatility, bet on?
So if you look at it, as you said, we need to see what is needed for technological sovereignty of a country. So we need to see what technologies we should be able to have control and not be dictated by other forces. Now that will have to be decided. There are many of them which are very obvious, as you pointed out, but also we have to also see which are little bit futuristic. And that also we have to focus right away. I mean, of course, the immediate thing which you saw in the recent conflicts is the unmanned armed vehicle, UAVs, autonomous vehicles. But that is something, again, is come very timely but there will be many such things which will happen. So we have to be tech ready to do all this. And in all this, the private sector investment and the private sector working with academia is absolutely must.
You're right in pointing that out, that we need much deeper collaboration and deeper partnership there. But linking tech sovereignty to national security, you brought up the issue of Operation Sindoor, and I would imagine that this now is a challenge and a priority as far as the government is concerned. UAVs are only one aspect to consider. So is there a thinking now? I mean, the Defense Ministry has its own agenda as far as indigenization and localization is concerned. But is there a thinking now on what India should bet on to marry tech sovereignty with defense self-reliance as well?
Answer is yes. I mean, these are being discussed at various fora, and many of us are part of it. And in all this, when you say tech sovereignty, it also does not mean doing everything yourself. It's not like 100% you have to do it here. You need to see what is critical here and which are your reliable global partners on a long term, which is always...
Is there any reliable global partner today?
May not be, but you can do in stages. You have to do in stages. And this is where the critical thinking is needed. And answer is that a lot of it is now being thought over, be it drones, be it anti-drones, be it semiconductor technology, be it AI, as you have been getting to know this. So many of these things like biotechnology, which is really, really in the background of many, many development, is again happening on this in this manner.
Mr. Chaudhary, I know that you're a worried man, and I know you've been a worried man for a few years now, and you believe that time is of the essence. We need to act, and we need to act with a sense of urgency. So for the benefit of everyone watching now, let's lay out the next steps. What are we supposed to focus on? What should one think is going to be in the escalation ladder, if I can use that since we're talking about defense, the next steps of action?
You see, I think one area that we must understand that economy and military strength is now directly linked to technology. So if we don't have the technology, we'll have neither. Now, first thing that we need to do is to identify areas where we must excel and own our own technology. As you rightly said, we don't have any friends. We don't know who are our friends. So if we are living in this unipolar world, we need to identify all the technologies that we will need for the next 10 to 15 years. Some of them will not work for us. Some of them will work for us. But as Professor Sood said, in some cases, if we have to collaborate, I would rather go and buy some technology. So this fund actually provides for buying of technology also. And buying of companies also.
And not just Indian companies?
No, global companies. So, for example, we are sitting in one particular technology at level 5. We want to get to 10. Why not go and buy 5 and then get to 10 rather than go from 0 to 10? So that's the approach we have to take because, as you rightly said, time is of essence. Suddenly, this particular war was thrust on us. You know, before that, see what the technology that the Pakistanis used? They went to a private satellite company called Maxar, where a Pakistani had an interest in that company. They were looking at Pahalgam 3 months before Pahalgam happened. So technology was used by our enemies. So if we are not there and we don't use the technology, we are not going to be successful.
Let's now talk about operationalizing this fund. And Mr. Srivastava, you have the experience of having worked with the government and within the government ecosystem. That's how NASSCOM happened, and that's how the Indian IT export story happened as well. You're talking about acquisitions. You're talking about investing in private companies. This is a government fund. How does this government fund now decide which companies to invest in, which entrepreneurs to back, which technology to invest behind?
Shireen, the very heartening thing is that the government does understand that this fund can't be run in the normal bureaucratic way that things are done. It completely understands that. And so the best thing that's happening is that the intent of the government is to make sure that all these decisions that you said, which companies to invest in, which technologies to buy, which corporates to work with, which startups. Government does not plan to take those decisions. The government plans to layer it down and create a second level of entities, which may be fund of funds, AIFs, NBFCs, DFIs, all of those banks. And basically, each of these will have its own investment committee. And they will have experts in different domains, different disciplines, and they will take the calls. But what would have been decided beforehand, where is it that we are focused?
Yeah.
Which areas, which sectors? Just like you said, we have to get very specific that we don't boil the ocean. We have a limited budget. 1 lakh crore is good.
It sounds big, but actually, I mean, you know, when
In
you talk
global
about the
terms,
kind of investments that are required,
It's $12 billion.
Yeah.
It's not a lot of money like global standards.
Yeah.
So we have to spend it very wisely, in a very targeted way. And I'm really encouraged by the level of industry consultations that the government is doing. You talked about NASSCOM. The last time I felt like this
was at NASSCOM.
Was when we cracked this whole thing between government and industry at NASSCOM. That's the environment today. And that's why we're also really encouraged, because we think we can see that light.
So, you know, what should we now expect the next steps to be in terms of actually operationalizing what we've just spoken of as far as the actual money starting to be disbursed? And I come back again to, you know, whether these investment committees will sit and look at which companies and so on and so forth. But there has to be, as you pointed out, an overarching direction that each investment committee will need to follow before they make any decisions. So has that overarching decision been set? You know, if you can share that with us, and when should we expect the fund to actually be operationalized?
So a lot of thinking and a lot of work has already happened. Actually, there are two levels. One is the overarching committee, which is called EGOS, which is chaired by Cabinet Secretary, and PSA and few secretaries are members, which will take overall decisions. The next one, where the fund will be parked, the first level, is Anusandhan National Research Foundation.
Okay.
ANRF, which you know was recently operationalized. So the executive council of that will really be seeing many things which you have asked. So that's where, and a lot of thinking has already is happening as we speak, because EC, as you know, is chaired by Principal Scientific Advisor, and DST is responsible for operationalizing it. So many things are actually happening in the background to see how do we have our first cut. Then we have the second level fund managers, which Saurabhji said there can be many. In addition to what he said, we also have a possibility it can go to focused research organizations like BIRAC or TDB, which already have some experience, and they can be done, because you know, like many incubation parks and the research parks in IITs are doing very well. And now if this is given to them, they can really accelerate what they have been doing. So that is a very new thing, not new thing, a very novel thing. So all that actually as we speak is happening. And the identification of whether it is AIF or various, all of will be eligible. It's not one or the other.
Or the other.
It will be multi-prong attack. Also, in addition, some funds are also there for deep tech funds of funds.
Right.
Which will be differently dealt with as compared to corporates. Because we also need substantial support for that. And that is also covered in this. And that could be a mix of equity and loan.
So the government will actually pick up equity in some of these deep tech companies as well?
Only in that startup.
In the startups.
Not in the
Through the
others.
funds.
Not in the others.
Right.
No, see, the one good thing is, you talked about implementation. The idea is that we want to accelerate the deployment. You use multiple channels. Now in life, some will work very well, some will be slow, some may not. This is something very new that we're doing. So the idea is to diversify the risks. which is a very, very intelligent thing to do. When it comes to equity, the government is open to taking equity in startups. But large corporates obviously is a different.
It's a different story.
Different story.
Yeah.
So
But so far, the government has stayed away from picking up equity. I mean, with the exception of debt conversion into equity, which has happened in Vodafone, etc. But that's a separate story altogether.
No, I want to correct.
Yeah.
When we remember last time we talked about quantum.
Yes.
In quantum, all startups are being given up to 30 to 50 crores per startup. And we are taking an option to take equity. Already decided. So we are against the money that they are getting. We are not asking for any guarantees, but we are saying when you go for an exit, you give us the equity at 30% discount. So this is the first time the government has already started to think that way. And the interesting part of this fund is that originally when it was announced, it was said to be 50 years, zero interest loan of 1 lakh crore. Now already 20,000 crores this year has already been given to DST. So now DST has the challenge to spend that 20,000 crores by March. So therefore, DST is working very fast. Like PSA has been literally working with DST to make this move because we need to take these decisions very, very fast. And this is the time we want to nudge the corporates to get into R&D. See, this is a major problem. Corporates have not got into R&D. And by giving loans, let's say, for example, I think the plan is to give 50-50. So if, for example, a particular area of product that we want them to develop, let's take magnets, which are really in short. Let's say that needs 500 crores. The government will put in 250 crores. The corporate has to put in 250 crores. The same thing goes for startups. In case of startups, government will put in 70%, 30% startups. So this is the kind of thinking that is going on. And the pace at which this whole program is moving is quite amazing because it's really got the support of the Prime Minister. And therefore, it is very critical for us to take quite quick decisions.
So if I may add something.
Yes.
See, the one other very good thing that's happening, and again that takes me back to NASSCOM, that there's very good jugalbandi right now between the government departments. PSA, DST, I mean, everybody is working in sync. There's no turf wars going on. Everybody's trying to make it happen. Huge involvement of industry. They're seeking out, talking to a lot of people, taking the inputs, which was the other part of the jugalbandi. That is accelerating it. What is happening, as Ajay said, if you look at deep tech, who's doing it in the country today? It's only startups. Well, I shouldn't say that. There are some corporates that are doing very good work, but they're in a minority. The bulk of them can get by without R&D. And so they do. The challenge we may have is not so much with the startups. They're doing that in any case. And the way we're dealing with startups, or at least the plan, is a very good one, which is to say to startups, government can take equity, but instead of diluting you today, we'll give you a very concessional loan and convert some of it in your next round, which is very helpful for startups.
brings me also to the question of IP, because if the government is actually putting in the money as well, then what happens as far as IP is concerned? Who owns the IP, Professor?
The company things are very liberal here. The government is not trying to get IPs actually here. Even in our quantum mission, the IPs will rest
with the company.
With the company, yeah, like the startups or the so it's not that one is trying to get control of IP. So it's not, the process has to be friendly to make sure that the high-end R&D, deep R&D gets into commercialization. That is the bottom line of this scheme. We have to convert deep science and technology into viable commercialization. That's a one-line definition of this concept.
That's the mission. That's the mission as far as
mission statement. And that is why I am emphasizing deep R&D. It cannot be routine R&D. So through your program, we want to give also this message. It is not for really solving day-to-day R&D and you take this. Answer is no. We have to see whatever we do, we have a probability, a high probability to become a global leader.
I mean, and if I could get each one of you then to wrap the conversation with exactly that. So, Mr. Chaudhary, those who are watching, companies who are in this space, you know, you talked about, of course, betting on current technologies, AI and so on and so forth, but futuristic technologies that you believe that we should bet on as well. So give us a lay of the land in terms of priorities. I mean, what kind of companies, what kind of technologies do you believe this fund will help commercialize?
You know, quantum is already funded. But if quantum, we want to add more things beyond what we have planned, we can do through this fund. Semiconductors, for example. Today, what are we doing in semiconductors? We are basically manufacturing, right? The part that is missing today, which is the government is now seriously looking at doing, is the design part of it, because that's where our capability lies. Now, we now need to work on system to chip to manufacturing. So we now need to fund system companies, we need to fund chip companies, and then we will have a full ecosystem. So this kind of thinking is what will come in here, where a lot of the areas which various ministries may not be doing fully, the RDI fund can provide for those things to happen. And to each of those corporates or startups, it will be a top-down approach. So we will finally work on deciding which technologies. This whole discussion is going on between industry and the government. And this discussion started even before it was announced. 3-4 months before. So we will have a good list available. At this moment, we can't talk about it because it's not final.
I know. So you're constrained by that. Yes, Mr. Srivastava, final comments from you, and then I'll get the PSA.
No, I would say this. You mentioned 0.65% of GDP that we do today. We need to get to 3% in 10 years. $7 trillion economy, let's say, 210 billion from 18 billion. The bulk of it has to come from the private sector. This fund's intention is not to make a good return on the money.
Is to nudge the private sector
Is to make the private sector take the lead. At the startup world, I can tell you things are happening that are actually unique in the world, right? IIT Kanpur is doing an artificial heart, 1/7 the price of the only other one manufacturer that exists today. Brain mapping being done in IIT Madras and IC Bangalore, 1/10 the price, 10 times the resolution. So we're like, where? Enough things here.
So where we have a right to win, that is where you believe this fund is going to actually place its bet on. The final comment, when can we expect the first check to be written?
If I can be bold enough, I think it will be in less than 2 to 3 months.
Less than 2 to 3 months, we'll have the first check being written.
That's our target.
That's the target,
but as I said, I hope we will do it in this because it's really going at a very, very good pace, and a lot of alignment is there. And as he said, there is a lot of enthusiasm that we have to now convert
into actual
action. And we cannot do alone from the government. We need this cutting-edge technology proposals from private sector.
From the private sector, from industry. Well, ladies and gentlemen, you heard it first right here on CNBC-TV18. The hope, the target, the aspiration is that the first check, courtesy the government's R&D fund, is written out in the next 2 to 3 months. We wish you the very best of luck with that, Professor Sood. Thank you very much, Mr. Chaudhary and Mr. Srivastava, for joining us. And if that does indeed happen, then CNBC-TV18 would have played a part in that as well. So thank you very much. But with that, it is time for us to wrap up this special. We will, of course, continue to bring you all the latest developments with the government's R&D push to galvanize the private sector to take bets and risks with deep technology. From all of us here, thanks very much for watching. Hello and welcome to Startup Street. I'm Arundhati Ramanan. These are the top headlines from the startup world. Delhi High Court grants stay on angel tax demand of 1,400 crore rupees against OYO for assessment year 2020 to 2021. The court directs the stay order to prevail till the Commissioner of Appeals of the Income Tax Department doesn't pass an order on the same. Bitcoin at an new all-time high of $118,000. This on the back of strong institutional demand and inflows into crypto ETFs. The surge triggers the liquidation of over $1 billion of short contracts. Travel booking platform EaseMyTrip co-founder announces the launch of an AI venture studio aimed at supporting the country's technology entrepreneurs. It will represent a shift from traditional investment models toward collaborative partnerships. Omnichannel eyewear retailer Lenskart is likely to issue additional shares to its founder and CEO Piyush Bansal through a structured payout arrangement. This could increase Bansal's stake in the public markets-bound company by 1.5% to 2%, as per a report by ET. Bansal, along with his sister Neha, who is also a co-founder, hold about 12 to 13% stake in the firm. An Indian venture philanthropy platform, ACT, announces 1.43 crore rupees in grant capital to 5 idea state solutions as a part of a pilot. With this move, it aims to bridge the early stage funding gap faced by social innovators in India.
Those were the headlines that we're tracking for you this evening. But on the hot seat today, paying insurance premiums just got a lot easier. Bima Pay Finsure has launched a financing solution for corporate insurance policies, allowing businesses to pay premiums in easy EMIs instead of upfront lump sums. From group medical to fire and accident cover, the solution targets MSMEs and large companies alike, aiming to finance over 20 crore rupees worth of premiums by FY26. This could be a game changer for business cash flows and insurance penetration. So how will this exactly work? Let's find out. Joining me now to discuss this further is Hanut Mehta, the co-founder and CEO of Bima Pay Finsure. Hanut, thank you so much for taking time out and being here with us on Startup Street. You know, you are a digital lending platform and you've now decided to enter the corporate insurance space. If you could take us through how big of an opportunity this is and why you've decided to take this route.
Hi, thanks for having me here, and thank you for that introduction. We at Bima Pay have been into premium financing since the last 3 years. Broadly, till now, we were focusing on the retail segment where we were financing health insurance policies. We were guiding new and renewal policyholders to buy or renew their policies over a EMI plan, wherein they did not have to pay their entire premium upfront. Rather, the flexibility of payment was being provided to them. However, what we recently gathered with the market feedback was that there's another huge gap in the corporate insurance space, which also needs to be filled. Like we were doing it for the retail audience, we're now going to be starting this for the corporate audience. Any small or medium enterprise who does not have easy access to credit, but has to have an insurance policy, could be for its employees, could be for its assets or its building or any other kind of a facility. They'd had to chunk out a huge premium upfront for that cover to get live. However, now Bima Pay is going to be offering them a solution where they could split their payments throughout the policy period, putting less burden on them. So this market, we look at this market entirely at about a 60,000 crore market annual premiums of health insurance altogether, with a good chunk going to the corporates as well.
Yeah, so a big opportunity that you're seeing over here, but most businesses are used to paying premiums upfront, right? As you just mentioned. So what's driving this demand for EMI-based insurance payments in the corporate segment?
See, the larger corporates are obviously cash heavy and have good access from bank ODs and various other sources, right? But what about the smaller enterprises, which are newer businesses, smaller and medium enterprises, where they don't have easy access to credit? But insurance has to be taken any which ways, right? So the kind of credit these guys have is extremely expensive. And here we kind of bridge that gap. We're going to be providing them cheaper solutions to credit where, and they don't have to go out and look for it anywhere else. It's going to be a part of their policy buying journey. Yeah.
All right. And, you know, you are targeting over 20 crore rupees in finance premiums by FY26, right? So if you could sort of tell us what's the scale of the pilot so far and what kind of traction are you seeing across sectors like healthcare, IT and logistics?
It's a very small pilot, to be honest. If you look at the entire market size, this is not even it's less than 1% of the entire chunk. We've kind of focusing on getting this through a few insurance companies and a few industries. Once we are able to do this 20-25 crore pilot, then is when we look to scale in the next financial year. We've already would have done around 40 to 45 insurance policies in this space, and we're looking to do a lot more in this particular pilot. And this is across industries.
So you're looking to do a lot more in this pilot, but this model uses the policy itself as the only collateral, right? So how are you managing credit risk, and what role do insurance companies and NBFC partners play in the ecosystem?
So we basically, we found a way where we can take an assignment of these insurance policies where the policies itself will act as a collateral for our lenders. And through that model, we are kind of been able to provide, a kind of a credit approval to customers who otherwise would never get a loan. Right. That's the mechanism that we've arranged with our insurance partners. And that's what will provide security to our lenders to manage the credit risk.
Sure. And let's talk about the lending business, the core part of your business, and how it's done so far. Where are your revenues, NPAs, and what's the loan book looking like?
Yeah, so as I told you previously, we've been focusing mostly on the retail segment. We would have done more than 500 crores worth of lending, particularly in the previous financial year. We did fairly well in terms of numbers. We had financed more than 80,000 policies. whereas our top line went at around 7 crore rupees for the previous financial year. We were profitable. We maintained a decent margin of about 30-35%. And we see this just as a very small beginning because, the corporate segment is a much larger segment that we've just started to tap in. These numbers are going to be much more in the coming years.
Sure. And looking ahead, will you expand into retail insurance premium financing or stay focused on institutional and corporate policy? What's the broader roadmap for Bima Pay Finsure?
Retail is always going to be priority one for us. We've been doing retail aggressively, and we kind of target about 70 to 75% of our book to always be retail. We're coming up with fairly new products in retail segment as well, related to the other segments of insurance other than health. But yes, always focus is going to be first on retail. However, 30% of the book is what we imagine for the corporate premium financing.
All right, Hanut, thank you so much for taking time out and being here with us on Startup Street. We wish you all the best on this journey going forward.
Thank you so much. Thank you for having me.
And moving on, specialty coffee chain Third Wave Coffee has forayed into a new segment beyond just coffee, launching a range of bubble teas amid rising demand for such beverages, especially among Gen Z. In a conversation with Shilpa Rani Peta, the co-founder Anirudh Sharma also spoke about the company's target to turn profitable this fiscal and clocking a growth of 35 to 40%. Take a look.
Currently, we are 165 operational stores across 12 cities. We closed the last financial year with 150 stores. So we opened 50 odd stores so far. We want to have a quality growth path, be able to be profitable, and close this fiscal year with around 220 to 240 stores this year.
Right. So let's talk a little bit about the launch today. From being a proper coffee shop, today you're foraying into, boba, and you're also expanding your matcha range also. What's the idea behind the launch of Bobbles, and what was the consumer insight behind that?
So we've always been and will always be a coffee-first brand. Having said that, we have always wanted to make sure that our relevance to consumers, different genre of consumers and relevant across day parts was very, very important. And that's one of the reasons why we adapted to the matcha culture very, very early on and launched matcha back in 2019. When we saw the trend picking up, the millennials, Gen Z, adapting towards and indulging towards the bubble teas, we wanted to make sure that that is also part of our offerings, because those are also our customers who have coffee as a functional beverage. We've seen the beverage consumption increasing, and we wanted to make sure that these offerings are there on our own menu as well.
Can you talk about the target that you have? What are we going to see? Are we going to see you entering new cities, especially, I think, which would be tier 2, 3 markets, or are you mainly or largely focusing on further populating the metros that you're already there in?
I think this year we also entered Chennai as a new market. We entered Mysore as a new market. Mangalore, Trivandrum as a new market. So we've also entered a lot of new markets, but the focus would be to go deeper into these markets, open a lot of neighborhoods. I think there's a lot of potential for us to open up in existing markets. We are only 25, 26 odd stores in Bombay itself. As a brand, we do feel that these markets can easily take 100, 150 stores, without any stress.
And you closed in at about 241 crores in revenue for FY24. What is FY25? How did FY25 look like for you? And what are are you confident of maintaining this healthy high double-digit growth going forward as well, especially given you have such a strong expansion plan in place?
See, we are very careful when it comes to store locations, the way we sign our stores, the ramp up that happens. And for us, we want to make sure that we have a 35 to 40% growth year on year.
Okay.
Making sure that the growth which is there, the profitability remains consistent across year, and we don't see any shift happening over there. So that's what the focus is on, where we have that P&L rigor, we have the profitability rigor, and we have a revenue growth of 35 to 40%.
How many of your stores are currently EBITDA positive or profitable at this point?
We actually have close to around 90% plus stores which are EBITDA positive.
Right. And I mean, how far do you see a company level operational profitability for you?
See, our focus and our aspiration is to become profitable this financial year.
Okay.
And that's
fair
what
enough.
we'll eventually target for.
Okay.
This year, as I mentioned, we want to make sure that we have a 35-40% incremental from last year.
Right. So you've already hit about 300 crores in revenue. Yeah. You've crossed that?
We have not crossed that.
Okay, okay. How do you view the competitive intensity right now? And what are the levers that you're playing? Is it purely on innovation? Is pricing an important lever that you can play when it comes to competition?
So it's a balance. We look at the way we are expanding, the stores that we open up, where we open up. Pricing is a very important part of it. How do we make sure that we are a lot more accessible to consumers? We were the first one to launch our own loyalty app, where we had subscriptions, we had app, people could order through it, get a cashback, which also made the pricing and the cost very affordable, very accessible to consumers. And that was the whole idea, that how do you make sure that a consumer visits and comes to you every single day? Because despite any other format, coffee shops are one place where people want to come every day. It's an everyday brand, everyday place, right? One of the other very strong verticals and levers that we have is the innovation. That is one thing that keeps us fresh, keeps us new, keeps us relevant. Because the frequency of visits is so high, fatigue hits in hard. And that's why consumers look at new things, look at new products, look at freshness. You can always go back to your classic and your everyday beverage, but having that really helps us get newer customers and something new to offer to consumers as well.
On that note, it is time for us to head into a short break. But coming up next, Amazon recently wrapped up the 4th season of its Propel Accelerator program aimed at turbocharging India's direct-to-consumer brands for global success. That and more when we come back. Stay tuned. Welcome back. You're still with us on Startup Street. Amazon recently wrapped up the 4th season of its Propel Accelerator program aimed at turbocharging India's direct-to-consumer brands for global success. From nearly 900 applicants, just 3 winners have emerged, each bringing unique innovations in personal care and beauty to the global marketplace. Aishwarya Anand caught up with Srinidhi Kalvapudi, head of Amazon Global Selling India, to understand more about this year's top startups, their growth potential, and what's next for the program. Take a look.
You've just concluded the 4th season of Amazon Propel Accelerator program. So I want to understand who are the top winners and what kind of innovations are they bringing to the fore?
We started with around 900 applications, for this particular program, out of which we shortlisted around 54, out of which we picked 3 winners. We have Fix My Curls, which is in the, the hair care, space. We have Auric, who's in the health and, personal care space, and Isaac, which is in the perfume space. But if there's one thing that I would pick up about all of these 3, I think it would be that, it's apart from the execution ability, of course, it is that, the right selection at the right pricing and the right targeting.
So when we talk about global expansion, it is often very capital intensive, right? So how significant are the equity-free grants in enabling very meaningful scale up for these winners? What is the kind of financial help that you provide them with?
So we give a grant, 100,000, but this is an equity-free grant. This is not this is not an equity grant, right? Part of this ecosystem, if you see, we have our venture capitalist partners as well, right? So the entire idea is to bring these different players of the ecosystem together so that they interact with each other, and the VCs also figure out where to invest. The brands also get the right kind of mentoring. There is industry experts, there is of course Amazon experts, guiding them, and so on and so on.
I also want to now understand that you've already opened season 5 of Propel now. Yes. So what are going to be the new elements and differentiators from all the other seasons that we've seen till now?
Yeah, I think the biggest differentiator is going to be that, this perhaps is going to be the biggest season so far. We are looking at having about up to 100 participants in season 5, right?
Okay.
So as I said, we had around 54 out of 900 applications, right? The year before that, we had 30. The first 2 years, we had around 10 or 12, right? And this year, we're looking to have up to 100, right?
Up to 100.
Up to 100 in season 5. And, this should be a testimony to our growing confidence in the D2C space, right? And, particularly how our D2C brands can actually make a big name for themselves globally, right? Okay. And, we are seeing a lot of these brands, right? I mean, you have Minimalist that has emerged out of Propel.
100%.
We have Sirona that has emerged out of Propel, right? Yeah. So we have a lot of these, great names, right? While not out of Propel, we also have a lot of D2C brands like Vadam Tea, for example.
Absolutely,
right?
absolutely.
Skillmatics.
Yeah.
All of them e-commerce export-first brands.
Just shifting the focus to now Amazon Global Selling. It has helped Indian exporters clock $13 billion in cumulative exports. So how do you see this number grow in the next 5 years, and especially in the context of government's export targets?
In our last summer announcement, we said that by 2030, we're actually going to hit $80 billion in cumulative exports, right? In the foreign trade policy, e-commerce exports was actually included as a separate category. It was the first time ever that it happened. Sort of testimony to how the government is looking at e-commerce exports, and that as a driver, to this entire export space. So yeah, we are pretty confident. I think we have already 1.5 lakh exporters, with us. We've already delivered this $13 billion, right? And we're pretty confident that we're going to hit that $80 billion.
$80 billion. Talking on that front, I want to understand that what kind of Indian-made products are you seeing the most traction on in the global markets? And are there any surprising or interesting categories that you've seen that have come up?
The cotton-based home textiles, that continues to do well. The D2C space, that continues to do well, right? Shilajit, that has picked up a huge traction in the US in the last couple of years, right? And a traditional Indian-based stuff like Multani Mitti, for example, right? That sees essentially a lot of traction, right? So broadly, if I were to summarize it for you, I would say that it's a combination of traditional Indian strengths combined with, what our D2C brands are innovating on, primarily in the health and personal care and beauty spaces. So this would straddles the entire spectrum, broadly speaking.
It is time to take a look at all of the deals that happened in the startup space this week. 13 startups raised over $66 million, according to Venture Intelligence, taking the total deal value to $4.45 billion for the year till date. NBFC Credit Wise Capital secured $23 million from Trident Growth Partners and others, while healthy food firm Ketika lands an investment worth $18 million with participation from Anicut Capital, Incofin, Narottam Seksaria Office and others. That's not all. NBFC In Prime FinServe secures $6 million from investors like InfoEdge, Kettle, Burrow VC, Pravega Ventures and others. Meanwhile, NRI-focused fintech company Belong and digital content startup Chai Biscuit added $5 million each to their kitty. With that, it is a wrap on this edition of Startup Street. More news and updates coming up on the other side. Stay tuned.
Hello and welcome to News Center. I'm Parikshit Luthra. The Election Commission's decision to conduct an electoral roll revision drive in Bihar just months ahead of the state's assembly elections has stirred a controversy. Opposition parties have alleged that the move is aimed at disenfranchising close to 3 crore voters who may not be in a position to furnish the required documents. The RJD and the Congress held a protest march against the Election Commission's decision in Patna. Congress's Rahul Gandhi and RJD leader Tejasvi Yadav led the rally. The BJP-led NDA has defended the revision exercise, accusing the opposition of trying to come up with an excuse ahead of a certain defeat in elections. The Supreme Court has raised serious doubts over the Election Commission completing this exercise within the stipulated timeline. It has also asked the Election Commission to include Aadhaar, voter ID, ration card as proof of identity. The Apex Court was hearing a batch of petitions challenging the legality of the exercise months before the Bihar election. Ashwin Kumar joins us now. Ashwin, what were the court's observations?
Well, it was almost a full day of arguments before the Supreme Court, and primarily there are two concerns that are weighing on the minds of the Apex Court. Number one, the compressed timelines of it all. The Supreme Court casting doubts over the 90-day timeline that has been prescribed for this intensive revision of the electoral rolls. The Supreme Court asking questions of the Election Commission as to why being done in such a short span of time, why is it being linked to the Bihar elections, what happens to voters who get excluded, will they have time to in fact appeal before the Bihar elections against any removal that may take place? Will there be time to in fact conduct hearings? All of these questions raised on quote-unquote practical questions being raised by the Apex Court being posed towards the Election Commission. This was one. The second key doubt is under the SIR, there are 11 documents that are provided for verification of your name on the electoral roll. Now, the question being asked is that why is Aadhaar, the voter card, as well as the ration card excluded from this list of 11 documents? And the question that was put forth before the Election Commission is that the voter ID card is issued by the Election Commission itself. Another question that was posed is that the Aadhaar is provided under the Representation of People's Act. The law provides for using Aadhaar as means of identification, and despite that, it's not been excluded as a part of the 11 documents that are cited under the SIR. And on account of both these questions, the Supreme Court has asked the Election Commission to consider the use of Aadhaar, the voter ID card, as well as the ration card for conducting this electoral revision. This was, in fact, one of the strongest demands that had been put forth by the petitioners. They want Aadhaar to be included. They want the voter ID to be included. And on account of this order, the petitioners not seeking any interim stay. However, the hearing in this case will resume later this month on July 28th. Back to you.
All right, joining us now to discuss this is BJP spokesperson Radhika Khera. Advocate KK Manan will be joining us, and Anwar Pasha, spokesperson of the RJD, will also be with us. Radhika Khera, in a big way, this is a question mark for the ruling party as well. The party had been defending the revision of electoral rolls for the state of Bihar, and today the Supreme Court has asked some tough questions. They've said, go ahead with this exercise, but why now? We have no problem with the timing, but with this exercise. And why are you excluding Aadhaar? What is the right of an ordinary citizen of Bihar to appeal in case he is disenfranchised? And also, What about the right to appeal? So some tough questions being raised there for the Election Commission. The opposition is going to ask questions on this. How would you respond?
You know, the opposition today isn't defending democracy, they're defending illegality. Let's be very clear, when more than 4 crore voters in Bihar have voluntarily submitted verification forms, when the Supreme Court has refused to stay the process and has acknowledged the constitutional validity of the Election Commission's actions, then what exactly is the Congress and RJD going to protest about? Also, let me remind you that the next date of hearing is post the last date of when the documents have to be submitted. So the stand of the court is very clear in that as well. Now, we have the RJD and the Congress and their India alliance, jo bhi wahan Gathbandhan mein hai, what are they fighting for? Are they fighting for Indian voters, or they're fighting to keep infiltrators on the electoral roll? The court today has made no bones about it. It is said that this matter this is a matter that goes to the root of democracy and refused to grant any interim stay. I will repeat myself, refused to grant any interim stay. Instead, it has asked the Election Commission to consider including Aadhaar, voter ID card and ration cards. That's fine. In fact, yesterday I was on a debate on your sister Hindi channel, and I believe one of your producers also said that he managed to get his verification done by using an Aadhaar card. Now, the EC has already said that they're going to consider it, and in some cases, the BLOs are also considering it. Now, what is the protest for? The truth is very uncomfortable. The opposition knows it cannot win Bihar through illegitimate votes. We've seen that, so it's preparing grounds for excuses, claiming rigging in advance, questioning the EC, and calling the entire democratic process into question. Rahul Gandhi and Tejasvi Yadav led street rallies while the matter was sub judice. That's not politics. It's an open attempt. I repeat myself. It's an open attempt to pressurize the judiciary and delegitimize democratic institutions. And I want to ask this. Was it not under RJD rule that Bihar earned the name of booth capturing capital of India? And the same RJD, which was led by Mr. Lalu Prasad Yadav and Rabri Yadav, the mother and father of the same Tejasvi Yadav who was protesting today, did we not witness rampant voter list fraud and muscle power during the Lalu Rabri era? We did. Today, when the process is transparent, legally backed by Section 21(3) of the Representation of the People's Act, with full opportunity for correction, appeal and redressal, they are calling it undemocratic. The truth is, they are not fighting voter suppression, they are fighting voter purification. This is not a bunt for democracy, it is a bunt to protect fake votes and power at any cost.
Anwar Pasha, Anwar Pasha of the RJD, you've got the BJP saying that this electoral roll revision, this special intensive revision was required to, to do away with fake voter ID cards and people who should not be participating in the voting process. The Supreme Court today has asked some very tough questions. How would you take your campaign against the special intensive revision here onwards?
Thank you so much. We had our parliamentary election some 1 year back, and it was the same electoral roll on which the election was conducted by the Election Commission. Before the parliamentary election, there was a normal, I think, ordinary revision of the electoral roll. Not only that, just 6 months back, a process of revision started in October 2024 and ended in January 2025. After these two revisions, now suddenly the Election Commission says that this electoral roll is bogus, and they want to revise it. And this is not a normal revision. This is not ordinary revision. This is a special intensive revision, which means that entire electoral roll is declared null and void, and a new set of electoral roll is going to be prepared. And the timing is also very important. Just 1 month or 1.5 months is being given for this, a special intensive revision. This is not possible. Around 8 crore people are there as voter, and all the names from the voter list has been deleted. A fresh inclusion of the names will take place. And for that, the conditions that has been put by the Election Commission are very, so strict that the common people cannot fulfill it. People do not have those those documents which is required for this special intensive revision. So all this shows that the Election Commission is conducting this special intensive revision at the behest of the BJP, because BJP knows it well that they are not going to win this election in Bihar. So they are quite desperate. They want, this is very interesting, this is very unfortunate, that a government is bent upon depriving the people from their voting rights, from the constitutional rights. So their democratic rights. They have deprived them, and they are trying to exclude those people who are poor people, marginalized people, who will fail to produce any document in support of their citizenship. So this is our main concern.
Right. You know, Mr.
Our
Pasha,
main concern is for the
stay with us. Let me also get in. I'm going to come back to you. Let me also get in Advocate KK Manan. Advocate Manan, do you expect more challenges? This is not the end of it. Today, the Supreme Court has said you cannot rule out Aadhaar as a proof of citizenship, a proof of residence. This has to be factored in. And in the coming months, there could be more legal challenges?
You see, the fingers are pointed out time and again so far as Aadhaar card is concerned by the Honorable Supreme Court. But at the same time, I don't agree for the purpose, you see that in this 2 months or 3 months, I think the election is there. After the parliament election, they should have, if they wanted to exercise this power or doing this job, or they should have done immediately after the elections. 1, 2. I can give you example because the bogus votes are definitely in Bihar, no doubt in it. Because I have 4 employees, domestic servants, 3 drivers. All the 7 are from Bihar. They have the voting rights in Bihar also and in Delhi also. Now, the question is that where they should exercise this right, whether in Bihar or here. Whenever they go to Bihar during the elections, they use this exercise there. Or whenever the election in Delhi, just a few months ago, election in Delhi was, and they all voted in Delhi also. So for that purpose, Election Commission is doing the exercise correctly. But the time, that is the question now, because the opposition or the other parties against the BJP, they are making hue and cry, no doubt in it. To some extent, they are right. But at the same time, it is not a very big issue. Rather, they should have cooperated for this purpose. And I know that my father was a sarpanch in the village. Whenever this election voter list used to be prepared, people comes from the election commission. He used to prepare. He used to add the names of the new persons, and it is the duty of every party, their supporters also in the village. But other thing which is very important is that the documents, as the Honorable one Supreme Court judge has asked, whatever the documents are being asked now, even he is not ready with those documents immediately. For that purpose, I think 15-20 days are there. If 15-20 days are there. So I don't think that Election Commission doesn't have the power to prepare the voter list. Who will prepare the voter list? Who is the other agency?
Okay.
Who is the other
institution? All right, Mr. Manan, Mr. Manan, the point that the court is raising, we are fine with the exercise, but don't link it to the Bihar election, because we don't have a problem with the exercise. We have an issue with the timing. Radhika Khera, respond to that.
Parikshit, I want to even respond to the RJD spokesperson's melodrama. This is not a protest to protect voters, like I said. It's a panic attack by a party that just got electorally wiped out in the Lok Sabha. Now, he was talking about this is the same voter list that we went to Lok Sabha elections with. Well, in May 2024, on this very voter list, the BJP-led NDA won 31 out of 40 seats in Bihar. RJD and Congress together, just 7. The people of Bihar crushed them out. That's the verdict that they could not digest, and now they're attacking the referee. Let's go back to the Supreme Court. Now, they went to the Supreme Court. The court refused to stay the process. That is one thing very clear. It did ask pointed questions like, A, is this revision outside law? Answer is no. 2, does the EC lack authority? Answer is no. 3, is cleaning a bloated, potential corrupted voter list unconstitutional? Answer is absolutely not. Yet, and we've seen how the next date is, like I said, I'll repeat myself, it is the next day after a couple of days after this entire process ends. So that is the day that the Supreme Court has given for the Honorable Supreme Court has given for the next hearing. We have to read into that as well. Now, having said that, now Rahul Gandhi and Tejasvi are doing road shows and crying wolf. Why? Because they have thrived on fake voters, infiltrators, and stolen ballots. A clean voter roll is a death sentence for their politics, and they've seen a sample during the Lok Sabha elections. So I'm going to be very blunt. This isn't about saving democracy. This is about saving their fake vote pack. They are not scared of disenfranchisement. They're scared of exposure. When the court questions the timing, the EC explained this is the first digital roll purification post 2003, mandated under Section 21(3) of the RPA. It's legal, it's necessary, and it's overdue. So those who are crying the timing thing, let me ask, is there ever a wrong time to clean a voter list? Or is it only wrong when your political frauds are being caught? And finally, when the RJD says, again, once again, I'll say that they fought the Lok Sabha on this list, yes, and Bihar fought back, and that is why the tantrum is happening, not for democracy, but to stop their funeral in November.
All right, Anwar Pasha, my final question to you. One of the points that the opposition has made is that more than 3 crore voters may not be able to meet this criteria. Birth registration levels in Bihar are very low. Now, this is for voters not included in the 2003 electoral roll, and they are now required to provide proof of citizenship. But why wasn't this correction done over the past so many years? Is it enough for political parties to say birth registration levels are very low? What was being done about this on the part of successive governments, successive political parties who were in power in the state for 2 decades?
Yeah, that is the question. Why after 22 years, after the 22 years? It was conducted in 2003. And after 2003, tell me in which state this revision was carried out, a special intensive revision? Election after elections have taken place in many states. Why only for Bihar? This is insult of Bihar, people of Bihar. This is a onslaught on the people of Bihar. This is attack on the voting right of the people of Bihar. You first carry out a digital intensive this revision, a special intensive revision in the whole country. We have no objection. If you are saying that the voter list is bogus, then the present elected government in the center, the BJP government in the center, is a bogus government. They should resign first, and they should go for a special intensive revision for entire country. Let there be intensive revision in the entire country. Why they have chosen only Bihar? It means they are targeting Bihar because they know that unless such things are done in Bihar, unless they deprive a particular section and the sizable section of the people in Bihar from their voting right, they cannot win election here in Bihar.
Okay.
They have seen the last assembly election, the result of the last assembly election. We emerged at the first with the largest party in Bihar, and we are about to form the government. But due to their mishandling and malpractices in the counting, we were not allowed to form the government. We couldn't get that number in Bihar. So this practice they adopted in the
we're running out of time,
election,
but I'd like to thank you for joining us, and Radhika Khera and KK Manan as well.
They are not going to succeed in it. We will not allow them.
Ended anytime soon. Some tough questions for the Election Commission today from the Supreme Court. There will be a next date of hearing. There could be more legal challenges as well. We're taking a short break, but coming up on the other side, Karnataka Chief Minister Siddaramaiah has rejected the possibility of a change of leadership in the state. More on this when we return. Welcome back. Karnataka Chief Minister Siddaramaiah has rejected the possibility of a leadership change in the state. His statement comes a day after Deputy Chief Minister D.K. Shivakumar met senior Congress leader Priyanka Gandhi Vadra at her residence. Siddaramaiah said that he will complete his 5-year tenure and brush aside talks of him paving the way for D.K. Shivakumar to take over later this year. His comments came hours before his meeting with the Congress leadership. CNN News 18's Pallavi Ghosh decodes the tussle for the Karnataka Chief Minister's post.
But Siddaramaiah has very much made it clear that he's a fighter and there's no question of him giving up his gaddi in Karnataka. Over the last few days and weeks, there has been a lot of speculation with many of DK Shivkumar's supporters actually demanding that he should be made the chief minister. Well, that has been made clear very much by Congress sources. But the fact that both DK Shivkumar as well as Siddaramaiah are parked in the national capital fueled the speculation that was there going to be a 2.5 year kind of a rotation pattern where there could be a change of guard. The fact is that Siddaramaiah is very rooted to the ground. He's also someone who has a large amount of support of the MLAs. But DK Shivkumar is also no pushover. He's someone who has the eyes and ears of the Gandhi siblings. He's seen as a troubleshooter and a fighter. But when Network 18 spoke to Siddaramaiah, he made it very clear to me that I am here for 5 years. There is no vacancy and I'm not giving up. From his kind of confidence and his candidness, it is very clear that Siddaramaiah would make life hell for the Congress top leadership in case he is replaced. And that is the reason why he is overconfident about the fact that at least for the 5-year term, there can be no change of guard. He also dismissed all the speculation that the High Command was angry with him as far as the caste survey is concerned. So Siddaramaiah gets to stay, no change of power, that's the message. But what is going to be the key point to point out is to see whether DK Shivkumar's camps would be happy with this kind of assertion coming in from the Chief Minister.
There is no vacancy so far as the CM chair is concerned. This has been said by Mr. DK Shivkumar himself. Then where is the question of tussle between me and DK Shivkumar?
There are supporters of Mr. DK Shivkumar who are putting forward the fact that after 2.5...
There are supporters to DK Shivkumar and there are supporters to me also. And they are making their statements on their own. But not much. See, there are not only DK Shivkumar, there are so many people, they want to become the chief minister. No, my answer is very clear. Whatever decision taken by the High Command, both of us, Mr. DK Shivkumar and myself, they should follow.
Which is that you stay on as the chief minister? Because, you know, whenever these talks happen, it leads to instability.
I said all. I will remain as a chief minister. I will continue as a chief minister. I will be there for full 5 years.
And Samsung has launched its next generation of foldable smartphones, Galaxy Z Flip and Fold, and the more affordable Flip 7 FE. The new devices are more AI-focused and powered by Android 16. Prices range from 90,000 rupees and can go upwards of 2 lakh rupees depending on the storage options. My colleague Ashwit Kumar spoke to Samsung's mobile head of marketing, Aditya Babbar, on the latest launch and the brand's strategy going forward.
You know how affordability have played the role at the consumer buying decision. We have been at the forefront of, making this device more affordable for the consumer. When we take affordability today, Ashmit, there are very different sense of affordability at the consumer. When I stand at the shop floor, I see a lot of consumer walking in and saying, I want to trade in my old device. So the need there is to get the best value. Now, there are a lot of consumer who walked in and says, I want 6,000 rupees EMI, give me the phone. Now, the onus is on to us that how do we really, come up with the need set which is addressing both of these consumer needs and how can we make it more affordable. So we have worked on both. We have made a Galaxy upgrade program. Today we have the long-term EMI, and we also have for all our power users a memory upgrade. So they can pre-book the 256 GB and get a free upgrade to 512.
Wonderful. Let's also get a sense of how the broader market is doing. At least from the numbers coming out from reports, they seem to suggest that the first half of 2025 has not been great from a consumer spend perspective. How has the first half of 2025 done for you? What has your experience been?
So, in terms of volume, if I talk about last 2-3 years, the market is fairly at the same number. The market is not growing. But what is the good news is the market above 30,000 have shown a very, very good growth of almost 36%, which continues in the first half this year. For us, that market has been growing faster. We have consolidated our share from 24 to 30% odd. So premiumization is taking place, and The premiumization is taking place on account of, for us at least, on account of democratization of AI, affordability and expansion of AI at the retail front. Those have been our key drivers.
With that, it's a wrap on this edition of News Center. More news and updates continue right here.
Hello and welcome to India Business Hour. I'm Ashmit Kumar, and here are the headlines that we're tracking this evening. TCS reports a 3.3% revenue decline on a constant currency basis sequentially in Q1. Margins beat estimates, deal wins remain steady but drops below $10 billion. Company says attrition at nearly 14% is above its comfort zone. Glenmark signs a landmark licensing pact with US pharma company AbbVie to develop and sell a drug to treat multiple myeloma. Glenmark retains rights to India and emerging markets. AbbVie will pay $700 million upfront for exclusive rights to North America, Europe, Japan, and Greater China. Rohit Chawla steps down as the CEO of Hindustan Unilever after 2 years at the helm. Priya Nair, who is currently the President of Beauty and Wellbeing at Unilever, will take the reins, becoming the first woman to lead India's largest consumer staples company. Public sector banks raise concerns about the efficacy of the IBC resolution process after Supreme Court judgment in the Bhushan Steel case. Sources say that 3 major banks have told a parliamentary panel that the judgment, which scrapped JSW Steel's plan, may open doors to retrospective challenges and impact investor confidence in resolutions. Finance Ministry may be considering a 32 to 35,000 crore fund to compensate state-run oil marketing companies for their under-recoveries on LPG. Sources say that proceeds from petroleum excise duty may be used towards compensating the companies. Government plans to step up the divestment drive. Sources say the sale of IDBI Bank should be completed by October. Stake sale in LIC gets the green light along with other public sector banks. SBI and other state-run banks will also raise 45,000 crore rupees through a qualified institutional placement. US President Donald Trump threatens to impose 50% tariff on Brazil, cites the trial against former far-right leader Bolsonaro as one of the reasons. Brazilian President Lula says his country will respond with reciprocity. Trump also sends letters threatening higher tariffs to 6 other nations. Supreme Court raises serious doubts over Election Commission completing the Bihar voter roll revision within the stipulated timeline. Asks the poll body to consider Aadhaar, voter ID and ration cards for verification. Questions why the Election Commission is refusing to accept Aadhaar and voter ID, which was issued by the Commission itself. At least 119 people confirmed dead after flooding in the U.S. state of Texas. More than 100 people still remain missing in what is the worst flood to hit the U.S. in nearly a century. Well, beginning with the day's trading action, the market failed to hold on to opening gains, with Nifty and the Sensex falling 0.5% each. The Nifty gave up 25,400, while nearly 40 stocks ended lower. IT stocks, banks, as well as PSU companies led the fall, while realty and metal stocks bucked the trend. Well, here's the top story this evening. Q1 earnings season kicked off with a mixed bag coming in from TCS. The IT giant reported a 3.3% revenue decline on a constant currency basis sequentially in the first quarter. While margins beat the estimates, deal wins remained steady but dropped below the $10 billion mark. Reema Tendulkar now joining us with the TCS Q1 report card. Reema, take it away.
So the one-line summary of TCS's numbers is that growth disappoints. It's a much weaker start to the financial year. Margins are in line, deal wins are steady. So the company's top line, constant currency revenue growth, has declined by 3.3% on a sequential basis. This is much worse than consensus expectation, which was anticipating a drop of 1.4%. The problem is the international markets, which is ex of BSNL, which has been propping up growth in the Indian market. So one, the contribution of BSNL dropped sequentially, so that explains the reason for the revenue decline. But even the international markets, revenues have fallen by nearly 0.6%. And again, it's the global uncertainty which weighed on growth. Deals got deferred, deals got paused. No major cancellation, not big, but decision making was impacted. So all that hurt the top line, and it was much worse than what the company and the street was anticipating. On margins, 24.5% marks an expansion of 30 basis points on a sequential basis. One reason is there were no wage hikes this time, and two, there was a slightly lower contribution of BSNL sequentially, which was margin dilutive. Deal wins have been fairly robust. They've come in at $9.4 billion, lower compared to 12.2 in the prior quarter, but largely in line with the 4-quarter average. Headcount went up by nearly 5,000 on a sequential basis. This perhaps can be explained because the company added to their headcount, anticipating a recovery in demand, but that recovery in demand didn't take place. So the company was just left with higher capacity. Attrition also inched up a little bit, 13.8% versus 13.3%. But in a nutshell, growth still remains very uncertain given the tenuous global environment, and the company's Q1 revenue growth has disappointed the street.
We are still confident and optimistic that international revenue in FY26 would be better than our FY25 revenue. Overall, it will be too early to call out when growth will resume, which to a great extent depends on more clarity emerging in the macroeconomic scenario. But I think with all the trade discussions coming to a close, the new bill that's been enacted in US gaining presidential sanction approval, I think things should become clearer maybe towards the end of July or early August.
It's a little more than our comfort level. We are 11 to 13% is our comfort range. It is a little more than that. We continue to make efforts to bring it down. Through continuous employee engagement, doing all the right things which we normally do with our people. We continue to do that and bring it down. It's what our aspiration is always, and that is what we continue to do. We honor all the offers. It's very important that we honor all the offers. That we will do. So that process is gone, and we have offered. So we'll go through that. How and when that will happen, how many will come in each quarter, will depend on the business situation.
Well, the other big story this evening, Glenmark has signed a licensing deal with US pharma company AbbVie to develop and sell an oncology drug to treat multiple myeloma, which is a cancer of plasma cells. Glenmark will retain rights for India and emerging markets. AbbVie will make an upfront payment of $700 million and could pay up to $1.2 billion. Speaking to CNBC-TV18, Ekta Batra, Glenn Saldana said that he expects the molecule to transform the multiple myeloma space. He added that the molecule is currently in phase 1 and could be commercially used in the next 4 to 5 years.
Clearly, this is a huge moment for us, right? I mean, we've been working on this for 25 years in the innovation space, and I think 2001 really is a world-class asset, right, which can be transformational for patients. From a partnering perspective, the way we've structured it is we've partnered with AbbVie for US, Canada, Europe, China, Japan, most of the developed markets, and Glenmark will commercialize this product eventually, right, in India and all emerging markets. So the two of us will make sure this asset is successful going forward.
So explain the financials to us. $700 million is what you would get upfront, $1.2 billion in terms of milestones, and the remaining would be royalties.
That's correct. So we get a $700 million payment upfront, and as soon as we get regulatory approvals, that money will be received by us. The milestones, the $1.2+ billion of milestones, are spread into clinical development milestones. So as the molecule progresses to clinics, we keep getting milestones. Regulatory milestones, so as the molecule gets filed in various markets, we get and approved, we get milestones. And then we get sales-linked milestones. So cumulatively, that number comes to $1.25 billion, for the asset. And then once it's commercial, we get royalties on sales, which, as you know, some of these innovative products, the life of the royalties is pretty long. So this could pretty much be an annuity if the molecule makes.
When do you think that it will probably hit the market or show any kind of results?
So AbbVie takes over all clinical development from here on. In terms of time frame, I mean, I can't give you a specific time frame, but typically molecules, if you look at other assets, right, in the space, they typically take about 4 or 5 years at least to get to commercialization.
Well, a big change at the helm of India's largest consumer staples company, Hindustan Unilever. Rohit Java has stepped down as the MD and CEO of the company. Java was appointed in June of 2023 and has ended his stint at the helm after 2 years. Priya Nair, who's currently heading the beauty and well-being division at Unilever, will take the reins. She will be the first woman to lead the company and has been appointed for a tenure of 5 years. Java's tenure will come to an end on the 31st of July. Priya Nair joined HUL in 1995. She became the executive director of the home care business between 2014 and 2020. From 2020 to 2022, Priya Nair was the executive director of the beauty and personal care segment. Since 2023, she has been the president of well-being and beauty divisions at HUL's global parent company, that's Unilever. The HUL stock has underperformed under Rohit Java's tenure. The stock declined by over 9% since Java took charge of the company in June of 23. In contrast, the benchmark Nifty 50
Hello and welcome to the Global Dialogue. I'm Shireen Bhan. My guest today has been a regular on CNBC-TV18 since he took over as the CEO of Cisco, and that's now been a 10-year story. Joining him for this conversation today is the President and Chief Product Officer, Jeetu Patel, as well. Chuck Robbins and Jeetu, thank you so much for joining us here on CNBC-TV18. What an absolute pleasure to have the two of you back. Chuck, I want to talk to you about India, but before that I have to talk to you about what's happening in the world. You also have a ringside view of what's happening in DC because you look at the business chamber as well. You wanted tariffs to be surgically imposed. It's anything but that, right?
I would say that's correct.
I think where we'll land will be much more of a view. If you didn't know how we got there, you will think they were surgically deployed when we get to the end, is what my perspective is. I think the process we're going through right now is the way the administration wants to go about it. But I do believe that, look, they want a strong economy in the U.S. They clearly want to solve some of the trade barriers that exist around the world, and a lot of those are real, and I think their intent is correct. I think most of us in the business community would prefer a different approach, but this is the one we have, and I think they'll end up in a good place, though. I think they're going to end up in a good place.
He's made it clear that the tariff deadline has now moved from the 9th of July to perhaps the 1st of August or somewhere down that line. We don't know just yet. And perhaps there's room for further negotiations, even as far as the rates are concerned. But for a company like yours, you have manufacturing here in India, you have manufacturing in Malaysia, you have manufacturing in Vietnam. What does it mean for you? I mean, Vietnam, a generalized 20% tariff. Malaysia is now up to 25% from 24% as per the latest letter that he sent out. What does this mean for a company like yours that's manufacturing across the globe?
Well, this is the issue in the business community right now is the uncertainty just freezes everyone. Because if and when we get to the end game, then we can adapt appropriately. And so if you look at the tariffs that were put in 2018, I think it was, we knew what they were put in, and we were able to kind of flex our dynamic supply chain in order to adapt to those things. And we'll do the same to the extent we can once we see what the end game looks like. But right now it's a little more complicated, looking at a multi-quarter P&L for the business because you just don't know which tariffs you have to consider. So what we've effectively decided to do is we're just going to look at our numbers based on what's in effect today. And then, I mean, we can do all sorts of speculating and scenario planning, but tomorrow they could be useless. So
what's the impact as of today? As you said, we don't know what finally any of this will end up to be. What's the impact as of today?
Well, for us, it's not meaningful yet because a lot of the products that we sell are under the 232 investigation that is happening now, the national security view on some of the technology stuff. So as of now, we don't have meaningful impact, which again is the reason we're anxious to get to the end so we know exactly what we're dealing with.
Well, let's talk about India. I mean, it's been a 30-year journey for Cisco here in India. We spoke last year when you set up your facility in Chennai. How's the India story shaping up? And in the context of this global uncertainty and tariff uncertainty, what role do you see India likely to play?
India is one of the top 3 countries around the world from our perspective. If you look at the next 5 to 10 years from a growth perspective and an opportunity perspective, G2 and I came here together September, I think was the last time, and we left with this unbelievable view that we needed to begin to invest even more heavily here. And we were very pleased, I was very pleased at least, and that we had already made the decision to deploy the manufacturing platform. We've had a couple of false starts on manufacturing over the years. This time we did it right. We went full node. We turned it into an export hub. We had a plan for multiple products. We're now doing PCB assembly. So we've got that rolling, which is a good baseline. We've got our R&D and Innovation Center in Bangalore, which is really good. We have an education program going around the country right now where we've educated millions of Indians with digital skills. I think 650,000 in the last 6 months alone. So we see a huge opportunity. And as we leave here, we see even more. I mean, by lunchtime yesterday, G2 and I had 5 more ideas of things we needed to be doing in India. So we're working on that with the team.
So G2, what are those 5 more ideas that we should expect you to deliver on from an India perspective?
I think if you take a step back, I mean, I'm from here. I actually grew up here, and there's such a huge advantage that India has right now because of the demographics, the young workforce. I think we are kind of in this mode of just getting into this AI wave, the second phase of the AI wave. You're moving from, chatbots intelligently answering questions for us to agents that are going to conduct, automate workflows and conduct tasks and jobs autonomously. And so what I think we have is this unique opportunity in India where there's going to be an exponential rise in throughput per capita. And that'll require India to make sure that they've got the right infrastructure built out. And just like you folks had the huge infrastructure build out during mobile, and you were very successful, I think there's going to be data center capacity build out that's going to be a huge opportunity for India. And I think there's hopefully a lot of opportunity for Cisco to participate in that and helping India on a couple of dimensions. One is to make sure that we're infrastructure ready, but second is safety and security.
Yeah.
I think with AI, there's a lot of concern that, you know, if people don't trust these systems, they aren't going to get used. And so we provide the common kind of capabilities for safety and security. And so our hope is, whether it be with the public sector or the private sector, we want to make sure that we actually participate in helping India get the most of the advantage from AI that's possible.
You know, I'll talk about the agentic AI inflection point that we're currently starting to see in just a second, but I want to talk about India in the larger context, Chuck. You know, R&D facility, and Cisco's been a long-term committed investor in India, now manufacturing here in India as well. Do you believe that India could potentially offset, as and when we do have this trade deal with the US, could potentially offset some of the manufacturing uncertainty that you deal with today?
Well, I think they already are, and because we're not only manufacturing products for India, but if you look at the first product line that we brought up in the manufacturing facility here, it's the only line we have in the world for that product. So we actually distribute to the entire world for this product just out of India. So that's what I meant by making it a full node here. So I think that's our plan. We've added 2 more products since.
Two more products since.
And so I think it could absolutely play a major role. We're never going to consolidate everything. We're in 13, 14 countries. You got to have you need regional distribution for geographic reasons for high volume products. You have to take taxes and tariffs into consideration. You have to the risks associated with certain places, redundancy, resiliency, all those things come into play when our teams are thinking about how we run our supply chains. Proximity to components is another thing, which is something we need to get
done
going
here in India.
Yeah, it's a big thing we need.
So would it be fair to assume that you could look at adding capacity here in India anytime soon?
I think that's what we're doing now. Yeah, we're ahead of where we thought we would be relative to the volumes we're producing here now.
So what could that potentially mean in terms of expansion and investments?
Well, if it's being as successful as it is now, I think there's an opportunity for us to continue to grow it.
Okay. Jeetu, let's talk about what's happening on the AI side. And I know that you previously said that AI is a seismic force, and you're seeing a major inflection point today as far as agentic AI is concerned. Now, from an infrastructure perspective, you know, what's the role that you believe Cisco is likely to play? We're talking about AI hubs, we're talking about AI factories, but in real terms, what does this now mean?
Well, if you think of what the constraints of AI are, infrastructure is a big constraint, and there's a trust deficit. Those are the 2 big areas that we should think about. And on the infrastructure side, what are we constrained with? We're constrained with power, we're constrained with compute, and we're constrained with network bandwidth. Imagine if there were billions of digital workers that get added to the workforce that actually behave like humans, that are able to get jobs done autonomously. You're going to need a lot more network bandwidth. You're going to need a lot more compute. And you're going to need to be where there is power availability, because right now there's a shortage of power globally. And so that's where we come in the fact that we provide power efficient networks that are low latency, high performance, that can really, really help kind of catalyze the movement for AI. And right now we've got some great partnerships all throughout the world in building out these data centers. And I feel like India is going to be a great market for that to happen as well, because there's also a need for sovereignty of data. So there's more and more nationalistic, priorities that are being pursued by countries, and so you're going to need to make sure that you honor those. And so we can help with making sure that those build-outs also have a sovereign element to it.
I want to talk about jobs. And you said that, look, the second narrative is more interesting, but I think the first narrative is what everyone's concerned about. In the near term, in the medium term, what does this mean as far as jobs are concerned? We've gone from CEOs talking about, some CEOs talking about the potential of having a white-collar bloodbath, to some saying that this is going to be significantly disruptive. Chuck, what is this going to mean for jobs in a real way?
Well, I think there are certainly jobs that are going to go away. Any massive new technology innovation will ultimately replace jobs, even the advent of the internet and all the things that you now do online versus standing in line, as an example. So that's going to happen. There are going to be some basic stuff. I mean, there's a lot of discussion around basic contact center agents and things of that nature. But I think over time, what I'm telling my team is, figure out how you make your teams more productive, to G2's point, so that you can mitigate the number of new hires you need. I actually think you can look at this in two ways as a CEO. You can look at it as enabling your organization to move faster, deliver more innovation, and do greater things for your customers more quickly than you used to be able to. Or you can say, I'm going to make my company more efficient, and I'm going to increase my EPS by cutting costs. I think that's interesting in the near term. If your competitors take the other path, you lose. So I think you're going to see people aggressively use AI to try to move faster. So G2 and I have talked about like using AI coding capabilities, not to eliminate a bunch of engineers, but to increase the degree of the speed of innovation that we're able to deliver to our customers, which makes our engineering teams cringe because they're moving pretty fast now. But
what I would urge people to think about is worry less about AI taking your job, worry more about someone that uses AI really well actually having a higher risk to your job. Because if you're not dexterous with the use of AI, you will soon become irrelevant in your contribution. And that actually is going to be a far greater impact.
No, I get that, and Jensen's been pretty much saying the same thing, but when you talk about net hiring, that you're probably going to look at hiring differently. I mean, in a real way, how much are you hiring today, and potentially what could that number look like maybe a year down the line, considering the fast-paced adoption of AI?
Well, we're still hiring a lot of people. I think we have probably thousands of recs open right now, so I don't think there's any danger on that. But what I'm trying to do is not have the 1,000 be 10,000. And it's early right now for people to get really comfortable with this, but our teams, all of our teams, the leaders that work for me, have a mandate to figure out how are you using AI in your function? How are you? And every CEO is giving his team the same, giving his or her team the same mandate. It's just that's just what it is. But again, I don't think it's about eliminating jobs per se. There will be some of that. It's about making your people more effective so your organization can move more quickly and take care of your customers more effectively.
I think if we think about the list of ideas we have and the amount of resources we have to prosecute those ideas, the list of ideas is far greater than the amount of people we have to prosecute them. And if AI can augment that, we would actually be able to prosecute a much larger list of those ideas.
So give me numbers. What is it meant in terms of efficiency? What is it meant in terms of productivity? What's the kind of uplift that we've already seen internally for Cisco?
So if you think about coding, for example, engineers, today the industry is starting to see maybe 15-20% uplift in coding, maybe 30% on the optimistic end. I mean, could we have 70% of the code eventually written by AI, maybe 80% of the code written by AI? And what that would allow us to do is have engineers worry less about syntax and much more about ideas and architecture. And that's what we want to try to get to, is can we get people to actually up-level as a result of this? And so it's the lens we look at is not from a cost lens as much as what kind of throughput capacity per capita can you increase as a result of AI. And that actually gets exciting, because one of the most underhyped parts of AI is the original insights over time that AI will be able to generate that will allow us to think about solving problems we couldn't even dream of solving today.
Yeah.
And that's probably the area that we should be focused more on, because you'll be able to solve problems in every industry, by the way. Healthcare, the way we cure cancer should be very different a decade from now than what it is today.
Yeah, well, that certainly is the hope. that certainly is the hope. And 3 years from now, exactly.
You know, the worst thing about what he just said is my COBOL skills are not going to be needed anymore.
How have you upgraded your tech skills?
I'm way behind. I take him with me.
But speaking of upgrading skills, I mean, M&A, and is that going to be a large part of strategy as the AI era starts to unfold? You've done a large acquisition with Splunk, but how much of building out this AI capability is going to be organic versus inorganic, Chuck?
Well, the good news for us is that, particularly since G2 has taken the entire product portfolio over, he's much more of a build it than buy it leader, which is good. And then if you look at what we've done in the last year since Splunk, last year and a half, 2 years, there's two big things I would say. Number one, we have really thought hard about keeping our powder dry for potential acquisitions in the AI space. So we've kind of, with the exception of security, maybe observability and other things, we're sort of not looking anywhere else because we just want to make sure that if something, because everything's moving so fast, so you don't know what's going to exist 6-9 months from now that doesn't exist today or you don't know about today. That's the first thing we've done. And the second thing we've done is we've shifted hard to an investment strategy. So we have invested in, I can't even,
most leading vendors in AI, I would say right now.
G2 has a new one every third day, I think, that he wants us to invest in. But it's been great for us because as we've invested, we've done it in conjunction with what does a partnership between us and them look like? What's the value we're going to derive other than just being an investor? And we thought about this when we started, but boy, the value of these partnerships, the learning, I mean, all of a sudden now Kevin Weil, the Chief Product Officer, has joined our board, and he's providing immense value.
But Chuck brings up an interesting point. The strategy should never be about M&A in a company. The strategy should be about innovation and building. If a company can accelerate that strategy, we shouldn't be shy to deploy our balance sheet. But it's a very risky thing to say my product strategy is going to be dependent on whether or not a transaction happens, because these things, I mean, there's a 1 in 10 chance that these transactions actually happen.
And especially with the valuations that we're seeing today. Well, what do you make of the kind of valuations that these companies are going at?
You got to remember, I'm old, so I've seen this movie. I've seen this movie a few times, and water will find its own level at some point. It'll settle down, but we've seen this 2 or 3 times in the last 20 years.
We have, but let's talk about what's real, and I want to tie this down to your numbers. You've already exceeded your $1 billion target as far as AI orders are concerned, coming in at $1.3 billion. What's the expectation now?
Well, the expectation is more.
How much more?
Well, we said on the last earnings call that we weren't going to give a new target because when I gave that target, first of all, when I walked off the earnings call, my team looked at me like I was crazy because they were like, well, where'd that come from? Not really, but it was me putting it out there because I wanted to indicate to the investors that I was serious about my belief that we were going to have a role to play in the infrastructure for AI. And I wanted them to know that I'm putting this out there to tell you that we're going to. And one of our competitors put out a number that was slightly less than that. And I think that competitor was viewed as being better positioned. And then we have since blown through that number. And so now they're just going to see it show up in our continued, our steady growth that we're going to show as a company going forward because it's only getting bigger. And it's expanding in the enterprise. We're really just on the front end of the enterprise play here.
Yeah, you're right in pointing that out, and Jitu, that's what I want to understand from you. That the big story that's playing out at the enterprise side. You've already surpassed the target that you set for yourself in terms of AI orders of $1 billion. At the enterprise level, in terms of the pace of adoption, what are you seeing? What could that number potentially look like?
Without giving a number, let me actually give you the larger trend that's happening in the enterprise, where you're seeing re-acceleration of private data centers also in the enterprise for AI inferencing workloads. And that'll actually have a positive effect for us because we'll be a benefactor of that because we provide compute, we provide networking, we provide security, we provide a full stack solution. All of those things actually help enterprises where infrastructure is today still too complicated. We got to make it plug and play. And Cisco has all of the software and hardware and full stack capabilities. We make our own silicon. That really helps to provide that full stack. In addition to that, I'd say that what you should keep in mind at a macro level is, and I'm thinking about this phase as the second phase of AI. The first phase was chatbots, the second phase is agentic. The chatbot phase, the inference volumes are very kind of sporadic. You'd see peaks, but you'd also see a lot of drops in inferencing volume. Whereas in the agentic era, imagine if you have an agent that today probably works autonomously for 20 minutes.
Yeah.
Eventually it'll work for 2 hours and 2 weeks and 2 months and 2 quarters. When that happens, there's going to be a much more persistent, sustained demand for inferencing, which is going to just be a direct benefit to companies like Cisco who provide the infrastructure. So you should think about Cisco as an AI infrastructure company, very similar to the way that during the gold rush there were picks and shovels companies that benefited. Cisco is going to benefit because we provide and fuel the infrastructure.
And we haven't even talked about what robotics are going to do to the
Exactly.
Robotics are just going to take it
physically I will be
to another level.
Level. You know, but what are we talking about in terms of timelines by when this could potentially be real on the ground, humanoids, robotics, all of that, and the kind of disruptions that we're likely to see on account of that?
Well, I'll give you a couple comments, and G2, he's deep in the middle of this, but I think on the robotic side, you see it in manufacturing today, you see it in industrial companies today, and it's only going to continue to expand. You see it in surgical rooms, operating rooms, right? So I think that's placed. From a humanoid perspective, I don't know what you're...
So I would say right now what you're seeing with robotics is special purpose use cases are what will actually get adopted first. One of the big benefits that we had with language models is you had a lot of free internet data that you could train the models on. With world models, which is the models that you need to have for physical dimensions of robots actually getting trained on it, we just don't have enough data in the world. And so that takes a little longer. So a generic robot that can do everything from pick up your kids to, from school to go cook a meal for you, all of those pieces aren't going to happen for
I just saw a robot cook a meal for me while we were in the valley, but picking up your kids, I mean, how far out is that?
Well, that's actually closer because of the autonomous vehicles.
That's right, yeah.
But what you will see is these robots will be special purpose, and you're not going to have one generic robot because the models take a long time to train because we just don't have as much physical data. But I think even over the course of the past, I'd say 6 months, the progress that's been made in the robotics side is pretty huge.
Well, let me end then by asking you, Chuck, you said that chaos is the new normal that CEOs have to deal with, but really this kind of chaos, is it going along as per expectations, or has it defied your own expectations of how chaotic it was likely to be?
I did say that because most CEOs today have sort of developed as executives during this 20 years of sort of on and off crisis mode and uncertainty and chaos. And so it's you don't find a lot of CEOs that are going, well, I think I got to slow down for a while till this thing settles down, because nobody believes it's going to settle down. I mean, and now we're dealing with so many complexities. You're dealing with the tariff situation, the geopolitical dynamics, the wars, the supply chain shocks, the nationalism. I mean, it's a super complicated world to navigate. But I think most CEOs wake up every day and say, this is the world we have, so we just got to go get it done.
So it's not wait and watch, and it's not pause. You're saying you're making the investments that you need to make.
You have no choice. Yeah. You may have temporary pauses, like I was talking about. Like our team's not making a ton of investments on moving supply chain elements around right now because we need to understand the end vision first.
Yeah.
But in other areas, you have no choice. You get left behind. You will absolutely get left behind.
So let me end by asking you for the India number. What's the aspiration on how much you intend to export from India, and how much you intend to also invest or add in terms of capacity in India?
I have no idea. I will tell you this. G2 and I are pressing our team in a massive way here that we should be able to triple the size of the business here in a much more compressed window than our team believes. My team's listening to this interview right now, so we want to make sure. And that's going to require us to invest. It's going to require us to invest our time and our team's time. G2's coming here with his entire product leadership team in January. They're going to do an offsite here. We're going to host a big event here that's going to focus on cybersecurity, AI. And so we have to invest here to enable our teams to actually achieve what we see as being possible, and that's what we're going to focus on.
Well, we look forward to seeing you both again in January, and appreciate you joining us here on CNBC-TV18 to talk to us about what's happening in the world and what's happening here in India. Chuck and Jitu, many, many thanks for joining us on the Global Dialogue.
Always great to see you.
With that, it is time for us to wrap up this edition of the Global Dialogue. From all of us here on the team, for now, goodbye. Many thanks for watching. The news will continue on CNBC-TV18. Good evening. Thanks very much for joining us on India Business Hour. I'm Shireen Bhan. The headlines that we're tracking for you this evening: a management shake-up at Hindustan Unilever. Ritesh Tiwari is set to step down as CFO and move to a global role. This comes a day after Rohit Java stepped down as CEO, with Priya Nair set to take the reins. The HUL stock up more than 4% today. Sensex and the Nifty decline for a second week in a row, losing 1% each. IT stocks lead the decline. Mid-caps fall in tandem with blue chips. India Inc. braces for a difficult first quarter as TCS starts the earnings season on a tepid note. Autos, banks, consumer staples likely to see weak growth, but healthcare services, construction material, renewables and telecom likely to report strong growth. The first check from the new 1 lakh crore rupee R&D fund will be issued in the next 2 to 3 months as the government's principal scientific advisor Ajay Sood calls on the private sector to get moving on increasing R&D budgets, says the government is open to picking up a stake in deep tech startups. That's an exclusive. The suspense over Tesla's India entry set to end next week. The Mumbai showroom will open on the 15th of July. Timelines on bookings and sales to be announced shortly. President Trump threatens 35% tariffs on Canada from the 1st of August. Also says he plans to impose 15 to 20% tariffs on remaining countries who are yet to receive any letters. 23 nations have received tariff letters so far. UK and Vietnam have signed a trade deal framework. Promoters of VIP Industries in advanced talks to sell a stake in the company. Sources say private equity players, including multiples PE, are in the race and a deal is imminent. Insurance regulator initiates the process of issuing show-cause notice to 8 health insurers over alleged lapses in claim settlements and rejections. Sources say insurers are likely to be asked to pay a penalty or return money to policyholders with interest. Israel intensifies bombings in Gaza amidst widespread reports of hunger and starvation. At least 15 people, including 10 children, killed in an Israeli strike as they queued outside a medical point for treatment. More than 57,700 people have been killed in Gaza since the war began 21 months ago. Multiple roads in Gurugram remain waterlogged as a sudden downpour 2 days ago exposes creaking infrastructure. Traffic still paralyzed at the Jaipur Expressway, Golf Course Road and Sona Road. Let's start with the day's market action. The Sensex and the Nifty failing to hold on to the key support levels today. The Nifty, in fact, ending below the 25,200 mark. The Nifty Bank fell about 200 points while mid-caps dropped more than 500 points today. That's the story for you. The mid-caps losing about 500, 690 gone on the Sensex and a 200-point cut there on the Nifty 50. In fact, the Sensex and the Nifty have slipped for the second straight week, with both the indices ending the week 1% lower each. FMCG, by the way, has been the big move up. That's been the top gaining index, while IT and capital markets have lost ground. So 4% cut there on the IT index, but FMCG up by about 2%. Now, India Inc. is bracing for a difficult first quarter. This after TCS kicked off the earnings season on a tepid note. Nimesh is here with what we can expect for earnings across different sectors. What's the expectation, Nimesh?
Broadly, the sense is that this will be a weak quarter, but it will set a tone for a very strong September quarter. So don't look too much into this quarter, but it will be a base for the next quarter. That's a broad consensus view. In fact, most of them are forecasting the Nifty 50 earnings to be 7 to 10%. This is going to be quite heartening because in the last 4 quarters, we've been reporting single-digit growth on the Nifty. So in that sense, it's going to be slightly better off. The low base of last year, as well as the early festive season, is going to set the tone for at least the domestic companies in this quarter as well as in the next quarter. And what RBI has done with front loading of the RBI cut, there's going to be a potential impact on a lot of the financial names as well. So that's going to be a trigger to watch out for in the very near term and for this quarter as well. So that's overall picture. I'll go with sectors which are going to do well to start with. These are the 4-5 sectors which are expected to do well in Q1. Construction materials, which is basically the cement companies, they're expected to do well. Healthcare services, renewable energy and telecom services. These are the 4 sectors which are expected to relatively do better earnings in Q1. Now look at some sectors which are going to report only single-digit earnings growth in Q1. And that includes consumer durables and apparels, electric utilities, IT services, as well as gas utilities and transport sectors. So these are the 4-5 sectors which are expected to report only single-digit earnings growth in Q1. So that's the second set. The third set is where the street is anticipating a very weak earnings, and that includes automobiles, especially Tata Motors is going to drag the auto numbers down this quarter. Banks are going to report weak. Consumer staples are going to report weak numbers. So is gas utilities and transportation. So these are the 5 sectors which are expected to report weak earnings in Q1.
Well, moving to the crypto markets, where the Bitcoin has touched a new all-time high. This on the back of strong institutional demand and inflows into crypto ETFs. The surge triggered the liquidation of over $1 billion of short contracts. Meanwhile, the price of silver hit an all-time high as US President Trump's tariff threats drove safe haven demand. President Trump's threat to impose tariffs of 50% on copper imports have driven the metal prices to record highs. Well, a top brass reshuffle at Hindustan Unilever. Sources say that Ritesh Tiwari is set to step down as the company's chief financial officer and could move possibly to a global role. Now, this comes a day after Rohit Java stepped down as the company's CEO, with Priya Nair set to take the reins. HUL stock gained more than 4% in trade today. Shilpa joins us now with more. Shilpa, take us through the likely management reshuffle in HUL after Java's exit.
Well, the management rejig at HUL seems to be continuing. What we're picking up from our sources is that Ritesh Tiwari, who's currently the chief financial officer of Hindustan Unilever, is also likely to step down from his role, but he's most likely to take on a global role at Unilever. Now, this comes close on the heels of Rohit Java also stepping down as the MD and CEO of HUL, with Priya Nair now taking on that role. Now, Ritesh Tiwari is currently the executive director, finance and IT, and CFO at HUL, and he's been the CFO since May 2021, and he's been with Unilever as a management trainee right from 1999, and he has held roles across core finance, demand planning, procurement within India and in South Asia as well. Now, we reached out to HUL regarding our query, and HUL has told us that, he continues to be in this current position of his, and they have said, and I quote, "At HUL, we consistently nurture talent and groom leaders as part of our ongoing talent development process. If there are any developments in this regard, necessary disclosures will be made." So they haven't exactly denied the story either. And remember, this management rejig comes at a time where both the industry in India and the company in particular has been grappling with low consumer demand, high inflation, rising competition, and also volume growth also has been in low single digits. And it's not, only HUL either. Unilever globally also has seen a management rejig. If you remember, earlier this year, Heinz Schumacher also stepped down as the MD CEO in less than 2 years of being appointed, and that also came as part of the company's turnaround plan globally as well. Now, we're also given to understand there are about 3 to 4 contenders to take up the CFO position in the place of Ritesh Tiwari. We'll keep you posted as we report on further developments in this case. Back to you.
All right, Shilpa, many thanks. That was a stock that was up, but a stock that was down was TCS. The stock fell after the company's first quarter revenue declined 3.3% on a constant currency basis sequentially in Q1. TCS's MD and CEO K. Krithivasan says that a strong order book makes him optimistic about the medium to long-term outlook. Speaking to CNBC-TV18, he said, surpassing the company's growth rate in the last fiscal will be difficult. The growth of its international business will be higher than FY25. Take a look.
We are not going to comment on Q2, but see the overall situation. We have a good pipeline, good order book. We are winning reasonably well in the marketplace. Growth better than FY25. We'll work towards it because we had about, I think, 4.2% growth in FY25. To reach that, that's looking like a tough number, no? But definitely growth, definitely international growth to be better than FY25.
Well, that's TCS, and here's more in earnings corner. Avenue Supermarts, which operates D-Mart, saw a flat profit in the first quarter of this fiscal. Revenue up 16%, coming in at over 16,359 crores. Margins did decline, though, on a sequential basis. Glenmark Pharma shares hitting a fresh 52-week high. This after the company signed a landmark licensing pact with U.S. pharma company AbbVie to develop and sell an oncology drug to treat multiple myeloma. Glenmark will retain the rights for India and the emerging markets. AbbVie will pay $700 million upfront for exclusive rights to North America, Europe, Japan and Greater China. Speaking to CNBC-TV18's Ekta Batra, Glenn Saldana said the molecule is currently in phase 1 and could be commercialized in the next 4 to 5 years.
Once it's commercial, we get royalties on sales, which as you know, some of these innovative products, the life of the royalties is pretty long. So this could pretty much be an annuity if the molecule makes it to market.
When do you think that it will probably hit the market or show any kind of results?
So AbbVie takes over all clinical development from here on. In terms of time frame, I mean, I can't give you a specific time frame, but typically molecules, if you look at other assets, right, in the space, they typically take about 4 or 5 years at least to get to commercialization.
Well, that's Glenn Saldana, and that stock was on fire today. Promoters of VIP Industries are said to be in advanced talks to offload stake in the company. Sources say that private equity players, including multiples PE, are in the race and a deal is imminent. Mangalam is standing by with the details. Mangalam, a deal likely to be inked soon concerning VIP Industries?
Well, the promoter's intent has been clear for the last couple of years. They've been alluding to looking to sell stake in the company owing to, lack of succession in the company, and as a result of which they were looking at multiple partners. There have been multiple times in the past reports that, some of the others are looking to buy stake in the company, but now we understand that a deal is imminent and it's very close. The promoters are in advanced talks to sell a stake in the company, and among many of the private equity players, multiples is the one which is likely to go ahead and be in the race for VIP Industries itself. Remember, the promoters own over 51% stake, and any such deal that happens triggers a mandatory open offer for minority shareholders So that is something that may happen as well. But promoters in the past, like I said, have alluded to, looking to sell stake in the company. And if you look at VIP, the stock, that there is a deal brewing, the stock was sniffing that, because in the last 3 months or so, it's up 75% from its 52-week lows. And more importantly, despite that rally, it's still about 36% away from its previous all-time high, which was last hit only about 3.5-4 years ago. If you look at VIP's performance in the market as well, over the last 5 years, the stock has rallied just about 80%, as against Safari, which has rallied over 1,000%. So not only are they losing market share in the stock markets, but even in the overall market. So whenever the deal happens, or whoever the company goes to, the important part will be the revival of brand VIP, along with growth in Skybags and their premium product Carlton. The second thing you'll be looking at, winning in channels. CSD was taken over by Safari, general trade and e-commerce channels. And finally, the upper end has been fairly disrupted by entrants like Mokobara, Uppercase and other newer players. So to that extent, competing against these players with this brand will also be very crucial to track.
Well, Mangala, many thanks for joining us. Could that be a deal that is likely to be closed soon? That's the indication we get. Now, the first check from the new 1 lakh crore rupee R&D fund will be issued in the next 2 to 3 months. This, as per the government's principal scientific advisor, Ajay Sood. Speaking to me, Sood added that the government is also open to picking up a stake in startups. He's called on the private sector to get moving on increasing R&D budgets. India's R&D expenditure is lagging behind several nations. It stands at just 0.65% of the total GDP. China spends 2.4%. US spends 3.5% of its GDP on R&D. Now, the contribution of the private sector to R&D spending in India remains very low. Private sector accounts for just over 36% of the total R&D expenditure in India, compared to 75% in the US, 77% in China. Here's the principal scientific advisor on operationalizing the government's 1 lakh crore rupee R&D fund.
Have to be tech ready to do all this. And in all this, the private sector investment and the private sector working with academia is absolutely must. Funds are also there for deep tech funds of funds, which will be differently dealt with as compared to corporates, because we also need substantial support for that, and that is also covered in this, and that could be mixed of equity and loan.
So the government will actually pick up equity in some of these deep tech companies as well?
Only in that startup.
In the startups? Okay.
Not in the others. Not in the others.
Right. Well, that is a CNBC-TV18 exclusive, and here's another. We told you first, and it is now official. Heavy Industries Minister H.D. Kumaraswamy says the centre will soon launch a scheme to offer subsidies to manufacturers of rare earth magnets. The scheme will have an outlay of over 1,300 crore rupees. The minister also announced a policy which would incentivize the sale of electric trucks in India. Approximately 100 crore rupees has been earmarked for the e-truck scheme.
Some progress is going on. We already allocated 1,345 crores. 1,345 crores. We are selecting 2 manufacturers.
The insurance regulator has initiated the process of issuing show cause notices to 8 health insurers over alleged lapses in claim settlements and rejections. We learned that insurers are likely to be asked to pay a penalty or return money to policyholders with interest. The IRDAI has found lapses in the health portfolio, including unnecessary deductions, claim rejections and delays in claim settlements as well. Now, companies have urged the government to ease restrictions in the CGST Act, which blocks input tax credit on key business expenses. Sources have told CNBC-TV18 these include costs such as hiring or renting vehicles, employee meals and medical or insurance expenses for staff. Industry has urged that the block ITC makes up a significant part of operational costs, which are essential. American EV giant Tesla all set to make its entry into India next week. Sources have said the Mumbai showroom will open on the 15th of July. Timelines on bookings and sales will be announced shortly. Parikshit Luthra, who broke that story, is standing by with the details. Parikshit, the India-US FTA, the suspense continues, but the suspense finally over as far as Tesla's entry into India is concerned.
Suspense over Tesla's India entry is finally over. The company will be inaugurating its first experience center in India on the 15th of July. The Tesla showroom will be in Maker Maxcity Mall in BKC, Mumbai. The showroom is spread over 4,000 square feet of space and will showcase Tesla cars and there will also be Tesla chargers in the building. While this is the first launch, we have been hearing that Tesla could launch a second showroom in Worldmark Mall in AeroCity in Delhi sometime in future. So what's going to happen on 15th of July in Mumbai? Well, for all of you who have been wanting to get your hands on a Tesla for years, the wait is over. Tesla officials will announce the timelines for bookings and sales in India. Which Tesla cars would you be able to buy? In all likelihood, it will be the Model 3 and Model Y, which are Tesla's entry-level models. But we have been told by sources that the cars will be fully loaded with all the features that are offered in US and other markets. The company will also announce charging options for prospective buyers. Are these cars manufactured in India? No. Tesla will be importing right-hand versions of these cars from either their plant in Berlin or the plant in Shanghai, which means the cost for you also goes up. But if a Tesla Model 3 is $34,990 and Model Y costs around $37,490 in the United States, then they will be imported into India with a 70% import duty. This means these cars could cost you anywhere between 50 to 60 lakhs in India. Tesla is likely to offer both standard and long-range versions of these cars.
Well, you heard it first, and we will bring you all the latest on Tesla's India entry. Parikshit, many thanks. Staying with auto, Ford has recalled around 850,000 cars across the U.S. because of defects in its low-pressure fuel pump. The automaker said that this fuel pumps could fail unexpectedly, which could cause the vehicle to stall while in operation. The recall covers models produced between 2021 and 2023 and includes truck models as well. Now, it has been almost a month since the London-bound Air India flight crashed in Ahmedabad. Aviation Minister Ram Mohan Naidu told CNBC-TV18 the preliminary report on the crash by the Aircraft Accident Investigation Bureau will be submitted soon. He will speak to reporters at an event in Mumbai today. Take a look.
When can we expect the preliminary reports?
Very soon, very soon.
So it was expected today?
No, very soon. They are working on it. AIB is working on it, so whenever they are ready. Very soon.
So any timeline that you could give us?
No, it is the responsibility of the AIB. Let them do their job and do it.
And since AIB is an independent body, will the Ministry of Civil Aviation have any oversight in ensuring that all transparency is maintained and what
No, that is the responsibility of the AIB, and the ministry also is ensuring that the transparency and accountability, everything is there. These are all, AIB is following the international protocol also. So everything is being done according to the procedure.
So it was expected the report will be out today.
I'm saying it's expected soon.
Well, that's the aviation minister. Up next, multiple roads in Gurugram remain waterlogged as a sudden downpour 2 days ago exposes creaking infrastructure yet again. A special report coming up. You can catch all of CNBC-TV18's news and updates on YouTube, Facebook, Instagram, X and Jio Hotstar. US President Trump has threatened to impose 35% tariffs on Canadian imports from the 1st of August. In a letter addressed to Prime Minister Mark Carney on Truth Social, Trump has said the 35% rate is separate from the sectoral tariffs imposed on Canada. He also warned that the rates could go up if Canada retaliated. Carney responded to the letter. He said that Canada has made vital progress to stop the scourge of fentanyl in North America. In a phone conversation with NBC News' Meet the Press moderator Kristen Walker, President Trump said he plans to impose blanket tariffs of 15 or 20% on countries which do not receive individual tariff letters, but he did not provide any further details. Now, 23 countries, including Brazil, Canada, Japan, South Korea have received letters so far. Here's that story.
President Trump said in a new interview with NBC News that he plans to impose blanket tariffs of 15% to 20% on most trading partners, saying the amounts were being worked out for all the remaining countries, those that haven't been receiving letters or the few with announced frameworks. That baseline number is up from across-the-board tariffs set at 10% right now. And the president dismissed concerns that further tariffs could hurt the stock market or drive inflation, saying, quote, "I think the tariffs have been very well received. The stock market hit a new high today," and that was yesterday. The S&P did close at a record high. But that comes, of course, after a tumultuous few months for the markets. And drilling down even more, President Trump announced a 35% tariff on all imports coming from Canada, specifically beginning next month, reviving tensions, of course, with that major trading partner that had largely gone away in recent weeks. And we did hear from Canadian officials that they have been working hard and in constant contact with the U.S. throughout this week, hoping to come to an agreement.
Alice Barr reporting there. U.S. Secretary of State Marco Rubio met with China's Foreign Minister Wang Yi in Malaysia. This is their first in-person meeting at a time of simmering trade tensions. The meeting was held less than 24 hours after Rubio met Russian Foreign Minister Sergei Lavrov. Israel has intensified bombings in Gaza amidst widespread reports of hunger and starvation. At least 15 people, including 10 children, killed in an Israeli strike as they queued outside a medical point for treatment. More than 57,700 people have been killed in Gaza since the war began 21 months ago. Tensions rising in Ukraine after a deadly wave of Russian drone and missile strikes hit Kyiv, killing at least 2 people. The overnight attack damaged multiple districts, shattering windows and forcing residents to take shelter in basements. This comes amidst U.S. President Donald Trump's pledge to send more weapons to Ukraine. Trump has promised to make a big statement on Russia this coming Monday. Elon Musk's social media platform X is cutting costs for its subscription in India by more than 30%. The cost of the basic plan, which costs 244 rupees per month, earlier will now cost 170 rupees. The cost of the premium plan has been cut from 650 rupees earlier to 427 rupees. The cost of the premium plus plan has been cut from 3,470 rupees to just over 2,500 rupees. An update from the Karnataka High Court, where Elon Musk's X is taking on the Indian government over its orders to take down content. The company said that thousands of government officers are issuing takedown orders on videos that could cause public criticism of their departments. The company also opposed the government's Sahyog portal for facilitating these orders, adding that the portal has no backing in law. The court will continue to hear the case. Several roads in Gurugram remain waterlogged 2 days after heavy rains brought the city to its knees. Home to some of India's richest, this monsoon season once again raises questions over the quality of Gurugram's infrastructure. Abhimanyu Sharma reports the traffic situation remains dire on the Jaipur Expressway, the Golf Course Road and Sona Road, key thoroughfares in the city.
We are currently in Sector 65 of Gurugram, an area which boasts of real estate prices that rival even places like Hong Kong or the Manhattan. Behind me is not a rivulet or a lake, neither is it a special lane created for boats. But this is a brutal reality, a brutal reminder for all residents of the Millennium City for 3 to 4 months every year. And this is what just over 100 millimeters of torrential rainfall within a span of a few hours brought down the city too. It has been 2 days since that torrential downpour. It was relatively a drier day yesterday. However, the situation is still quite worse and is still worsening in several areas of the Millennium City. Residents and travelers across the roads, across all arterial roads, and even the national highway which bisects the city are still facing problems with respect to transportation. It remains to be seen how early this torrential downpour is going to end, and also more importantly how early the drains are going to be cleaned and the roads are going to become motorable again.
City which is like the highest tax getter for Haryana and the second startup hub in India after Bangalore. I mean, you would expect much better. There's a 700 meter from here, there's a Choraha. I mean, I had to literally walk in knee-deep water from there because the cabs just wouldn't come. and the city was brought to a standstill. And this is that even at the jam started at 7 p.m. it went through the night.
यहाँ तो बहुत दिक्कत है, जरा सा पानी बरसता है, रोड पे पानी पानी दिखता है, ना तो नाला है, ना कुछ है, बहुत परेशानी है, बहुत भारी दिक्कत है, पैदल मोटरसाइकिल वाले तो चल ही नहीं सकते हैं.
Well, that story playing out across different cities, that's the story there on the infrastructure deficit in Gurugram. But we'll, of course, keep you posted on what's happening elsewhere. With that, it is time for us to wrap up this edition of India Business Hour. Thanks very much for watching the news. We'll continue right here on CNBC-TV18. Stay tuned. From all of us here, have a great weekend. And, of course, we'll be tracking all the developments globally and overnight here on CNBC-TV18. The Lal Street slipped for the week gone by. We had the second straight week of losses. Both the Sensex and the Nifty, they were down about 1%. If you look at the mid-cap index, it almost was down 2%. And the IT sector was one of the biggest laggards. However, on the flip side, FMCG stocks, pharma stocks, they were batting for the bulls. Over the next 30 minutes, we will take stock of the week gone by on the street. We'll tell you what to expect from the earnings season. We'll also put the spotlight on the mega deal in the pharma space. I'm talking about, of course, Glenmark Pharma. And we will make some sense of what the mutual fund flows are telling us in terms of the market's appetite for more stocks and more paper. Hello and welcome to the Editors Roundtable. I'm Surabhi Upadhyay, and with me, my colleagues Nigel D'Souza, Nimesh Shah and Ekta Batra. And also, to make our Friday far more interesting and livelier, we have with us Mahesh Nadurkar, MD and Head of Research at Jefferies India. Guys, hi to all of you. Thank God it's Friday. And Mahesh, welcome to the show.
Thank you. It's good to be back here again.
So there are four of us.
Exactly like 4 months or so, I think. Yeah.
There are lots of corporate deals. There's earnings season. There is a tariff news. And there are 4 of us waiting to grill you. I'm just putting out the disclaimer at the start of the show.
I think he's used to it. I think first let's start off the show by just giving a complete recap of what went on during the week. As Surabhi mentioned, the markets end a little bit lower, 1% down, all frontline indices. The Nifty Bank, small cap, mid cap, all of them down 1%. You'll say, what a boring week, right? But there's plenty of action actually. And as Nimesh and me had discussed earlier as well, the BSE SME index was up 5.5%. So there are plenty of stocks that were in focus from the broader markets, telling you the sentiment is still pretty much okay. And from the global markets, the Bitcoin made a fresh all-time high. So that's telling you it's still risk-on, in spite of what President Trump is saying. He's going after Powell, tariffs, and lots of global headlines. But still, you have the Bitcoin moving up, which is sometimes an indicator of the risk-on sentiment. The VIX didn't spike up. At times, the Nifty ended low, but the VIX as well cooled off. And the VIX is still below that 12-odd mark, which is telling you that still there is no big fear in the market. So that's another data point. Well, capital market plays, they got hit harder this week. The defense plays as well. Remember, they rallied very, very hard in the initial part of 2025. For this week itself, both of them were down close to around 2%. While we had two stars this week. One was Glenmark Pharma, which Ekta is going to be telling us more about, that big global licensing deal. So stock-specific action continued. The stock, after rallying 18%, it put on another 15% on Friday. And in this week, it was up close to 20%. And HUL, everyone was saying, no returns for the last few years, no returns. And this week, you got 8% return on HUL. So the rejig at the top, the street is optimistic, maybe in fact running a little bit ahead of itself for some. But otherwise, many believe that the proven track record that Priya comes in with, maybe in fact she can turn things around. And finally, what are we looking at now? Trump's tariffs, Q2 earnings, as well as will there be any kind of positive commentary coming in from the Fed? Because some on the street globally are expecting maybe a surprise cut. Maybe that's a little far-fetched, but at least commentary is something that we'll be tracking. I think we continue to remain in this range, 25,000 on the downside, 25,750 on the upside. Well, Mahesh, I want to come to a question to you. When you were here 3 or 4 months ago, as you said, and we are all waiting to grill you, but at that point of time, sentiment was very, very somber. And you said if the time is there to buy, maybe it's now. And you sounded far more optimistic than most voices we heard. How are you feeling about the markets right now? Because we're not at 21,700, we're at 25,000 plus levels.
Yeah, thanks for remembering that previous one, because I'm quite glad that, I came here and discussed market view with all of you guys at that time, and thankfully that call has worked quite well.
Come often. Tell us the call.
Yeah, no, I think at this point in time, things are obviously not looking that rosy from the market outlook perspective, in the sense that, okay, it has done well already. And as you mentioned that, some of the indicators are showing a bit of a risk on, as you mentioned. But I guess if you take a view from a 6-month or a 12-month perspective, I would say it's very difficult to take a very bullish view at this point in time. One is that valuations, have moved up. In fact, we've been highlighting that if you exclude the banks and financials, the 1-year forward PE multiple is 26 times. And the earnings growth is about 12-13%. So that growth versus value equation is not